Welcome to our class in financial accounting and welcome to Module 1. This module is all about the financial statements, but before we can learn to prepare the financial statements, and we will do that in this video series, you've got to learn 6 terms, and this video is just to introduce those 6 terms. When I was a student, I learned that they call accounting the language of business, and I think that is a very apt description. Accounting, although there's lots of numbers, is not mathy as you might expect. Adding, subtracting, multiplying, dividing, that's the complicated math, and I could do that in grade 6. Accounting is about language, understanding how people talk about revenues, expenses, profits, these types of things, and we're going to need to understand these 6 terms if we want to have a chance to survive our accounting class. Assets, liabilities, shareholders' equity, revenues, expenses, and dividends. That's all this video is, and you're going to see it's like going to be more than 10 minutes, probably 15 minutes or something like that, just for these 6 terms because you need them rock solid if you hope to survive your introductory accounting class. And we'll get there together. I'm confident by the end of this video, you will be rock solid on those 6 terms and then ready to tackle the financial statements. So, when I begin a course, the first exercise we do, before we do anything, I get students to list assets of a typical student in my school, right? I just say, okay, list some assets of a typical student in the school. And they come up with a list. And this is very typical things that my students would list. They would say, oh, cars. They basically look around the room like, oh, everyone's got a cell phone. That's probably an asset. And textbooks. And, they come up with other stuff. And I think these are great examples of assets. Some of my more creative students add to the list more creative answers. They see things like youth and beauty and high school diplomas. And I'm here to tell you, I think these are assets and I think these are assets. However, when we prepare financial statements, these are well represented and these ones are not represented in company financial statements. But I think they're all assets because I think they all share one thing in common. And the word I want you to think of when you think of assets, I want you to think the word value. Assets are things of value. So returning to my list of course, cars, phones, textbook, these are valuable things. They're worth money for sure. Youth, beauty, high school diploma, absolutely things of value. But the reason these types of things don't find their way onto company financial statements is pretty simple. It's hard to measure the value. I can tell you how much my Mazda truck is worth. Not very much. It's an old Mazda truck, but I could tell you about what it's worth. Can I tell you what my youth is worth? I just celebrated my 47th birthday. Good Lord, it's crazy to be getting this old. But no, I can't tell you what that's worth. I'm healthy. What's my health worth? I have no idea. My beauty? Got to be worth a lot, right? Very handsome guy that I am. No, my beauty would not be worth very much, but you get the idea. It's really hard to put a number. Now, my cell phone, yeah, I could figure out about what it's worth. My beauty, that's a little tougher. So assets are things of value where the value can be reliably or reasonably measured. Now, typical company assets include cash. And of course, we would all like to have cash. Accounts receivable is something you will see in company financial statements. What an account receivable is when somebody owes you money. You've done the work, they haven't paid you yet. They're going to pay you tomorrow, next week, sometime in the future. To be owed money is an asset. It's something that provides you with value, a future benefit. Inventory. When I think of inventory, I think of Walmart. Walk around a Walmart, look inside any retail store, but I always think of Walmart because it's a big one, and just look everywhere. That's inventory. Anything company's bought from its supplier that's going to sell for a higher price, obviously it's valuable stuff to Walmart. One big category here is called PPE, and that breaks down into property, which is land, plant, which is buildings, and equipment, which is equipment. Property, plant, and equipment, land, buildings, and equipment. As obviously, those are things of value. And to give a bit of a textbook definition, I don't ask my students to memorize textbook definitions, but maybe your professor will. An asset is anything a company owns or controls, created from a past transaction that gives them a future economic benefit. That's a little convoluted, I think. I think it's the stuff of value. Anything a company owns that's good to own. Now, own is not necessary. We can have leased assets as well, but that's an intermediate accounting topic. We'll leave it for now. It's the stuff of value that the company has, right? That's pretty much all you need to know. So if my word for asset is value, the next category, liabilities, the word I want you to think of with liabilities is O-W-E. I just blew out my microphone. Hopefully I didn't blow out your eardrums. That's something you have to pay back in the future. And I can think of all kinds of things I owe. I have a phone bill that hasn't been paid. I owe the phone company that money. I have a mortgage. I owe the bank, the mortgage payments, right? Anything you can think of. Maybe you have a student loan. Maybe you have a car loan. These are all things you can owe. And just like you and I can get ourselves into debt, so too can companies. Liabilities are what the company has to pay back. So common examples of liabilities. For assets, we said accounts receivable. Well, liabilities has a counterpart called accounts payable. And an account payable is an unpaid bill. The phone bill is a perfect example, or a utilities bill, your heating or electricity bill, right? An unpaid bill is an account payable, and that's a very typical liability. Companies get bills just like you and I do. Companies also have employees to pay, and they have salaries and, benefits payable. I'll just call it salaries payable, but they also have unpaid, you didn't take your vacation for months and months and months. Well, they're building up that vacation that they owe you, or benefits that they owe you. So, right. So they have employee expenses that haven't been paid. So that's a very common type of liability for companies, unpaid employee benefits. What else could there be? Well, there's a big category called notes payable. And a note is just essentially a contract, right? So it's like I signed a piece of paper saying I promise to pay them back. So that's bank loans, mortgages, car loans would all sort of fit under notes payable. I'm just going to say bank loans, mortgages, but we could have car loans. We could have just loans between companies, etc. Like these debts, right? It's just debts, the traditional, we sign a piece of paper saying I promise to pay you back. That's a note payable, and there's all kinds of types of notes payable. So when I'm teaching this class, we get through assets. Everybody's like, yeah, got it. No problem. I know what assets are. No worries about me. And I talk about liabilities. No problem. Tears of joy streaming down my students' face because they're like, oh, I'm going to ace this class. And those tears of joy turn to tears of sadness when we introduce our third topic, shareholders' equity. It's the first one that I think most normal people don't have a concept of, just like when they walk into the class. It's the first one that's a little bit trickier. So let me explain shareholders' equity by talking about my house. I have a beautiful house. Let's take a look at that beautiful house. There it is. That's my house right there. And it's my house. It's an asset. It's something I own and control, and it's something of value. In fact, the value of my house is $300,000. I'm not trying to flex. That doesn't buy you much of a house in my hometown, but that's my house. I have a $300,000 house. Now, I led on, and I think you understood that I have a mortgage. And the size of the mortgage is how much I owe on the house, and I owe $200,000 on my mortgage right now. So I have a $300,000 house, that's my asset, against which I have a $200,000 mortgage. My home equity is a theoretical value because I'm not planning to sell the house. I'm happy here. Theoretically, though, a nice thought exercise I can do is, if I sold the house and if I paid off the mortgage, how much would go into my pocket? Right? And it's a theoretical value because, of course, I'm not selling the house. I don't know what the house would sell for. I'm guessing it's worth $300. How much is my equity in the house, though? My piece of the house is $100,000, and we call that the home equity. For a company, though, they can do the same exercise with their assets and liabilities. They call it shareholders' equity. And that creates this fundamental concept in accounting, this fundamental equation called the accounting equation. The accounting equation says assets equals liabilities plus shareholders' equity. When I think of the shareholders' equity, I think theoretically, if the company sold its assets, paid its debts, how much money would go back to the shareholder, and that is their equity. Okay. So when I think of assets, I think things of value, anything a company owns or controls that is good to own or control. Liabilities, those are the debts that have to be paid. Shareholders' equity, the theoretical value. If I sold my assets, paid off all my debts, how much would flow back to the shareholders? And it's a scoreboard, right? Because they're not going to sell all their assets. They're not going to pay all their debts. It's just a theoretically how much would flow through to them. And when I think of shareholders' equity, I don't think of one word. I think of the equation. A equals L plus SE, but I actually don't think of that. I think of it this way. SE equals A minus L. If I took all my assets, sold them off, paid off all my debts, how much would go to my shareholders? The two accounts here that I want you to be concerned with on day one of our accounting class, and we're in day one, maybe we're in day 0. The two accounts I want you to think about here are common shares and retained earnings. Remember what shareholders' equity is. It's the shareholders' piece of the company. It's the thing that measures the shareholders' piece of the pie. And so common shares are when the shareholder buys into the company, they get common shares to signify, hey, this is your piece of the pie. This is what you bought in for. And retained earnings is when the company's making lots of money. The money that the company makes, the profits the company makes, belongs to the shareholders. So we'll talk more about retained earnings in a second. But for now, just know, okay, key equity accounts are common shares, retained earnings. We'll introduce more. There's preferred shares. There's all kinds of other equity accounts. But on day one, these are the two that you need to know. Okay, let's get into our final 3. I'll go quicker with these 3. Revenues, expenses, and dividends. Then I'll return to that retained earnings account in a second. Revenues, the word I want you to think of with revenues is the word earn. Earn. It's the company doing whatever it is the company does to earn money. So if you're at a university right now, that university has tuition revenue. You got to pay your tuition. Walmart has sales revenue. Your landlord, if you pay rent to somebody, they have rent revenue, right? You're paying them rent. They have rent revenue. These are the company doing whatever it is the company does to earn money. Expenses are costs. Whoa, that was messy. Let's try that again. So when we think about costs of a company, think about a university. What are the costs of a university? Well, they got to pay to keep it heated or cooled in the summer, the heating and air conditioning. It's a utilities cost. University would have a utilities expense. If you walk through the hallways and it's clean, well, surely there's a maintenance expense. If something breaks, it's repaired. There's a repair expense. I work for the university. I don't do it for free, right? I love my job, but I don't do it for free. The university has a salary expense. They have to pay me to show up, and that's the case at any university. And we could list dozens and dozens of other costs of operating a university. These are the expenses. And there's a scoreboard here. We're keeping track of our earnings, our revenues. We keep track of our expenses, and revenues are sort of a positive thing. Expenses are a negative thing. They're costs. And at the end of the day, we say, do I have more revenues than I have expenses? If so, we call it the net income. This is also called the profit, right? Did the company make any money? Did the revenues exceed expenses? And if so, by how much? So, these are some of the key concepts. Now, at the end of the year, let's just say the company makes lots and lots of money. They have tons of net income. Shareholders, if let's just say you're the only owner of the company, you're the sole shareholder, you have a choice. You can leave that extra profit in the company, leave that typically extra money in the company, or you can take it out yourself. If you take the money out of the company and just use it in your own life because your company was profitable and you were fortunate enough to be the owner of a profitable company, you would take what's called a dividend. And that's just pulling your profits out of the company to use it in your own life. If you decide, no, I would like to leave the money in the company, that extra money the company made, the excess of revenues over expenses, I want to leave that in the company, maybe buy some new assets or hire a new person, whatever, right? I've got extra money, I'm going to use it for the business. If you do that, we keep track of it in an account called retained earnings. Retained means keep. Earnings means profit. So at the end of the year, we have this net income number, and we can either take it out of the company, take a dividend, or put it into retained earnings and keep track of it there, that excess money that we had made. Okay, we've done it. It's 16, almost 17 minutes. Those are the 6 terms. Let's just recap. Assets, things of value, anything a company owns or controls that provides them with value. Anything they own or control that is good to own or control. Liabilities, that's what's owed. That's what has to be paid back. Shareholders' equity, if I theoretically sold off all my assets, paid off all my bills, how much would flow through to my shareholders? That's their equity, assets minus liabilities. Revenues of the company doing whatever it is the company does to earn money. Expenses are the costs of operating the business, and dividends are when the shareholders take profits out of the business. And those 6 terms are all you need to go on and learn how to prepare financial statements. I'm going to link right up here the next video in this series. Please keep going with the series. I'm so glad you're here. Thank you so much for watching this video, and I'll see you in the next one. Bye for now. Let's examine problem 11A. All of my problems you can download from tonybell.com. It's a free PDF link. There's no sign in, no sign up. You just click and the PDF will pop right up for you. You'll see it linked below this video as well. This one has us looking at the accounting equation. And if you don't know anything about the accounting equation, I really advise you to watch the first video in this series. This is the second video in this series, so you've joined at number 2, but hopefully you saw that first video, and hopefully you'll remember the accounting equation says assets equals liabilities plus shareholders' equity. And I mentioned this is a way to think of equity, right? I have a $300,000 house against which I have a $200,000 mortgage. Therefore, my home equity is $100,000. If I sold my house, which is an asset, paid the mortgage, which is a debt, a liability, how much money would I get? I'd get my equity, $100,000. Okay, so let's look at business 1 now. Again, we're just using that formula, assets equals liabilities plus equity. So we don't know the assets, but if we know the liabilities and equity, we just add them, right? 150 plus 100. Business 1's assets have got to be $250,000. Let's do business 2. Business 2, the assets are 80. The liabilities we don't know, but we know the equity is 32. So something plus 32 equals 80. The math would be you go 80 minus 32. The answer here is 48,000. And I always double check. I always go, when I do ones like this, I go, well, let's pretend I didn't know the assets. I go, what's 48 plus 32? It is 80, right? That the math worked. We do the same thing with business 3. Assets equals liabilities plus shareholders' equity. I know the assets are 50. If the liabilities are 21, the equity has got to be 50 minus 21. It's got to be 29,000. And just double checking, 21 plus 29. Yes, indeed, it is 50. So things are balancing, right? This is what makes a balance sheet balance. So it's working. Business 4 is a little tricky for an intro class, but it's important to understand the concept of negative equity. And I'll give you an example of negative home equity. In the great financial crisis, so again, A equals L plus SE, people bought houses that they thought, and the mortgage company thought was worth say 500K, I'm making numbers up here, 500K, and they gave them a $450,000 mortgage, meaning the person had to put down 50 grand, say, and their equity was $50,000 in the house. And in 2008, property values plummeted. Really went down. So let's say the property value went from 500 to 300 over the course of like 6 months, which is just insane, right? And that type of thing was happening. Property values plummeted. Well, the mortgage doesn't plummet at the same time. The mortgage just stays the same, or maybe you're making some small payments on it, but let's just say the mortgage here stayed the same. Well, what does that mean? Well, again, if you take the assets, sell them off, you pay off the debts, how much money goes to you, the shareholder? 50 grand. Well, in this case, if I sold my assets and I paid off my bill, I still owe 150 grand, right? I've got $150,000 negative equity. What an economic catastrophe. And it's bad for companies too. This is not just a home equity example. It can happen for companies when they're in a negative equity situation. They're in big trouble. And this company, business number 4, is in big trouble. Why? Because the liabilities are greater than the assets. The value of what you owe is greater than the value of what you own. You're in trouble. So in this case, the liabilities have got to be $10,000 more than the assets. Assets equals liabilities plus shareholders' equity. Well, $95,000 plus negative 10 is 85, so it works, but we have more debts than we have assets. A bad place to be. But a very good place to be is right here with me in these videos. I hope they're helping, and I'll see you in the next one. Stay tuned. Bye for now. Let's examine problem 12A. You can download this problem and all my problems from tonybell.com. It's a free PDF link. There's no sign in, no sign up. You just click a link and you'll have the PDF yourself. This problem has us examining assets, liabilities, shareholders' equity, revenue, expenses, and dividends. And the idea here is we're getting ready to prepare financial statements, but we have to understand the accounts first. So just quickly, high level, remembering what we learned in the very first video. Assets are the stuff the company owns or controls that has value. Things that give them a benefit, right? The owners have a benefit to own. That is an asset. Things of value. Liabilities, that's what the company owes. That's what they have to pay back. Shareholders' equity is a scoreboard number. It's a theoretical number. If I sold my assets, if I paid my debts, how much money would the shareholders have left over for them, right? That is their equity in the company. Revenues are the company doing whatever the company does to earn money. Expenses are costs of doing business, and dividends are where if the company is profitable, the shareholders can pull money out of the company, and if they want to pull their money out of the company, they might take a dividend. It's a way of taking money out of the company and just using it for the shareholders' own purposes. Okay, so those are our big categories. It also notes if you have identified an item as an asset or liability, so we're going to be identifying each item as an asset, liability, shareholders' equity, revenue, expense, or dividend. If we know it's an asset or liability, further, we want to say if it's current or long-term. The distinguishing feature between current and long-term is typically 1 year. So I'll think of a couple of liabilities. One is a phone bill. Okay, phone bill is definitely a liability. Is it going to be with me for more than a year? No, I pay my phone bill every month. That's less than a year. It would be a current liability. Well, what about my mortgage? I've got a 30-year mortgage. It's going to be with me for 30 years. Oh, no. That mortgage is a long-term liability. So you can see the distinguishing line is current or long-term, and it should be pretty clear. And if it's not clear, I will make it clear in our conversation, whether something's current or long-term. But let's go into it. The first one, long-term investment. So is it asset, liability, shareholders' equity, revenue, expense, or dividend? Which of those is it? It's an asset. A long-term investment is something you can own or control that has value for you, so it's an asset. Is it current or long-term? It's long-term, right? That says it in the name. Accounts receivable. Now, the word receivable is a dead giveaway. This is an asset. An account receivable is when you do work for somebody, they don't pay you right away. They're going to pay you typically 30 days. This is current. We're going to get our money in less than a year in almost all circumstances. Consulting revenue. It's got the word revenue. Let's call it what it is. It's a revenue. Now, for assets and liability, we want to denote if it's current or long-term. Everything else, we don't denote current or long-term. Computers. Computers are assets, and yeah, they don't last forever, but they last more than a year. You would think if you bought a computer, it would be long term. Mortgage payable, there's that word payable. It's a liability, and I just talked about my mortgage. These are 10 years, 20 years, 30 years. These are long term. Cash is an asset, and cash is thought of as the most current of current assets. Occasionally I'll have a student that says, well, I had cash last year, I have cash this year, isn't it long term? I'm going to have cash next year too. And the answer is no, because that cash is cycling through, right? It's always moving, it's always changing. Retained earnings is one of our two key shareholders' equity accounts that at this point, I think students just need to remember. Retained earnings, and do we have common shares here? Yeah, common shares. Those are equity accounts, and it's just worth remembering them as such, right? In my class, you're only going to have two. There might be some other classes that have paid in capital. That's another common or capital stock or something like this, common stock instead of shares. But it's the same idea. These are all equity accounts. Okay, next, temporary investments. Well, investments are assets. They're things we own and control. They're things of value. Think of just buying Microsoft shares. You're planning to sell them in a few weeks. It's an asset. Now, it's current, and the word temporary is what leads you to think it's current. Accounts payable, this is your phone bill. This is a unpaid liability. Again, the word payable is the giveaway there. And is it current or long term? Well, my phone bill, my utilities bill, these types of unpaid bills, I'm going to pay them off in a month, not a year. This is current. Income tax expense is an expense. I'm going to put a little star beside it just because it's a special expense. When we get to our financial statements, we're going to separate out the income tax expense. Car is an asset, and it's long term, right? You will own a car for many years, and it's a long-term asset. Utilities expense, that's an expense. Got the word expense in it. Land is an asset, and it is a very long-term asset. We think of land as the longest of long-term assets. When you buy an asset, you have to estimate the life. Car maybe 10 years, a computer maybe 5 years. Land is deemed to have an infinite life. It lasts forever, according to accounting standard setters. Dividends are, well, they're their own category. These are dividends. Inventory, it's an asset, and it's a current asset. And what denotes that it's current is the company thinks they're going to sell it in less than a year. So it doesn't matter, like let's say you're a Toyota dealership, you sell Toyota cars. Well, all the cars you're selling are long-term assets, right? Your inventory is long-term assets, but for you, it's current. Your customer will have it for 5-10 years. You're hoping to only have it for a few months sitting on the lot unsold. So it's a current asset, even though the actual object will be long-term when the customer buys it. Buildings, that's a long-term asset. Buildings last 20 to 40 years typically. Interest expense, this is another expense that I want to put a little star beside. And when we get to our financial statements, we separate out income tax and interest. They're called non-operating expenses. So this is just setting the table for later in the course. But just know interest and income tax, we're going to kind of treat them a little differently from the rest of our expenses. Bank loan payable, this is a liability. Now, it could be current. Usually, though, these are long-term. Unclear here, but usually a bank loan is going to be more than a year, usually. Common shares, we said, is shareholders' equity, again, called common stock, capital stock, and it's related to something called paid-in capital. If you see that, that is a shareholders' equity account as well. Rent revenue, it's got the word revenue in it. It's a revenue. Salaries payable, it's a liability. Unpaid salaries, you better be paying them in the next week or two, right? You can't go months and months or years without paying them. It's current. Salaries expense, that's an expense. It's a cost of doing business. Supplies expense is an expense. And you can see the last one, supplies. Well, supplies are assets. Now let's talk about this. And supplies are current assets. They last less than a year. This, I do this intentionally. I put supplies expense and supplies at the bottom because, like, wait a second, are we not talking about the same thing? Supplies and supplies expense. It can be confusing when you're a beginning student. You'll see things like this and you'll be like, what, are we talking about the same thing here? And the answer is no. This is actually quite different, these accounts. Even though they're totally related to each other, they are capturing different information. So I've got a little example here to explain supplies expense versus supplies. It's December 15th. Our company's supply closet was empty. So we have $0 of supplies, right? Our supplies are all gone. We buy $2,000 worth of supplies. These are assets. We buy, let's just pretend it's office supplies, pens and paper and pencils, things like this. So now I have $2,000 of office supplies. I have a $2,000 asset. 2 weeks go by, so I'm imagining a college campus, and we call the professors, we go, professors, there's more supplies, and the professors circle like vultures, and they pick away at all the supplies, post-it notes and whiteboard markers and these types of things. And on December 31st, we count the supplies. We had 2,000. We only have $500 worth of supplies left. And now we're getting ready to do a financial report on December 31st. So what I'm going to tell my shareholders, I list my assets, and I'm going to say, oh, shareholders, my supplies, I have $500 worth of supplies. Like I'm telling them my assets, I have $500 worth of supplies. Well, what do you suppose related to this situation, my supplies expenses? The supplies expenses, how many supplies I've used up during a period. And here, between December 15th and December 31st, we used up $1,500 worth of supplies. So these are absolutely related concepts, but it's important to know supplies expense is the amount of supplies you've used up during a given period. Supplies is the amount of physical assets you have on hand at a given time. They're related to each other, but they're not the same thing. And you'll see this with expenses and assets and expenses and liabilities. You'll see there's a relationship there, but they're not the same thing. So I wanted to introduce that one in this video. As always, I make these videos hoping that they're helpful to you. If they're helpful to you, I hope you'll hit me with a thumbs up, and I hope you'll watch the next one. See you later. Thanks for watching. Goodbye. Let's take a look at problem 1.3a. We are finally here. Our first full set of financial statements. This problem asks us to prepare an income statement, which we're going to do in this video. In the next part of the video, we'll do a statement of retained earnings and then a balance sheet. So 3 new financial statements to be explored. I just want to remind you what happens on these big 3 financial statements. In fact, there's a big 4, but we're only looking at 3 here. The first one, the income statement, we've discussed this before, but it's worth reiterating, is the summary of a company's revenues. Revenues are the company doing whatever it does to earn money. So the revenues minus its costs, its expenses. And if the revenues exceed the costs, we say the company made a profit. It was profitable, but we don't use the word profit. I'm going to use the abbreviation NI. Can you guess what NI stands for? Net income. So net income happens when the company makes money. And so the income statement tells us, did the company make any money? And if so, how much did it make, right? How profitable was it? You'll sometimes hear the income statement referred to as the P&L or the profit and loss statement. We're going to call it the income statement. Revenues minus expenses equals net income. And we'll summarize that shortly. That'll be in this video. In the next part of the video, we'll introduce, this will be the shortest of the 3 videos, the statement of retained earnings. This tells us how the company's retained earnings changed during a period. We start with our beginning retained earnings. We look at how it changed, and then we calculate the ending retained earnings. Now, how might retained earnings change? Well, it generally is going to go up by the amount of the net income from the income statement, and it's going to go down if the company paid out any dividends. So remember what retained earnings means. Retained earnings is an account that keeps track of the profits that we've kept in the company. So if I had retained earnings and I made a profit, net income, my shareholders might opt to pay themselves a dividend. If they pay themselves a dividend, that reduces the amount of profits I've kept in the company. Remember, retained, keep, earnings, profits. So the shareholders have a choice when they make a profit. They can take the money out, take a dividend, or put that profit, put that net income into retained earnings. And this statement summarizes that. The third statement we're going to look at is the balance sheet. And the balance sheet captures the accounting equation. A equals L plus SE, assets equals liabilities plus shareholders' equity. And so we'll do the balance sheet, and you'll see it's not too difficult to calculate, although formatting it can be tricky. But the usefulness of the balance sheet is, does this company have enough assets to pay the bills? What kind of financial position is the company in? Are they going to be in trouble? Are they going to run out of money next year? I would learn that by looking at the balance sheet. Now, there is a fourth financial statement. Some textbooks introduce this in chapter 1. I don't do it until chapter 11. I think most textbooks really dive in later in the course. It's called the statement of cash flows, and it says, how did my cash balance change during the year? And it's the most complicated of the four, so I save it for later in the course. The big picture way it works is you start with your beginning cash balance. You say, how did my cash change? And you calculate your ending cash balance. Now, this is a gross oversimplification. You'll learn about operating, investing, and financing cash flows, and calculating those amounts can be tricky when you're a rookie. So we're going to leave that fourth statement. It's a very important statement. People in finance really want to know about cash balances and cash flows of a company. So it's a very useful statement, but we're going to save it for later in our course because it is the most complicated to prepare. So in this video, we're going to do the income statement, but in this series of videos, we'll do the income statement, the statement of retained earnings, and the balance sheet. So let's jump in and prepare our income statement. Well, let's read the problem. So again, download the problem from myname.com, tonybell.com, but let's read the problem and see what we're up against. 1.3a. Sherry's Shuttles is a bus company offering rides to outdoor adventurers. In the summer, she caters to mountain bikers, and in winter to skiers. Sherry's company has the following account balances, all on December 31st, 2029, and for the year then ended, unless otherwise noted, and there's a big long list of accounts. It says, make me an income statement. That's what we're going to do in this part of the video. I got the wrong pen here. We'll do an income statement in this part of the video. In part 2, a statement of retained earnings, and in part 3 we'll do parts C and D here, the balance sheet and the ratios. So that's the game plan here. But before I can prepare the financial statements, and we will do it in this video, we need to identify our accounts. This is a lot like problem 1.2 of the workbook. If you haven't done that, I highly recommend the problem. I think there's a free 1.2a video. I think you should watch that. But we're going to flex that same muscle. So we're going to go through each account and we're going to identify, is this an asset, a liability, shareholders equity account, revenue, expense, or dividend? Asset, liability, shareholders equity, revenue, expense, or dividend. We'll identify each account because that way we know where to put it. Does it go on the income statement or the balance sheet, or where does it go? So let's start with buildings. What is a building? Well, I hope you're shouting at your screen, a building's an asset. Now, if it's an asset or liability, let's go a step further like we did in problem 1.2. Is it current or long-term? And the answer is a building. It's going to last 30 years. It's a long-term asset, right? A year is sort of our cutoff between current and long-term. It is a long-term asset. What about wages expense? Well, I hope, again, you're shouting at your computer, it says expense, for goodness sakes. It's an expense. Yes, it's an expense. No tricks there. Shuttle revenue? Well, I would suggest that is a revenue account. Bank loan payable? Payable is a real signifier of a liability, and this is a liability. The question is it current or long-term? Generally speaking, we can assume bank loans are long-term unless it tells us otherwise. Now, it is very possible to have a short-term bank loan, like 6 months, 7 months, or whatever. But unless it tells me otherwise, I'm going to assume a bank loan is long-term. Accounts receivable, that, again, the word payable tells me liability. The word receivable signals to me it's an asset, and it's a current asset. So when we've done some work for a client, they haven't paid us yet, we're not going to wait a year for payment. So because it's less than a year, it's current. Office supplies, another current asset. Here I want you thinking of papers, pens, paper clips, whiteboard markers for professors. This is current. They're assets. They're stuff you can own and control that are good to own and control, but they will last less than a year. Utilities expense, that's an expense. Repairs expense, got the word expense in it. Wages payable, there's that word payable. What do I think? When I think payable, I think liabilities, and so too should you. A wage payable, my employees aren't going to wait a year for me to pay their wages. This is current. Moving over to fuel expense. Well, it's got the word expense. It's an expense. Dividends are dividends. They are their own category. So call dividends dividends. What about equipment? Equipment is an asset, and it's a long-term asset. If you're wondering about the word net, we'll talk about that in problem 1-4. For now, just kind of go with it. Okay, it's a long-term asset. Common shares, that's one of two shareholders' equity accounts we're introducing here in Chapter 1. Common shares, its counterpart, retained earnings. Those are the two that we're interested in here. This is a shareholders' equity account. Accounts payable, it's got the word payable, and think of it as your unpaid phone bill. It's a current liability. I'll pay it in 30 days. Insurance expense, that's an expense. Depreciation expense, also an expense. Cash, the most current of current assets. And last but not least, retained earnings, that is my other shareholders equity account. Okay, so I know it's like we're 9 minutes in here, but let's continue. We've set the table now. This is all table setting. Maybe I'll put a little timestamp at the start of the video to tell people jump ahead if they don't want to sit through that, but it's time now to prepare the income statement. We have sufficiently set the table. I think it was important table setting. I hope you'll agree. So what is on an income statement? Well, we just said it's the summary of revenues and expenses. So I want to hone in on my revenues and my expenses. Just highlighting them. And I could ignore everything else. So it sort of helps me narrow things down to identify, well, what are my revenues and expenses? Because that's all I'm going to need for the income statement. When we're asked to prepare any financial statement, including this one, we need a 3-line title, 3 lines. The first line is the name of the company. So the first line is going to be Sherry's Shuttles. The second line is the name of the financial statement we're asked to prepare. We are asked to prepare an income statement. You know, I'd like my pen to be just a touch bigger here. Let's switch this for 1 notch thicker. There we go. Yeah, I like that better. Let me switch this one. There we go. And so name of the company, name of the financial statement. The third line down is the date. And so this is a December 31st, 2029 income statement. For income statement and statement of retained earnings, we have to actually give a time period. So I'll show you what to do and then I'll explain why. This is for the year ended and then the date. For the year ended, and the date is December 31st, 2029. Now, why do I have to say for the year ended? And the answer has to do with what's on the income statement. It's telling me how much money I made. Well, companies can report how much money they made for a month. They can report how much money they made for a quarter, which is 3 months, or as we're doing here, how much money they made for a year. But as a shareholder, you kind of need to know, am I looking at a monthly statement or a yearly one? Big difference, right? If you tell me you made $10,000 last month, I'll go, wow, you're making tons of money. If you say you made $10,000 last year, well, that's not that much money. Certainly in Canada, you can't afford rent. If you made $10,000 last month, you can afford rent. So big difference. And the same is true for a company, right? If they give me an income statement for a month, my interpretation is very different than for a year. So we have to give a time period with an income statement, and we did. How did I know it was for a year? The question said, prepare an income statement for the year, right? That's how. So okay, so an income statement is the summary of revenues and expenses, and we're going to determine if revenues minus expenses equals net income. We'll determine how much money, if any, did we make. So we're going to start with revenue. So I'll do a big heading here. Revenues. And under revenues, I'm going to say shuttle revenue. And I'll just rev for short. And my shuttle revenue is $140,000. Now we're going to list our expenses. And the expenses are all the items I've highlighted in blue. Now, if you go on and do problem 1-4, you'll see it gets a little more complicated. We can have different classifications of expenses, operating and non-operating and taxes, and it'll get more complicated, but all these expenses just lump into the category of expense. So I'm just going to do them in the order I see them, starting with wages expense of $35,000. Now, you're going to notice format choices I make. If I have a big long list of numbers, I list them on the left and I total to the right. Follow your professor's format conventions, but this is the way I'm going to encourage you to do it. So wages expense, next is utilities expense, $14,000. Next up is repairs expense, $13,000. And next up is fuel, $10,000. Next is insurance, $12,000. And last up is depreciation, $21,000. Okay, so we've listed our expenses. We're going to need our total expenses, which I do not know the number. I need a calculator here. Let's see. There is my calculator. 35 plus 14 plus 13 plus 10 plus 12 plus 21. $105,000 is my total expenses. So revenues minus expenses equals net income. Did I make any money? Well, I can see I made some money, right? How do I know I made some money? Well, 140 is my revenue, 105 is my expenses. I made a profit. I made net income of 140 minus 105. What is that? $35,000. Hooray! We're almost done. Now, is $35,000 good or bad? I couldn't tell you. If last year I made $2,000, I'd say, well, 35, that's really good. If last year I made $150,000, I go, oh, 35, eesh, that's pretty bad. The truth is we don't know. When we look at income statements, we typically look at year over year or month over month performance to see how we're doing compared to last time, or maybe look at a competitors and see how we're doing compared to our competition. A couple of formatting things. The bottom line number, in this case, net income, the bottom line of any financial statement gets 2 underlines. And here's some place where I make a choice formatting wise, and your professor may be different from me, so be careful here, but you got to put dollar signs. I put a dollar sign beside the top number of each column. So I have 2 columns here, right? I've got my revenues and then my expenses. Because there was more than one expense, I put the list on the left, total on the right. So dollar sign at the top of each column and dollar sign beside anything with a double underline. So at this moment, I think I have a beautiful, spectacular income statement. Summary of revenues minus expenses equals net income, and I think we've done a wonderful job. In the next part of the video, we'll prepare a statement of retained earnings. So stay tuned for that one. Hit the thumbs up on your way out of here and onto the statement of retained earnings. See you in that video. Welcome back. We have been working on problem 1.3a, Sherry's Shuttles, and we've just prepared our first financial statement of the whole course. We've prepared an income statement for Sherry's Shuttles, summarizing the revenues and expenses, and we learned that Sherry's Shuttles had a profit of $35,000 for the year. In this video, we're going to learn to prepare a statement of retained earnings. That's our second financial statement. And it starts just like the income statement with a 3-line title. You're going to get used to these 3-line titles. So let's do it. Name of the company: Sherry's Shuttles. Name of the statement. This is a statement of retained earnings. And it gets dated the same way for a time period. So this is for the year ended December 31st, 2029. Now, a lot of companies have fiscal years that don't end on December 31st. Very normal to have a year ended, May 31st or something like this. So don't think that every company has to be December 31st, and you'll see that in future questions. Okay, so what is the statement of retained earnings? Well, we said we're going to do 3 financial statements here. We're not doing the statement of cash flows. Income statement summarizes revenues minus expenses equals net income equals the profit. Statement of retained earnings just says, how did retained earnings change? So we start with our beginning retained earnings. We're going to add net income, deduct dividends, and we'll get our ending retained earnings. So this is short and sweet as far as the statements go. We want to give our beginning retained earnings. So you write retained earnings, no special heading here, retained earnings, and then you give a date, and you give the date at the start of the year. So if the year ends on December 31st, what day did the year start on? January 1st was the start of this year. It gets trickier when it's like May 31st is our year end. What was the first day of that year? Well, it was actually June 1st. The year before was the first day of the year ended May 31st. Anyway, December 31st, the trick is you add a day and then you take off a year. So December 31st plus a day is January 1st, 2030. Take off a year, January 1st, 2029. So our retained earnings on January 1st, 2029 was... And what is my retained earnings on January 1st, 2029? Well, let's erase this stuff that I've highlighted and look at this right here, retained earnings. And look at that, January 1st, 2029. I wrote the question. I knew we were going to need the January 1st, 2029 retained earnings. You'll notice all the other numbers don't say that, right? Just this one is sort of a special one, and it's $80,000. Okay, so my retained earnings January 1st, 2029 was $80,000. We're going to add, and I do write the word add, net income. If this was a net loss, in other words, if we lost money, net income was a negative number, right? Revenues minus expenses was negative, we would deduct the net loss. But here we're going to add the net income, and I can see it from the income statement. This $35,000, it doesn't come from the question, right? There's no $35,000. Well, there's wages expenses $35,000, but there's no net income $35,000 in the question. So it comes from our statement, our income statement. So retained earnings 80 plus net income 35 gives us a subtotal. And I do label this as subtotal. I've seen some textbooks label it subtotal. Some textbooks don't label it at all. They just leave it blank here. But 80 plus 35 is $115,000. So if the company didn't pay any dividends, right, they would go, well, we made $80,000. We had $80,000 in retained earnings before. We made $35,000 in profit this year. So if I don't pay any dividends, I'm going to have $115,000 in retained earnings. But I did pay dividends. How big were my dividends? Well, right there, $5,000 under dividends. So I take away the dividends. That's the shareholders taking money out of the company. So I deduct dividends. And my dividends were $5,000. Now this one goes in brackets. We deduct dividends minus $5,000 and we get our ending retained earnings. Here we write retained earnings and a date. Now what is the end of year date? Well, it's the date of the statement for the year ended. So the end of the year is December 31st, 2029. 115 minus 5 is $110,000. Now, like we did with the income statement, we put dollar signs. We put dollar signs at the top of each column. In this case, there's only one column, so the top of the column, and a dollar sign beside anything double underlined. So our statement of retained earnings gets two dollar signs, one at the top, one at the bottom. And there we have it, a beautiful statement of retained earnings. What does the statement of retained earnings tell us? It tells us how did retained earnings change? And if I was a shareholder, I'd be particularly interested in the dividends. It's the only place where you see dividends, right? There's no dividends on the income statement. There's no dividends presented on the balance sheet, at least the way I present it. So this is the place you would find the dividend. And if you're a shareholder, you want to know if you're getting dividends. That's you getting paid. So you'd be very curious about that. Okay, we've made it to the end of our statement of retained earnings. One more statement left to do, but it's a big one. The balance sheet will be in our next video. Thanks so much for watching, and I'll see you in the final part, the balance sheet. Bye-bye. Welcome back. We have been working through problem 13A from my workbook. You can download from tonybell.com. Just click the link below. We have prepared an income statement. We've prepared a statement of retained earnings, and now we're going to prepare a balance sheet, and we're going to do these ratios. But let's just remind ourselves the big picture here. An income statement summarizes revenues and expenses, tells us if we made any money, did we make profit, and this company made $35,000 in profit. Statement of retained earnings says how did retained earnings change during the year, and did the company pay any dividends? If so, how much? The final statement we're going to learn, now we're not going to do a statement of cash flow in this video, that's for chapter 11, but we're going to learn the balance sheet. Summary of assets, liabilities, and shareholders' equity. And when I get my students prepare a balance sheet for the first time, I encourage them to turn their paper sideways, like portrait versus landscape. I think it's called landscape. You want to have a wide statement, at least the way I format the balance sheet. So if you're following along with me, I'd advise you turn your paper sideways, and let's start with a 3-line title. Name of our company, Sherry's Shuttles. Name of our financial statement. We are asked to prepare a balance sheet. And then the date. And a balance sheet's interesting because you don't date it for the year end, for the month end. It's not for a time period. It is a specific date. And the date here is December 31st, 2029. The reason we don't date the balance sheet as for the year ended, for the month ended, is because of the information on the balance sheet. If you think of the income statement, we're asking how much money did you make? Well, if I ask how much money did you make last month, that's different from how much money did you make last year. If you made $10,000 last month, that's a lot of money. $10,000 last year, that's not a lot of money. Now, the balance sheet is sort of what stuff do you have? So if I said, hey, what is your mortgage balance, right? Like how much do you owe on your house? And I owe $200,000. Well, it doesn't make sense. How much do you owe for the year? Well, at the start of the year, I owed $220,000 and then I paid it down and now it's $200,000. It's just like on December 31st, what did you owe? That's the question the balance sheet asks. So it's a specific moment in time. How much cash did you have on December 31st? What did you owe on December 31st? That's what the balance sheet answers, and that's why it's simply dated. So just reminding you, and we kind of just did, the balance sheet is a summary of assets, liabilities, and shareholders' equity. So as we go back to the question, when we identified all our accounts, we're going to be interested in assets, liabilities, and shareholders' equity, starting with the assets, and actually starting with the current assets. So we got current assets of accounts receivable, office supplies, cash. Do we have anything else? Don't see anything else. In terms of our long-term assets, we got buildings and we got equipment. Just seeing, are there any other assets? No. So we're going to list all of our assets, total it, list our liabilities and equity, total that, and hopefully when we're done, assets equals liabilities plus equity. That's what makes a balance sheet balance. We will find out. I'm nervous. I hope it works. So let's start with our current assets. Now, the order of the balance sheet is from the most current to the most long-term. Like I said, it's kind of a wide statement. So I'm going to do assets over here. I'll do liabilities over here. And somewhere down here, I'm not really sure where, I'm going to do shareholders' equity. Somewhere down there, but I'm not sure where yet because don't know how long my liability section is going to go. So we'll start with the assets, and we'll start specifically with our current assets. And we want to list them from the most current to the most long-term. So I have 3 current assets. I've got accounts receivable, I got office supplies, and I got cash. And the idea is it's order of liquidity, they call it, the most liquid asset. And liquid means cash-like. And so cash is the most cash-like. Cash will always come first on these things. So cash of $25,000 comes first. Receivables will come, generally speaking, second. So cash, then AR, because AR is going to turn into cash in 30 days. And office supplies are not a terribly liquid asset, so they're going to come third. 25, 12, and 3. Cash, AR, office supplies. Current assets. Cash. Then accounts receivable. Then office Supplies, I've already forgotten the numbers. Shame on me. 25, 12, and 3. 25, 12, and 3. 25,000, 12,000, and 3,000. Adding them up, that adds to 40,000 as my total current assets. Now, what about my long-term assets? I'll categorize these as long-term assets. You will often see this category called PPE, property, plant, and equipment. That's a great name for the category as well. For whatever reason, I like to call them long-term assets. And we have two. And again, we want to say the most short-term to the most long-term. So buildings or equipment, which one is shorter term, which one is longer term? Well, buildings last 20 to 40 years. Equipment tends to last 5 to 10 years. Equipment is shorter term. Buildings are longer term. So we'll do equipment first. So equipment, then buildings. Equipment net 50,000 and buildings net, and that was 100,000. So totaling it up, we're at 150 for our total long-term assets. And we can in fact do total assets now, because that's all the assets, right? We've touched everything that we highlighted. 40 plus 150, that's 190,000. That's a grand total. So at this point, we've only done half the statement, right? We've done the asset side. We got to do liabilities and equity next. I actually treat this as a moment to do some formatting. So this total assets is a bottom line number. It's a key number. It gets double underlined, and I can do dollar signs. And remember my rule of thumb around dollar signs. Top of each column. So this is one. This is another. So and you wouldn't have to do this in greening. I'm doing it in greening, make it stand out for you. But same color ink, I'm just making it stand out. So top of each column and one beside anything double underlined. And that's it for my dollar signs. Sometimes the students have a desire to put one here. I don't put one there. So I would just have $3 signs on the asset side. Okay, so the asset side is done. Let's move over to liabilities. Again, back to the question, we'll highlight our liabilities. This is what we need to be worried about now. Where are we? We got accounts payable. We've got wages payable. We've got a bank loan payable. And that looks like it. And in fact, the bank loan's long-term. I'll highlight it a different color. So now we got to pick which of the two of these is the most current, right? So obviously bank loan will come later in the long-term liabilities, but in our current liabilities section, we've got wages or accounts payable. In my classes, I teach it. I have my students do accounts payable first. I've seen it done both ways. I've seen wages payable at the top of the list. I've seen accounts payable at the top of the list. I'll just say, I'll be consistent here. Accounts payable is going to be first. Wages payable is going to be second every time. And then there'll be other liabilities that we add to this as we, this is basic as we move into more involved financial statements. But accounts payable first, wages payable second in my class. So accounts payable. Let's do it. Current liabilities. Accounts payable and wages payable. I do allow my students to use acronyms, abbreviations like APAR. Be careful though, your professor may not. Financial statements are things where formatting matters. So if your professor doesn't want you to do that, be careful, right? Accounts payable 17,000, wages payable 3,000. $17 and 3 is 20. And that is our total current liabilities. On to long-term liabilities. And we just had the one, I can remember it. It was the bank loan payable. I don't remember for how much, but I do remember it was a bank loan payable. Now, because I just have one item in the category, I write the number in the total column, sort of like with sales way back here, or sales with revenues. I only had one revenue, so I wrote it as total revenue. Remember, list on the left, total on the right. If I had two different revenue streams, I would list them and then total. If I had two different long-term liabilities, list and then total. List on the left, total on the right. Because I only have one $30,000 bank loan, I'm going to write the number on the right-hand side here, $30,000. 20 plus 30 is 50. That is my total liabilities. On to the final section here, and the final section is shareholders' equity. Under shareholders' equity, just two accounts will be common here for us, common shares. You'll also hear this called share capital, capital stock, common stock, all sorts of lingo for the same thing. And paid in capital will be a part of common shares. We treat it as one item, common shares, but you'll see paid in capital in this section as well in a lot of intro textbooks. Okay, so anyway, common shares, and the other one that certainly will be consistent between the textbooks will be retained earnings. They'll all have retained earnings and they'll all call it the same thing. Common shares. What were our common shares? I know I've seen them. Maybe I can highlight that. Well, I'll just circle it when I see it. There it is, $30,000 of common shares. 30,000. And retained earnings. Now, you'll notice retained earnings is $80,000, but that's January 1st retained earnings. We need December 31st retained earnings, and that number comes from not the question, but from the statement of retained earnings that we prepared in the last part here. The retained earnings is $110,000 on December 31st, 2029. That's the number we use, $110,000. 30 plus 110 is $140,000, and that is my total shareholders' equity. So now we need a grand total, because we've said at the start of this, A equals L plus SE, assets equals liabilities plus shareholders' equity. We need a grand total, total liabilities and shareholders' equity. And what is it? 50 plus 140, it is 190. And right now, at this moment, the birds are singing. The sun is shining. I am very, very happy ear to ear. Why am I so happy? Why am I smiling ear to ear? I hope you're seeing it, because our balance sheet balances. We'll talk about what happens when your balance sheet doesn't balance, and that can happen, but for now, just know we've done it. Double underline, because this is a bottom line, and to do some formatting here on the right side, $sign at the top of each column, so $sign there and $sign here, and $sign beside anything double underline. So only $3. There's a desire often to put a $sign there. I do not encourage my students to do that. Again, different professors will have different $signing conventions, but that's the one I use. And there we have it. We've got a beautiful balance sheet. Assets equals liabilities plus shareholders' equity. We've done a terrific job. So, before we jump into the final part of the video, which is ratios, I want to tell a quick story about what not to do when your balance sheet doesn't balance, and some words of encouragement from me. If you're not looking for that story, I'm going to put a timestamp right here. You can skip ahead and skip the story, but this is hopefully some words of encouragement, especially if you're the type of person that accounting isn't really your thing. So I thought accounting was my thing. When I was a little boy, I wanted to be an accountant. And from a very young age, whenever anyone would ask, what do you want to be when you grow up? I would say accountant, even though I didn't know what an accountant really did. And I hadn't ever taken an accounting class before. I was a little kid all through high school, all through my first year of university. And then finally, in my second year of university, I arrived at an accounting class and I thought, here it is. I'm going to really devote myself. I'm going to really do well in the class. And on the first midterm, we had a set of financial statements just like this. This was question number one of 4 or 5 questions. But the first question and the biggest was, give me an income statement. give me a statement of retained earnings and prepare a balance sheet. And when I got to the end of my balance sheet, bad news, everybody, the birds were not singing, the sun was not shining, my balance sheet was not balancing. And at that moment, I made a terrible mistake. And that's the point of this story, is you should not make the same mistake I made. I erased everything. I went back, I redid the income statement, I redid the statement of retained earnings, I redid the balance sheet, still didn't balance. And then I made an even worse mistake. I erased it all again and I did it again. Well, by the time I'd done it a third time, like this is an hour and 20-minute test, I was an hour into the test. I still hadn't completed question 1. And I'm looking at the clock and I'm starting to sweat. And I had a very visceral reaction and an unexpected reaction. I started to cry. In the seat, I was like, oh no, I'm failing the test. I've told everybody in my life I want to be an accountant. Never had failed a test before. I did fail that one, but I was freaking out in the moment, and I couldn't believe it. I had this stress reaction that I've just never had before that. And so what's the point of this story? Well, the first thing is, I have students that hand in a balance sheet and it's not balanced, and it happens all the time. And it's often like they just wrote a number down wrong. Instead of 14,000, they might have written 15,000 here. And then all of a sudden their total expenses is off by 1,000. Their net income is off by 1,000. If your net income's off by 1,000, this is off by 1,000. And therefore your retained earnings is going to be off by 1,000. And guess what? Your balance sheet doesn't balance by $1,000. And so what? So if a student did that in my class, if this was out of 10 marks, that student would get a 9 out of 10. They made one mistake. That's it. Don't try to fudge the numbers. Don't try to fake your way into a balanced balance sheet, right? If you make a mistake up there, don't make a second mistake to make the thing balanced. No. Leave it unbalanced, but just go, okay. The advice would be, just move on to the next question. Come back if you have time. If you don't have time, it really isn't the end of the world. As a professor who marks these things all the time, don't lose your mind. That's the small level feedback, but I've got some big level encouragement. If you're a student that knows you've struggled with this, or you've struggled with it in the past, I failed that test, right? I remember the number, 27%. I failed the test miserably. I've never failed a test before or since that badly. Well, I went on to an accounting degree. I got a CPA. I'm a college professor in accounting. I'm an accounting YouTuber, for goodness sakes. Failing a test is a setback. Don't get me wrong. It's a bummer. It is not the end of the world. And I know it feels like it in the moment. It certainly felt that way to me, but I can just tell you I have a different perspective now. It is not the end of the world. And in fact, I have students that fail the class and they come back and try again and they do better the next time. So please don't lose hope if you have done poorly. Hopefully these videos help and they're a bit of a lifeline for some of you, but it really isn't the end of the world. And it isn't like a judgment about you as a person, right? You can struggle on these tests. I'm living proof, and you can get over that hurdle, and I hope you do, and I hope these videos help you in doing that. Okay, on to the final part of our problem. We got to do some ratios. Ratios are little calculations you can do to understand the company better. Because you look at the numbers, maybe they don't make a lot of sense to you, and a ratio can help you make some sense of the numbers. So these are our ratios for the balance sheet: the current ratio, the debt ratio, and the equity ratio. I'll give you the formulas and then we'll solve. So the current ratio is current assets divided by current liabilities. The debt ratio is total liabilities divided by total assets, not current now. And the equity ratio is total shareholders' equity divided by total assets. So let's do these three and I'll talk about each of them briefly. The current ratio of this company, current assets divided by current liabilities, it's $40,000. That's my current assets divided by current liabilities, which is 20. Our current ratio is 2. Now, normally, this will be a big long decimal for a real company, like made up company, made up numbers, everything worked out evenly. The rule of thumb here is you want a ratio above 1.5 for most normal companies. And let's think about what it's measuring. Current assets, that's my short-term liquid assets, divided by current liabilities, that's my short-term liquid debts, that's what I got to pay off soon. And it's saying, do I have enough short-term assets to pay my bills? Or is this company going to be in a crunch here? Are they going to run out of money, essentially? So 1.5 is thought of as safe, 1.5 or more. So we're above 1.5, we would think of that as safe. Debt ratio, total liabilities divided by total assets. In this case, that's 50,000 divided by total assets. So total liabilities, not current, but total 50, and divided by total assets, which are 190. 50 divided by 190 is 50 divided by 190, 0.2631, 26.3%. That was 0.263. Okay, we'll do the equity ratio, then we'll discuss both of these. Equity ratio is 140 divided by 190. What you'll notice is, because of the nature of the balance sheet, these two have to add up to 100%. So this one's 26.3. The equity ratio is going to be 73.7. I can tell you that already, but let's calculate it. Our total shareholders' equity was 140. Our total assets, 190. And yeah, 73.68, so 73.7%. And what does this tell us? It says if the company stopped today and I had to pay off all the debts, it would take 26% of my assets to cover the debts. It's a measure of how much debt I've taken on. And the general rule of thumb is smaller is, we'll say better, smaller is safer, right? Less debt is generally thought of as safer, more debt is riskier. So is 26% a lot of debt or a little debt? We don't know. We have to learn more about the company and its industry. We would want to compare the trend over time. But so we know that 26% of the assets, if I sold off all my assets, paid off all my bills, 26% of that money would go to pay off debts, and 74% of that money would go to pay shareholders. And obviously you're potentially a shareholder, you'd be interested in that. Okay, we've made it to the end of Sherry Shuttles. For goodness sakes, if you made it to the end, if you prepared with me the income statement, the statement of retained earnings, you sat through that long story about my sad balance sheet not balancing, and you made it to the end of this video, smash one of those buttons. Thank you so much for being here. I can't wait to join you in the next videos. We learn more advanced financial statements and we move on to journal entries, one of the most challenging and useful topics of our course. Thanks for watching. See you in the next video. Bye-bye. Welcome to Module 2 of our financial accounting course. This might be the single most important module of the class. It's not the hardest, but I think it's the most important. And the reason is it's about journal entries, recording accounting transactions. And the issue with this module is it follows you through the course. So our next module, the big topic, is adjusting journal entries. It's like journal entries, but harder. If you didn't get journal entries, you're in trouble on adjusting journal entries. When we learn about cash, we do journal entries for cash. When we learn about inventory, we do journal entries for inventory. So unfortunately, when it happens that a student fails the course, and I am going over how they did and we're reviewing their work, often the root problem was they didn't understand journal entries well enough. The best way to understand journal entries is by practicing, and that's what this module offers. And we're going to start the practicing here, where I'm going to explain how to do journal entries. And when I think of journal entries, I always think of this character, this handsome fella. This is a guy called Isaac Newton. If you've ever taken a physics class, Isaac Newton will be the star character of that class. And we know him because of his laws, Newton's law of force equals mass times acceleration, or an object in motion wants to stay in motion, an object at rest wants to stay at rest. But it's Newton's third law that I call to mind when I think of journal entries. Newton's third law, you've probably heard it. It says, for every action, there is an equal and opposite reaction. And that's what I think about when I think of journal entries. Whenever one thing happens in accounting, there's always at least two things happening, at least two equal and opposite forces. So the best way to do journal entries, though, is to do examples. So that's what we're going to do now. We're going to do several journal entry examples. And I think by the end of the video, you'll be taking your first steps to better understand journal entries. Let's see what we're up against. Scenario 1. It's January 1st. I buy a $20,000 car for cash. Okay. Something has happened. And when something happens, this would be a financial transaction. An accountant has to keep track of that thing that happened. So the accountant will ask themselves, all right, well, what happened here? What accounts were involved? Like what things were involved here? And of course, you might look at this and say, well, I have more cars today than I had yesterday. You might say something like, my cars went up by $20,000. And I think you would be absolutely right. Our car asset increased by $20,000. And I said, well, now think back to old Isaac Newton. For every action, there's an equal and opposite reaction. What else happened here? And you might astutely say, well, my cash went down. I have less cash today than I had yesterday. Cash went down by 20,000. And you've absolutely summarized this transaction. Car goes up, cash goes down. Well done. But that is not how an accountant keeps track of things. Wouldn't it be nice if we just said up arrows and down arrows? No. Accountants use debits and credits to keep track of stuff. So I'm going to teach you the rules of debits and credits. We're going to apply it to this scenario, and we're going to apply it to a few more scenarios in this video. Let's scroll over. Here are the rules for journal entries, the rules of debits and credits. If I know an asset and I want to make it go up, if I like my car in this last scenario, we debit the car, right? DR stands for debit, CR stands for credit. I debit the car to make it go up. I credit the car to make it go down. It's an asset. If I want to make a liability increase, it takes a credit. That's the opposite now, right? Credits decrease assets. Credits increase liabilities. Debits make liabilities go down. Shareholders' equity works the same as the liabilities. Credits make them go up. Debits make them go down. I don't expect you to have this memorized in the first moment, but we're going to use this chart so often that you are going to remember it if you practice effectively. It's just you got to be attuned with this chart. Revenues, expenses, and dividends are interesting. They all impact shareholders' equity. Specifically, they impact the retained earnings account. If my company makes more revenues, that means we're more profitable, and that means we have more retained earnings. Revenues always help our shareholders' equity. They make shareholders' equity go up. So revenues take a credit because credits make equity go up. Expenses and dividends negatively impact your equity. Expenses make your net income go down. Dividends are taking money out of retained earnings. They make equity accounts go down. So they take debits. All right, that's it, right? There's not a lot on the screen here, honestly. If you sort of learn how to operate this little table, you'll learn journal entry. So let's apply it to that situation we are looking at. Let me just bring this over with me. Pull you over, maybe make you a little smaller on the way. Let's see if I can make it a bit smaller. Yeah, I think that's beautiful. Okay, so we said, hey, we've got a car going up and we've got cash going down. And I said, well, we got to do journal entry. So let's return to our car. We say to ourselves, what is a car on this table? And I had said, well, a car is an asset and we want the asset to go up. So what do we do to our car? We debit our car. What does a debit look like? Let's pretend this is my sheet of paper. Okay, so this is my sheet of paper. Actually, on the top, I've missed this part. We date it. So we'll say January 1st. Okay, so I've got a date. Also along the top, just towards the right-hand side, I'm going to write DR and I'm going to write CR. All right, so there's a debit column and a credit column. On the left-hand side, I want to do my debits on the left. You'll maybe hear that a few times. Debits go on the left. I'm going to write the word of the account I want to debit. Oops, not cash. I want to debit car, right? We just said car is going up. Car is an asset. It's going up. It takes a debit. Let's debit car. So I write car on the left to signify it's going to be a debit. I write the amount under the DR. So the amount here is $20,000. And congratulations, we have just debited our car for $20,000. But that's not a complete journal entry. A journal entry needs equal parts debits and credits. That's what I'm talking about when I talk about Isaac Newton. This is what keeps a balance sheet balancing, is you have to do two things at once. So we credit cash. And let's just talk about why we credit cash. Obviously, I've said we want equal parts debits and credits, but let's think about why. Cash is an asset, an important asset, and our cash is going down. So it's an asset, it's going down, credit cash. So here's what a credit looks like. If I hit the enter key, I'm on the next line down, and then I hit the space bar 4 or 5 times, and somewhere over here I'm going to write the word cash, and under the credit I write $20,000. And there we have it. We've debited the car, we've credited the cash. One thing left to do: describe what happened. Purchased a car for cash. Any reasonable description will do. So there we have it. We have a complete journal entry. There's a date. There's an account debited, at least one. There can be more. There's at least one account credited. The value of the debits equals the value of the credits. And there's a description. Well done, our first of many journal entries. So hopefully you hung in there for that one. Let's see how we do on scenario 2. So scenario 2. And you can see I've got the table here because I'm going to refer to it every time. I would advise students just to write this in the corner of their page. When you get a test, write it in the corner of the test paper as soon as you receive it, because if you know your professor is going to give you journal entries like I give mine, my students, that's something you're going to want to have. It's January 1st. I buy a $20,000 car, but this time not for cash. This time with a car loan. All right, let's think about what's happening in terms of up and down. I have more cars today than I had yesterday. So yes, indeed, my car is going up by $20,000. What about my car loan? Do I have more or less car loans today than I had yesterday? Yesterday, I didn't have any car loans. Today, I have a $20,000 car loan. My car loan is also going up. It is at this moment that sometimes I have an unsatisfied student and when I'm teaching the class, and a student that will raise their hand and they'll say, wait just a minute. Didn't you just tell us Isaac Newton, for every action there's an equal and opposite reaction? You got an up arrow and you got another up arrow. Shouldn't it always be an up and a down? And they look at me disappointed. They say, what would Sir Isaac say if he were here right now? And I think, well, he'd probably look at my sick razor blade PC and say, is that a razor blade with a NVIDIA RTX graphic card? And I'd say, Isaac, yes, it is. And I'd feign embarrassment, but I'd say it is pretty sick. But no, Isaac would not be disappointed in me. Isaac would be, would know that it's not the up arrows and down arrows that matter here. It's the debits and credits. So let's see how this one plays out. Do we have equal parts debits and credits? So car is still an asset and we bought the car, so it's still going up. So we're still going to debit our car. So car. Now, if you're doing this all on one page, you do not need to write DR, CR at the top of every journal entry. You just write it once at the top of the page, and that sort of holds those columns forever. Well, for the page anyway. So I'm going to debit my car by $20,000. And, well, let's look at our car loan. Now, what is a car loan? Is it an asset? No, 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 my friends. It is not an asset. A car loan is a debt. It's a liability. And our car loan, we've said, is a liability. It's going up. So it takes a credit. So we credit car loan. And I like to say car loan payable. I like to put the word payable on the end of most of my liabilities. Helps students keep it straight. It helps me keep it straight. So there we go. Credit car loan payable. And let's put a date. I forgot that. January 1st. Let's put a description. Purchased a car with a loan. Okay. I'm going to call out a bit of an elephant in the room. And this is something I'll do in my class. Your professor might feel differently, so be careful here. I do not require my students to write this description. And the reason is, if they copy pasted this one, which I give you in the question, if they just copy and pasted that down to here, they'd get it right, right? I buy a car, a $20,000 car with a car loan. If you just wrote that, I bought a $20,000 car with a car loan, you are correct. So because accounting exams can be time constrained, and mine are, I don't want them wasting time rewriting or rephrasing the question and just spitting the question back to me. I think the value is in the debits and the credits, so I don't require that description, and so I won't be doing it in these videos. I won't be giving a description, so that's something to be aware of. So January 1st, we bought a car, debit car. We entered into a car loan payable. We entered into a new liability, and here we have it, right? A date, at least one account debited, at least one account credited. The value of the debits and credits are equal. Beautiful journal entry, if I do say so myself. Sir Isaac Newton would be nodding his approval and smiling right now at all of us. Okay, let's continue. It's September 3rd. No, it's not. September 3rd. How did I get that? It's scenario 3. I read September in my brain. It's January 1st. I buy a $20,000 car with $5,000 cash and a $15,000 car loan. I think I was laughing about my own Isaac Newton comedy bit that I'm doing here. Okay, well, what's happening here? We have a car, and it's going up by $20,000. What's happening to cash? Well, our cash is going down by $5,000. What's happening with our car loan? Well, we have more car loans today than we had yesterday. Our car loan's going up by 15. You can see the value of the up and down there is totally mismatched, but our debits and credits are going to work. Spoiler alert. So January 1st, we date it and we go, okay, our car went up. So start there. We got an asset, it's going up. Let's debit that asset. Debit car. For $20,000. Okay, debited my car for $20,000. What happened to cash? Cash went down. Cash is also an asset. So let me erase these underlines and highlights. Cash is also an asset. It's decreasing, so we credit our cash. So remember, it's indented a little bit there. And of course, we write the number under the credit heading. Okay, last one. Our car loan, we said, was a liability, and we have more car loans, right? Yesterday, we didn't have a car loan. Today, we have a $15,000 car loan. Let's credit car loan, and again, I'll hit it with that word payable. Just as a reminder, this is a liability. Different companies will have different account names, but I think car loan payable is just fine. I feel like I'm just a little off kilter. There we go. Okay, so we've done a beautiful job. This is a good journal entry. Again, I'm not going to be writing descriptions, but if you had to write a description, you could say, I bought a $20,000 car with $5,000 cash and a $15,000 car loan, and that would be sufficient. In the real world, you might put things like what make and model of car, maybe some vehicle ID number, maybe some invoice number from the dealer. You know, it's like you would put some more details to this, but you know, you're not going to get that much detail in an accounting problem. Okay, a couple more scenarios, and then we'll jump into some more comprehensive examples. It's January 1st. I do consulting work for $1,000 cash. Okay, well, let's date it, January 1st. We did consulting work for cash. Let's start with cash. Oops. Yeah, well, let's just start with cash. Cash is an asset, And our cash is going up, right? We did the work, so somebody's paying us $1,000 for our consulting service. So we debit cash by $1,000. Okay, so we're off to the races. Now, what is this when I do consulting work? Like, what is happening here? Well, if I do consulting work for money, this is me doing what I do to earn money. And if you don't know what I'm talking about, go back to chapter 1. We said, and I'm not joking when I say that, you should watch my chapter 1 videos if you're not clear on what's happening here. We earned money. And when we earn money, that is a revenue situation. This is us earning revenue. Now, we don't credit an account called revenue. You have to put a name on it. So Walmart has sales revenue. My university I work for has tuition revenue. What would a consulting company have? They would have consulting revenue, or a consultant. It doesn't even have to be a company. Consulting rev. So yeah, there's consulting revenue. We credit consulting revenue for $1,000, and that's good because it balances. We got equal parts debits and credits. I forgot to mention in the last one, I got one debit, I got two credits, but the value is $20,000. The value is $20,000, right? $20,000 worth of debits, $20,000 worth of credits. Our journal entry works. Here, it's $1,000 worth of debits, $1,000 worth of credits. Our journal entry works. One last journal entry, and then I'll set you loose onto the next video. It's January 1st. A plumber comes and repairs a leak. I pay $1,000 cash. Okay, well, let's follow the cash. Cash is always easy to deal with. Cash is an asset. Is our cash going up or down? Our cash is going down. So we're going to credit cash. So here's how I cope with this. I date it. I leave room for a debit, and then I put the credit. Now, some students ask me, can I put the credit first and the debit second? And the answer is yes. It just looks weird. So I do it this way because this is the way journal entries normally look. But if you have your credits first and your debit second, that is a proper and okay journal entry. It just looks funny in terms of the formatting. So credit cash for $1,000. And the debit, what is the debit when a plumber comes and repairs a leak? Well, I hope you're saying this is a cost, right? This is a cost of operating a business. You're going to have leaks in your building from time to time. You're going to have to pay plumbers or repair people or whoever. And this is an expense. Costs are expenses. And so we would call this a repair expense. And the amount is $1,000. So there we have our last journal entry from scenario 5. As I mentioned, and I think it's worth reiterating, I thought I would have the rules of journal entries handy, but I just realized I've scribbled all over my rules. These rules right here, I'm zooming in tight. This is everything. If you have mastery over this teeny little table, you have such a head start in an accounting class. And chapter 2 of my workbook is what's meant to do that. So please work through some more journal entry example problems. I've got to be hours worth here on YouTube, and I hope you'll continue your accounting journey with me. Thanks so much for watching, and I'll see you in our next video. Bye for now. Hello and welcome to Journal Entry Bootcamp. In this video, we are going to practice journal entries. It assumes that you've heard of journal entries before and you've done a few before. If you've never heard of journal entries or you need to start from ground zero, I'm going to link a video right now. You'll see it pop up. Please click on that and watch that video. This video is for those of us that have tried journal entries and we're struggling a little bit. I'm a college professor. I teach accounting, and when a student fails my class, and it does happen unfortunately, often we can trace the root of their problem back to not understanding journal entries well enough. So this video is going to provide you with all kinds of practice. Now there's one rule. I shouldn't call this rules. I should call it a rule. And the rule is, if you want to succeed if you want to get the most out of this video, you need to pause the video each time a journal entry question is on the screen and answer it yourself, either by writing down the debit and credit or just by saying aloud what you think should be debited and credited. It's not enough just to watch me do it. I'm going to go fast here. It's not enough just to watch me do it and go, No. You've got to be very active if you want to get the most out of this video. Write down what you think the journal entry is, say it out loud, and that way when you make a mistake, you'll remember. If you just say as I do it in the video, you're not going to learn nearly as much. So I do hope you'll follow my one and only rule. I do hope you will try to write them down or try to answer these journal entries first. Okay, enough preamble. One last thing before we get going. I just want to remind you about how journal entries work. You should all know this, but oops, I got the wrong highlighter. Let me use my bigger highlighter. If I want to make an asset increase, I debit the asset. If I want it to decrease, I credit it. Liabilities and equity are the exact opposite. Credits make them go up, debits make them go down. And the final piece of the rule, revenues, expenses, and dividends, well, these are all sub-accounts of shareholders' equity. So revenues always help our shareholders' equity. Revenues, therefore, take a credit because credits make equity go up. Expenses and dividends always hurt your shareholders' equity, so they always take a debit because, again, they make shareholders' equity go down. Okay, those are the rules. You should be familiar with them from before, and if you're not, you should go back and watch that earlier video that I've linked before because I really go through it in some slow detail. This is meant for people who have an idea about journal entries but just need more practice. Here we go. Let's get down to business. This problem is linked right below the video. You'll see a link to a PDF file of the problem and a few of my others. Speedy Landscaping has been in business for years. The company has the following transactions during the month of August. Record the needed journal entries. Okay, so we've got a big job. We got to do a bunch of journal entries. Okay, so the first one, and again, here's where you should be pausing your video and doing this yourself, but I'm not going to say that every time. I'm just going to do the problems, and I'll go reasonably quickly. August 1st, borrowed $50,000 from the bank, signed a note payable. The first thing I'm thinking about when I see a journal entry is, did cash change hands? And if you borrow $10 from your friends, did cash change hands? Yeah, I've borrowed $10 from my friend, I got cash. Borrowed $50,000 from our friend, the bank. Did cash change hands? Yes, we got cash. Well, cash is, of course, an asset, and our cash asset is increasing. Therefore, we should debit cash. So I write the word cash over here, and under debit, I write the amount of the debit, $50,000. Okay, well, what's the other part of this? And, well, I guess the other part is sort of outlined here. We signed a note payable. We signed a note promising to pay them back. A note payable, not an asset. A note payable is a liability. If it has the word payable, that's a dead giveaway. It's a liability. Now, is our liability increasing or decreasing? Well, yesterday I owed the bank $0. Today I owe the bank $50,000. My liability has grown. My liability is going up. So we're going to credit notes payable for $50,000. Okay, our first entry is in the bag. Let's continue. Again, consider pausing this and solving this yourself. I won't say that every time. August 2nd, purchased landscaping equipment for cash, $10,000. First question I ask myself, did cash change hands? The answer here is definitely yes. So we got an asset, cash, that's changing hands. Is our cash asset going up or down as a result of buying this equipment? Of course it's going down, right? We are reducing our cash. We paid out cash. So to make cash go down, we credit cash. Again, beginning students screw this up. They look at their bank statement, it shows a credit to their account, and they see the money go up. Not in accounting. It's the opposite of what would show up on a bank statement. Credit cash to make it go down. I'll leave room for a debit. I'm going to credit cash for $10,000. Now I have to think, what is the rest of this? And of course, it's what did we buy for our cash? What did we spend our money on? And in this case, we spent our money on some equipment. So I debit, well, first of all, what is equipment? Looking at my table, I keep referring to this table. I highly recommend you putting this table in the corner of your test papers. I think it's a useful thing to have, but in any event, equipment is an asset, and equipment is increasing, right? We have more equipment as a result of this transaction than we had before. So I debit equipment, my equipment account, to make it go up. Debit equipment for $10,000. Let's continue. August 3rd, paid $100 to repair a broken wheel on a lawnmower. Okay, did cash change hands? The answer, yes. Paid, right? Paid is the giveaway here. So our cash asset, cash of course is an asset, and it's decreasing. We paid cash. So let's credit cash for $100. The debit, well, it's to repair a broken wheel on a lawnmower. There might be some temptation to debit lawnmower, like we're adding value to our lawnmower, but that's not the case. A repair is a cost of doing business. A repair is an expense. And luckily enough, repairs are always debited, and look at our journal entry, we're missing a debit. Of course, we need equal parts debits and credits, and here we have it. Debit, repair, expense, and I just put it as EXP, but you might have to write out the whole amount. That just depends on your professor. Okay, August 3rd is in the bag. We'll keep going. August 4th, provided landscaping service for a customer. The customer paid cash of $75 for the service. Did cash change hands? Yes. Is our company's cash going up or down? It's going up. So our cash asset is increasing. In this case, we debit cash. $75. If a customer is paying cash for a service that we have provided, this is us doing what we do to earn money, right? $75 for service means we did work for them. We did landscaping service. This is our company doing what it does to earn. And when we do what we do to earn, this is indeed a revenue earning situation. We're going to credit landscaping revenue for $75. There we are. That's August 4th. Continuing on to August 5th, purchased and used fuel in the lawnmowers. It cost $150 cash. Did cash change hands? Yes. I promise in some of these cash will not change hands, but so far cash has changed hands in every one. That makes our life a little easier because dealing with cash I find straightforward. And once you've got cash, and of course it's an asset, in this case it's decreasing. Once you've got cash, you're sort of halfway home, and if you can get halfway there easily, it makes the job easier, right? If you can get halfway done without any issues, you got a head start. Okay, well, what's the other half of this? Well, we bought fuel. Now, if we were buying the fuel and storing it and going to use it for later, we bought the fuel, we put it in a storage container, we kept the fuel, I think we would be debiting a fuel asset. It's something we own, control, it's useful, it gives us value in the future, it's a thing of value. I think we would be debiting a fuel supplies asset account. So I think that's a reasonable guess. I think more likely we put the fuel in the mower and we just used it right away. We just started using the mowers. And if that's the case, I think a normal company in this circumstance would debit fuel expense. This is a cost of running a lawn mowing business. Expenses are costs. So fuel expense makes more sense to me. Fuel supplies isn't an outrageous answer. I think it's reasonable, but I would do fuel expense for sure for my August 5th transaction. Moving on to August 6th. Provided landscaping service for 3 customers, $100 each, 2 paid, 1 will pay next week. Okay, the 2 customers who paid, cash changed hands, and we are getting cash from 2 out of the 3 customers, so that's an asset. Cash asset is increasing. Let's debit cash. And the amount here is $200. Our credit in this case, well, actually, no, I jumped the gun here. What about the one who didn't pay? The one who will pay next week? That's $100 of work I did for which I haven't been paid. If you've done work for which you haven't been paid, this creates a receivable. So this is, an accounting concept you should be familiar with early on in your course. This is an account receivable. We did work, our customer didn't pay us, and accounts receivable are assets. Now, do we have more or less accounts receivable as a result of doing the work? We have more. They didn't owe us anything yesterday. Now they owe us $100. So we're going to debit AR. So this entry, we have two debits. That's the first time we've had that. We've all been one debit, one credit, but it is very common to have more than one debit or more than one credit in a journal entry. Okay, well, what should we credit? Well, we did landscaping service. I would call this landscaping revenue. And of course, we credit revenue accounts. Now, not just for $200, not just for the money received. We earn revenue for work done. And even though I didn't get the money, I've done the work, so I've earned the revenue. Credit landscaping rev, $300. Okay, on to the next. August 7th. Received but did not pay the telephone bill, $50. The bill is due in 30 days. Did cash change hands? No. Oh, okay. Well, let's break it down then. What happened here? If I'm not going to credit cash, what's going on? Well, let's start with the telephone bill. What is a telephone bill to a company? What is a telephone? Telephone's a cost, right? You got phone bills. That's a cost of doing business. This is an expense. Like a bill comes in, it's an expense. So we're going to debit either telephone, or sometimes people will call this utilities expense. I'm going to call it telephone expense for $50. Our credit, normally you pay a telephone bill, you credit cash. An unpaid bill, when a client doesn't pay us, it's accounts receivable. When we don't pay our supplier, it's accounts payable. It's a liability, and our liability in this case is increasing. I didn't owe the telephone company anything, and then they sent the bill, and now I owe them $50. So I credit accounts payable, AP, for $50. Next, August 8th. Purchased a new piece of landscaping equipment, a line trimmer, for $500 on account. On account becomes a key thing because, of course, the first question I ask is, did cash change hands? The answer, no. How do I know? Because it was on account. You buy something on account means you didn't pay for it right away. You said, send me the bill. So let's start with what we got. We got a piece of landscaping equipment. Equipment, of course, is an asset, and our asset is increasing. So let's debit equipment. $500. And our credit here, well, I would think if I bought it, I would credit cash, but this is just like my phone bill. I didn't pay. So unpaid bills are accounts payable. And accounts payable, of course, going over to my table, it's a liability and it's increasing. I didn't owe the equipment company any money yesterday, and now I owe them $500, so my accounts payable increases here by $500. August 9th, did social media advertising paid $200? Okay, well, we're back to good old cash. We paid. Cash is an asset. It is decreasing. Credit cash. The debit here, well, this is advertising. Advertising is a cost of running a business. Debit advertising expense for $200. There we have August 9th. On to August 10th. August 10th, completed a sod installation job. Billed $2,000. Payment is due in 30 days. We did work. We did not get paid. Cash did not change hands. We billed, and they haven't paid us yet. So when I do work for which I am not paid, it is an asset. It is accounts receivable, and our accounts receivable is increasing. So let's debit AR. Debit accounts receivable for $2,000. And the key is we did work. So you could call this a few different things. You could call it sod installation revenue. I think a lot of companies might do that. Or we could just put this in our general landscaping revenue account. And I think that's also reasonable. honestly, if I were running the company, I would split it out. I would call this sod installation revenue. So maybe I should have done that here, but I'm calling it landscaping revenue. Whenever I have revenue in this problem, I'm just going to keep it simple. Landscaping revenue will be the account, and of course, revenues do take a credit. August 11th, collected the amount owing from August 6th. What happened on August 6th? Got to scroll up. August 6th, we had one customer, that we had yet to collect from, this $100 that was owing. Now we collected. Did cash change hands? Yep. Is our cash going up or down? It's going up. So let's debit cash for the $100. And the credit here is to accounts receivable. Accounts receivable, also an asset. We had a $100 AR from the customer, and now it's going down. The idea being, oops, I scrolled by mistake. The idea being, this customer owed us $100, and now we're saying, you don't owe us anymore. We're ripping up the IOU, right? You paid. We don't have anything receivable from you because you paid us the $100. This is a place students sometimes make a mistake. They sometimes credit the revenue account. They'll say landscaping revenue because we're getting paid for landscaping. But remember, we've already recorded the revenue before. To record it here again would be double counting. August 12th. Completed a major landscaping job. Billed $4,500, collected half. Did cash change hands? You bet. Our cash is going up. So debit cash, $2,250. What's the other half? The other half, I hope it's fresh in your mind. We just talked about this account. It's a receivable of $2,250. And again, our cash and AR are both assets, and they're both increasing. We did the work. It means we have more money because of it, and we also have more receivables because of it. So those are both increasing. What's the other piece of this puzzle? It's revenue. This is landscaping work. We did work. We earned revenue. $4,500. Next, August 13th, received and paid the electricity bill, $400. Okay, did cash change hands? Yes. Is our cash going up or down? It's going down. We credit cash. The debit here, either to, this is a cost of doing business. It's either electricity expense or utilities expense. I'm going to call it utilities expense. If you call it electricity expense, I think you're totally fine. Cool with me. Again, be consistent with what your professor says to do in your own classes, but I think that's a pretty reasonable thing to do. August 14th, bought a new trailer for $1,200 cash. All right, did cash change hands? Yes. Is our cash going up or down? Down. We credit cash. And what do we get for our cash? A trailer. We can either debit equipment. I think that's totally reasonable. We can debit trailer. I think that's totally reasonable. I'm going to debit trailer. If you debit equipment, though, I think that's absolutely fine. We got an asset, a trailer. We have more trailers today than we had yesterday, so that's why we debit it. Continuing. Paid wages to employees of $2,000. Does cash change hands when we pay someone wages? Yes. Our cash goes down. So we credit cash. Their cash goes up, but the company's cash decreases by $2,000. The debit here, what's a wage to a company? A wage is a cost. It's an expense. So we debit wages expense, $2,000. Next, August 16th, had a lawnmower repaired. We did a repair earlier. Cost $600. Payment is due in 30 days. That means we didn't pay. So we can't credit cash. Cash did not change hands. Let's deal with the repair, though. If you see the word repair, you should be thinking expense. This is a cost of running business and is getting things repaired. And absolutely, that's what we're going to do here. Debit, repair, expense, and we do that for $600. And I'm not going to credit cash. I'm going to credit accounts payable for $600. This is a liability. This is an unpaid bill, and it's increasing. So accounts payable is an increasing liability, in this case, credit AP. August 17th. Paid the phone bill from August 7th. I got to scroll up quite a bit here. Let's go back to August 7th. Got to find that one. August 9th, 8th, 7th. Okay, so we had a $50 phone bill. Now we're paying it, right? We said, well, we didn't pay it, but we're gonna, and now we did. So did cash change hands? Yes. What's happening here? We're going to credit cash $50, and let's think about the debit, but definitely credit cash $50 as a starting point on August the 17th. Credit cash 50, and we debit accounts payable. Again, we don't want to debit phone expense. That would be double counting it. We want to debit AP to say that liability is no more. I don't owe them any more money. I've paid off my entire phone bill. So get rid of that liability. AP goes down by $50. August 18th, collected the other half owing from August 12th. I think this was that $22.50. I vaguely remember the number. It's sort of rattling around my brain. Yeah. So it's saying, okay, we got paid $22.50 and we were waiting to collect $22.50 more. We had $22.50 receivable. Now we've received it. So did cash change hands? You bet. Debit cash $22.50. And what do we do with the AR? We credit it, right? Our accounts receivable is no longer receivable. So again, I debited the cash asset to make it go up. I credit the accounts receivable asset to make it decrease. Okay. I just want to check in with you. Make sure, please, that you're pausing the video and trying to solve this before I am. I know I'm going fast here. But the idea is I want to go fast to make sure you get a lot of practice in. You should be practicing, and I hope you are. August 19th, Judy Smith invested $25,000 into the company in exchange for common shares. Okay, did money change hands? The answer is yes. Judy Smith gave the company $25,000. Okay, so the company's cash is going up as a result of the shareholder or the new shareholder putting money into the company. We debit cash for $25,000. Now, the credit here, a lot of people get it right, but they get it right for a confused reason. They get confused on share issuances. So I just want to pause and touch on it briefly. We credit here, I'll just tell you what we credit. We credit common shares. And a lot of beginning students, they see this as us losing an asset. They go, well, we're giving up shares. Shares are something of value and we're giving them away. Therefore, we credit it because we're crediting an asset. And that's just not the case. What's happening here is Judy Smith's equity in the company is growing. She has a growing piece of the company. Our shareholders' equity is increasing. She's given money. Her piece of the pie has gotten bigger. So that's why we credit common shares. There are more common shares in the world today than there were yesterday. There's more value to our common shares today than there was yesterday because there's $25,000 associated with our common shares that was not associated with our common shares yesterday. Okay, let's continue. August 20th, rented tools for a special job, paid $350 cash. Did cash change hands? Our answer, yes. And our cash, of course, is going down, so we credit cash. What is renting tools? Well, to us, this is a cost of doing business. I imagine they do have to rent tools. I would call this tool rental expense. You could call it rental expense or rent expense. The reason I wouldn't do that is so often companies have to rent like a facility or a building. And so you don't want to mix in your tool rental with your building rental. You'd want those separated. So I would be specific here and call this tool rental expense. By the way, we've done 20 entries. We're going to do, I think, over 30 altogether. If this has been useful so far, don't be shy about hitting that like button for me. It's a huge favor to me. I genuinely appreciate it. Don't be shy about hitting the subscribe button either. I genuinely do appreciate it. I hope you're getting value out of this. And if you are, it sends a signal to me. By the way, this is my first time doing this style of video. Is this good? I don't know. I hope so. I guess if you've gotten this far, you probably think it's all right. But please let me know in the comments if you'd like to see more videos like this. You can see my other style of videos on my channel. So this is a new boot camp style video for me. I hope it's working, and if it is, please let me know. Send me that signal that you'd like to see more. Okay, let's continue. August 21st. Completed and billed for the special job. I guess because we got a tool for a special job here, and now we did the special job, and the client pays us $1,800. Did money change hands? Yes. Client paid. Our cash is going up, so we debit cash $1,800. What should I credit here? Well, we did work. I'm going to call this, and we got a landscaping company. I'm going to call this a landscaping rev, 1,800. On to the next. August 22nd. An upset client threatened to sue. Our company paid legal fees of $400 to consult with a lawyer. The client eventually changed their mind about suing, so they decided not to sue us when we lawyered up. Good. Okay, well, what happened here in terms of a transaction? We paid legal fees. The rest of this is interesting story. We don't need it. Paid legal fees, $400. Did cash change hands? Yes. Our cash asset is decreasing. Credit cash. We're paying those greedy lawyers. Never like lawyers until you need one. And then, boy, are they helpful people. So I won't slag lawyers too much here. Credit cash, $400. Well, what is paying a lawyer? It's an expense. It's a cost of doing business. I would call this legal fees expense or legal expense. You could call it professional fees expense. You see that account used all the time. But there we go. Debit legal fees expense. We always debit expenses, and this is no exception. August 23rd. Took a local business development training course through the local college. Paid $180. Did cash change hands? Yes. Is our cash going up or down? Down. Credit cash. Cash is an asset. It is decreasing. We credit cash for $180. What's the other part of this? Well, we took a training course. I would call this training expense. Right? We're making ourselves better. Maybe professional development expense. That could be. We could call this PD, professional development. Training seems just fine to me. And again, it's just a cost of doing a business. You train your employees. You train yourself. These are costs of running a business. August 24th. Purchased a used leaf blower on account. The $275 bill is due next month. All right, so we bought some equipment. Did cash change hands? No, because the bill's due next month. So what did change hands? Well, a leaf blower changed hands. So let's deal with that. You could debit leaf blower or you could debit equipment. Either one I think would be acceptable. I'm sorry if I'm not being consistent. I remember I debited trailer and I was specific there. Companies will sort of make decisions about what they want to call their various assets. I think calling this equipment is very much appropriate. $275. I'm not going to credit cash because I didn't pay it, so unpaid bill. Unpaid bill is a liability, and we credit our liability. What kind of liability is it? It's an account payable. This is a normal supplier and a normal unpaid bill. August 25th. Completed lawn mowing work at 8 houses. Billed $50 per house. Received payment from 3 of the 8, didn't receive payment from 5 of them. So it's $50 a house times 3 houses. We got paid $150. And of course, if it was 8 houses, then 50 times 5, there's $250 unpaid, right? 5 houses at 50 did not pay. Okay, let's deal with the 3 that paid. Of course, this is cash changing hands and it's going up. Let's debit cash for $150. What about the other $250? Well, that's just receivable. It's work I've done for which I haven't been paid. My receivables are increasing by $250. The credit here, this goes to landscaping revenue. Again, we could call this lawn mowing revenue if we wanted to be a little more specific. I think that would be fine. I think landscaping rev as a catch-all would also be appropriate for this company. And $400. Doesn't matter that we got paid for it or not. What matters is we did the work. We did $400 worth of work. Let's continue. Received a bill for a business license fee. Or business license fees, $240. The bill hasn't been paid. Did cash change hands? No. All right, well, what's a business license fee? It's an expense. You got to get a business license to operate. This is a cost of running a business. Debit, business license expense or business license fee expense. I like the word expense to be at the end of my expenses, so I'll put, it might seem redundant with fee and expense, but let's put it there. Business license fee expense, and we didn't pay for it, so don't credit cash. An unpaid bill, you credit AP. It's a liability and it is increasing. $240. August 27th. Collected full payment from the August 10th job. Good Lord, this is going to be a long scroll. August 10th. My goodness, we're almost there. August 10th. $2,000, right? We did a job, they didn't pay, and now they've paid. They brought in their $2,000. So did cash change hands? You bet. Debit cash, $2,000. Let's find the question again. There it is. Debit cash, $2,000, because we collected payment, and we credit AR. This is no longer receivable, and we have to give up on that receivable and say we're not going to try to collect it anymore because it's been collected. August 28th, paid the lawnmower repair bill from August 16th. Let's go up to August 16th and find it. There we are, $600 repair bill. Now we're paying. Well, you pay a bill, you credit cash. Cash is decreasing by $600, and the debit here, not to repair expense, because we already had the thing repaired and we've already incurred that expense back on August 16th, we debit AP to say this is no longer a liability, this is no longer payable. August 29th, paid wages to employees, $2,000. Well, we did a very similar journal entry a couple of weeks back. We credit cash, because we're paying, of course, $2,000, and we debit wages expense for $2,000. Pretty straightforward entry. August the 30th, paid interest of $250 on the note. Way back on the first journal entry, we had like a $50,000 note. Now we're paying interest on it. Well, paid, so did cash change hands? Yes. Is our cash going up or down? Down, so we credit cash, of course. An asset that's decreasing, we credit that to make it go down. The debit, well, what is interest? Interest is a cost. It's a borrowing cost. It's an expense. We debit interest expense for $250. One more entry, the last day of August, August 31st, declared and paid a cash dividend of $1,000 to the shareholders. So we pay $1,000 to our shareholders. Did cash change hands? Yes. Company's cash is going down. We credit cash for $1,000. And at long last, we have a dividend. You just debit an account called dividends for $1,000. Not expense. This is not an expense. A dividend is a dividend. It's shareholders pulling their profits from the company. Okay, we've made it to August 31st. We've done 31 journal entries, hopefully in around 30 minutes here. I hope this video helped. And for goodness sakes, if you made it all the way to the end, I do hope you'll drop a like and or a subscribe on my channel. Thanks so much for watching. And again, let me know if this was useful. Let me know if I should do more of these boot camp style videos where I just go through a lot of accounting entries. Thanks for watching. Have a great day. Bye for now. Let's take a look at problem 2-4A. We've got to do journal entries, we've got to do T accounts, and we've got to make a trial balance. This is a terrific problem, if I do say so myself. Let's read through it. Teacher's pet tutoring service provides extra help for students. The company has been operating successfully for several years and has the following account balances entering April. So this is the first one of these where we are joining a company in progress. All the other ones, we are starting a new company, issuing common shares for cash as our first transaction. Well, this one, the company's up and going. They've got cash, accounts receivable, supplies. They got some computers. They have some debts, accounts payable and a bank loan, common shares, and retained earnings. So they've given us some opening balances. Those will be relevant for some of our journal entries. And also when we make T accounts and the new trial balance, those will be very relevant. We're given a bunch of transactions and we're asked to prepare journal entries. Now, I always think it's sensible for students to try to work on these problems out ahead of me. You should be downloading the problems, and if you don't know where to get them, just myname.com, tonybell.com. You click the PDF, look at that, it just loads right up. You don't have to sign up for anything. There's the PDF, and you can scroll through and find this problem. You can also find, about a third of my problems are free and open on YouTube. About 2/3 are members only, so if you're looking for more, scroll through and you can click on any of the members only links and it'll take you to a sign up page. But certainly I hope the free videos are useful to you, and this is one of them. So we are asked to prepare journal entries, and I've laid it out here. Now, I keep this rules of journal entries in my mind. If I want an asset to increase, I debit it. Crediting an asset makes it go down. Liabilities and equity are the opposite. Debiting those makes them decrease. Crediting them makes it increase. Revenues, because revenues, expenses, and dividends are sub-accounts of retained earnings. They're sub-accounts of equity. So revenues always make your equity go up. Expenses and dividends always make your equity go down. And therefore, revenues always take a credit because that makes equity go up. Expenses and dividends always take a debit because that makes expenses and dividends always take a debit because that makes equity go down. Okay, let's do a bunch of these journal entries. April 1st, it says paid off the account payable owing from March. Well, how much did I owe from March? I got to look back to the problem description, and it says we had an account payable entering this question of $300. So it's saying we paid off this old account payable. Okay. First question, I'll always ask this, did cash change hands? The answer, yes. Is our company's cash going up or down? Our company's cash is decreasing, right? We paid. So cash is an asset. It is decreasing. Let's credit cash. So I credit cash for $300. And the debit, as you might guess, is accounts payable. Why are we debiting accounts payable though? Because you can just figure it out looking at, well, it's a credit to cash. I got to debit something. But why does debiting accounts payable make sense here? Well, accounts payable is a liability. It says, I owe you money. Well, if I pay you, I don't owe you money anymore. We have to reduce our liability. How do I reduce a liability? I debit it. So I debit AP by $300. And April 1st is in the bag. We'll go more quickly from here. Paid $3,000 advertising for advertising for the month of April. So we paid some advertiser to advertise our business. Paid is a key word here. Did cash change hands? Paid. Yes, of course. Our asset, cash, is going down. We need to credit cash. The debit related to advertising. What do you suppose that would be? Well, it's an expense. Debit advertising expense by $3,000. That's good news because we always debit expenses. And we're on to April 4th. And just keeping something in mind here. I've mentioned this a few times through the videos. You want to have a good journal entry, a date. Well, I did the date in advance, but you should be dating every journal entry. An amount debited, an account debited, and an account credit and amount, and the amounts need to be equal. You can have more than one debit, more than one credit, but the amounts need to be equal. And the last thing is a description. But in my class, I don't require students to write a description because this is the description of what happened. It's given in these questions. Okay, let's continue to April 4th. Purchased supplies on account. Okay, did cash change hands? No. So when cash didn't change hands, I think, well, what did I do? What did I buy? In this case, I bought some supplies. In our class, supplies will always be treated as an asset initially. Again, some classes, it might be treated as an expense. Our class, we consider supplies an asset that we'll use up over time. So we bought an asset, supplies. Our supplies are going up. We have more supplies today than we had yesterday. So let's debit our supplies asset for $1,000. What's the credit? Well, not cash. If we buy something on account, the liability is going up. I owe my supplier more money today than yesterday, so I credit the liability related to this, and the liability is AP, accounts payable. I bought something on account. Collected the $1,500 receivable from March. If we look back to the question, we will see we had receivables of $1,500. Now it's saying we collected that $1,500 receivable. So did cash change hands? Yep, cash is an asset. It's going up. We debit cash. The credit here, well, it's a receivable we collected. Receivables are also an asset. When somebody owes us money in the future, that is an asset. Well, they don't owe us money anymore. So we have to get rid of that receivable. That's an asset going down. The AR is going down, so we credit accounts receivable to reduce that asset to zero, to bring that AR down to nothing. April 8th, received but did not pay a $250 electricity bill. Did cash change hands? No. What is an electricity bill generally going to be? A cost, an expense. So our debit is an expense related to electricity. You could call it electricity expense. I would be tempted to call it utilities expense. So that's what we'll call it here. $250. If I got a bill that I didn't pay, unpaid bills are payables. And the most common is accounts payable. And before I had the bill, I didn't owe the electric company, or I hadn't recorded that I owed the electric company $250. Now I got to say, oh, I owe these guys $250. Credit AP, credit accounts payable, $250. An employee who was short on money borrowed $500. He signed a note and promised to repay the company after payday. He's a good employee, and the company chose not to charge him any interest or fees. Well, this is interesting, sort of a paragraph where our previous journal entries had just been sentences. Did any money change hands? Yes. Our employee borrowed $500 of money from us, so it's our cash. Cash is an asset, and our cash is going down. We're giving the guy money or loaning him money, so let's credit cash for $500. What do you suppose the debit should be? And there's a few options here in terms of language. This is, I think, broadly a note receivable or an employee loan receivable. I think either one of those is fine. I think because it says he signed a note, I'm going to call it a note. Notes receivable, but I actually think employee loan receivable is also totally appropriate here. It's a special situation. You might even create a new account just for this one thing because it's a weird circumstance. There we go. April 15th, we pay our employees' salaries, a very normal journal entry for us. Paid salary, so paid $4,000. Cash is, of course, an asset, and it is going down, so we credit cash. Our debit here, well, is salaries. And what are salaries typically? An expense. So we debit salaries, expense, and we credit cash for $4,000. Let's continue. The employee was a person of their word. After payday, they gave us back the $500 they owed. Terrific. Is cash changing hands? Yes. Is our cash going up or down? It's going up. We have an asset. It's going up. So let's debit that cash. And what's the credit here? Well, if we called it employee loan receivable, we would credit employee loan receivable. This is a note receivable. So we rip up that piece of paper. He gave us a piece of paper saying, I, Joe Smith, promised to pay you $500 back. Well, they paid us back, so we rip up the paper. They don't owe us the money anymore. So let's rip up that note receivable. That's an asset. We want to make it go to zero. So to make an asset go down, you credit the asset by $500. April the 20th, borrowed $10,000 from the bank with the intention of purchasing new computers. Again, intention does not matter here. What happened, right? I went to the restaurant. I thought I was going to buy a salad. I ended up buying a poutine, Canadian French fries covered in gravy and cheese. I don't get to say, well, but I had the intention of buying a salad, therefore I bought a salad. No, who cares about the intention? We borrowed money from the bank, $10,000. Did cash change hands? The answer is yes, cash change hands. Is our cash going up or down? It's going up. We borrowed cash. So cash asset goes up by $10,000. Debit cash, $10,000. What's the credit here? Well, you borrowed from the bank. I would suggest this is a bank loan payable, a bank loan situation. A bank loan, what is it in the categories? Asset, liability, shareholders' equity, revenue, expense, or dividend. Of course, it's I was just about to say asset. It's a liability you owe on a bank loan. So it's a liability, and we owe the bank more today than we did yesterday. We're going to credit that liability to make it go up. Credit bank loan payable for $10,000. April 21st, we did use the money to buy new computers, but not all of it. $8,500 to buy new computers. Let's assume cash. I'll probably write that into the question here. Purchase new computers for $8,500 cash. Did cash change hands? Yes. Is our cash going up or down? It's going down. Our cash is decreasing. Cash is an asset. It's decreasing. We credit cash. What about the other side of this? Well, we got computers for our cash. Let's debit computers. Some people might call this equipment, and computers are an asset. They're going up, right? Some people might call it equipment. I think computers is fine. Separate it from equipment. $8,500. April the 24th, received and paid the telephone bill. $150. Did cash change hands? Yes. Is cash going up or down? Down. Cash is an asset, going down. We credit cash. The debit related to a telephone bill is telephone expense. $150. Beautiful. Next. Paid employee salaries. Well, this one's dead simple. We've done it before. We paid salary, so we credit cash. Cash, an asset going down. Credit cash. $4,000. And what are salaries? They're an expense. Debit salaries. Expense. $4,000. Next. Paid the electricity bill that we received on April 8th. That I can't remember. I got to scroll up. April 8th, utilities expense. There we go. $250. Okay, so we got the bill. We didn't pay. A couple of weeks later, we pay it for $250. Did cash change hands? You bet. Is our cash going up or down when we pay a bill? Our cash is going down. It's an asset decreasing. We credit cash. $250. The debit when you pay off a bill that has already been recorded, right? We already recorded the bill. It's not utilities expense. We don't want to double count it. It's debit to AP. That amount is no longer payable. We are reducing our liability to the electric company. It was $250. Now it's dropping by $250 down to $0. April 30th. Billed $18,000 for the month of tutoring service, collected $16,000, awaiting payment on the remainder. This is kind of an unrealistic transaction. I'll explain why in a moment. This is sort of a summary transaction. So during the month, we tutored, let's just say we have 180 students. They each pay $100, maybe they get a couple of hours of tutoring service a month, and 180 divided by 100, 180 times 100 is $18,000. So we bill them $18,000, we collect $16,000, we're waiting for payment on the rest. Let's just do the journal entry and I'll explain kind of how this would really work. Collected $16,000 in cash. Cash is going up, so it's an asset going up. Debit cash. $16,000. I'm going to leave room for another debit. If I billed $18,000 for tutoring service, why did I do that? Presumably because I did the work. this is a tutoring company doing what it does to earn revenue. And even though I wasn't paid for everything, I earned $18,000. So I'm going to leave room for another debit. I'm going to credit tutoring rev for $18,000. So I billed and earned $18,000. I collected $16,000. What's the other two? The other two is receivable. I'm owed $2,000. Receivable asset goes up, debit AR by $2,000. So we've done the journal entry. Let me explain this one quickly, why it's unrealistic. Realistically, let's just say we had a client come in for tutoring, and let's just say it's $100 a session, right? 2-hour session, $50 an hour, something like this. I would go, each client, debit cash, credit tutoring rev for $100. And then some small percentage of the clients don't pay, and for them I would go debit AR, credit tutoring rev, $100, or however the system works. And I would do that same journal entry like 100 times, 180 to every customer that comes in. So why is this a bit unrealistic? Well, in the question, I don't want you to do the same journal entry, this one 160 times, this one 20 times. That gets us up to our 16,000 in cash and 2,000 in AR. We just summarize it into one step. So, there's AR being, collected through the period as well. And there's just steps being kind of skipped in this summary. And the reason is I don't want you doing hundreds of journal entries as this company would do. So there you go. We've done all of our journal entries through April 30th. As always, if you make it to the end, don't be shy about hitting those buttons. It really does help me. I appreciate your being here. In the next part of the video, we'll do a trial balance. Stay with me. See you soon. Welcome back. We've been working through problem 2.4a. In our previous video, we worked through all of these journal entries. Now we're going to post the journal entries into T accounts. And to do it, we actually have to post our opening balances into T accounts as well. Let's just read through that first paragraph again. Teacher's pet tutoring service provides extra help to students. Company has been operating successfully for several years and has the following account balances entering April. They have cash of $8,000, accounts receivable $1,500, supplies of $5,000. They've got computers $15,000, accounts payable $300, bank loan payable $3,500, common shares, and retained earnings. So when we begin to post these journal entries, and I've sort of summarized them here in this long list, before we can start to move journal entries into T accounts, we have to make T accounts for these opening balances. So I got 1, 2, 3, 4, 5, 6, 7. I got to make 8 T accounts before I can begin moving my journal entries over, because I have to enter the opening balances into T accounts. So the way I encourage my students to do this is to have separate sections on their piece of paper. So this will be a section for assets, and I'm leaving some blank space over to the right here. I'll leave a lot of room here. Be liabilities, then shareholders equity, and then I'll just put revenues and expenses down here. I'll put revenues first, right? So this will be my tutoring revenue when we get there. I know I only had the one revenue, so I'll just reserve a spot for tutoring revenue. Okay, so I need to open T accounts for those 8 accounts that I had underlined there. Let's start with cash. Cash is always going to be a big T. So again, this is what a T account looks like. You just draw a big T. You write the word of the account on top, cash. AR can be smaller, so let's just make a smaller T for AR. Accounts receivable. Supplies can also be sort of half-sized here, supplies. Cash is extra long because there's lots of debits and credits running through cash. Next, we got computers. And I guess I should be putting in my account balances as well. So let's do that as we go here. Cash, they said, was $8,000. Now, cash is an asset. To make an asset go up, it takes a debit. So if we have a positive cash balance, it is a debit cash balance. Accounts receivable is an asset, so debit side. Supplies, an asset, debit. Computers, an asset, debit. Now, as we move on to our liabilities, I think you'll predict that they're going to go on the credit side. And we got accounts payable, 300, and it's a credit account. And we got a bank loan. And of course, that is also a credit. Now, again, it's going to depend on your professor, how they want you to lay this out on a page. I am not particular. I just encourage students to group assets, liabilities, equity accounts together because it's going to be helpful for the next step, the trial balance. Common shares and retained earnings, both credit accounts, both equity accounts. Common shares, retained earnings, boom, and the amounts were 50 and 2560, both in credits. 50, 25, 6, 20, what was it? 25, 650, 25, 650. Now, something you should do, if this is all of our opening balances, before I move in my journal entries, I should just double check to make sure debits equal credits, because at the end of this, debits need to be equal to credits. And if you look at every journal entry, debits equals credits, the whole way down that list, debits equals credits. Well, if I start from a point where my debits and credits aren't equal, I'm screwed, right? I've screwed up somehow. I don't mean to be so vulgar, but we are in trouble. So let me add up the debits. 8,000 plus 1,500 plus 5,000 plus 15,000. Okay, so my total debits 29,500. Remember that number, 29,500. Total credits 300 in AP, 3,500 plus 50. Plus 25, 650, 29,500. Debits equal credits. We are safe to continue. If your debits don't equal credits, probably you just put something on the wrong side. You put something in the credit side that should have been in the debit, or vice versa. Once we've done that, the table is set to enter our journal entries into these T accounts. So let's start with debit AP, credit cash. Debit AP, 300. I'm just doing the journal entries. Credit cash, 300. Next, debit advertising expense, credit cash, 3,000. All right, I'll make a new T for advertising expense. And the amount was 3,000. And we're going to credit cash, 3,000. Debit supplies, credit AP, 1,000. Debit supplies, 1,000. Credit accounts payable, 1,000. Debit cash credit AR 1,500, debit cash 1,500, credit accounts receivable 1,500. Debit utilities expense credit AP 250. Need a new T. Debit utilities expense 250, credit accounts payable, where are you? 250. Debit notes receivable credit cash 500. All right, I need a new T. Now, again, I note that this note receivable is a current asset. So if I were listing this into my trial balance, I'd list this before computers, even though I'm writing it after. You'd like to have them in the right order, but I missed there. Debit notes receivable, credit cash, 500. And it's not the end of the world. Like I said, I'm not picky with T accounts. With the trial balance, I'll get pickier. Debit salaries expense, credit cash, 4,000. Need a new T for that. Debit salaries expense, 4,000. Credit cash, 4,000. Next, debit cash credit notes receivable, 500. Okay, so there's notes receivable, credit 500, cash debit 500. Next, debit cash credit bank loan payable, 10K. Debit cash, 10. Credit bank loan, 10. We're off to the races here. Debit computers credit cash, 8,500. Debit our computers, credit our cash, 8,500. And next, debit telephone expense credit cash, 150. Need a new T for telephone expense. It was 150, I think. Yeah, 150. And we credit cash. 150. Next. That was telephone expense. Salaries expense, cash, 4,000. Debit, salaries expense, credit cash, 4,000. Debit AP, credit cash, 250. That's our next one. Debit AP, credit cash, 250. 250. And our last one, debit cash, debit AR, credit tutoring revenue. Cash is 16,000. AR is 2,000. And tutoring revenue is 18,000. And at this point, I've done a beautiful job setting up my T accounts. Let me move this over so I can have this isolated on screen. And we can talk about, maybe I should have done this in thicker ink. Let's see if this looks better or worse. I'm going to right click, pen properties, thicker. How's that? It's borderline. I think it's better overall. I'll go with the thicker pen. Okay, so we need totals. So let's go down to our telephone expense. On our telephone expense, the total is just 150. I don't have to do any work. Salary expense, 4 plus 4 is 8. If you have 2 on the debit side, you just add them. If you have 2 on the credit side, you just add them. This is a total. I don't need to do anything. Utilities, advertising, that's total. Tutoring revenue, it's fine. Common shares retained earnings, those were unadjusted. Let's do the bank loan. I have 2 credits, so a $10,000 credit and a $3,000 credit make a $13,000 credit. Onto AP. Now, if you have debits and credits, you add up both sides, take the big side minus the small side. So I have 1,550 on the credit side. I have 550 on the debit side. And I just take the big one minus the small one. And I get, of course, 1,550 minus 550. It's 1,000. Now, if you want to, you can definitely just look at this and go, well, this one cancels this one cancels this one, and I've got 1,000. And I think that's totally fine. It's not going to work for every T account, but it certainly does work a lot on payables and receivables. Next, sorry, I kind of shouted next. Notes receivable, 500 minus 500 is 0. Computers, 15 and 8, it's 23,500. 5 plus 1 is 6 for supplies. All right, so 3,500 on the left, 1,500 on the right. Take the big one, 3,500 minus the small one, 1,500. We're left with 2,000. And last but not least, we got to figure out what's left in our cash account. So I'm going to add up the left side, I'll add up the right side, and then we will make a determination here. 8,000 plus 1,500 plus 500 plus 10,000 plus 16,000. It's 36,000. That's debits. I'm doing this in blue ink because you wouldn't typically write this, right? You just do it in your calculator, but I want to show you what I'm doing. 300 plus 3,000 plus 500 plus 4,000 plus 8,500 plus 150 plus 4,000 plus 250 is 20,700. So I just take the big side, 36,000, minus the smaller side, 20,700. Whatever side's bigger minus whatever side's smaller. 36,000 minus 20,700. The big side gets the balance. It's 15,300. Okay, and at that point, we have done it. This is all of our T accounts laid out. In the next part of our video, we're going to move from T accounts to the trial balance. So I hope you'll stay tuned for that. And on your way out, I hope you'll hit one of those buttons for me. Thanks for watching. Have a great day. I'll see you in the next video. Bye-bye. Welcome back. We've been working through problem 24A. In part 1, we prepared a lot of journal entries based on the transactions above. In part 2, we moved those journal entries and opened new T accounts for them. We posted from journal entries to T accounts. The final part, that's this part, we're going to prepare a trial balance. Now, you'll recall a trial balance is a list of all of our accounts, and it's important to list them in the following order. We'll go assets, then liabilities, then equity accounts, then revenues and expenses and dividends if we have them. But we'll start with our assets. Now, the good thing about the trial balance from a student perspective is it doesn't have these complicated subtotals, income before tax or total current assets. You just list everything and say whether it's a debit or credit. And the idea is, in the old times when you'd move journal entries to T accounts over to the trial balance, people would make mistakes. And so the trial was you're trying it out, balance to see if it's going to balance. These days, it's just nice to have all the accounts on one sheet, but it harkens back to the old days of accounting where you literally were like, does this still balance? I'm not sure. Now a computer can tell us in 2 seconds if it's balanced. Okay, so let's go ahead and prepare it. We'll start with a 3-line title, name of our company, teacher's pet, tutoring service, name of the statement we're being asked to make. This is a trial balance. And trial balances are just dated, and they're dated the month end date or the whatever, the last date relevant is. And this is April 30th. And if you need a year in our workbook, everything's going to be 2029 in this workbook. Okay, so remember with a trial balance, there's just 2 headings. 1, DR for debit accounts, and 2, CR for accounts that ended in a credit. We just work our way down the list. So we've got cash, $15,300, debit, of course, AR, $2,000 debit. I'm going to try to make these all fit in my grid. There's a reason I have graph paper. I should use it. Supplies, $6,000 debit. Notes receivable would come next. We want to be in balance sheet order. Now, I note that the notes are 0. They would typically, you would find 0 balances on trial balances, maybe not in financial statements, but in trial balances, because it just indicates the account is in use. And certainly this account was used this month. Computers, $23,500. We will spend quite a bit of time next chapter talking about why net is attached to that. Accounts payable. Now, everything so far has been a debit. Here's our first credit. Accounts payable is a credit of $1,000. We expect assets to be debits. We expect liabilities and equity accounts to be credits, generally speaking. Our bank loan payable is a credit of $13,500. We got common shares and retained earnings. Common shares are 50. Retained earnings $25,650. And now on to revenues and expenses. Tutoring rev. We're still in the credits here. Tutoring rev, 18,000 credit. And then we got a bunch of expenses. Advertising expense, 3,000 debit. Utilities expense, $250 debit. Salaries expense, 8,000 debit. And telephone expense, 150 debit. So summing these all up, we'll see if our trial balance is in balance. Let me move this to a fresh part of the page just to give us a little real estate to work with. There we go. That looks beautiful. Okay, so we just need totals, right? We want to make sure our total debits equals our total credits. That'll mean our financial statements will be in balance when we at last prepare them. It also means we didn't make any errors in transferring the accounts. We might have screwed up a journal entry. We didn't, but you might have. You could still balance if you screwed up a journal entry, but it's a good error catching mechanism. Let's add them up. 15,300 plus 2,000 plus 6,000 plus 23,500 plus 3 plus 250 plus 8,000 plus 150. I get 58,200 on the debit side of the ledger. On the credit side, it's 1,000 plus 13,500 plus 50 plus 25,650 plus 18,000. I get 58,200 on the credit side of the ledger. A very good sign. My trial balance is in balance. I double underline both the bottom lines. I put dollar signs at the top of each column. I put dollar signs beside anything that's double underlined. And there I have it, a beautiful trial balance. You wouldn't provide this to shareholders of a company, but insiders of the company do look at the trial balance all the time. It's a useful document to know what it is and to know how to prepare it. And I hope you know how to prepare it now. Thank you so much for watching. Stay tuned for the next video and hit me with one of those thumbs or subs if you liked it. Thanks a lot. Have a great day. Goodbye. Welcome to Module 3 of our course in financial accounting. This is the hardest module so far. In my first midterm of my class, this is the #1 subject that students struggle on: adjusting journal entries. It takes what we learned last chapter in Module 2 on journal entries, and it just cranks up the difficulty a little bit. So let's jump into it. Here is an example of a typical journal entry, not an adjusting journal entry. We'll get to that in a minute, but a typical journal entry from chapter 2. It's January 1st. So this is a transaction. I buy a car for $20,000 cash, right? That's what's happening here. And you'll recall this table. If you don't remember how it works, go back and review chapter 2, but we've got to do a journal entry. So let's start with the car. I would say, okay, I got a car. What is a car? Well, a car is an asset, and we have more cars today than we had yesterday. So I'm going to, on January 1st, debit, credit. I'm going to debit my car. So debit my car asset by $20,000. And what's the other side of this? Well, my cash, that's also an asset. So it's still an asset, but my cash asset is falling, right? It's going down. And so in journal entry parlance, that means we've got to credit cash. All right, so you're probably looking at this transaction going, that was pretty straightforward, especially if you hung in there for chapter 2. You might be saying that's a beautiful drawing of a car. It is, thank you. But you're also saying, okay, this is pretty straightforward. Where's this tricky business of adjusting journal entries come in? And here's where it comes in. So we drive the car for the year, right? We buy a car. There's actual things happening in the world. We're driving the car. We're using the car for work. We're making good use of our new piece of equipment, the car. The year goes by and we go, it's time to prepare a balance sheet. So it's December 31st. We make a balance sheet for our company. We list our assets, our cash, AR supplies, our current assets. And then we go to list our long-term assets. And we've got this car asset. And it's a $20,000 car. Now remember, we're trying to communicate the value of this car on December 31st. The car, and I don't think anyone would dispute this, on January 1st, a year ago, it was worth $20,000 because that's what I paid for it. It's December 31st now. I'm preparing a balance sheet. I don't think it's fair to say that my car is still worth $20,000. I've been driving it. It's experienced wear and tear. There's mileage on the car that I'm putting on the car. This car should clearly be worth something less than $20,000. So that's where adjusting journal entries come in. A transaction is, oh, I bought something for cash. There's a receipt. Some financial event happened. An adjusting journal entry is, I'm about to prepare financial statements. I list all my assets and liabilities, and I look at them and I go, something's not quite right here. Something's missing, something's wrong. And in this case, my car's not worth $20,000. So this chapter, we're going to learn how to calculate those adjustments. We obviously want to adjust the value of the car downwards. How do you do it? Well, there's a little bit of a math puzzle in front of every one of these adjusting journal entries. And the best way to learn how to do this stuff is by doing examples. So we would call this, the fact that the car's losing value over time, we would call it a depreciation adjustment. We'll learn depreciation adjustments. We'll also learn 4 other types of adjustments. Rather than introducing them all in this video, though, I think it's best to do it by doing an example. Problem 3.1a. I don't do this in many of my intro problems. You should work through problem 3.1a with me, and we'll introduce all 5 types of adjusting journal entries. I'm going to link it. It's going to be, I don't know how YouTube works, so this is my first time doing this. Hopefully a box pops up in the middle of your screen saying, here's 3.1a. We'll go through all the types of adjustments. Thanks for watching, and work through examples. If you want to survive adjusting journal entries, do lots of examples. Bye-bye. Let's take a look at problem 3.1a. This problem goes over 5 different types of adjusting journal entries. When I test on this topic, and when I test on many other topics, on midterm 1 of my intro financial accounting class, this is the topic students lose the most marks on. So if you practice along with me, hopefully you don't lose marks like many of my students do. This problem explores 5 common types of adjusting journal entries. All problems relate to ABC Company, which has a December 31st fiscal year end. Now remember what an adjusting journal entry is. We're getting ready to prepare financial statements on a fiscal year end or a month end, and we're saying, are these accounts all up to date? Do any of them need updating? And that's what we'll look at. So the first example, and it's one you'll find in every course, is something called prepaid expenses. And it's a funny name, prepaid expenses, because prepaid expenses are not expenses at all. Prepaid expenses are assets. And the most common example you'll find is insurance. If you think of insurance, you have to buy the insurance in advance before you use it. So if I buy a year's worth of insurance, and I do, like for my car and my house, I buy a year of insurance a year at a time, and I buy it for next year, right? You buy it a year ahead of time. Well, this actually has the characteristics of an asset. It's something you own and control that's going to give you a benefit in the future. That is an asset. So dealing with this can be a little bit tricky. Let's read the problem and see how we do. ABC Company purchases a 1-year insurance policy on June 1st, 2029 for $1,800 cash. The required says record the entry for the purchase of the insurance and for the year-end adjustment. Okay, so just setting up here my DRCR headings. CR was pretty ugly. Let's try it again. DR was ugly too. Let's try that again too. Oh, much better. Okay, so we got to record a journal entry for the purchase of the insurance on June 1st. This is a transaction. This is not an adjusting journal entry. We just bought some stuff, essentially. So did cash change hands? Yes. Is our cash going up or down? It's going down, so we credit cash. Now, if my saying that was like, you have no idea why I'm crediting cash, you should be reviewing chapter 2. Right, that should have just been second nature to you. So go back to watch my chapter 2 videos, my journal entry bootcamp videos, if you're feeling shaky on this entry. The debit here is, well, we bought an insurance policy. And the knee-jerk reaction, if you didn't know better, would be to say, well, that's insurance is a cost. This is debit insurance expense. But we've just said, actually, insurance is special because we buy it before we get to use it. It actually has the characteristics of an asset. And the name of our insurance asset in accounting is prepaid insurance. And the date, or not the date, the amount is $1,800. The date is June 1st, 2029. Okay, we've done a beautiful job, and this wasn't asked for, but just to keep track of things, just to help me in this conversation about prepaid insurance, I would say, okay, we've got this prepaid insurance asset worth $1,800, right? That's the T account for insurance. I have an $1,800 insurance policy. Great. Months go by, and now I'm getting ready to prepare financial statements on December 31st, 2029. And so it says record the journal entry for the purchase of insurance. We did that. Now it says record the year-end adjustment. What we have to say to ourselves is our insurance policy still worth $1,800? And the answer is, of course not, right? If you bought a one-year insurance policy in June, it was worth $1,800 in June, a lot of that insurance has expired. So the question we need to answer is, how much, put a dollar figure on it, how much insurance has now expired? Here's the math. You say, okay, it's an $1,800 insurance policy for a year, and how many months have gone by since June? So count June, because it's June 1st. So June, July, August, September, October, November, December. 7 months of our insurance policy has expired. So you go 1,800, and now we say 7/12, because it's a 12-month insurance policy. It's a one-year insurance policy. 7/12 of that insurance policy has now expired. 1,800 times 7/12 is... Oh, my calculator is doing crazy things right now. There we go. 1,800 times 7 divided by 12, 1,050. All right, so we would say $1,050 worth of insurance has expired. So the journal entry: debit insurance expense to record the fact that the insurance has expired, right? We've used up $1,050 worth of insurance. That's what we're saying here. And the credit is to prepaid insurance. We're saying we have less insurance. Like our insurance asset has fallen as time's gone on and we've had that insurance coverage. So we credit prepaid insurance. Okay, so that is an insurance adjustment. We buy some insurance. It's an asset. And then at year end, we have to say how much of this insurance has expired. And what makes it an adjustment is the insurance broker is not calling us saying, hey, just so you know, 7 months of insurance has expired. You have only 5 months remaining. The accountant has to say, wait a second, I'm showing an $1,800 insurance asset. I need to make an adjustment. So this one's a transaction, right? You get a receipt, you go to the insurance company. There's a financial event there. This one, there's not really a financial event other than I'm preparing financial statements. I'm going, does anything fallen out of date? And the answer would be, yeah, I don't have $1,800 worth of insurance. By the way, how much insurance do we have left? Well, if we go, we bought $1,800 of insurance. We've used up $1,050. We have $750 of insurance left. And that's how this T account would work, right? $1,800 of insurance. We credit it for $1,050. That's what we did in this entry. We have $750 left. And that should make sense, right? $1,800 and we have 5/12 of our insurance left. We use 7/12, so times 5/12. That's $750 worth of insurance left. So that's the number that's going to appear on the balance sheet. We're going to tell shareholders we have $750 of insurance because that's exactly what we have. Okay, so that is our first adjusting journal entry. Let's keep going. Depreciation is a type of prepaid. It's an asset you buy and you use up over time. Just like with our insurance, we bought some insurance, we used it up over time. Depreciation is a special type of prepaid. So, ABC Company purchases a vehicle on August 31st, 2029 for $36,000 cash. The vehicle is expected to have a useful life of 10 years, after which time it will have no residual value. So that means there's no value left over. We're not going to sell it off. The company wants to use straight line depreciation. That's good. That's the only type we're going to learn in Module 3. It says, do the journal entry for the purchase of the vehicle and for the year-end adjustment. Okay, so let's buy a vehicle for $36,000 cash on August 31st, 2029. Did I date my other entry? I did. Okay. So we're going to debit vehicle because we bought a vehicle. That's an asset. It is increasing. Debit an asset to make it go up. $36,000. And what did we buy it for? If we bought it on account, we would credit accounts payable. If we bought it with a car loan, we would credit car loan payable. We bought it for cash. So our cash asset is falling. We credit cash. $36,000. Now, the year goes by. It's December 31st. We have to say to ourselves, is this vehicle still worth $36,000? Because that's what we're faced with, right? Looking at the T account for the vehicle, it would be showing $36,000. We've got to say, no, our vehicle will have been used. It will have lost some value. We need to adjust down the value of the vehicle. The question then is, by how much? And this is where a little math puzzle plays out. We have a $36,000 car. It's going to be useful for 10 years, so that means $3,600 per year is what we estimate our vehicle loses in value. Now, this is an estimate of an accountant in an accountant's office, and let's be clear, it's a guess. Is the car going to last 10 years, or is it going to last 8 years, or 12? And is, losing at a rate of $3,600 a year every year reasonable? For many assets it is, but sometimes the accountant's going to be off, but this is the accountant's best guess. The accountant's saying, I think this asset's going to drop in value at a rate of $3,600 a year. That is what is called straight line depreciation. We'll learn other depreciation methods in like chapter 8. Well, from August to December, is it a year? And the answer is no. Now, when we're counting months, we don't count August because this is on August 31st. So we start counting in September, right? Because August 31st, you don't count the month of August as a month it was depreciating. You didn't own it in August. You owned it at the end of August. So start in September. September, October, November, December is 4 months. 4 months. So we need to record 4/12 of a year of depreciation. It was $3,600 a year. 4/12 of that is $1,200. Here's our journal entry. Debit. Depreciation expense, the expense related to depreciation, just like insurance expense was the expense related to prepaid insurance. The expense related to an asset losing value over time, a long-term asset, they call it a depreciable asset losing value over time, is called depreciation expense. It's $1,200. Our assets lost value. So our vehicle has lost $1,200 in value. So of course we credit our, I hope you didn't say vehicle. I led you into that one. We don't credit the vehicle, which is very interesting. You might think your intuition should be telling you, no, my vehicle lost value. I credit an asset to make it go down. We have a special account to keep track of the accountant's estimate for the loss in value of an asset, and that is this account called accumulated depreciation vehicle, right? So you'd say accumulated depreciation and whatever the asset is, and that's what we credit. Now, you might be saying to yourself, why don't I just credit the vehicle directly? And the answer is, this number is so flawed, this accumulated depreciation, and it's flawed because it's based on an accountant's guess about the future. The accountant's predicting this thing's going to be useful for 10 years. Well, who says 10? Why not 12? Why not 15? And so because it's such a flawed guess, an estimate, we track it in a different account. And so at the end of the year, when we're presenting to our shareholders, and you have learned this in chapter 1, we say our vehicle is on our books for $36,000. Our accumulated depreciation on that vehicle is $1,200. Accumulated depreciation is a credit. The vehicle is a debit. And therefore, our vehicle's net book value, our vehicle net of depreciation is 36 minus 1, $34,800. Now, we keep these two separate because this $36,000, it's a real number. It's what I paid for the car. This $1,200 is the accountant going, well, it's a year older. I guess I've lost $1,200. It's a bit of a like shaky number, and therefore it gets its own account. If we credit the vehicle directly, it's different, right? So as a financial statement user, you can sort of say, this is a real number. This one, maybe take it with a grain of salt. I follow AI and that type of stuff, it's technology. And a lot of the AI companies are debating how many years should they depreciate their GPU. And if one company says, well, I think one of these fancy NVIDIA GPUs that they use in data centers lasts 3 years, and a different company doing the exact same business says, I think it lasts 5 years, they come up with totally different depreciations that can be billions of dollars apart. And as a financial statement user, you've got to be sophisticated enough to go, oh, well, they use this depreciation, they use that. And how can I figure that out? Well, I have to look at the accumulated depreciation of both companies that bought their GPUs around the same time. And one goes one direction, one goes another. So in any event, the journal entry to buy an asset, very straightforward. Debit the asset, credit the either cash or bank loan or accounts payable. Then when you depreciate the asset, it's always the same journal entry. Debit depreciation expense, credit accumulated depreciation. There we have it. We've done part B. Let's continue. Part C, accrued expenses. So we're going to do accrued expenses and accrued revenues next. Accrued expenses are expenses that are building up over time, but the money hasn't changed hands yet. They haven't been paid. So accrued means building up. It's accruing. It's adding up. When I think of accrued expenses, I always think of like my air conditioning bill in the summer. So it'll be like July 15th. And my city gets very hot. It goes over 100, 110 degrees Fahrenheit, like 40 plus degrees Celsius. And my wife really cranks the air conditioner. And around July 15th, I'll start to go, my vein will burst in my head. You'll see a vein just popping out there. And because I'll be thinking, oh no, at the end of this month, I'm going to have a really big bill. I'm going to owe a lot of money. My air conditioning bill is building up over time, and I know it's going to be a big one, and I haven't paid it yet. Well, an accrued expense is an expense that's building up for the company, but they haven't paid it yet. And in fact, they haven't recorded it yet. We've got to record it. So a common example is interest, right? We've borrowed some money. There's interest clock ticking. Interest is building up and it's gone unpaid. We've got to say, well, how much interest is unpaid here? On May 1st, 2029, ABC Company borrows $10,000 and signs a note payable. The debt carries annual interest of 6% and is repaid in full with interest on July 1st, 2030. It says record the journal entry for the borrowing, the year-end adjustment, and the repayment of the debt. Okay, so when you borrow money, that's a transaction. We just borrow $10,000, signed a note payable. Let's do that. May 1st, 2029, we borrow some money. So did cash change hands? Yep. Our cash is going up. We debit cash for $10,000. The credit is, well, note payable. It's a liability. It's also increasing. We credit notes or note payable. $10,000. Okay, so now we got to say, what's going on December 31st, 2029? And the answer is not much, right? I'm not repaying the person. They're not calling me saying, hey, where's my money? Nothing happens. But I have to, as the accountant, go, oh, but wait, I've got this money I've borrowed. I'm going to have to pay back with interest. And that interest clock is ticking from day one. How much interest has built up unpaid? That's the adjustment. Again, this May 1st is just a transaction. December 31st is like an adjustment. There's nothing happening that day other than financial statements going out and New Year's celebrations. But there's nothing happening in terms of accounting, but we have to go, oh, it's a financial statement date. I need to adjust up for the interest that's been built in that I haven't recorded yet. Unrecorded interest. So how much unrecorded interest is there? Well, it's a $10,000 note. It accrues interest at a rate of 6% per year. 10,000 times 0.06, that's $600 per year. And we've borrowed this money from May to December. Count May because it's May 1st. So May, June, July, August, September, October, November, December. That's 8 months. So I go, well, it's 8/12ths. Now, sometimes a student looks at this and goes, well, wait, this note is from May to July. It's not a year. Why do I do a year's worth of interest? When you get an interest rate, assume it is annual. So this is 12 months worth of interest is 6%. Got nothing to do with the length of the note. We could have a 3-month note that has 6% annual interest, and you don't have to, do anything tricky there. So again, the annual interest means we accrue interest at a rate of $600 a year. We've had the note out for 8 months, so 600 times 8 divided by 12, $400 worth of interest. Our journal entry, the expense related to interest, expense, $400. The credit is, well, it's a liability related to interest. Now, this is not an account payable. That would be a very common liability. We want to credit interest payable. So this is one of those payables that gets its own name, interest payable. This is not a normal day-to-day business like a phone bill type thing. This is something different, and so it's tracked differently. Okay, so that brings us up to December 31st. It also asks for the repayment of the debt. So the easiest way to do this, and we will do it the easier way, is to say how much more interest accrues up to July 1st. So we went from May to December. We said that was 8 months, and we set up 8 months worth of interest. How many months from December to July, December 31st to July 1st, 2030? Well, we got January, February, March, April, May, June. Don't count July because the debt's not outstanding for July. So it's 6 more months gets us up to July. So on July 1st, 2030, again, it's a $10,000 note, pays 6% interest, or will be repaying 6% interest. That's $600 per year, and we need 6 more months of interest. We already did the first 8 months. We don't need to redo that. We need to do 6 months worth of interest, so that's $300. So let's accrue that interest, and then we'll pay it all back. You can do this in one step. I won't show you how to do that today, but in future videos I will. But let's just do this the easy way, which is to say how much new interest is there between December 31st, 2029 and July 1st, 2030? And the answer is $300. Debit interest expense, credit interest payable, $300. And finally, we got to pay them back. And how much do we pay them back? We pay them $10,000 plus $400 of interest for the first 8 months plus $300 for the second 6 months. $700 of interest in total. So on July 1st, 2030, I pay him back the full pull. I pay him back $10,700. 10,000 of it was the note that I borrowed. 700 is the interest that's accrued so far. So credit cash 10,700. Get rid of all the payables. How do I get rid of note payable? It was a credit of 10,000. To get rid of it, I debit notes payable. 10,000. I thought I'd give one too many zeros there. And then interest payable, I credited 400 and 300. Overall, I credited interest payable 700. I got to get rid of it. Debit interest payable 700. Okay, and there we have it. We've solved for the accrued interest. Moving on. Part D, accrued revenues. These are revenues that have been built up, but we haven't received payment for them yet. We're doing work, or sometimes you're earning interest if you loan somebody money, but we're doing work, presumably, for which we haven't been paid, right? And it's like, well, how much work have I done? How much do they owe me? That's what we got to figure out here. On December 15, 2029, ABC Company agreed to provide consulting services to a client at a rate of $3,000 per month, with the first payment expected on January 15th, 2030. As of December 31st, the company had done good work and the client was pleased. ABC Company completed the contract on January 15th and received $3,000 payment as agreed. Record the journal entry for the year-end adjustment and for the payment on January 15th. Okay, so December 15th, nothing happens. We agree to start doing work for somebody, but we haven't done any work. So no journal entry on December 15th. They didn't give us any money yet. December 31st, they still haven't given us any money, and we're not annoyed with them because we know we're getting paid in the middle of January, a couple weeks later. But on December 31st, we got to say, have we earned any of this money yet? And the answer is yeah. We've earned, the first half, essentially. If we're going December 15th to Jan 15th, whereas December 31st, it's right in the middle, right? We've earned half the money. You could count days. You go, it's 31 days, and we've earned 16 out of those 31 days, so slightly more than half, honestly. But I think most companies, you would just say, okay, half is a reasonable estimate here. If you wanted to do 16 31sts, you could say, I've earned 16 31st of the money. I think it's reasonable to say, we're at the halfway mark of our contract between December 15th and January 15th. So $3,000 times half, we've earned half the dough. $1,500 is what has been earned. Here's the journal entry. We debit accounts receivable. Just to say they owe me this money. I haven't billed them yet, but it's owed to me, $1,500, and I'm going to credit consulting revenue for $1,500. And sorry, just give some headings here, DRCR, and there we go. So I've earned $1,500 on this contract. Now, what happens next? It says, and for the payment on January 15th. Well, January 15th, again, we can do this a couple of ways. I'm going to do it the slow, steady way. I'm going to say, okay, well, let's record the next half of the contract, because obviously there's another, half a contract here. And I'm going to say debit AR 1,500, because I earned 1,500 more between December 31st and January 15th. Credit consulting rev 1,500. And then also on January 15th, we get paid. Debit cash. Now, how much do they pay? They pay the full amount. They give us $3,000, and we credit AR for $3,000. I'll show you the sort of shortcut here. You could condense this second entry into one. You could say this, rather than do these two entries, you could do this. You could say, okay, they're giving me $3,000 cash. Now, I haven't done this entry here, so ignoring that, I credit my AR that I had already set up, $1,500, and I credit consulting rev for the other $15 that I have since earned. This green entry is totally fine, but if you didn't understand that well, you could stick with the red, sort of do it in two steps. You're doing the exact same thing. You end up in the exact same spot. These are both equally correct, and they're equally beautiful. I love them all equally. Let's continue into our last one, unearned revenues. This is also called deferred revenue sometimes, but we'll use the phrase unearned revenues to refer to this. This happens, and this, by the way, just like the first one, we said prepaid expenses, not really an expense, it's more of a liability. Unearned revenues, not a revenue. Sorry, we said prepaid expenses were assets, pardon me. Unearned revenues are not a revenue, they are liabilities. And an unearned revenue happens when somebody pays you before you've done any work. And so you owe them, but you don't owe them money. You owe them a service or a product. I don't like liabilities as a rule in life. I love unearned revenues. This is my favorite liability because it means my client likes me enough. They think enough of me to give me money before I do anything. That's how much they value my service or product. A client prepays ABC Company on November 1st, 2029 for 5 months of consulting service for November through the end of March. The company pays $15,000. Let's just do some quick math here. $15,000 they give me for 5 months. That means it's $3,000 per month that they're paying here. ABC Company earns the money evenly over the life of the project and has fulfilled its obligations up to December 31st. It says, do the journal entry for November 1st. All right, so November 1st is a transaction. This is normal business. We'll receive some cash. It's, enters the accounting system very clearly. So they pay us $15,000. We debit cash, $15,000, and we credit unearned consulting revenue, unearned revenue. And this account, even though it says the word revenue in it, this is a liability. Make no mistake. This is a liability. It's an account that says, I owe these guys $15,000 worth of service, right? I have not delivered on my end of the promise. They've already delivered the money. I got to deliver my end and do some work. So as of December 31st, 2029, we look at this and we say, are any adjustments needed? And the question we got to answer is, well, have I earned any of the money? And the answer is, yeah. I've been working in November and I've been working in December. I'm working this thing off. I've done 2 months worth of work, right? I've done November, from November 1st to November 30th. I've done December 1st to the 31st. I've earned 2 months, and we've said this is $3,000 a month that I earn. So I've earned $6,000. How much do I owe? Well, I owe 3 more months. I owe for January, February, March. I owe 3 months of service. I owe $9,000 still, but I've earned $6,000. So the journal entry for having earned the $6,000 is, this is a weird entry. It looks weird anyway. You debit unearned consulting rev for $6,000. You can see my debits and credits are looking a little wonky here. Let me move. Oh, I can't. It's not dragging. Let's see. That's going to work. Move that one over. Move that one over. I have no idea why this thing's here. Debit unearned consulting revenue, $6,000. They say that is no longer unearned, right? I don't owe them those 2 months of service because I delivered. And we just credit consulting rev. And so again, this one looks weird because it looks like we're almost debiting and crediting the same account. This is a revenue account. This is a liability. So we're saying I paid off my liability by working, by earning the money. And we did earn the money. So just a quick peek at that T account for unearned consulting rev. We owed them $15,000 because they paid us in advance. And now we're saying, well, no, I did 2 months worth of work, so I've paid off the $6,000. That's a debit there. So where are we? Well, we still owe them $9,000, which is 3 more months of service, January, February, March. So as of December 31st, this is exactly where it should be. Okay, we've done our 5 adjusting journal entries. And just to recap, let me hide my calculator here. This table, my students find to be so useful, so I hope it's useful to you too. Let's go over them one more time at a high level. The first type of adjustment we learned was an adjustment for prepaid expenses. And what we said about these is they are not expenses at all. They're assets. Think about an insurance policy you buy. You get to use it over the course of the year. Well, when you first buy it, it is an asset. It's something you own and control that has value. And so when we buy the prepaid insurance, we debit the prepaid assets. Now, there's also, you could prepay rent or prepay a lease. Supplies is a common example of a prepaid expense here. So debit that prepaid asset, credit cash or accounts payable. And then over time, we decide or calculate how much of that asset has been used up, and we adjust it down at year end. So if I've used 6 months of a 12-month insurance policy, I need to adjust half the policy down, right? I need to reduce that asset's value on my financial statement. So I debit the expense and I credit the prepaid. So debit insurance expense, credit prepaid insurance, debit supplies expense, credit supplies, debit rent expense, credit prepaid rent, and so on. The second type of adjustment we learned was for depreciation. And what we said here is it requires a long-term depreciable asset. So at some point, the setup is you buy an asset, debit long-term asset, debit equipment, debit building, that type of thing, and credit cash or however we bought it, credit accounts payable if it was on account, or credit note payable if we had to take out a loan to buy the thing, but you got to buy an asset. Then at year end, you say, well, how much of this asset has been used up, right? You calculate the years and the months and you say, how much of this has been depreciated? The journal entry here is always the same. Debit, depreciation expense, credit, accumulated depreciation. So that is the second one we learned. The third type of adjustment we learned is for accrued expenses. And accrued means built up over time, but the money hasn't changed hands yet. So it's an expense that's been building, but we haven't paid the bill yet. So how does that work? Well, If it's an expense that's building that we haven't paid or recorded yet, you debit the expense. And since we haven't paid it, you credit the related payable. In the case of the question we just did, it's interest expense and interest payable. You will frequently see salaries expense and salaries payable as the accrued expense in your questions and in future questions in this workbook. Number 4 is accrued revenues. These are like expenses, except they're revenues. So revenues that have been building up over time, but the money hasn't changed hands yet. We haven't collected. So we've been earning, but our customer, our client, hasn't paid us yet. What does that create? That creates 9 times out of 10 an account receivable, but we could also have interest, and in that case it's interest receivable, right? If you're a lender, you could have interest receivable. And of course it creates a revenue. It's us earning revenue for which we haven't been paid. The revenue's building up, we haven't got the money yet. The last one, unearned revenues. Again, the name is funny. Prepaid expenses, we said it's not an expense at all, it's an asset. Unearned revenues, we say it's not a revenue at all, it's a liability. And it's my favorite liability because it means your customer paid you before you did any work. Well, what a nice position that is to be, right? You've gotten paid and you haven't done anything yet. So you owe your customer, and that's why an unearned revenue is a liability. Even though it's got the word revenue in it, it's a liability. You owe your customer a product or a service that you have yet to deliver. Now, at year end, we're trying to determine, well, how much of this have I actually earned, if any, right? And you look at your unearned revenue account, you go, oh, I've actually earned 30% of this, and you adjust accordingly. And so you say it's no longer unearned, debit that liability to reduce it, and you just credit the actual revenue account. So in this one, it was unearned consulting revenue, debit unearned consulting revenue to reduce it, credit consulting revenue to record it. Okay, so we've learned those 5 types of adjustments. I think this table will serve you really well, certainly in my workbook, but I expect in any introductory accounting class. And I know what you're thinking. You're thinking, where on earth can I find the thumbs up button? This video was so helpful. Well, I hope it was helpful. If you've stuck around this long, we're 30 some odd minutes in. Thank you so much for being here. Thank you so much for watching, and keep practicing this stuff, okay? I hope it pays off for you. Thanks for watching. Goodbye. Where's my stop button? Goodbye. Welcome to problem 3.3a. We're going to do a lot of stuff in this problem. We're going to do adjusting journal entries. We're going to prepare an adjusted trial balance. We're going to use that adjusted trial balance to prepare financial statements. And finally, we'll do closing entries. This is a substantial problem. I'm going to break it up into many parts, but the first part will be adjusting journal entries. So the question says, below is the June 30th, 2029 unadjusted trial balance of NetLock Security, a firm that offers hacking prevention services to large companies. And there's a big, long trial balance. The question says the company's fiscal year end is June the 30th, and the following items require adjustment. And we're going to have to do, what is this? 1, 2, 3, 4, 5, 6, 7 adjusting journal entries. And that's what the first part of the problem is about. It says, as necessary, do adjusting journal entries. So that's what this video will be. Once we've got our adjusting journal entries, we will complete this table, which is an adjusted trial balance table. That'll be in part 2. Part 3, we'll prepare financial statements, and part 4, we will do closing journal entries. That's the game plan anyway. We'll see how those parts divide up. But let's start with the first item. Now, it notes all we need to do is adjusting journal entries. And just to recap, you know, we've learned how to do this. And if you don't know what you're looking at here, I would suggest going back and watching my previous videos introducing adjusting journal entries. But what I want to make clear is in this table, this question is only asking for our year-end adjustments. So there's not going to be any setups required. It's all going to be adjusting journal entries. So let's look at the first one, and I think you'll see what I mean. So the first entry says, account of supplies reveals $300 of supplies were on hand on June 30th. So doesn't really give us all the information we've usually had, but here's what we need to do. We need to think a little differently when we solve this problem. We count the supplies. We say there's $300 worth of supplies. And what an adjusting journal entry says is, well, what do our records say? And our records say, no, we have $5,000 worth of supplies. So our records show 5,000, but we just counted and we only have 300. Our records are off. So we need to adjust our records to fix them. So our records say 5,000. Reality says 300. We're $4,700 off. We need to adjust down our supplies account. Remember the journal entry. Supplies are a prepaid. We're going to debit the expense related to supplies, and we're going to credit the asset. Debit supplies expense, credit supplies. Let's do it. Debit supplies expense, credit supplies, and the amount $4,700. Next, the $24,000 insurance policy was purchased on March 1st, 2029. Okay, so let's kind of scroll over and see what they're talking about here. They're talking about this $24,000 insurance policy, and they're saying we bought it on March 1st, 2029. Well, today is June 30th, 2029, and when we bought it, we would have gone debit, prepaid insurance, credit, cash. We already did that. How do I know we did it? Because it's there in our record. So somebody did a journal entry to record that we bought some insurance. What we have to say is, how much of this insurance has expired? So, and with an assumption here, and maybe I'll make that clear, I'll edit the question, but it's a 12-month. The $24,000 12-month insurance policy was purchased on March 1st, 2029. And we're going to say, well, today's June 30th, how much of this insurance policy has expired? So let's do some figuring here. March, April, May, June. 4 months have expired. March, April, May, June. Yes. So 4/12 of our $24,000 insurance policy is gone. 4/12 times 24,000. Oh dear, my calculator. I didn't set this up properly. Let's just put it there actually. 4/12 times 24,000 is 8,000. Okay, so our journal entry now, insurance also a prepaid. We debit insurance expense. We credit prepaid insurance. Let's do it. Insurance expense, and we credit prepaid insurance for the amount of insurance that has expired. 4 months, which we said was $8,000. Debit insurance expense, credit prepaid insurance for $8,000. There is our journal entry for Part B. On to Part C. It says the computers were purchased on July 1st, 2027. Well, remember, this is fiscal year ended June 30th, 2029. So that's like 2 years ago we bought these computers for $200,000. At the time of the purchase, the estimated life of the computers was 5 years. So $200,000 divided by 5 years means we're going to depreciate our computers at a rate of $40,000 per year. The estimated life was 5 years, no residual value. Depreciation had been properly recorded up to June 30th, 2028. So if we bought it July 1st, 2027, we depreciated 2028, we would have recorded $40,000 of depreciation already before this year started. And I think we can see that if we look at the table. Yes, there's $200,000 in computers, there's $40,000 of depreciation. So that was year one, but that was a year ago. We've got to record this year's depreciation. Now, in previous questions, I had you counting months, but if I bought an asset years and years ago, I just do a full year of depreciation in the year that I'm examining. So here it's June 30th, again, 2029. Maybe I should have put the year on this. We've got to record, we depreciated all the way up to June 30th, 2028. Well, to go from June 30th, 2028 to 2029, it's 1 year. Our depreciation is $40,000 per year, so our depreciation is $40,000. Debit, depreciation expense, $40,000. Credit, accumulated depreciation on our computers, $40,000. Most assets, you do a full year of depreciation because most assets you've owned for a little while, but only those ones where you bought it, 3 months into the year, then you go, oh, how many months did I own this? But for this one, it's just like do a full year of depreciation. We've done that. D, the $30,000 note payable was issued on February 1st, 2029. So again, today's June 30th, 2029. Immediately you're like, let's count some months. So February, March, April, May, June, 5 months. So I don't know what I'm going to do with that information, but I'm just noting it. It says it accrues interest at a 10% annual rate, and the note is expected to be repaid in late 2029. We're not worried about that. We just want to know how much interest has built up on this note, right? This is an accrued expense. $30,000 times 10% is $3,000 a year in interest, and we know it's 5 months has built up. So $3,000 times 5/12 times 5 divided by 12, $1,250. Okay, so $1,250 in interest. And to be clear, we did the depreciation with the last one, debit depreciation expense, credit accumulated depreciation. This one is an accrued expense, and it's an expense that's building that hasn't yet been paid, and it's debit interest expense, credit interest payable. And the amount here was, of course, $1,250. That's D. Let's move on to E. On May 1st, 2029, the company entered into a 3-month contract to provide security for a major corporation. The corporation paid $15,000 for their 3-month contract on May 1st. So they paid in advance. And when they pay in advance, this is unearned revenue, but we would have already recorded this. We would have gone debit, cash, credit, unearned security revenue. And the question even says it. It says, and that amount was correctly recorded as unearned revenue at that time. On June 30th, Netlock had filled the first 2 months of the 3-month contract. So again, this is $5,000 per month, and we've done 2 months out of 3 worth of work. So we've earned $10,000 of the $15,000. So our journal entry, and I just want to make sure I have the account names right. You don't want to misname an account. Yeah, the journal entry is the unearned security revenue. You can see here it's $15,000 that we owe. Well, we've delivered $10,000 worth of security, so it's not unearned anymore. We can move that and consider it earned security revenue. So debit unearned security revenue, credit security revenue for the $10,000. Debit unearned security revenue, credit security revenue for, again, 2/3 of the money has been earned. And looking at our table, this is of course an unearned revenue situation. We're only doing the adjusting journal entry, but at some point in the past, they got paid the $15,000. The accountant went debit, cash, credit, unearned security revenue, and now we're saying we've earned 2 months. Congratulations, us. Let's keep it going. So we're on to F. The company had 3 employees who were owed for 2 days of salaries at year end. Each employee gets $250 a day. All right, this is an accrued expense. We're just saying, how much unpaid wages are there? How many dollars worth of unpaid wages are there? Each employee gets $250 a day. There's 3 of them, so that means $750 per day in total wages. And I owe them for 2 days. So times 2 means I owe $1,500 of unpaid wages. It's awkward framing. There's a lot of like 3 and 2 and, figure out how much we're owed. But, just read through it and say, how much in total do I owe? If I owed 3 people, $250 a day, and they had 2 days of unpaid wages, you'd get to $1,500. The journal entry, this is an accrued expense. We're going to debit an expense. The expense related to salaries is salaries expense. If it was wages, we would call it wages expense. And the credit here is to the payable, the liability related to salaries, which is salaries payable. They called it salaries, so we'll call it salaries. Debit salaries expense. Credit salaries payable. And the amount was $1,500. That's F. On to G. The company entered into, on June 1st, 2029, the company entered into an agreement to provide service for a new client at a rate of $4,000 a month. At the end of June, NetLock had provided the first month of service, but we hadn't gotten paid. All right, so somebody owes us for a month of work. This is very typical. You do work for somebody, and obviously we hadn't recorded it yet. That's why it's on this list. When I do work for which I'm not paid, this is an accrued revenue, debit accounts receivable, $4,000, and we credit, whatever our revenue is. I think we called it security revenue. Is that what we called it? I can't remember the name. If you're given a table like this, you want to use the same words that are on the on their trial balance. So we're given the name. I want to be consistent in my naming. So credit security revenue. Okay, so we've done the A through G, those 7 journal entries, those 7 adjusting journal entries that I promised we would do. I'm going to, in the next video, I'll sort of consolidate these into one sort of simple, short list, and we will go from our adjusting journal entries to a trial balance. Stay with me. I hope these videos help, and as always, if they're helping, it really does help me if you hit one of those buttons. Have a great day. Goodbye. All right, we are continuing our work on problem 3.3a. We've done part A, which are part 1, part A, which is to record the adjusting journal entries, and I've summarized them here. And the next step says, okay, now use those adjusting journal entries to complete the adjusted trial balance worksheet to prepare an adjusted trial balance, which we'll do in this table, which again, you can download the problem, tonybell.com, and you can have a copy of the table for yourself. Let's do the journal entries. Debit supplies expense, credit supplies, $4,700. Debit supplies expense. So I'm in the adjustments section. On the left-hand side, I'm going to write a debit to supplies expense. On the right-hand side, I'm going to credit supplies. Debit insurance expense, credit prepaid insurance for $8,000. Insurance expense, there you are, $8,000, and we credit prepaid insurance by $8,000. Debit depreciation expense, credit accumulated depreciation computers, $40,000. That seems like a lot, but yes, I remember it now. It's like $40K. That's huge, but yeah, computers depreciate quickly, and if we have a lot of them, that can be the case. Debit interest expense, credit interest payable, $1,250. Debit interest expense, $1,250. Credit interest payable, $1,250. Debit unearned security revenue, credit security revenue, $10,000. Debit unearned security revenue, there you are. Credit security revenue, $10,000. Now I'm squeezing it in because I know I have a couple that are going to go to security revenue. Debit salary expense, credit salary payable, $1,500. Salaries expense, where are you? There you are, $1,500. And we're going to credit salaries payable for $1,500. Last one, debit AR, credit security revenue, $4,000. Accounts receivable, debit, $4,000. Security revenue, credit, $4,000. So I just put a little plus $4,000 there. You could erase it and put 14 is the total amount of credits there, but there you have it. So we should make sure our debits equal credits. Of course they have to, right? Because the total debits here equals the total credits there. Something else to note is when you're doing adjusting journal entries, no cash, right? Never hits cash. Cash is like the busiest T account in a typical company, and adjustments don't hit cash. They hit one revenue or expense account and one asset or liability account. So that's just something to keep your eyes peeled for. Let's total these up though. So I'm going to say 4,000. I'm doing the debits plus 10,000 plus $1,500 plus $1,250 plus $40,000 plus $4,700 plus $8,000. 69450, that is my total here, 69450. And on the other side, hopefully these match, 4,700 plus 8,000 plus 40,000 plus 1,500 plus 1,250 plus, I'm going to just say 14,000. Do it in one shot. 10 and 4 is 14. 69,450. Yes, indeed. All right, that's good news. That's what we expect to see. On to the adjusted trial balance, and all you're doing is summing the unadjusted trial balance with the adjustments. So 56,000, there's no adjustment, so 56,000 debit, no adjustment, so it just stays at 56,000. 12,000 debit and a 4,000 debit. If you have two debits, add them together, you get a bigger debit. So 12 plus 4 is 16. Now we got one with a debit and a credit. Well, if you've got a debit and a credit, take the big one minus the small one. The big one gets the balance. So 5 minus 47 leaves us $300 in supplies, which that's actually good news. I remember we counted supplies, the very first journal entry, and we said, yeah, there's $300 in supplies. Well, now our records reflect that. That's the whole point of this exercise. Prepaid insurance, 24 debit, 8,000 credit, 24 minus 8 is 16. Computers, 200,000, it was not adjusted. Our accumulated depreciation went up to 80,000, and that makes sense to me too. Remember, we had a $200,000 computer when we bought them. We dropped it by 40,000 in year one and another 40,000 in year two. So our computer's net, 200 minus 40 is 160. So it went from 200 to 160, and now it's down to 120, right? 200 minus 80 is 120. So it's straight lining its way down to zero. That's very predictable, and that's good news. Accounts payable, 14,000 credit, unadjusted. Salaries payable, 1,500, so 0, and then 1,500 credit, so 1,500 credit. Interest payable, 1,250 credit. Under security revenue, we got a big credit and a smaller debit. Take the big one minus the small one. The big one gets the balance. 15 minus 10 is 5. And it goes to the credit side. The credits were bigger this time. It's one that students screw up sometimes. They put it on the debit side just because, I don't know, something goes wrong. Notes payable is 30. Common shares, 40. Unadjusted. Retained earnings, 87 credit. Unadjusted dividends. We don't tend to adjust the dividends account. And now security revenue, 485, and then $14,000 of credit. So it's a credit and a credit equals a bigger credit. It's 499. 320 plus 1,500 is 321, 500. Interest expense, 1,250. Depreciation, 40. Supplies expense, 4,700. Repairs expense, 17,000. Insurance expense is 8. Rent expense 60, and taxes are 7. Okay, so let's add these up and see if this does in fact balance. We hope so. 56,000 plus 16,000 plus 300 plus 16,000 plus 200,000. Now we're down to 10,000, right? I'm just adding up the debits, plus 321,500, plus 1,250, plus 40,000, 40,000, plus 4,700, plus 17,000, plus 8,000, 8 plus 60, plus 7. So I land on 757, 750. What a funny number. 757,750. You might be thinking, well, like, this doesn't add, right? 711 plus 69 is like 780. Why doesn't it add? And because sometimes the debit actually minuses from the account, so it's not going to add. That's just the reality. It doesn't, this plus this doesn't equal that. Okay, let's add up our credits. Hopefully it works. 80 plus 14,000 plus 1,500 plus 1,250 plus 5,000 plus 30,000 plus 40,000 plus 87,000. Now I'm scared. The moment of truth plus 499. Oh, I don't want to hit equals, but I will. 757, 750. Okay, fantastic news. Our adjusted trial balance balances. So let's put some dollar signs. Dollar sign at the top of each column, dollar sign beside anything with a double underline. So dollar sign at the top of that column, dollar sign top there, and dollar sign beside anything double underline. And there I have my beautiful adjusted trial balance. Now remember the accounting cycle. Maybe I'm doing this at the wrong time in the video, but let's just do it now. We do journal entries, right? A transaction occurs. We do a journal entry. We summarize our journal entries to T accounts. Then we prepare an unadjusted trial balance. That's all Chapter 2 gets us to the unadjusted trial balance. Chapter 3, we prepare adjusting journal entries, what we've done over here based on wherever my table went. I moved it somewhere. Anyway, you guys have seen the table. There it is. So based on that table, I prepare adjusting journal entries. And heaven help me, where's my thing? There it is. Those allow me to go to an adjusted trial balance. Once you have your adjusted trial balance, you can use that adjusted trial balance to prepare your financial statement. That's the only thing left to do. Make your financial statements, go goodbye, this year's over, on to the next year, and we'll do a closing entry as well. So the next part of our video will be substantial. We're going to use this to make an income statement, statement of retained earnings, and a balance sheet. So stay tuned for that one. I'll see you in that video. See ya. Welcome back. In the first part of the video, we prepared journal entries, adjusting journal entries, I should say, for problem 3.3a. In the second part of the video, we went from our unadjusted trial balance to our adjusted trial balance. And now we're going to use our adjusted trial balance to prepare financial statements. We've got the information to prepare an income statement, statement of retained earnings, and a balance sheet. So let's stop dilly-dallying and let's get down to business. We're going to start with our income statement, of course. That always comes first. Name of the company is NetLock Security. NetLock Security. The name of the statement we're being asked to prepare is an income statement. And this is dated for the year ended. And then the date. June 30th, 2029. Okay, so we've got ourselves a beautiful title. Now remember what the income statement is. It's a summary of revenues and expenses. And the good news is, if you have a trial balance, which you will have in real life, preparing an income statement is easy because revenues and expenses are all grouped together here, right? So we just take our revenues, $499, we deduct our expenses with appropriate subtitles and subtotals, I should say, and subtitles maybe, and then we calculate. So it's going to be $499 minus all this stuff is going to give us our net income, but we have to lay it out properly, of course. And this is a flashback to chapter 1. Very similar actually to problem 1.5a. So if you're looking for more financial statement practice, I think 1.5a is a good version of this. Okay, so we'll start with revenues. I'll do a heading, revenues. And under that revenue, we just have the one, security rev. And security revenue was $499,000. Because I just have the one, I write it towards the right. And then we're going to do our operating expenses, which for us is everything except interest and income tax. So I'm just going to list them in the order they appear here. Salaries, expense. And to be clear, we're taking our adjusted totals, $321,500. is our adjusted salaries expense. Interest expense we'll save till the end. Depreciation expense is $12.50. Oh my gosh, I got the wrong number. 40,000. I hope you're yelling at your screen. I'm glad I caught it. Depreciation expense is 40,000. Supplies expense is 4,700. Repairs expense 17,000. Insurance expense 8,000. And rent expense is 60. Okay, so that's it for our operating expenses because we left off interest and we left off taxes, which are non-operating expenses. So let's total this up. There's my calculator. Bring it back. 321,500 plus 40,000 plus 4,700 plus 17,000 plus 8,000 plus 60,000. And we land on 451,200. 451,200. That is our total operating expenses. So remember, we have now a subtotal is needed. Our operating revenues, which security revenue is our operating revenue, minus our operating expenses, 451, gives us our operating income. And this is just the income our company generates from its, doing security work. Operating income, also called operating profit, minus 499,000, hit the plus minus, 47,800. So 499 minus 451 is 47,800. Then we have our other, and in our other category for now is just one thing. It's another expense, and it's interest. And our interest expense here is $12.50. Because there's only one other, I write it towards the right. I don't have to say other interest $12.50, total other expenses $12.50. No, you just, because there's only one item, you can just make it its own total. And that brings us down to another subtotal, income before tax. Our pre-tax profit, 47,800 minus 1250 is 46,550. And then we have income tax expense. And that was $7,000. And that's going to bring us down to our profit, our net income. How much money did we make? 46,550 minus 7,000. Our after-tax profit, 39,550. We need some dollar signs to celebrate our $40,000 in profit. Dollar sign at the top of each column, dollar sign beside the bottom line. And there we have a beautiful income statement. I'm going to right below it do the statement of retained earnings. So it's a 3-line title. Net lock security. I'm going to make it smaller just to make it all fit. Net lock security. Statement of retained earnings. And this gets dated for the year ended, just like our income statement. For the year ended, and then the date, June 30th, 2029. Okay. So remember how our statement of retained earnings works. It actually starts with a date, which is our beginning of year retained earnings, which will be this number. Is assuming there is no adjustments to retained earnings, there's quirky things that could cause us to adjust our retained earnings, but not in an introductory class. So we're going to start with our retained earnings of $87,000. That is our retained earnings beginning of year. And the beginning of the year, you just add a day. So you go June 30th. What's one day later is July 1st, 2029. And you take off a year. So July 1st, 2028 was the beginning of this year. So July 1, 2028. And our retained earnings on July 1st, 2028. Maybe I'll leave myself a little space here. Move this down just a notch just to, yeah, that looks nicer. Was $87,000. We're going to add net income. Our net income was from our income statement, $39,550. We're going to deduct, or subtotal, 87,000 plus 39,550 is 126,550. We deduct dividends, and our dividends were right here, $10,000. And that gives us our retained earnings at the end of the period as of June 30th, 2029. 126 minus 10 is 116,550. All right, so we've done a beautiful statement of retained earnings, dollar signs at the top and at the bottom. And now we're on to the last statement, which will be the hardest, the balance sheet. The good news, though, is, again, just like our income statement, if we've done a good job on our trial balance, we've got our assets, then liabilities, then shareholders' equity account, just all in order, right? So it will make our life easier. I'm just debating how to lay this out. You know what I'm going to do? Is that going to work? I'll try something. I'm going to move this, all this stuff way over to the right. And then I'm going to do my balance sheet to the left of that. We'll see how this works. All right, well, I'll give it a shot. Let's start with a 3-line title. Name of our company. Now, remember, balance sheets, I always make them a little bit wider, so you can see I've kind of left myself a fairly wide berth here. Name of the company, Netlock Security. Name of the statement we are preparing, which is a balance sheet. And remember, balance sheets just get a date. They don't get a for the year ended or for the month ended. They just get a date. And the date is June 30th, 2029. Okay, so on the left half of our balance sheet, maybe I should just draw a line there to distinguish. We have a big heading for assets. On the right side, liabilities. And 2/3 of the way down the page, somewhere down here, we're going to put shareholders' equity, but we're not sure where yet. So let's start with our assets. And of course, we do current assets to begin. I'm thinking, I don't know, my calculator is just in the way, but I think I want to do this. Oh, you know what? This is probably better just like this. Okay, let's do that there, and then I can zoom in a little bit. That'll have to do. All right, so under current assets, what do we have for current assets? Well, the first one on our list, and the good news is the list is in order. So cash, accounts receivable, supplies, prepaid insurance. These are all current. Prepaid insurance is going to last for a year, but now we have 8 months left, so it's less than a year. It's a current asset. So let's list these out. Cash, and our cash was $56,000. Accounts receivable And our AR was, the adjusted balance, of course, was 16,000. Supplies, 300. And prepaid insurance, 16,000. So the total here, 56,000 plus 16,000 plus 300 plus 16,000 is 88,300. That is our total current assets. On to our long-term assets, PPE. And we just have the one item, and it's computers, but there's AD on those computers. And remember, we're using the adjusted, not the unadjusted amount. So it's 200,000 of computers with 80,000 of accumulated depreciation. So what do we think our computers are worth? 200 minus 80. We think they're worth 120. So that's how we list them. We go computers net 200 minus 80 is $120,000. And because there's only one, we put it in the totals column. All right, so that brings us down to our total assets. 120 plus 88 is 208,300. 208,300. That is our grand total assets. We might want to do a little star there, and really different professors will prefer you to treat this accumulated depreciation calculation differently. I don't require my students to do it, but you might want to show your work, which is computers, which were 200,000, minus AD, accumulated depreciation, which was 80,000, equals computers net, which was, of course, 120. So that's an optional step, but it might be a step that you need to make. Depends on your prof. I'm fine with just doing computers net 120. This calculation would be in the footnotes, the notes of the financial statements. Let's put some dollar signs. I always treat the finishing assets as like finishing a statement, and it's only half, but the balance sheet's a big statement. So there we go. We've got our left side of our balance sheet done. Let's move on to the liabilities. And again, we're just working our way down the list. We did all the assets, cash, AR, supplies, prepaid insurance, computers, AD, and now we're on to liabilities. And I think they're all current. So let's list them out and see if we have anything long term, but I think everything is current. So first one is accounts payable, $14,000. List on the left, total on the right. Then we got salaries, that's definitely current. Salaries payable is $1,500. Interest payable, $1,250. Unearned security revenue, $5,000. Unearned, I'm going to make this go on to two lines. Security rev, $5,000. Now, again, it's all in the same group. Note payable is the only one I had a question about, but I think, if I recall the question, we were planning to, let's see, it says, the note is expected to be repaid in late 2029. Well, it is 2029. It's June 2029. If we think the note's going back to be paid in late 2029, it's current. So the note payable, which is $30,000, is current. And that's it for liabilities. So let's total it up. Total current liabilities, which is also total liabilities. And we need a total. 14,000 plus 1,500 plus 1,250 plus 5,000 plus 30,000 is 51,750. 51,750. So that's it for liabilities. On to our final heading here, shareholders' equity, and we always just have the same two accounts. Common shares, which at this stage of the game aren't going to change much, and then retained earnings, which comes from our statement of retained earnings. Our common shares, though, we just take the number 40. Retained earnings, look at the statement of retained earnings, the bottom line there, 116,550. We don't take our retained earnings from the question, right? It's not 87,000 or 87,000 over there. It's 116,550. And now we add this up to get our total shareholders' equity, 40,000 plus 116,550, 156,550. And now we need a grand total. Our total liabilities and shareholders' equity, 156,550 plus the liabilities, 51,750, and we get 208,300. Folks, the birds are singing. The sun is shining. What a long question, but our balance sheet is balancing. Again, a fantastic moment. You write the greatest essay in the world, and your English professor might disagree with you. When your balance sheet balances, your professor's got to mark you right. Congratulations, well done. Well, you could definitely make formatting errors, and you can balance with some errors in there, but I'm pretty confident we got this one right. $sign at the top of each column, $sign beside the bottom line, and we've got ourselves a beautiful set of financial statements. Let's move this over. I just want to admire those financial statements for just a half a moment, just a second here. And there they are, sitting alone on the page. Okay, we have completed adjusting journal entries. We've prepared an adjusted trial balance. We prepared our financial statements, our income statement, our statement of changes in equity. No, our statement of retained earnings. Sorry, we'll learn a statement of changes in equity later in the course. Our statement of retained earnings and our balance sheet. If you've gotten this far, you should be feeling fantastic. You should be smashing thumbs up buttons, but we've got one more part, and that'll be in the next video. We'll say, okay, we're done. Now we got to start a new year. We're going to learn how to prepare a closing entry, but that's in the next part of the video. Thanks so much for watching. I'll see you then. Bye-bye. Welcome to the final part of our big problem 3.3a. This has been a doozy. I hope you've made it this far, and if you have, congratulations. I guess if you're watching this, by definition, you've made it this far. Anyway, congratulations on having made it this far. We've done adjusting journal entries, we prepared an adjusted trial balance, and we just prepared financial statements, and now we've got one last thing. So part A, adjusting journal entries. Part B, prepare an adjusted trial balance. Part C, do financial statements. And now we've got to do this mysterious thing called a closing entry. The good news about closing entries is mechanically they're easy to do. The bad thing is they're kind of like confusing. Like, what is happening here? So to do it, I'll look at our adjusted trial balance. This is what we're going to close. And what a closing journal entry says is some accounts, not all, some accounts need to start again at zero. So if you think about like how much money we're making, right? If I say, well, how much money did I make in 2020, the year ended June 30th, 2029, I got to start counting how much money I made again for 2030. I got to start again from zero. Like if you think, how much money did you make last year? Well, when you say, how much money did you make this year? You start counting again at zero. If you made 40,000 last year and you made 50,000 this year, you start counting the 50,000 from zero. So companies have to start counting stuff again from zero each year. Now, not everything starts again at zero. My revenues start again at zero. My expenses start again at zero. My dividends start again at zero. But my debts don't start again at zero. I don't get to call the bank and say, hey, it's a new year. Let's reset my debt to zero. No, we don't get to do that. So a closing entry will reset, that's the word I use, revenues, expenses, and dividends to 0 through retained earnings. Now, I'll explain why through retained earnings later, but for now, just go with me that we reset revenues, expenses, and dividends. We make them 0. We force them to become 0 because we want to start a new year. We want to keep score from new. We want to start a fresh scoreboard here. And we do it through retained earnings. So let's make revenues and expenses go to 0. So here you can see my revenue is $499,000. My adjusted balance of revenue is $499 credit. How do I make that go to 0? Well, I'm going to do something I don't normally do. I'm going to debit a revenue account to make it go to 0. So on June 30th, 2029, this is one of 2 closing journal entries we'll learn to do. I debit security rev by $499,000. Hideous revenue, hideous handwriting. I credit all of those expenses. So, and we just have to write them all out. Credit salaries expense to make it go to 0 because it's a debit balance. To make it go to 0, it takes a credit. 321,500. I credit interest expense. The amount is $1,250. I credit depreciation by 40. I credit supplies expense by $4,700. I credit repairs by $17,000. I credit insurance by $8,000. I credit rent by $60,000. And I credit income tax by $7,000. Okay, and what we will find is when I make my revenues and I make my expenses go to 0, the journal entry doesn't balance. The debits don't equal credits. So let's figure out how much we're off by. And what we do is we plug whatever we're off by into retained earnings. Just force it into retained earnings. So my total debits here. Now this is, maybe I should do it in different ink just to say it. Like you wouldn't have to write this and you wouldn't want to write this particularly, but you want to know the number. So our total debits is $499,000. Our total credits is 321,500 plus 1,250 plus 40,000 plus 4,700 plus 17,000 plus 8,000 plus 60,000 plus 7,000. Our total credits is 459. Oops, 459. 450. And so you can see that we're off. And how much are we off by? Minus 499,000. We're off by 39,550. We need 39,000 more on the right-hand side. So whatever we're off by, we just put it to retained earnings. If we're missing by a debit, we would debit retained earnings, but we're going to, because we need to credit this to make a balance, we credit retained earnings by 39,550, and that should make it balance. And you maybe ought to just re-add the credit column to see if it works, and of course it will. 321,500 now plus 1,250 plus 40,000 plus 4,700 plus 17,000 plus 8,000. 8 plus 60,000 plus 7,000 plus 39550 equals 499,000. So now my debits equal my credits. Beautiful. I closed revenues and expenses to retained earnings. Your professor might do this to an account called income summary. That's totally appropriate. That's a fine way to do it. There's lots of different ways one could do this. I do it the straightest line, and I just put it right into retained earnings. The other thing we have to close, though, is dividends. June 30th, 2029. We're going to make our dividends go to zero. Our dividends were $10,000. I got to make that go to zero. So to make dividends go to zero, we credit dividends by $10,000, and we plug the balance through retained earnings, $10,000. And there we have it. We've done our closing entry. We've reset revenues and expenses to zero here. We've reset our dividends to zero here. Now, if that's all you're asked, and that's likely all you'll be asked, is just to like do a closing entry, you've done it. But if you kind of want to know like why retained earnings, what are we doing here? You got to actually look at our financial statements. So let me pull these over. Let's do this. I'm just going to copy them and paste them. See if this works. Let's put the financial statements right beside here. Bad sign. Oh, it worked. Okay. It was like very slow incoming. So what I'd like to look at is these retained earnings amounts. So based on our revenues and expenses, we credited retained earnings by $39,000. Based on our dividends, we debited retained earnings by $10,000. Now take a look at your statement of retained earnings. We said when we prepared our statement of retained earnings, we add net income. So our retained earnings goes up by $39,000 because of our revenues and expenses. That's this journal entry. We've said in our statement, we want retained earnings to go up. Well, you got to do a journal entry to change an account. This is the journal entry that makes retained earnings go up by $39,550. And you can see the amounts match perfectly. You can also see we want retained earnings to go down because of dividends. Well, that's this journal entry. So that's the reason for the closing journal entry. We're saying revenues and expenses make retained earnings go, well, up in this case. Dividends make retained earnings go down. But of course, we're saying retained earnings going up and down. The only way an accountant can make anything go up or down is with a journal entry. So these are the journal entries that cause our statement of retained earnings to take shape. So I wanted to show you the reason, but if you were like, you know what, this has been a long problem, I've kind of lost the plot. All you need to know for a closing entry is you're going to reset your revenues, expenses, and dividends. You're going to force them to zero, and you do it through the retained earnings account. Thank you so much for watching. As always, if you make it to the end of these, for goodness sakes, hit me with a thumbs up. That was a lot of work. I hope it helped, and I'll see you in our next video. Bye-bye. I enjoy the work, by the way. I think I sounded like I was complaining. I like doing it, so it's fun for me, and I hope it was reasonably interesting for you. Okay, now we'll say goodbye. Bye. Welcome to Module 4 in our class in financial accounting. This is one of my favorite assets, is the focus of this module, cash. Everybody likes cash. Everybody would love to have more cash. And as a consequence, controlling your cash, making sure nobody steals it, becomes a major focus of the accounting function, right? We don't want to lose cash. We don't want to run out of cash. We need to keep track of cash. Cash is an asset that everybody wants. Your customers would like more cash. Your employees would like more cash. And yes, even your trustworthy, loved accountant would like more cash. So when you're operating a business, you need to be keeping very close watch on your cash. It is the most stealable asset. And so that's why companies work hard to control it. Now, a fundamental way you control your cash is you don't keep much of it around. If you've ever been to a convenience store, the convenience store usually has signs that says no more than $20 is kept in this till at any given time. Why is that? Because they don't want to get robbed. And I promise you, those convenience stores that put that sign up bring their money to a bank all the time to keep the cash safe. Now, this has implications for the accounting department. This has implications for accounting because the bank keeps track of our cash for us. they send us a statement. They say, this is how much money you have with us. And, here's all your deposits for the month. Here's all your withdrawals. And here's what you ended the month with in cash. And isn't that interesting that our accounting function also keeps track of the cash? The accountant will say, well, we had a debit balance in cash of this much money at the start of the month, and we had deposits, debits on the left, deposits, we had some withdrawals, and here's what we have at the end of the month. And so one would think if we sat these two beside each other, we could get them to agree because they're talking about the same thing, right? The bank's talking about our money. The accountant or the bookkeeper is talking about our money. These two things should just line up with each other. Unfortunately, well, maybe fortunately, I don't know, it's just a reality, they don't. And so it's our job every month to explain why these are different. And that's the fundamental concept of this chapter. It's called a bank reconciliation. The bank tells us this number. Our bookkeeper tells us this number. Why don't they match? Can I explain it? And if I can explain the differences, I can spot errors as well. I can spot honest mistakes and dishonest mistakes because, again, the bank is very trustworthy here. Yes, they charge lots of money. There's bank charges and fees and all kinds of ways they screw you, but they will screw you in the open. They write it right on the bank statement. Here's the money we're taking out, right? This helps you catch some mistakes, either honest or dishonest ones, on your side of the house. And so every month, every company will prepare something called a bank reconciliation. It's just to double check this super important asset. So why are these different? So this is a big focus of our chapter, but why might these things be different? Why might our bank statement say something different from our cash account if we're putting everything into the bank, let's presume, right? Well, there's two reasons. There's items the company has recorded that the bank doesn't know about yet, and there's items the bank has recorded that the company doesn't know about yet. So let's start with items the company's recorded that the bank doesn't know about yet. So this is stuff that's going to be debits or credits that the company has on its books that aren't over here on the bank statement. Well, what could that be? And the most common example by far is the outstanding check. And let me explain what that is. Outstanding check. Now, I'm a Canadian, so I'm going to spell this like a Canadian, but of course, you Americans spell it this way. I don't know why. I don't like all the Canadian Europeanized spellings, but this one, I like ours better. I don't know why. The QUE, I just like it. So what's an outstanding check? Well, let's say this is the bank statement for May 31st, 2029, and this is our cash T account, May 31st, 2029, and the amounts are different. And let's further say on May 29th, right? May 29th, I wrote a check to pay my phone bill. $150 phone bill. I didn't use online banking. I wrote a check. Lots of companies use checks. Why might they use checks? Well, the reason is for checks and balances. It's so somebody has to sign that check, and often two people have to sign the check. Why is that? Because you want to watch every dollar going in and out of your company. You want somebody double checking. So checks are a great paper trail to make sure you're spending the money how you want to. So anyway, May 29th, we write a check to pay our phone bill for $150. Well, why might that not be on the May 31st bank statement? And it probably wouldn't be, because it's got to work its way through the mail system. It's got to land in the phone company, and somebody's got to open the mail, deposit the check on their side. It takes a few days. And so it might not show up on the bank statement until June. So that's something that I've recorded that as of May 31st, the bank doesn't know about yet. And that's called an outstanding check. In the same way, we can have outstanding deposits, which are also called deposits in transit. And what a deposit in transit or an outstanding deposit is money came into us, and we debited cash. Maybe it's the last day of the year, the month, and money came into us and we haven't got it to the bank yet. right? So money comes into us on the 31st. We bring it into the bank on the 1st of the next month. Well, that's an outstanding deposit. It's money that's waiting to go to the bank, but we didn't quite get there yet. So that's called a deposit in transit. And that's something that's going to show up on our books because, the money came in. We went debit cash right away. The bank just hasn't received the money yet. So deposit in transit. So those are really the two big things on that the company will have recorded that the bank doesn't know about yet. Now, what about on the bank side of things? What's something that the bank will have recorded before we know it? Well, there's two that annoy me. They annoy me equally. The first is every month I get an unpleasant surprise. Maybe you have a fixed fee banking or maybe you're on free banking. My bank fees actually go up and down every month, and I never know what it is until I look at the bank and go, wow, I paid $6 for my bank fee this month. Why was that? So bank fees are things that show up on the bank statement that the bank knows about. So the bank will have taken some money out of my account. They'll have made a withdrawal. Somewhere in this withdrawals, it'll say bank fee, $7 or whatever the number is. And I won't have it in my books until I get the bank statement, right? I don't know what the bank fee is exactly going to be until I see the bank statement. Another thing the bank puts on my account statement that I just I don't know about, or I won't know about, and the bank will know first, is interest. They'll give me 4 cents of interest. Like, thanks, bank. Really appreciate that 0.04 in my account. Well, there's interest revenue on our accounts. And again, interest revenue, and the bank will tell you how much interest you have before your bookkeeper certainly knows about it. So those are things that are on the bank side of the house that they know about before we know. But there's a few others. Sometimes if you have auto pay set up, like I have my mortgage auto paying out, and I have a variable rate mortgage, well, it goes up and down. I don't know exactly what I'm going to pay until the money shows up on the bank statement. The bank knows before I do. We call these EFTs, electronic fund transfers. And we can have EFTs going in, going out rather, withdrawals, and think something that you've got set up to auto pay. Maybe your phone bill isn't on. My phone bill's on an auto pay. And again, my phone bill is variable. Every month it's different. I don't know exactly what it's going to be. And then the bank says, oh, it cost you this much this month. You can have EFT deposits as well. Customers or clients or people you do business with can deposit money into your account. My YouTube money actually is an EFT deposit. And I never know exactly what it's going to be because YouTube reports money to me in US currency and then it shows up in my Canadian bank in Canadian dollars and they do some conversion along the way. I don't know exactly what I'm getting paid until the money shows up in the bank account. So that means the bank knows about it first and I might not have recorded it myself. You'll also see examples of NSF checks. Do you know what an NSF check stands for? It's when somebody bounces you a check, you're not going to be happy about it. NSF stands for non-sufficient funds. Somebody paid you the money. You went, oh, right, I got cash, debit cash, $1,000, right? They gave you $1,000. Then your bank goes, wait a minute, that check bounced. They'll know before you do that the check bounced, though. So NSF checks create issues where the bank knows the bad news before you know the bad news. And this list could go on and on, but those are key items where the bank is going to record it before we know about it. Now, once the bank tells us, hey, by the way, here's our bank fees, well, we've got to record it ourselves. And so part of the bank reconciliation process is we catch all these things that we miss. So if this is stuff we missed, well, we don't want to miss it, so we'll be made aware of stuff we missed. And how do we catch it? We do journal entries. So our bank reconciliation, the stuff over here, the stuff we missed, creates journal entries for us, the accountant. And that'll be a part of our chapter as well. So there you have it, my favorite asset and one of the best tools. Every company does bank reconciliations. And why don't you do some bank reconciliations right after this? It'll be the next video in the series, and I think it's a banger. All right, thanks for watching. See you in the next video. Bye-bye. Let's jump into problem 4.1a. This is a bank reconciliation problem. As with all my problems, you can download them from tonybell.com. There's no login. You just click the PDF link. You get the PDF immediately. Scroll down, find the problem we're working on. Here it is. And you can have a copy of this and all my problems for yourself. You'll notice that a lot of my problems are free here, but some are members only. If you're interested in the members only videos, consider hitting the join button beneath this video player. So, Zipflyer Inc.'s Cash T account for May shows the following information. And there's our Cash T account with some debits on the left, credits on the right, and you can see our ending cash balance shows $14,600, $619. And then we receive a bank statement, also for the month of May. And the thing I note on the bank statement is the bank says we don't have 14,000, we have 16,000. Those amounts don't match. We need to prepare a bank reconciliation. We need to be able to explain the differences between what's showing in our Cash T account, our bookkeepers keeping track of our cash, and compared to our banker keeping track of our cash. Our banker says 16,000, our bookkeeper says 14,000. Who's right? The answer is neither. They're both going to be off. We have to be able to explain those differences. So let's get going. Let's start with a 3-line title. Name of our company, Zipflyer Inc., is it? Zipflyer Inc. We are preparing a bank reconciliation. And bank reconciliations just get dated with the bank statement date, May 31st, 2029. Now, remember how a bank reconciliation works. If you didn't watch the intro video to the chapter, I highly recommend watching it. But anyway, here's the synopsis. On the left side, we're going to say, here's what the bank thinks our cash balance should be, and here's all the stuff the bank is missing. On the right side, we're going to say, here's what our bookkeeper thinks the cash account should be, and here's all the stuff the bookkeeper is missing. At the end of the day, if nobody's missing anything, the numbers should match, and that's how we'll reconcile our bank balance. So on the left-hand side, I'm going to say ending balance per, and per just means according to, bank statement. You could also say May 31st balance per bank statement, something like this. And the balance according to our bank statement was $16,707. On the right-hand side, I'm going to say ending balance per books. And that's, again, according to our bookkeeper. Ending balance per books. And you can see the amount there, $14,619. We see these two amounts do not match. We want to explain those differences. Okay, so what could the bank be missing? And we're really looking for, well, 3 things, but 2 things really. Something called deposit in transit. That's where we've received the money, but we haven't gotten to the bank yet. Also called outstanding deposit. So we've got the money, but we haven't taken it to our bank. We haven't deposited it. So our bookkeeper knows about it, but the banker doesn't know because the money hasn't gone in yet. Or outstanding checks. And what's an outstanding check? It's where we write a check on, May 29th. We put it in the mail and it hasn't arrived at its destination yet. So we've recorded that we've issued a check, but the banker doesn't know until the recipient deposits the check in their account. So those are the 2 main things we're looking for. Also, if the banker makes an error, that'll show up on the left-hand side of our bank reconciliation. So let's go through and look for outstanding checks and deposits and maybe look for some errors as well. Let's start with the deposit, the debit side. So our opening balance matches. That's unusual. It's to make the question easier. If you want to see one where the opening balance doesn't match, problem 4.2a or 4.2b, you'll have to deal with that. All you have to do is look at the previous month's bank reconciliation and you'll figure that out. We'll do that in problem 4.2, but this is, our first bank rec. We'll have that opening balance match to make your life easy. $1,550 deposit. I see it there. $2,700 deposit. Yes. $4,950. There it is down there. $2,600. I see it. $3,000. I do not see. I would call this an outstanding deposit or a deposit in transit. You might have been saying to yourself, well, what about this number? What about this $4,300? Well, that's something the bank has recorded that we've missed. That's going to go on the other side of the bank reconciliation. That's definitely something we're going to consider, but not now. That's not something the bank has missed, right? The bank has it. So we're looking for things the bank has missed, and the bank has missed this $3,000 deposit. We'll call that a deposit in transit. Oops. Just means we got the money, but the bank doesn't know about it yet, and that happened on May 31st for $3,000. Now, if I had 2 or 3, I would list on the left, total on the right, following those format rules that we're getting so used to. Okay, on to outstanding checks. I spell checks like a Canadian. Of course, you American folks will spell it C-H-E-C-K. We're talking about the same thing, though. Okay, so what are our outstanding checks? Let's go through them. So we're looking for things that we've recorded that the bank doesn't know about. So check number 75 for $550. I see it there. For $875. Yes, I see it there. For $1256. Yep, I see it there. Now, you might notice the $875 is listed first and then $1256 is second, but here it's $1256 first, $875 second. That's no big deal. We expect our checks to, the bank finds out about them in unusual orders because some check you might be sending across town, the other one you might be sending across the country. It'll just take longer for one of the checks to get there. It's very normal for checks to clear out of order. 77 before 76. Check number 78, 3684. Yes, that matches. Check number 79 for 1100. Yes. Check number 80 for 486. I see it. Check 80 for 486, but down here, check 80 is 468. This is an error. There's something wrong here, right? Somebody's got this wrong. We say the check is 486. The bank says 468. The bank will send you your checks back. They get your checks, and they will send them to you, or they'll send you pictures of them, and you can look at the picture and figure out who got it right. And this one, it says, the correct amount of check 80, a payment of an account payable, is 468. The bank got it right? This is correct. This is wrong. So right now we're looking for outstanding checks. I would say this is not an outstanding check because the bank knows about it. The outstanding check is one that hasn't cleared on the bank yet. This one has. The bank knows about it. So this is not an outstanding check. And in fact, because the error is our error, we're going to fix the error on this side. So on this part of the bank reconciliation, if the banker makes the error, we list it over here, but when we make the error, it gets listed over here. And I think we do a banker's error in like 4.2b, maybe 4.2a, I can't remember which, but one of the 4.2s, it's actually the banker makes the error. But this one, the bookkeeper makes the error. By far the most common in my career would be the banks usually get it right. The bookkeeper usually is the one to make the mistake. Okay, so this is not an outstanding check. I'm just going to sort of leave that as is. We're continuing. Check for 548. 548. I don't see a check for 548. This one looks like an outstanding check. So that's an outstanding check. I'm going to take my circle away from that one because it's going to confuse me. 3058. Yes, that check clears. 1244. Yes, that check clears. 983. No. 68. No. 175. So I think we've got 4 outstanding checks by my count. Check number 81, check number 84, 85, and 86. Okay, so we got to list out our 4 outstanding checks. 84, 85, 86. So 81, 84, 85, 86. And the amounts 548. 983, 68 and 175, Sum them all up. 548 plus 983 plus 68 plus 175 equals 1774. That's something funny happening with my tech, but I think we're okay. 1774 is my total outstanding checks. Now, something to note here is that we always add deposits in transit and we always deduct our outstanding checks. And why is that? Well, when the bank learns of the outstanding deposit, it's going to be a plus to my bank balance, right? They're going to add that amount in. When the bank learns about the outstanding checks, right? I've sent all these checks out. Well, when the check's clear, the money comes out of my account. So that's why this one's a minus. So that, because there are no errors on the bank side of things, that's it. It's just outstanding checks and outstanding deposits or deposits in transit. We call this, or I call this, our reconciling balance on May 31st. So 16,707 plus 3,000 minus 1774. So it should be 17,933. I treat this like a balance sheet in terms of formatting. So I put dollar signs at the top of each column, dollar signs beside the bottom line. So $3 signs on the left. And I'm expecting there'll be just 2 on the right when we get to it. Okay, so here we've done it. We have said, here's what the bank thinks my cash is. Here's why the bank's wrong. Still doesn't match, right? We got to say, well, what are we missing? And the answer is quite a bit of stuff. So if we've done a good job here, we can just say anything without a tick mark now is something that the bank has recorded that I haven't. By definition, I've checked everything off here, and it's either been circled or, everything has been accounted for. So anything on the bank statement that's not up in this T account is an issue. So the first one, NSF check W White, the bank collection there, EFT stands for electronic funds transfer, auto pay, EFT telephone, we got a bank fee, and we have some interest on the account. So I get 1, 2, 3, 4, 5, 6 items, plus I have that error to worry about. Let's deal with, though, the 6 items, and I'll just do them in the order I see them here. So we got an NSF check. NSF stands for non-sufficient funds. It means the person bounced the check. And it was $600, and it's a withdrawal, so it reduces our cash. Bank collection of $4,300. And of course, that was an increase to our cash. The bank collected money on our behalf. EFT utilities. $300 negative. We'll leave this 468 versus I think it was 486, that keying error till the end. EFT telephone. $100. Bank fee. $5, and that's bad for cash. It's on the withdrawal side. And then interest. It's money coming in, so I'll call it interest revenue here, and it's a positive $1. We got one more item, and that's this 468 versus 486. Maybe I'll highlight this one in green. 468, 486. And just to reread this, it says the correct amount of check 80, payment of account payable is 468. Zipfire's bookkeeper made an error. So here's what I like to think about anyway. Let's think about what we did. We did this. Credit cash 486. We should have done this. Credit cash 468. I always ask myself, did I credit cash? There's an error here. Did I credit cash too much or too little? In other words, did I credit cash too much or not enough? The answer is I credited cash too much. I credited cash too much. How much too much? Well, what's the difference? 486 minus 468. So $18 too much in terms of a credit. So I'll just say my credit was $18 too big. How do I fix it? If I credited something too much, how would I fix it? To fix it, I debit it by $18. I always think I over-explain here, but this is a spot that students do struggle on. So I wanted to walk you through the full process. That's it. That's the entire thought process. So again, we credited cash $486. We should have credited cash $468. We're off by $18, and we credited cash too much. I took away too much cash, so to fix it, I debit cash by $18. Hopefully that logic flows through. And so when we're filling this in here, I'll call this a bookkeeper's, oops, misspelled it. One of the weird words in the English language, double O, double K, double E. There's not a lot of words with 3 double letters in a row. Bookkeeper's error. And we said it was $18. And we said to fix it, we need to debit cash. So it's a plus to our cash. So that's why it's a plus 18. What I advise students is if they get to the end and this answer is wrong, just try the bookkeeper's error with the other side. Try, if it was a plus, try to make it a minus. Just see if you screwed up the explanation. Okay, so let's see if our reconciling balance works. I sure hope it does. Let's add these up. 14619 minus 600 plus 4300. Minus 300, minus 100, minus 5, plus 1, plus 18, 17933. The birds are singing, the sun is shining. If you have a baby sitting near you, reach for them, throw them in the air in celebration. This is a very happy moment. Our bank reconciliation, as it must, is reconciled. We have found everything. Double underline there. We put a $sign at the top and bottom of each column. And we have got ourselves a beautiful bank reconciliation. But the job is not done, my friends, unfortunately. Because if you look at the right-hand side of this, we said, well, here's what the bank thinks. Here's why the bank's wrong. On the right-hand side, we said, here's what we think, but here's all the stuff we're missing. Well, I don't want to be missing anything. And so how do I stop from missing anything? I got to do a bunch of journal entries. So part B says, do any journal entries that are required here. Well, we've got 1, 2, 3, 4, 5. My voice is getting higher. 6, 7. Okay, we've got 7 journal entries we're going to need to do. The good news is they all involve the same account. They all involve, I hope you guessed it, cash. So let's do those 7 entries. 1, 2, 3, 4, 5, 6, and we'll do 7 down there. So since they all involve cash, something I do is I cover this part up. Now, you shouldn't be doing this because I'll uncover it in a minute, but I cover this up and I go, okay, I can kind of do half the journal entries without even thinking. So these are all going to be dated May 31st, 2029. I'm just going to do May 31st. I won't give a year on the rest, but we should date all of our entries May 31st. Doesn't take too long. And of course a heading DR, CR, right? Just to establish where my debits and credits are going. And then, because I know they all involve cash, journal entry number 1 here is a credit to cash, $600, because it's a minus $600 to cash. Journal entry 2 is a debit to cash of $4,300. Journal entry 3, a credit to cash $300. Journal entry 4, credit to cash $100. Journal entry 5, credit cash $5. Journal entry 6, debit cash by $1. And journal entry 7, debit cash by $18. So now I've set the table and I haven't burned a lot of brain cells, right? Just to do that was like a minus was credit cash, a plus was debit cash, and I've set it all up. Well, now I can do the other half of this. There it goes. So the first one, the NSF check W. White. You need to think about what's happening here. W. White, I guess it was late last month. It says the NSF check was deposited in late April. So in late April, we put money into our account. The bank took the money. They said, probably you don't get to withdraw it, but we're going to show the check, this $600. They put it into our account. And then in May, they go, oh, wait a second, this guy didn't have the money. The W. White bounced the check. It's an NSF check, non-sufficient funds check. So we're going to pull the money back out of your account. The $600 comes out. What do we do when this happens? Well, tell you what I would do. I would call W. White and I would say, W. White, you owe me money, right? Like that $600 check you gave me bounced. I need the money. And so I would debit AR. When a client owes you money, you're expecting to collect, it's an account receivable. You might note it's from W. White. You would know this account receivable well because you'd be calling them and haranguing them, trying to get the money out of them. May 31st, there's a bank collection. We need to know, what did the bank collect? Was it just normal revenue or what was it? And it says the bank collection was a note receivable. The note included principal of $4,000 and interest of $300. There were no previous interest accruals, so that just means it's purely interest revenue. So let's deal with the interest revenue. Credit interest rev, $300, and we credit notes receivable for the $4,000. We've collected our note receivable, so the note receivable goes away. The next one, EFT utilities. Well, utilities are a cost. It's an expense. So we debit utilities expense. And it's good, right? Because we're looking for a debit. Expenses always get debited. So debit utilities expense certainly makes sense to me there. Hopefully it makes sense to you too. Same thing with telephone. Telephone's just an expense. Debit telephone expense. $100. We credit cash $100. The bank fee, well, this is another expense. It's money getting pulled out of our account. I would insist my students write the word expense there. If you don't write the word expense, I would mark you wrong. I'm a meanie, but be careful about things like that. Interest revenue. Credit interest revenue. We credit revenue accounts. So I hope you're feeling like, oh, these journal entries aren't so bad. And even the last one, you're going to have to read an explanation and figure out what we paid. So it notes this is a payment of an account payable, this error. So the correct amount of check 80, a payment of account payable was $468. Well, remember, we did this. Now it was a payment of account payable. So we would have gone debit AP 486, credit cash 486. We should have gone debit AP 468. Because remember, when you screw up something in accounting, you always screw up two things. That's how double entry accounting works. It's not one account got messed up. It's always two. And so when we screwed up our cash and we said to fix it, debit cash 18, well, the other half of this is credit AP 18. When we fix the cash, we also have to fix the AP. So let's do that. Debit cash, credit AP for $18. And there we have it. We've done a beautiful bank reconciliation, and we've also done 7 journal entries. If your professor gets you to do this and they ask you to do the journal entries on a test, you should be thanking them. You should be saying, oh yes, easy marks. The bank rec isn't super easy, but the journal entries, because they all involve cash, are some of the more straightforward journal entries of the semester. I hope this video helped. If it helped you, please help me. All the thumbs up help me with the algorithm, so don't be shy about hitting one of those buttons. Thanks for watching. I'll put the problem back up there if you need to see it. Have a great day. Bye for now. Bye-bye. Welcome to Module 5 on Accounts Receivable. Now, I'm a man who loves assets, because who wouldn't? Assets are things of value. But if I had to list all the assets in order of what I like most to least, I think receivables would be my least favorite asset. And the reason is, to have a receivable, that means somebody owes you money. So I always start my classes asking my students, hey, has anybody here ever been owed money by a friend or a loved one, someone you know, right? Then think about in your life, somebody who has owed you money at some point. And then the follow-up question is very telling. I ask my class, have you ever been in a position where the person who owed you money never paid? Look at this guy's sad face. It's a guy with his hand out hoping to get paid. He doesn't get paid. And all the hands stay up. Everybody has experienced somebody owing them money and them not getting paid. Well, we're thinking about friends and loved ones here. Now imagine you're in a business relationship. This is not your friend. This is not your loved one. Plenty of times in business, you are owed money by a customer or a client, and for one reason or another, they fail to pay. And so that's a big topic of this module, is collecting receivables and the challenges of collecting those receivables. So I wanted to run through sort of 3 scenarios here. First, we'll look at a typical cash customer and the journal entries around them. Then we'll look at a good credit customer. What makes a good credit customer? They pay on time. And then we'll look at the nightmare credit customer. And these folks do exist. And this is somebody that is eventually not going to pay. But the problem with a credit customer is you don't know it, and you can spend months chasing them before they don't pay. So they're costly in that sense, not only in terms of not getting your money, but also in terms of eating away at your time. But let's first look at a typical cash customer. So it's December 10th, 2029. You perform a $1,000 consulting job for a client who pays cash. Your fiscal year ends December 31st. Okay, record any relevant journal entries. Cash change hands. We got cash. It's December 10th. We're going to debit cash for $1,000. And we're going to credit. This is us doing work. This is consulting rev, of course. Consulting rev. I'm running out of space here. There we go. Okay, so December 10th, 2029. Debit cash, credit consulting rev. Easy peasy. Typical cash customer. Let's move over to a good credit customer. So what's the story with a good credit customer? Again, December 10th, 2029, we do a $1,000 consulting job for a client on account. All right, well, what does that look like for a journal entry? So on December 10th, 2029, I debit not cash, I debit AR because I did some work for them and they haven't paid. And I, of course, credit consulting rev. Consulting revenue for that $1,000. And this is DR and CR. And my fiscal year ends December 31st. Okay, so I prepare a balance sheet. I'll show receivables of $1,000 on that date. I'll prepare an income statement as well, showing the consulting revenue. They pay their bill on January 8th, 2030. So January 8th, 2030. They paid their bill. So what does that look like? Well, cash changes hands. They're giving me cash, $1,000, and I credit AR for this customer. Now, when I was a beginning articling student working at a CPA firm, I'd look at this situation and I'd go, why doesn't everybody just do cash? Like, the credit customer, it's twice the work, right? Twice the journal entries. And in fact, it's more than twice the work because not everybody's a good credit customer. Sometimes you're chasing them. There's checks in the mail. There's way more work than a typical cash customer. So why doesn't everybody just make all your customers pay cash? And the answer, I hope, is fairly obvious to you. It's attractive to your customers. It will attract more customers to offer credit. I often think of my university. If they showed up to buy office supplies at your office supply store, let's say you're a Staples type of company, and they say, oh, we'll do $1,000 test purchase with you, and if we like you, we'll keep buying. And my university probably buys more than $1 million of office supplies in a year. We'd be the best client in this city for sure for office supplies. So the buyer walks into Staples, they go, okay, let's do $1,000 test buy. And if they walked out the door and Staples said, okay, well, now you got to pay cash because we only do cash because Tony Bell had said cash is way easier, the university buyer would go, no, send us a bill. It's going to go through a purchasing department, and it's going to go through the university's controls, and you'll send us a bill, and we'll handle it that way. And if the Staples guy stuck to their guns and said no, cash only, the university would just say, oh, okay, we can't do business with you. Right? Like, we're not interested in doing business on a cash basis. Send us a bill. We'll pay the bill. There's approvals processes. And at that moment, the Staples person would change their policy. They would go, oh, the biggest account in town wants to be a credit customer. I guess they're a credit customer because I want the biggest account in town. So that's the reason that companies begin to offer credit. And then once they start offering it for the amazing client, they start to go, oh, I can get more customers anyway. And it's attractive, right? That's the reason they do it. But the fact that they open themselves up to more and more credit customers means they take on a risk of a nightmare credit customer. So this is a whole drama that's going to play out. It's December 10th. We perform the same $1,000 accounting job for our client. So let's just do that journal entry. Same journal entry as above. We debit AR, or the previous one. Let's just say AR nightmare, right? This is a nightmare client. We don't know it at the time. If we knew they were going to be a nightmare, we wouldn't have taken them on as a client, but that's the reality of life. You don't know it's going bad until after it goes bad. Debit AR nightmare, credit consulting rev for $1,000. What happens next? Well, our fiscal year ends December 31st. So on December 31st, 2029, we do financial statements. We have an income statement showing this consulting revenue. We have a balance sheet showing the accounts receivable from nightmare of $1,000. We don't know it's going bad yet. Among our other receivables, though, we show there's $1,000 receivable from nightmare. And we prepare our financial statements. That's going to be relevant in a few minutes. You called them January 10th because, it's a month later. Maybe you wait till January 15th or something, a few days in case the check's in the mail. You don't get payment. You ask them about payment. They say, oh, I'm sorry, I misplaced the bill. I'll get to it right away. Don't worry, I'm going to pay you. February 14th, another month goes by. You still haven't been paid. You call them again, and they blow you off for another month. They say, oh, don't worry, the check is literally in the mail. March 15th, you're starting to get impatient with them. You call and say, well, we're sending you to collections. If you don't get this money to us, and, by the way, we're starting to charge you interest on your overdue account. Now you don't owe us $1,000, you owe us $1,020, whatever, right? We're getting way more threatening and way more mean to them. And then April 15th, we get this, we call them and it goes, the number you have reached is not in service. Or, if we're emailing them, the email bounces back. It's like unsendable address. And so we do what anybody does in the modern internet era. We Google the owner, we Google the person, our point of contact, and we see their Facebook page or some social media post, Instagram, and they're just open to the public. And we see they're skiing in Switzerland. And it's like they've been crying poor. They've been saying they can't afford to pay our bill. And yet if you're skiing in Switzerland, you got a lot more than $1,000. You definitely could afford to pay the bill. And so we contact them on the social media platform, Instagram or whatever. And we say, hey, you're in Switzerland skiing. You've been saying you can't afford. You got to pay the bill, and the person goes, "LOL, I'm in Switzerland. I'm Swiss. I'm not from your country. I'm not going to pay." They just say, "I'm not going to pay." Lawyer up, right? And they know, and you know, that if you hire a lawyer, you're getting involved with some international police aren't going to chase this person. They know they're probably getting away with it, right? If they don't return to your country from Switzerland or wherever they are in the world, it's going to be very difficult for you to collect. And you think, oh, lawyers are like a couple $100 an hour just to get started. It's not even worth it. And so on that day, you decide. Now, you might not decide this, but in this hypothetical scenario, you decide you want to give up. All right. So a big piece of this chapter is, when you give up, how do you do it, right? From an accountant's perspective, how do you give up? And the answer, well, this is a well-known thing. Like, you know, they don't go skiing in Switzerland every time, but you can be owed money for which you're not going to collect, and you at some point give up on the money, right? You give up on receiving the money, and it sucks. And there's an expense related to giving up, the fact that debts go bad. We call it the bad debt expense. This can also be called the uncollectible account expense, right? It's just an expense account related to the fact that sometimes the customer doesn't pay. They might go bankrupt. They might disappear to Switzerland. They might just dispute their bill, right? They might say, you did a terrible job consulting. I'm not paying. That happens, right? So for one reason or another, they don't pay. Here's what I want to do on April 15th, but I'm not allowed to. GAAP, the rules of accounting, do not allow this journal entry, so don't do it. Let me make it a different color ink. I'm going to make it green ink? Sure, green ink. On April 15th, this is what I want to do, but I'm not allowed. Again, don't do this. I want to go, well, okay, there's an expense. I want to get rid of their AR because I'm never going to collect it, right? Give up on their AR. So credit AR nightmare customer. Because, again, AR is an asset. It's something that indicates a future economic benefit. Well, I'm going to get no economic benefit from this character. They're not paying, and I'm not chasing. So I give up on their AR, credit AR. I would love to debit this expense account that I've just identified, the bad debt expense, for $1,000. Unfortunately, I can't do this. If you read your chapter, they call this the direct write-off method, and wouldn't that be nice if we could do the direct write-off method? It wouldn't be much of a chapter, though. It's a pretty easy transaction. Unfortunately, the rules of GAAP, the rules of accounting say you can't do this. And the reason you can't do this is because of something called the matching principle. And it says, if I recorded a revenue in fiscal 2029, so December 10th, 2029, I recorded a revenue. I need to record all of the expenses related to that revenue in 2029. So my bad debt expense needs to be on these financial statements. Can you think of the problem with this? I hope you're saying, well, I didn't know it was a bad debt, right? Like, I wasn't even trying to collect until January 10th, 2030. So on December 31st, 2029, how could I have known there was a bad debt? Because I wasn't even trying to collect yet. Like, it was no problem at that point. And the answer is, of course, we accountants know this. We know this is a problem. On December 31st, 2029, presumably, we have a lot of people that owe us money. We do work for all kinds of clients. And you guess, that's a bad word, you estimate. Well, if I have 100 clients, they each owe me $1,000, that's $100,000 in receivables. Some of them are going bad. Based on the fact I've been in business for a while, I know it's 3%, right? I know 2% of the time, two out of every 100 customers goes bad. They go bankrupt. They die before they can pay their bill. Some other tragedy befalls them, and they don't pay their bill. Okay, well, on December 31st, 2029, we have to make an estimate of who's not going to pay. We don't know who it is, but we guess. That is a big focus of Chapter 5. Setting up that estimate, we call it the allowance for doubtful accounts, and we get into it in problems 5.3, 5.4, and 5.5. I hope you'll stay with me for this chapter. I think it's an interesting one. I think it's a challenging one. And like I said, receivables are my least favorite asset. I hate it when people owe me money. Part of the reason is because I hate trying to collect. And the other part of the reason is sometimes you don't get paid. All right, stay with me. It's a great chapter. I can't wait for the next video. Bye-bye. Let's have a look at problem 5.3a, the percentage of sales method. So this question is the first in a series that we look at what happens, how do we account for the fact that some customers who owe us money aren't going to pay? And how do we deal with the reality that we don't know who, right? We don't know who's going to go bankrupt. We don't know who's going to dispute their bill. We don't know who isn't going to pay. But if you're owed a lot of money by a lot of people, somebody ain't paying. And what we do is we estimate that amount. And there's two different ways we're going to learn in this chapter. In problem 5.3, we'll learn the simpler of the two methods, the percentage of sales method. In 5.4, we'll learn the aging of receivables method, a little more complicated, but I like it a little better. But let's jump into the first one, the simpler method, the percentage of sales method. Let's read through our problem and let's solve. Salazar Inc. shows the following information on May 31st, 2029, the company's fiscal year end. They got some receivables. They got this allowance for doubtful accounts account, and it's one we haven't seen so far. I'm going to explain it in great detail at the end of this video. Once we've solved, this is a little bit out of order, I know. I'm going to sort of work through the problem. You'll hopefully be working through it with me, and then at the end, when we're wrapping it up, when everything sort of falls into place, that's when I'm going to explain in detail kind of what's going on. So accounts receivable 235, we got an allowance for doubtful accounts with a debit balance of 2,000. Sales 448 of cash sales, 1850 in total sales. And it says the company's accountant estimates bad debts to be 2% of credit sales. Now that's important and that's kind of interesting already. Why credit sales and why not cash sales? And the answer is because we're going to collect the cash sales. We've already collected them. I don't need to worry about the collectability of a cash sale. The person came in and gave me cash. So we got to first figure out, well, what are my credit sales? If my total sales were 1850, now sometimes students see this under the credit column and think, oh, is that credit sales? No. That's just debits and credits. That's different, right? Credit sales are sales on account. So if I have 1850 in total sales, and my cash sales were 448, well, we can fill in the blank here and say credit sales were just the difference. Well, 1850 minus 448, what is that? 1402. I'm going to use a smaller font on my pen. I'm not happy with the pen size. Make it one notch smaller. Okay, so our credit sales are 1402, and the accountant says 2% of credit sales. That's a number that's going to be important. 1402 times 0.02, 28040. So times 2% is 28040. When you do the percentage of sales method, when you take a percentage of your sales, which we just did, a percentage of our credit sales, the number you calculate, the answer is your bad debt expense for the year or for the period, whatever period you're looking at. So in this case, 28040 is going to be our bad debt expense we're going to record. The journal entry looks like this. So part A says prepare an adjustment. The number we calculate goes right into the adjustment. So for part A, the journal entry is debit on May 31st. Debit bad debt expense 28040. And we credit this allowance account. And again, I'll explain the allowance at the end of part B here. And I allow students just to write allowance. It should be allowance for doubtful accounts. A lot of professors do AFDA, allowance for doubtful accounts. I think that's totally appropriate as well. But there we go. We've got our beautiful adjustment. So done. Part A is correct. Part B says, show how accounts receivable net is going to be disclosed. And this is the first time this chapter talking about the concept of net stuff. We talked about this in chapter 1 with equipment. We said equipment minus accumulated depreciation is equipment net. Well, the same thing is true for receivables. We say accounts receivable minus not accumulated depreciation minus the allowance for doubtful accounts equals AR net. And now's as good a time as any to explain this allowance account. Allowance is a contra asset account. It's an account saying, this is what I don't think I'm going to be able to collect. So accounts receivable, this is what I'm legally owed. But based on track record, again, if 100 people each owe you $1,000, you know you're not going to get $100,000. Some of them aren't going to pay for one reason or another. And so the accountant has to estimate how many people aren't going to pay. The allowance is that estimate. So I'm legally owed $100,000. I allow for 3% not to pay. So that's $3,000 allowance for doubtful accounts. I only think I'm going to collect $97,000. AR 100 minus allowance of 3 equals AR net of 97, for example. But let's apply that to this situation. We'll discuss it with this company. Our AR right here, 235, just at the top of the question there. Our AR is 235. Our allowance for doubtful accounts, you might think, oh, 28040. No. We have a T account for the allowance because the allowance had an opening balance of $2,000 debit. We've just credited it by 28040, meaning I have 20, oops, wrong side. I end with, take the big side minus the small side, 28 minus 2 is 26040. I end with a $26,000 credit balance in the allowance, which is why it works against their AR. AR is a debit. The allowance is a credit. It's a contra asset, 26040. So 235 minus 26040 equals 208,960. Our net accounts receivable is 208,960. So let's explain that last piece again. I explained it with the hypothetical $100,000 example, but here's the more real example. I'm legally owed $235,000 based on work I've already done and billed. Based on track record, though, I know not everybody's going to pay. I estimate, I'm going to allow for the fact that in the future, $26,000 of this $235,000 is going to go back based on my estimates. So how much do I actually think I'm going to get? Well, I actually only think I'm going to get $208,000, $208,960. That's the number shareholders care about. They don't care about what you're legally owed. They care about what you actually think you can get. That's the asset. The asset isn't like money you're never going to see. The asset is money you think you can collect. So when we look at real companies, I just called down Apple's balance sheet and just, under current assets, the only thing I wanted to point out, not even the numbers, just real companies don't list accounts receivable. They list accounts receivable net. And that's what they're talking about. They've already taken out that allowance for doubtful accounts on their balance sheet. And that's what we're going to do on our balance sheet when we prepare one in chapter 6, right? We'll have the concept of AR net fresh in our mind. So you'll see that in chapter 6. But the concept's important for this chapter. AR, what I'm legally owed, minus allowance, the fact that I'm estimating what I'm not going to be able to collect out of what I'm legally owed equals AR net. Okay, on to part C. On June 23rd, 2029, the company writes off a $1,400 receivable from a customer. Okay, if I want to write off a receivable from a customer, you just credit the receivable. So C. Sorry, this is B here, right? This part is B. C says, again, we want to write off AR from a customer. So I credit AR to say, okay, I'm writing it off. That's how you write something off. You credit the asset to write it off. AR, customer, you give the customer a name. $1,400. The debit, the tempting debit here on June 23rd is bad debt expense, but we know that's wrong. We don't debit bad debt expense when we write off a bad debt. That's called the direct write-off method. It's not allowed. We're doing the allowance method, which is allowed under GAAP. And whenever we write off a bad debt, we use up our allowance. So we debit allowance for doubtful accounts for the amount that we wrote off. Okay, we have fully solved 5.3a. Just a quick aside before we move on here. Sometimes students ask me, they go, well, wait, why is this allowance a debit of $2,000? If it always ends in a credit, it's always a negative asset. Like, accumulated depreciation is never a debit. Accumulated depreciation always is a credit. It always reduces the value of our asset. Allowance always reduces the value of our AR. How could we have allowance be a debit? And the answer would be, well, like, let's say this year I have an allowance of $26,000. Every time I write off a bad debt, I debit the allowance. If I wrote off $30,000 in bad debts because more customers went bad than I estimated, I'm going to end with a debit in my allowance. How do I fix that? How do I repair it? Next year, rather than 2%, maybe I have to take 3% or 4%, right? You just change your estimate prospectively. You change your estimate going forward. You don't have to go back in time and fix it. You just go, okay, next year I'm going to make a bigger estimate. But that's how you'd end up with a debit balance in your allowance. Kind of a quirky situation, but it does happen all the time. And what else would I love to happen all the time? Thumbs up, smash those buttons. Thanks for watching. See you in the next video. Next video, allowance for doubtful accounts calculated, the aging of receivables method. I like that method better. And this method's great. The next method, even better. Can't wait to get started there. Bye-bye. Let's jump into problem 5.4a. This is on the aging of receivables method. When a customer owes us money, we know some percentage of the time they're not going to pay, and we have to estimate the amount that's not going to come in. We have to estimate our allowance for doubtful accounts. And to do it, we've in the previous video learned the percentage of sales method. In this video, we'll learn the aging of receivables method. Remember, at the base of this, they're both guesses, right? We're both estimating, what's going to happen in the future. So nothing's perfect, but this one just suits me better. I look at it and I go, yeah, this matches the way I would want to estimate. But again, different companies will do different things. Kilt Company shows the following information on January 31st, 2029, the company's fiscal year end. They've got accounts receivable 68, allowance for doubtful accounts in a credit balance, and sales 55,000 of which are cash sales, 981 of credit sales. And it notes, and this is where the aging of receivables comes in, a very common report a company will produce is an aging of receivables report. And the idea is, as the receivables get older, more and more overdue, we give those customers a harder time, right? We chase them, right? We go, hey, you owe us money, you're 3 months past due, and you give them a harder time. So the computer will report, it'll say, these are your oldest receivables, and you go, okay, that's who I'm getting my receivables clerk to chase. So companies produce an aging of receivables report because it makes sense to know who's owed you for the longest. And of course, from an accountant's also going to be concerned with collectability, right? As they get older, they get harder and harder to collect. And so when we're setting up an allowance for doubtful accounts, doesn't it make sense to say, well, my oldest AR is going to be harder to collect than my newest AR? So that's what this method is all about. So we have 68,000 of AR. It breaks down. 42,000 of it is fresh. 15,000 of it is a month or older, and 2 months or older is 6,000, and more than 3 months old is 5,000. If you add that list up, you do indeed get to $68,000. And so the accountant, again, based on track record, these numbers will generally be provided to you in an intro class, but, they were just based on past years, past performance. And if you've been selling a lot for a long time, you have a pretty good idea of the percentages that don't come in. And in this case, the accountant says, well, 1% of our newest AR isn't going to come in, and you can see it gets less and less collectible as time goes by. Important, though, to remind you, we don't know who's not going to pay. We hope that they'll all pay, but this is just an estimate. So $42,000 times 1% means we estimate that $420 of this 42,000 isn't coming in. 15,000 times 4% means $600 of this isn't coming in. 6,000 times 8%, 480 is our guess there. 5,000 times 25%, 1,250 is our guess there. So adding this up, 420 plus 600 plus 480 plus 1,250, we are guessing that of our 68,000, $27.50 is not going to be collected, not going to be collectible. That is our calculation. And what we are calculating, if you scroll back up to problem 5.3, we calculate a number, and that number is our bad debt expense. With 5.4, with the aging of receivables method, we calculate a number. That number is the ending balance of our allowance for doubtful accounts. So ending balance of allowance, and it is a credit account. It is always going to end in a credit. Okay, so it says prepare the adjustment to allowance for doubtful accounts based on the information above. Well, we actually have to do a T account first. So step one is to do this calculation. Step two, we got to do a T account for the allowance for doubtful accounts. It was $1,000, and we're saying no, the ending balance of the allowance has got to be $27.50. It was $1,000 credit. It's got to end at $27.50, as I noted, credit. So what's the difference here? Like, how do I get from $1,000 to $27.50? What's the missing number? Right? We're missing a number. What number is missing? Well, hope you're saying the missing number is $17.50. Right? To go from $1,000 to $27.50 is $17.50. Okay, well, if our T account is missing a number, how do I make it so the T account is not missing a number? We do a journal entry. The journal entry is the same as it was for the percentage of sales method. It is, we date it January 31st, 2029, debit bad debt expense, and we credit, well, just look at this. We credit the allowance, right? The missing number needs to go into that allowance T account. How do I get it there? Journal entry. I credit allowance $17.50. I debit bad debt expense $17.50. So step 3, do a journal entry. Step 4, update or show how AR net is going to be shown in the financial statements. Remember, when we look at real companies, they don't say our accounts receivable, they say accounts receivable net. And we know accounts receivable net is AR minus the allowance for doubtful accounts equals AR net. Just as Apple disclosed, right? Apple's AR, when they list it, they call it AR net. That means they've taken AR, their account receivable, minus any allowance for doubtful accounts. So AR minus allowance equals AR net. Our company's accounts receivable, $68,000. Oops, $68,000. Our allowance for doubtful accounts, it's the ending balance of the allowance, not $17.50. That's a mistake students make. It's $27.50. AR minus allowance is AR net. This is going to be $65,250. And remember what this is saying. Legally, I'm owed $68,000. I've done $68,000 worth of work that I haven't collected yet. But I know based on track record, some percentage of the customers aren't going to pay. We've done all this work and said, well, $27.50 of that $68,000 isn't coming in. So how much do I actually think I'm going to collect out of the $68,000? I think I'm going to collect about $65,000. Well, this is the number shareholders care about. They don't care what you're owed. They care what you think you're going to get, right? $65,000 is really the value of the asset. So allowance is a contra asset account. It's a negative asset account. It always ends in a credit, and it always reduces the value of our accounts receivable. So one last point comparing this to percentage of sales method. The steps are a little different. Here, step 1, you take a percentage of your sales. Step 2, you do the journal entry. Step 3, you update your allowance. And step 4, you show AR net. So you can see the steps are a little different. Here, take a percentage of your aging receivables. These two steps are swapped. Basically, you do the allowance T account second, journal entry third, and then calculate AR net. So if you have to do both, just know, okay, they're similar, but they're not the same. And it's a source of confusion, at least for my students. Maybe it's a source of confusion for you. Hopefully that helps to clear it up. C, on February 14th, Valentine's Day, 2029, the company writes off a $900 receivable from a customer. Record the entry. Writing off receivables when you know how to do it is not difficult. Feb 14, 2029. I want to write off a receivable. How do I do it? I credit the receivable, credit AR from this customer. Heartbreak. Oh, can I make a heart broken? So that looks like a piranha plant in Super Mario. I was thinking because it's Valentine's Day. Anyway, credit AR customer, $900. Debit the allowance for doubtful accounts. That's the reason we allow for it, right? We're saying, I'm allowing for the fact that some of my customers aren't going to pay. Well, now somebody didn't pay. I'm using up my allowance. Thank you so much for watching. I hope the video helped, and I'll see you in the next one. Goodbye. Let's have a look at problem 5.5b. We're going to write off a bad debt, and then they're going to come in and pay. On July 21st, 2029, ABC Company wishes to write off $200 receivable from XYZ Company. Record the journal entry to write off this receivable. Okay, so July 21st, my birthday, very important day. We want to write off receivable. So what do? You credit the accounts receivable from XYZ Company. And how much is this for? It's $200. And how do you write off a receivable? You use an allowance for doubtful accounts. So we're always debiting the allowance for doubtful accounts and crediting the AR when we want to write off an account receivable. Now, that's usually where these questions end, but this one, the students always ask, well, what happens? I write them off and then the person comes and pays. What do you do then? What you don't say is, oh, I wrote you off already. I don't want your money. No. We'll take your money. So on September 15th, the person shows up with some money and we got to do some quick accounting behind the scenes. We go, this one was a bad journal entry. Let's pretend it didn't happen. Let's reinstate their AR. So we'll debit AR to say, we're putting you back on the books. Oops, I had the wrong thing. XYZ Co for my American cousins. Debit AR 200. And we credit the allowance. We say, we never used that allowance because that's allowing for people who aren't going to pay. Well, these people are going to pay, so let's use the allowance on somebody else. And then on September 15th, we just collect their AR. Debit cash, credit AR for XYZ Co. $200. I know what you're thinking. You're thinking, can I just do this in one step? The answer is, yeah, you could. You can see there's a debit to AR there and a credit to AR there. Could I just do this as this journal entry? You could, but honestly, I do think doing it in two steps is better. So I think the way I've got it is the way to go. Thanks so much for watching. We're done. 5.5b. Welcome to Module 6 of our course on financial accounting. This is our first of two modules on inventory. It's that crucial a topic that it deserved two modules. And this first module, a bit of a grab bag of inventory topics. There's three things I want to discuss in this video. And the first thing is products, and that's what you're doing when you're selling inventory. Products are different from services and a little bit more complicated. There's a reason we left this until module 6. The second thing we'll talk about is just accounts receivable, actually the topic we talked about last chapter, and how collecting AR is a pain and one solution to that pain, which creates accounting challenges. The final thing we'll talk about is freight. When you sell a service, you're not shipping anything. Well, with inventory, shipping starts to become an issue, and we'll talk about some of the quirks around freight. So we'll do that all in this video, and we'll do it all throughout the chapter, but this will be a useful video to introduce the topic. So the first thing was products are different from services. So here's a service example. You sell a service. ABC Consulting Company provides consulting services for a client for $1,000 cash. All right, so we debit cash. We credit consulting rev for $1,000. XYZ Shoe Company, shoe store, buys shoes from Nike for $120 cash, then turns around and sells them to their customer for $200 cash. So when a company, and in this class, a company is always going to buy their product from a supplier for one price, presumably a low price, and sell it to the customer for a higher price. And that's, think of Walmart. That's the model, right? Companies that sell inventory, that's a common model. If you're interested in how to deal with it when a company makes its own inventory, that's a whole course. That is a management accounting course, and I've got a course for it here on YouTube. But for now, we're going to assume almost the Walmart model. We bring in products that somebody else makes. Nike makes the shoes, we buy them from Nike, and we turn around and sell them at a higher price to our own customer. So here, XYZ Shoe Store buys the product from its customer for $120 cash. So when they buy shoes, they don't debit shoes, they debit inventory, of course. And they would never buy just one pair, but that's this example. And they credit cash, and of course they would probably buy them on account. Okay, so they bought the shoes. Now when they sell them and when they earn revenue, so this is us earning revenue as a consultancy, debit, cash, credit, consulting revenue. When you earn revenue as a merchandiser, it's actually a double journal entry you have to do. You have to record one part of the entry to record the fact that you've received some money, you've earned some revenue. And the second part of the entry that is new here is the customer took some of our assets with them, right? They walked out of our store with a bag full of our assets, our inventory. So let's look at this transaction. So the second transaction, this is the key one. This is the what's new here. So let's start with the customer gives us $200 cash. So we debit cash, 200, and we credit sales rev, because this is us doing what we do to earn money, 200. Now, what's the other piece of this? Well, they walked out of the store with some of our inventory, so we credit inventory for how much inventory did they walk out with? 120. That was our cost on the inventory. And this creates a new expense account, one we haven't seen before. And the expense account is called cost of goods sold. And we're going to abbreviate that through our class as COGS, cost of goods sold. And our cost of the goods that we sold was $120. This creates a new and totally crucial relationship. You'll see this on the top of a merchandiser's income statement, a company that sells inventory. This is what their income statement looks like. They're going to have their sales revenue at the top, which here it's $200. The next line down will be COGS, cost of goods sold, 120. And then the next line down is a key number, and it's a new subtotal, and it's called, we're going to call it in our class, gross profit, but you often hear this called gross margin. So keep your eye open for that when you're doing your own course, what your class calls it. But in this video series, we're going to call it gross profit. And our gross profit here is $80. And you can see just revenue minus the expense, cost of goods sold. Even though it's an expense, it's our first expense I can think of so far that doesn't have the word expense in it. Sales minus COGS equals gross profit. And this is a crucial number if you're running a business. You keep an eye on your gross profit, a critical number to understand well. So we know if we're, Walmart and we're bringing in these Nikes costing us $120, we sell it to our customer for $200, we know we make $80 on every pair of shoes we sell. And that's an important number. And it's so important, in fact, there's a little ratio that companies do. So here's the dollar amount. They like to look at it as a percentage. So if we say sales are 100%, well, what's 120 out of 200? Costs here are 60%, right? 120 divided by 200 is 0.6, that's 60%. And 80 divided by 200 is 40%. Well, this 40% is a number that will be talked about in board meetings, in shareholder meetings. They'll say, oh, our margins, our gross profit percentage is up or down, and they're referring to this number. If you ever watch the show Shark Tank, a favorite show of mine, they'll often say, hey, as a person comes in, they say, I've got this new invention. It's a fancy new pen. And they say, oh, what do you charge for it? And the person will say, oh, I charge $20 for my pen. I'll say, oh, what does it cost you to make it? And the person will say, oh, it cost me $8, right? And they'll go, all the sharks in their mind, they're going, okay, 20 minus 8 is 12. And they're calculating not only the amount, $12 per unit in gross profit, they're doing this percentage number in their minds. And they're saying, is this good gross profit or a bad gross profit? It is a key number for any company or any inventor that sells a product. So, I hope I'm illustrating the first point here well, and that is that product-based companies, it's just a little more complicated than service-based companies. I know we're up for it, but it is introducing new challenges to us. A second challenge that gets introduced this chapter is related to something we learned last chapter, which is it sucks to be owed money, right? You have people owing you money. If you're operating a business, people owe you money all the time, and it sucks to be owed money. Now, there is a stick version of getting your money, which is you wait until, the due date, and then you start sending nasty letters to the people who haven't paid, and you're chasing them. And what we find is it's very labor intensive, and it's a pain in the neck. As a consequence, many companies have introduced a carrot. And the carrot is, rather than chasing you with a stick, the enticement to pay early is you offer people discounts to pay early. And you're going to see this code all through the chapter, 2, 10, and 30, something like this. And here's what this stands for. 2%, that's a percentage. This 2, whatever number comes before the slash is a percentage. This is the size of the discount. So you get a 2% discount if you pay within 10 days. That's the 10. The N30 is otherwise pay in 30. And the idea is, that's when interest and penalties and you're overdue at 30, right? 30 is the due date. So 2% discount if you pay me in the next 10 days, otherwise just pay the full amount in 30. Now, why does this happen and why does it matter? 2% discount. If I go to Best Buy tomorrow and they say, hey, we're having a big sale, 2% off everything in the store. You're like, 2%? Who cares? I don't get out of bed for 2%. Why is this an enticing discount? And why does it entice anybody to pay early? Like 2% off. Well, the answer is they already bought the product, right? This is not enticing them to come into your store. But if they've already bought the product, it should be an enticement to get them to pay early. And if you just think about this, you go, okay, 2% return on your money over, let's just say it's a 30-day period. It's actually better than that, but 30-day period. Well, if you impute that to a year, it's like more than 20% guaranteed interest on your money, right? Just to pay early. So it's a smart decision to take you up on the offer. So yes, we will be offered these discounts as a buyer. We'll also offer the discounts as a seller. Now, again, this creates accounting challenges, as you might guess. And let's think of an accounting challenge. Well, let's say I bought something for $100 and I bought some inventory from a supplier for $100 and I do pay early, so I get the 2% discount. So I end up only paying $98. Well, how much is my inventory worth? Is it worth $100? Or is it worth $98? I bought a $100 piece of inventory, but then I took 2% off because I paid early. Is this $98 in inventory or $100? The answer is this is a $98 piece of inventory. But isn't that strange, though, that if I pay within 10 days, it's a $98 piece of inventory, but if I pay within 11 days, it's a $100 piece of inventory. The asset itself hasn't changed at all. It's the same thing I bought, and it's just like I paid one day before, one day later, and it changes the value of the asset. And the answer is yes. And when I think about this, I always think about my wife and our shopping habits. This happened to us one time. We were out of toothpaste. I called my wife. I said, hey, can you get me that toothpaste I like on your way home? And for whatever reason, I happened to be in the store that day. I don't normally, we divide labor in our house. You know, I do certain chores, but her main chore, one of her main chores, is she does most of the shopping. I do other things though. So in any event, I asked her to go to the store and get the toothpaste when she got a chance. And it just so happened I was in the store that day and I thought, screw it, I'll buy the toothpaste myself. And so I went and I bought the toothpaste for $5. She is a coupon clipper, and she got the exact same toothpaste. I mean, literally same barcode, same size, same everything. But because she's a coupon clipper, she got it for $3. Now, it's very strange, at least as you're thinking of this, that if we look at these in terms of asset value, I have a $5 asset, and she has a $3 asset, even though it's the exact same product. And so that's something you got to kind of wrap your head around. The cost is what you've paid for it. So if you get the discount, the cost of your inventory is a little bit lower. If you don't get the discount, the cost of the inventory is a little bit higher. And we'll look at all sorts of scenarios where companies will be getting and not getting the discount. Okay, the final piece here is kind of related. It's related to shipping costs, and freight is funny. So here's two scenarios, and we'll deal with similar ones in our questions this chapter. We're looking at t-shirts, and we find two t-shirts on online shops, right? We're online shopping, we're comparison shopping, and I get the identical t-shirt, site number 1 and site number 2. Site number 1 says the t-shirt's going to cost you $25, free shipping. Site number 2 says the t-shirt's going to cost you $20 and there's a $5 shipping surcharge. Well, from the perspective of an accountant, these are the same thing. These are both $25 t-shirts. So the t-shirt here is $25 and the t-shirt here is $25. Now, this is something where when I was a beginning accountant, my intuition would have been wrong and your intuition might be wrong. You might think, no, it's a $20 t-shirt, asset, right? This t-shirt, something you own and control. It has something of value, and a $5 shipping expense. Well, when you buy inventory and you buy any asset, the shipping cost becomes part of the cost of the asset. And I hope this t-shirt example illustrates that, right? If you were comparison shopping and you said, I got a $25 t-shirt with free shipping or a $20 t-shirt with $5 shipping, the truth is in both scenarios, you have a $25 t-shirt. Again, easy when we're discussing this example, gets trickier in real life because the tendency is you see this scenario and you go, I paid $5 in shipping. It's a $5 shipping expense. No. When you pay the $5 in shipping, you don't debit shipping expense. You debit t-shirt, or in this case, inventory. So those were 3 quirky concepts that are going to come into our journal entries for chapter 6. The best way to learn accounting, though, is to do examples, and we got lots of them coming. I can't wait to get started. See you in the next video. Thanks for watching. Bye-bye. Let's jump into problem 6.1a, inventory purchase discounts. I hope you haven't forgotten, but a lot of companies offer these early payment terms, 210 net 30. It means if we pay within 10 days, we get a 2% discount if paid within 10 days. Otherwise, we just got to pay the bill in 30. After 30, they're going to start assessing us late fees and penalties, that type of thing. But of course, we're going to pay within 10 days because it makes economic sense to do so. The following transactions occurred for May Inc. Purchased on April 3rd, purchased $10,000 of inventory on account. And there's the terms. And on April 10th, we pay the bill. And it says, do the journal entries. Okay, so April, not 30th, 3rd. What happened? We bought some inventory on account. We debit inventory $10,000. And we credit accounts payable $10,000. Good for us. We bought some inventory. Now, what happens on April the 10th? Well, on April the 10th, we pay. And the question is, how much do we pay? And the answer is we don't pay the full 10 grand because we're going to take our 2% discount. So what does that look like? Well, 2% of 10,000 is $200. We're going to take a $200 discount. So we're not going to pay 10 grand. We'll pay 9,800, right? 2% off. So let's credit cash. Let's see. Maybe I'll zoom out just a touch here. Let's credit cash for 9,800, the amount we're going to pay. Now we got to think, well, what happens to this payable? And the payable, of course, is reduced. It was a $10,000 payable. We don't owe these people anything, so our payable's got to go to zero. So I debit AP by $10,000, and you can see we're off. We're missing a credit of $200. Now, the mistake students make here is they credit discount. And they'll say, well, this is the discount. Let's credit an account called discount. You'll do that as the seller. As the buyer, you don't. As the buyer, you credit an account that the first time you see it, you're like, really? Credit this account? Does that make sense? I'll explain why, but the first time you see it, you'll be like, nah, that seems a little weird to me. We credit inventory. So that's it. We've solved the problem. This is correct. But let me explain that credit to inventory by showing you the inventory T account. Oh my goodness, inventory. It looks like inventory. Let me change that. There we go. Now it looks like inventory. Okay, so I've got my beautiful inventory T, and you can see I got a debit of 10,000. I just credited it by 200. So what is my inventory worth? My inventory is worth $9,800. That makes sense. Why does it make sense? Because that's what I paid for my inventory. When you buy an asset, the value of the asset is what you paid to make it useful. We didn't pay $10,000. So to report this inventory as 10K, which we would have done, right? If we didn't do this credit, our inventory is just on the books for 10,000. That's wrong. We only paid $9,800 for this inventory. That's the value of our inventory. So you don't get to include the discount. So in other words, if you go to a car lot and you want to buy a truck and the truck price is $80,000 and you negotiate and you get it for 70, you don't get to go debit truck 80 and, oh, I got a $10,000 discount. No, it's a $70,000 truck. Well, this inventory, the true value of the inventory is $9,800. Why? That's what we paid for it. Brings up the quirky situation where if we just waited another week and paid on April 17th, this inventory value would be $10,000 because that's what we would have paid for it. We didn't claim the discount. So it's the exact same piece of inventory. It could be worth more if we paid more. So it's a funny situation, but there you have it. Our inventory is worth what we paid for it. It's worth $9,800. As always, hope these videos are helping, and I'll see you in the next one. Bye for now. Let's jump into problem 6.2a. This has us doing inventory purchases. There's going to be a discount element to this. You'll all remember at this point, terms mean 210 net 30 means if we pay within 10 days, we get to take a 2% discount if paid within 10 days. And 30 means if we don't take that 2% discount, the bill's due in 30 days. So after 30, we get charged interest and penalties. The other thing I just want to say at the start is if you're looking for this problem and you want to download it, go to tonybell.com. You just click that PDF link and scroll down to whatever problem it is you're looking for. You don't have to log in. The PDF pops right up. I'm very proud of that element of this website. And search for the problem. You'll notice, like this video, many are free, but there are some members-only videos. If you're interested in viewing the members-only videos, you got to hit the join button underneath the video player. So the problem we're working on is 6.2a. It says the following transactions occurred for Belco. May 7th, we purchased $1,000 of inventory on account. May 10th, we returned some of the goods. Some of the goods were damaged, so they give us credit to our account. And then May 14th, we pay the bill. Okay, let's start with May 7th. And what happens? We buy inventory. Inventory is an asset, so we debit inventory. We're going to have more inventory today than we had yesterday. Debit inventory, $1,000, and we credit AP. We bought the inventory on account. Had we bought it for cash? Credit cash. May 10th, what's happening? Well, some of the goods were damaged, and we got a credit memo. What's a credit memo? We emailed them. Maybe we showed them pictures, texted them pictures, and said, look, the stuff you gave us, there's a lot of this stuff is garbage. And they said, take $250 off the bill, right? We're sorry about that. We accept your explanation. Maybe we return the product. And they said, take $250 off the bill because of the damaged merchandise. And we said, sure. So take $250 off the bill. What does that look like? Well, we're going to reduce our AP, debit AP to reduce AP by $250. And well, if the goods were damaged, it means the inventory is less valuable than we thought. We credit inventory by $250. In other words, we bought $1,000 worth of inventory. Well, no, we didn't. We only got $750 because a quarter of the inventory was bad. Okay, well, what happens next? May the 14th, we pay the bill. How much do we have to pay? Well, first, do we get a discount? The answer is yes, right? It's within 10 days, we're going to take a 2% discount. Now, what do we take the 2% discount on? We owed them $1,000 initially, but remember, they credit our account for $250. We only get to take the discount on this $750 amount that we owe after the credit memo. We don't get to take a 2% discount on the whole $1,000 because we basically returned a bunch of the goods. So what's 2% discount on $750? It's $15. That's the size of the discount. So how much are we actually going to pay here? Well, $750 minus a $15 discount, we're going to pay $735. That's the amount we're going to pay. So let's credit cash for $735. We got to get rid of all of the AP. The full amount of the AP was $750, and then we're off by $15. Now, you'll recall, this one is quirky. The first few times you see it, you go, what should I credit here? And the mistake students make is they credit an account called discount. That is not correct. We have to credit our inventory. And why do we have to credit our inventory? Inventory is only worth what you have paid for it. So the easiest way to summarize this is to just look at our inventory account through all of this. So we had $1,000 worth of inventory. We said, no, $250 of this inventory is garbage. We received it. It was damaged. We didn't want it, whatever. So we sent back the $250, or we threw it in the garbage, and now we're left with $750 of inventory after that. Well, we credit our inventory $15 here, meaning after all is said and done, we only purchased $735 worth of inventory. That hits me as being correct. Why is that correct? Because that's what I paid for the inventory. An asset is worth what you pay to make the thing useful. So we only paid $735 for our inventory. That's how much the inventory is in our records after having done all of these journal entries. This number is the correct number. So that's why we credit inventory here, because otherwise we'd be showing $750 of inventory. That's not true. You got to take out that discount amount. The analogy I always give is you go on the car lot, you buy a $60,000 car, and it's the sticker price. You negotiate it down to $50,000. You don't get to debit car for $60,000 because you got a $10,000 discount. No, you just bought a $50,000 car, not a $60,000 car. We bought $735 worth of inventory, not $750. Why? Because we paid $735. As always, thank you so much for watching. Don't be shy about hitting those buttons, and I'll see you in our next video. Bye for now. Let's jump into problem 6.3a. This time we're the seller, not the buyer. And you're going to see dealing with inventory as the seller a little bit different. The following transactions occurred for Samco. October 5th, we sold $5,000 of inventory on account, and the inventory cost us $3,000. So something new is happening here. When you make an inventory sale, you also have to be worried about your internal costs. So when Walmart sells you a pair of socks for $5, they have a cost on the socks, something lower, right? They buy from their supplier, Hanes or Fruit of the Loom or whatever brand, Nike, Under Armour, whatever brand of sock they bought. If they're selling to you for $5, they probably bought it from their supplier for, let's say, $3, right? And they got a little $2 markup. Well, when you sell inventory, you not only are aware of the price you charge your customer, but you're also aware of the cost. And in this case, we're offering terms. So, there's more moving pieces to being a seller, and you'll see it's much more complicated than the accounting from the buyer's perspective. Well, much more, maybe that's too much to say. Marginally more complicated. Okay, so let's get into it. So it's October 5th, and we're asked to do some journal entries. So sold $5,000 of inventory on account. Okay, let's deal with the sales revenue side of this. If I make a sale on account, I debit accounts receivable because if they paid cash, I would debit cash, and I credit sales rev. And this is my price to the customer. I charge the customer $5,000. But at the same time, the customer walks out the door with some of my assets. I lose inventory because I'm shipping some inventory off to the customer. They're walking out the store with $3,000 worth of my inventory. That creates this new special account called cost of goods sold, which we can abbreviate as COGS. Cost of goods sold is a key expense account, and that creates the relationship. Sales minus COGS is gross profit. 5,000 minus 3,000. Our gross profit on the deal is $2,000. We made $2,000 on this deal, but of course we got other expenses. We got to pay employees. We got to pay to keep the lights on in our factory or our building, wherever, our retail store, property tax, all kinds of other expenses. But on this just pure transaction, we made $2,000 of gross profit on the deal. That's what we could say as of October 5th. Okay. Now remember, there's a discount offered if they pay quickly. Why do I want to offer people a discount to pay quickly? I don't want to deal with receivables, right? This is a way to reduce my receivables. I don't want to be calling them, collecting from them in a month and chasing them. I don't want to be a bill collector, and this incentivizes them to pay early. So it's a 2% discount if they pay within 10 days. And look at that, they do pay within 10 days. So how much are they going to pay me? $5,000, but they get to take 2% off the bill. 2% of $5,000 is $100. So they're going to pay me $4,900. That's how much they're going to pay me on October the 12th. So we're going to debit cash for $4,900, and we are going to get rid of the AR, credit AR, for $5,000 because we don't owe them the $5,000 anymore. We don't owe them anything. Now, what of this other $100? Well, if you've tuned in for the previous videos in the series, you'll know, well, when we're the buyer of inventory, we credit inventory. When we're the seller of inventory, we actually debit discount. And this is what screws students up because they go, I just got it through my head when I'm the buyer, I don't deal with a discount. As a seller, you do have a discount. They call it a sales discount sometimes. Our discount is $100. So what is happening here? Well, time to introduce a couple of new concepts. We've answered the question. This would be a correct answer. This is the journal entry for October 5th. This is the journal entry for October 12th. Correct. Beautiful job. So what's happening? Well, there's a concept called sales rev net. And if you look up your favorite company, if you look up Walmart, maybe I'll do that right now. Let's look up Walmart income statement. Walmart income statement. Sorry, I'll put this on screen in a second. Okay, so grabbed Walmart income statement. And the only thing I just wanted to point out is, look at that top line there. What is it label? Net sales. Net sales. So there's this concept of net sales that companies have to be worried about. What is net sales? It's sales minus any discounts that we grant, minus any returns. And we want to track those separately to know how much discount and how much return we're offering. So for for our company's net sales, we have sales revenue of $5,000. We have discounts of $100 and no sales returns in this one. There'll be sales returns in the next problem you see in the list. So our net sales rev net is $4,900, and again, it makes intuitive sense. Our sale, the net amount of our sale, is how much we got paid at the end of the day, and we got paid $4,900 cash. So what is that relationship? And again, an important income statement relationship. Sales rev net minus cost of goods sold equals gross profit. So our net sales was $4,900. Our costs were $3,000. Our gross profit was $1,900. You often see this presented in a dollar amount, but it's very common to see this presented as a percentage, especially that gross profit number. So you set sales as 100%. You go, what is COGS as a percentage of sales? So our COGS is 3,000 divided by 4,900. It's 61.2%. And what is our gross profit? 1,900 divided by, again, just divide by sales. Every number is a percentage of sales, 38.8%. And you can bet any company that's a retailer looks at this number very carefully. They're focused on their margins. They want higher gross profit percentage each year. And when the margins, the gross profit percentages are shrinking, that is cause for concern for any retail store. So that stuff wasn't asked for, but it certainly could be. It's a very common thing for professors to ask about. I certainly ask my students about it. So I wanted to add that here to problem 6.3a. And if it helped you, I do hope you'll consider helping me by dropping a like. Thanks for watching. Bye-bye. Let's take a look at problem 6.4a. This has us selling some inventory. The customer makes a return and they pay us within a discount period. It's fairly complicated. As always, I recommend downloading these problems from tonybell.com. When you click the PDF link, there is no sign up, there's no sign in, there's no nothing. Scroll down, find whatever problem it is we are working on. As you scroll down, you can't help but notice there are free videos. As you're watching, this one is a free one. There are also members only videos. If you're interested in joining and getting a channel membership, getting access to all those extra videos, hit the join button beneath this video. So, the following transactions occurred for Smithco, a plumbing retailer. I don't know why we need to know they're a plumber, or plumbing retailer. January 6th, we sold $3,000 of inventory on account. The inventory cost $1,200. Remember, when we are making sales of inventory, there are two simultaneous transactions. One to record that there's a revenue side to this, and the second to record the fact that inventory walks out the door with our customer. We are losing an asset. All right? Every time you make a sale as a retailer, your assets go down. So two journal entries to be made for every sale. Let's do the January 6th sale. Sold $3,000. Okay, so when you make a sale, debit cash if it's for cash, but in this case it's on account, so we're going to debit AR. Accounts receivable, $3,000. The credit here is, of course, to sales revenue, $3,000. Now it says our cost on this stuff, our cost of goods was $1,200. We credit inventory because inventory walked out the door with our customer, $1,200, and the debit is to COGS, cost of goods sold, that very special expense account. Okay, January 11th, inventory was returned. It was not broken or damaged, just the wrong item. $100 credit was applied to the customer's account. The returned inventory had a cost of $40. Okay, so the customer brings back inventory and we're able to sell it again. That's an important distinction, right? Sometimes the customer will bring back inventory that's broken. You got to throw it in the garbage. In this case, though, it is good inventory that they're returning on January 11th. So what do we do on January 11th? Well, because the inventory is good, we're going to put it back on the shelf. Let's actually start by giving the customer $100 credit, right? They return a bunch of inventory. We say, you don't have to pay for this. So let's credit our AR because we're not going to collect that 100 that they've returned. Credit AR. The debit here is to a new account called sales returns. And we track our sales returns, and we would likely do it by product because you want to know which products are getting returned. Maybe you don't reorder them because they're lower quality product or frequently returned. I go on Amazon right now. It says this item is frequently returned when I go to order certain things. And the reason is it's a pain for you as the retailer. So you to keep track of your returns, and we use an account called Sales Returns. You'll recall if you watched previous videos in this series that this creates this new calculation. Sales revenue minus any sales returns minus any discounts that we provide to our customer equals sales revenue net sales. And if we look up our favorite retailer, Walmart, here's Walmart's income statement. I just wanted to bring down to this revenue amount. You can see how they present their revenue. It's net sales, or I'm trying to highlight it, but it's not working. There we go. So retailers show their sales net, and this is how they calculate that amount. So this $100 is a reduction in our gross sales to get us net sales. Okay, so anyway, they've returned it. We've reduced the receivable. Good for us. Now, because the inventory is good inventory, in other words, it wasn't damaged, they just bought the wrong thing, we put it back on the shelf. We're going to try to sell it to somebody else. We debit inventory. They brought back some inventory. We're going to put $40 of inventory, that's our cost on it, back on the shelf, and we reduce our COGS, because we're saying, well, that inventory we thought we had sold, we went debit, COGS, credit, inventory. That sale never happened. So get rid of the COGS because it's inventory that was not sold at the end of the day. Last one, January 15th, we get paid. Now, how much do we get paid? Okay. Well, they owed us $3,000, but then they returned $100 worth of goods, so they only owe us $2,900, right? They owed us $3,000, they returned $100, they only owe us $2,900. Now, something I failed to mention, I should have, was there's terms on this. There's early payment discount that we're offering. And do they qualify? Well, terms 210 net 30 means they get a 2% discount if they pay within 10 days. They bought on January 6th, they pay on January 15th. Did they pay within 10 days? Yes. So they're going to claim a 2% discount on this, $2,900 times 2%. I think it's $58. Yeah, it's $58. So they're going to take a $58 discount. So what are they going to pay us? They're going to pay us $2,900 minus the discount. They're going to pay us $28.42. So let's debit cash for that amount, $28.42. We're going to credit AR for the full amount, which was $2,900 as of this date. And then that $58 discount, when we did this as a purchaser, we credited inventory. When we do it as a seller, we debit an account called sales discounts, or I'll just put discounts. $58. That's it. We've done all of the journal entries for Part A. Something that wasn't asked that's worth doing, that's worth calculating here, is what is our net sales? Well, up above, we said it's our sales revenue minus any discounts, minus any returns. So our sales revenue is $3,000, but then they returned $100, so it's only $2,900, and then we discounted it by $58. So our net sales here, after all is said and done, is $28.42. That should make sense. That's how much we got paid, right? That's our net revenue. That's what shareholders are going to be most interested in. So our net sales, $28.42 sales net. Our cost of goods is the COGS, $1,200, but then minus 40. Our cost of goods is $1,160. Sales minus COGS is gross profit. $28.42 minus $1,160 is $1,682. That's our gross profit. This is also called gross margin. So that wasn't asked for, but I often ask my students to do that. Now, I also ask them to give me the gross profit as a percentage of sales. So if sales are 100%, cost of goods is $1,160 divided by $28.42, 40.8%. And our gross profit is 59.2%. That's $1,682 divided by $28.42. 59.2%. So that is a number that any retail store will track very carefully. But that's sort of bonus content to Part A. Part B says, redo the January 11th entry. Redo January 11th, assuming the inventory was returned in bad condition and needed to be scrapped. Assume that a full credit of $100 was granted, but the returned inventory had $0 of value. Okay, so I'm just going to do January 11th sort of alternate history here in blue ink, sort of alongside here. So January, oh, my pen is too big. Let's shrink that by 1. Let's see, January 11th. Yeah, there we go. Sorry, Jan 11th. And so we're just redoing this entry. So what does that look like if the inventory was garbage? Well, we still debit sales returns $100. We credit their AR by $100 because we're giving them store credit. Even though they're bringing back garbage, maybe it got damaged in shipping and we're willing to eat it. It's a good customer. And we're saying, okay, well, we'll eat this one. So we're saying you don't owe us the $100 for that one. Now, in terms of debit, inventory, credit, COGS, what's the value of the inventory they're giving us back? 0. So in fact, you don't need to do this part. So it would just be debit sales returns, credit AR. You could debit inventory, credit COGS for the value you got back, 0, but you don't need to do journal entries for things that are zeros. And there we have it. We have solved Part B. We've solved the whole thing. Well done. As always, if these videos are helping, I do hope you'll consider helping me out. The likes and subs very much help the channel. Thanks for watching. Bye-bye. Welcome to Module 7 of our course in financial accounting, More Inventory. This module explores FIFO, LIFO, weighted average. If you're doing that type of stuff in your class, you are in the right place. So before we get into it, a little recap. So scenario 1 is a recap of stuff we learned in chapter 6, but it's worth going over one more time. So it's January 1st. My shoe store buys a pair of shoes from our supplier, $50 cash. So we date this January 1st. And of course, we want to do a journal entry. When a shoe store buys shoes, it is not buying shoes, it's buying inventory. So we debit inventory and we credit cash $50. Okay, so we've got our January 1st entry. Then on January 4th, a customer comes into the store. They buy this pair of shoes for $80. That's the business model, right? I buy it at a wholesale price. I sell it to my customers at a higher price, a retail price of $80. You can see the gross profit on this deal. 80 minus 50 is 30. But what's the journal entry look like? You'll recall we kind of do 2 journal entries in one here. We record the sale. So the customer gives us cash of $80. We debit cash. We credit sales revenue. This is a shoe store or a retailer doing what it does to earn money. It sells stuff. So this is us earning sales revenue. But then the other piece is the customer, when you have a retail store, they are always walking out of the store with some of what used to be your assets. We have to credit inventory $50, and we debit that new account, that new special expense account we abbreviate as COGS, but you'll recall that stands for cost of goods sold. So this is recapping some of the key issues from last chapter. Well, one of them, obviously we covered more ground than this, but I want to build on this specific relationship, right? When we sell inventory, debit cash, credit sales, debit COGS, credit inventory. Let's look at scenario 2, and it's layers up a few complications in front of us that we didn't look at last chapter. So same start. My shoe store buys a pair of shoes from our supplier for $50 cash. So I'm going to debit. This is January 1. DRCR. I'm going to debit inventory here, of course, for $50. And I'm going to credit cash for $50. And so I have a pair of shoes right now. Let me draw this beautiful pair of shoes. Oh my gosh. Spectacular. Yes, that is to scale. Those are perfectly awesome shoes. So I have one pair of shoes on the shelf. Now, I've just bought the pair of shoes. The cost to me was $50. I'm going to try to sell it for $80. Actually, let's note that this is a pair of shoes. Let me do this in green ink. Green ink. I put a price tag on these shoes. This is the price tag, and the price tag says, good Lord, this is getting away from me, $80. And my cost on these shoes, I'll do this in blue ink. My cost, cost $50. Okay, beautiful job. So I've got this one pair of shoes, $80 is the price, and it cost me $50. My shoe store buys a second pair of shoes from an outside supplier for $51 cash. Now, let's assume this is an exact same pair of shoes, the Nike Air, whatever. It probably cost more than this, but it's the exact same model, exact same size, exact same everything. But the supplier goes, hey, my costs are going up. There's inflation. It's going to cost you $51. We go, well, we're selling it for $80. We'll eat it. Now, maybe there'd be more of a protracted negotiation here. I don't know, but let's just assume for the purposes of this, we just buy the inventory. And again, our plan is to price this for $80. So debit inventory, credit cash. 51. So let's look at this second pair of shoes. It's identical to the first in every way. We are still pricing it at $80. Everything's the same, except for the cost is not $50. The cost of this one is $51. But other than that, it's the same pair of shoes. All right, we buy a third pair of shoes here. January 3rd, we go debit inventory. Don't worry, this will be the last pair of shoes we buy. Credit cash, and you can see the price has gone up to $55. Again, ridiculous that the prices are climbing so fast. It's some sort of weird hyperinflation, but it's just to illustrate a point here. Okay, so debit inventory, credit cash for $55. So we have a third pair of shoes on our shelf, and the price is $80. And these are all identical shoes. That's really important to say. But they just have different costs because I bought them at different times. Now, okay, so let's imagine the store display. I got my 3 pairs of shoes in some sort of pyramid configuration. Here they are all together in the store display. And the customer doesn't see the cost, right? When we walk into a store, you don't know what it cost the retailer. You can assume if they're charging you $80, it costs them something less than $80, but you don't know what it costs them. But anyway, it's laid bare here. Yes, they're all the same shoe, all costing the customer $80, but the cost of the supplier was slightly different across the board. Okay, now the purpose of this whole extravaganza, this whole art show. January the 4th, what happens? Somebody buys the shoes. They're all priced at $80, so, they give us $80 cash. Doesn't matter what pair they bought. Debit, cash, credit, sales, rev for $80, and then we debit cost of goods sold and credit inventory for how much? That's the $1 million question of this chapter. How much do I credit my inventory for? How much do I charge to cost of goods? Is it 50? Is it 51? Is it 55? Is it some other number? What should I charge cost of goods sold for? And the answer is, it depends on the company's accounting policy. So there are 4 options we'll explore this video in this chapter. The first is called FIFO, which stands for first in, first out. And I think of this as like milk example. When I go to the supermarket to buy milk, I'm a tall guy and I can look and I always reach to the back because in the back of the refrigerator is the freshest milk. And you go, oh, I got a better date than at the front. Well, why is that? Because they're trying to move their inventory first in, first out. They want to sell you the oldest milk because otherwise it'll go rotten on the shelf if everybody behaves like me and grabs the stuff from the back. So if this company was using first in, first out inventory on their shoes, which pair of shoes did the customer buy? the oldest, the first one, right? The first one we bought, the $50 shoes. So under first in, first out, the COGS would be $50. Maybe I'll say COGS here as a heading. Okay, so that's one option, right? That's one accounting policy they may have. If they use last in, first out, LIFO, what do you suppose the COGS is? What do you suppose the cost of goods sold is? Last in, first out. Well, I hope you said 55, because that's what COGS would be. It'd be the last pair of shoes. We assume that's the first one out. Unusual to have inventory that moves that way, so LIFO is a little bit more unusual for an accounting policy. There are some tax advantages to LIFO, but we'll leave that for a tax class. 3. What are other options that exist here? Well, one option would be take the average. Just go, okay, we're going to do an average cost here. And we call that weighted average. And we'll get into what we mean by weighted average when we get into examples in the chapter. But in this case, an average of those three, 50 and 51 and 55, if you took the average of those three numbers, you get 52. And it's important to note that 52 is not any of the numbers. There's a $50 pair of shoe, 51 and a 55. Add them all together, divide by 3, end up at 52. But none of the shoes themselves are 52. It just happens that that's the average. The final method is maybe we put RFID tags and we track each pair of shoes individually. And if we do that, there's a method for that. So we say, oh, which one did the customer actually buy? Did they buy this one? Did they buy this one? Or did they buy this one? If they bought this one, it's 50. If they bought this one, it's got to be 51. If they bought this one, it ought to be 55. Just which one did they walk out with? And if you're tracking your inventory that way, you would use a method called specific unit identification, specific unit ID. And you just say, I can identify which one they bought. I've got a cousin that's in the antique business. They own an antique store. And I promise you, when a customer goes in and buys an antique table, they don't go, well, what's the average? Or a FIFO, we'll assume we sold the first one. No, they go, oh, that is the oak table from 1932, and this is our cost on that. That was the walnut table from 1986, and this is the cost, and whatever, right? They would track their cost on each unit. When you go buy Toyota, it doesn't matter. Maybe Toyota has 7 Toyota Corollas on the lot at one time. They don't go, hey, what's the average when they track their cost and how much money they made? They go, we know the vehicle ID number of that Toyota Corolla. We will identify that specific unit and charge cost of goods. So what is our cost of goods sold? Well, it depends. It's going to be 50 if they bought the first unit, 51 if they grabbed the second one, and 55 if they bought the third one. So it's 1 or 50 or 51 or 55, depends on which one they bought. So that's specific unit identification. This chapter, we explore these various costing policies, inventory policies that a company may have. The best way to learn is to do lots of examples. So let's get started. Thanks for being here. See you in the next video. Bye-bye. Let's take a run through problem 7-2A. Now, as with all of my problems, you can download this workbook from tonybell.com. So, FIFO, LIFO, and weighted average. I'm going to break this into 3 parts. First, we'll do FIFO. Aberdeen Automart uses a perpetual inventory system and reports the following transactions for the month of May for one of its products. And you can see there's some inventory, some purchases and sales and more purchases. And it says do inventory records using FIFO. So we'll do that right now. It says under each of the methods, compute sales costs of goods sold and gross profit. We'll do that each method like one at a time. So we'll do that in this video for FIFO. And it says do journal entries for May 24th and May 31st. So we'll do those journal entries in this video for FIFO. In the next video, we'll do it all for LIFO. And in the final video, we'll do weighted average. Now, if you've watched previous videos where I've worked through this, you'll see I work through with a template. If you're not provided a template, though, you can make your own very easily to sort of track inventory as it moves through the system, FIFO, LIFO, or weighted average. And even if you're not told to do this, I think it's a good idea. It'll help you solve your problems. So let's get down to business. Now, the left-hand most column is just for the date. So let's go ahead and put in May the 1st, May 1. There we go. And we can see May 1st, we had beginning inventory. Change my pen color here. Beginning inventory of 20 units at a cost of $3 a unit. So 20 units, the cost was $3 a unit. That means we had $60 worth of inventory. 20 times 3 is 60. Oops, that wasn't a purchase. Sorry, so in terms of columns, right, this section we track dates. Here we track anytime we make a purchase. In this third column, this is when people screw up. We track our cost of goods sold, not our sales revenue, but our cost of goods sold, and we'll discuss that when we get there. And the final column is a running tally of what we have in inventory, and that's where we start. We had 20 units. The cost was $3 each. 20 times 3 is 60. All right, let's draw a line underneath and we can move on to the next step. So the next step, on May the 5th, we make a purchase. So May 5th, May 5th, we purchase 5 at $3.25 a piece. So this does indeed go in the purchases section. And 5 times 3.25 is $16.25. Did we make any sales on May 5th? Nope. So we go to our inventory running tally and we say, well, I had 20 units at $3. Did I sell them? No. Well, I still got them. Bring it down. We want to list all the inventory we have present on our site at May 5th. So on May 5th, I did have $23 units. And these are all the same inventories, right? It's all the same stuff. And I've added to it 5 at 3.25. And 5 times 3.25 is 16.25. So this is all the stuff I have. I have 25 units in total. I have 20 of the older $3 units, and I have 5 of the newer $3.25 units. And we're on to the next. So draw a line underneath, and we'll go on to May the 13th. On May the 13th, we make a sale. We sell 22 units. That's almost all the units we had. So I have to say to myself, okay, we're doing FIFO, first in, first out. That means we got to figure out, well, which 22 did we sell? Now you'll notice I ignore this $10. This is a price. And so my sales revenue on this day is 22 times 10. It's $220 in sales rev. But I'm not interested in sales rev. I'm interested in cost of goods sold, right? Sales rev is not on my mind when I'm making this table. So when I'm interested in cost of goods sold, I say, well, I sold 22 units. Which 22 did I sell and what was their cost? And so I have to look back up into this tab and I say, oh, well, I had 25 units to sell. I must have sold first in, first out. I must have sold the oldest stuff first. So of those 22 units, 20 of them, not 10, 20 of them were $3 units. 20 times 3 is 60. And 2 of them were 3.25. 2 times 3.25 is 6.5, leaving me, so I had 20 at 3. I sold 20 at 3, so I have no $3 units left. I had 5 at 3.25. I sold 2. That leaves me 3 at 3.25. And 3 times 3.25 is $9.75. Okay, there we have it. So if you can do that step, the sales, you can do FIFO. If you've understood what's happened here, that's great. It means you're in good shape to continue. If you didn't understand, that's fine, but pay attention on May 31st. Let's continue, and when we get to May 31st, give it another shot. May the 20th, we buy 7 units at $3.55, not $3.26, $3.55. 7 times 3.55 is $24.85. I didn't make any sales that day, so I'm in purchase mode. I had 3 at $3.25. I didn't sell them, so I keep those on the books, and I add to it 7 at $3.55 for $24.85. Draw a line, we're on to the next. And it's important we keep them in this order because we got to remember what came first, what came second, what came third. That's the idea of FIFO. That's also the idea of LIFO when we get to it. May 24th. we purchased 5 at 3.7. 5 times 3.7 is 18.5. I had 3 at 325. I didn't sell them. I still got them. I add to it 7 at 3.55 for 24.85. And I add to it 5 at 3.7 for 18.5. Okay, so that's May 24th. So again, making purchases is easy. You just bring down what you've got. Again, a lazy person like me might say, well, I can just remember that. Like I can look here and see the 3 and 7. Why do I have to rewrite it here? And the answer is, as things get more complicated, you'll lose the plot very easily. So this is the way to do it. May 31st. What happens on May 31st? Well, on May 31st, we make a sale. We sell 11 of these units. Now we have to say, which 11 did I sell? And the answer is the oldest 11. So I must have sold 3 at 325. I must have sold 7 at 355. And I must have sold just one of these 3.7 units. So 3 times 325 is 975. 7 times 355 is 24. And 1 times 3 is 3.7. So I had 3 at 325. I sold them all. I had 7 at 355. I sold them all. I had 5 at 370. I sold 1, leaving me 4 in inventory. 4 at 3.7 is 1480. And at that point, we've done it. We have completed our inventory record. Now, there's not a lot of inventory. This is very inexpensive inventory, but we've done the job. So that's it for part 1. Now, part 2 of these questions, I'm just going to move this to the side. Maybe I'll put it there. Let me just erase the scribbling that I did. Part 2 says, calculate sales, cost of goods sold, and gross profit. Sales, rev, COGS, and gross profit. So what is our sales revenue here? Well, I sold 22 units at $10 per unit. That's $220 that I sold on May 13th. Now here, revenue, we are using these numbers from the table, right? I had said ignore them when you're doing cost of goods. Well, these are revenue numbers. So 22 times 10 is 220. I can see my head's blocking here. I'm trying to duck and dodge out of the way. 11 times 10 is 110. And there you have it. 11 times 10 is 110. 220 plus 110 is 330. That is our total revenue. So our sales revenue, 330. Our cost of goods sold is just everything in the cost of goods sold column added up. So on May 13th, it was $66. And on May 31st, it was, well, whatever this is, 24 plus 9 plus 3. Well, we can total it up. The grand total for cost of goods sold, $104. And sales minus COGS is gross profit. Now, you know me. I always like to say these things as a percentage. Let me just get rid of that entirely. Oh, I can't get rid of those entirely. So to say them as a percentage, you just divide by the sales number. So you can see 330 divided by 330 is 1, and of course that converts to 100%. 104 divided by 330 is 31%, and 225 divided by 330 is 68%. The final thing this question asked for, and it could have asked us to do all the journal entries, but it specifically said, give me the journal entries that are required on May the 24th. So give me a journal entry for this one. Oh dear, what did I just do? I clicked over out of my Excel. That's what I did. Give me this journal entry and give me this journal entry, May the 31st. So let's do those two journal entries. Purchase journal entries are easy. On May 24th, we bought some inventory. So debit inventory and credit AP, right? Or credit cash if we bought it for cash. We don't know. I think a good assumption is we bought it on account. And what did we pay? $18.50. And you just took the number. I took the number from right here. That's the dollar value of the inventory I purchased. Now, what about May the 31st? Let me just format this. All right, that'll have to do. On May the 31st, what happens? Well, we make a sale. Let's assume the sale happened on account. We sold how many units? 11 units. And I remember the price was $10 a piece. So debit AR or cash, you know, it's not said here. In this credit to AP, we could also say or cash. And how much did we earn? Well, again, it was 11 units that we sold at $10 each. It was $110 in revenue, and you'll recall that number. And we credit sales rev for 110. We also have to debit cost of goods sold and credit inventory. And this amount is, well, what was my cost of goods sold on May 31st? And we get it from this table. 9 plus 24 plus 3, $38.30 is our debit to COGS and our credit to inventory. Let me zoom out just a touch. And there we have it. This is the entire thing that was asked for. Up here, this is our inventory record. Here's our sales, cost of goods sold, and gross profit, and this is the journal entry. Once more, if your professor does not give you this table, you should be able to make it by yourself in about 5 seconds. Like, here we go. If my professor didn't give me the table, I would just remember, okay, date, purchases, COGS, inventory. And then in our wider three, you just put QCT, quantity, cost, total, QCT, 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 and you can make this table by yourself, right? You don't need to be provided some fancy Excel template. You can just do it and answer it all by hand. All right, I hope this video helped, and if it helped you, I always am hoping, I'm thirsty for those likes. Don't be shy about hitting the like button. If you really liked it, don't be shy about hitting the subscribe button. Thanks for watching. Part 2, we'll do LIFO. Stay tuned for that. We have been working through problem 728. In part 1, we solved the problem you doing FIFO. This is part 2. We're going to solve this with the LIFO method. So Aberdeen Automart uses perpetual inventory system and reports the following transactions, and we have to do an inventory record using LIFO. Now, if your professor does not provide you with a template, now there's a template linked below and there would be linked in my workbook. If your professor isn't a nice guy like me and doesn't provide you a template, though, I show in the last like 30 seconds of the FIFO video, I show you how to make one of these. It takes 2 seconds to do. Highly recommend you make one if you're not being provided with the template. Let's go though. We're doing LIFO, and the leftmost column is just for the date, obviously, May 1st. The second section, we track any purchases. Well, on May 1st, we didn't make any purchases. We just had a balance forward from last month. On May 1st, we didn't make any sales. We just show a balance forward, and that's what the final column is. It's a running tally of what we have in inventory. We had 20 units at $3 a unit. That's $60 worth of inventory. Draw a line underneath and carry on to the next. I can't find the button to draw a line underneath. Oh, there it is. It was hiding on me. There we go. Oh, I hit the wrong thing. Having tech difficulties here. It's kind of tricky to lay this out. I'm not used to, I don't usually work in Excel, right? I work in a different piece of software, but that's no problem. We'll muddle through here. May the 5th, we do make a purchase. So we're going to use this column. May the 5th, we buy 5 at $3.25 each. 5 times 3.25 is $16.25. Now, May the 5th, did I make any sales? Nope. So I have a running tally of what's in my inventory. I had 20 units at $3 a unit. I still have them, so bring it down. And now I'm adding to it 5 at 3.25 for $16.25. I make no attempt to total. I just go, that's what I've got. Because, again, we're doing LIFO. We got to remember, what did we buy first? What did we buy second? What did we buy third? If I tried to combine them, I would lose that information. So that's not what I want to do here. May the 13th, we make a sale. Now, LIFO says we sold our most recently purchased stuff first. So I sold 22 units. Remember, we don't worry about this sales price. That's revenue. We're interested in cost of goods sold, and it's our cost, and our cost is tracked here. So which 22 units did I sell? Well, I must have sold these ones first because I got rid of the newest inventory first, 5 at $325 for $16.25. And then again, I sold 22 units in total, so I must have sold 17 of these 20 that I had there. 17 times 3 is $51. And what does that leave me with? It leaves me with three $3 units, right? I had 5 of these. I sold 5 of these. I had 20 of these. I sold 17 of them, leaving me with 3. And if you got that step, you pretty much have LIFO dialed. We'll make a couple purchases and you'll get another opportunity to try if you're feeling a little shaky here. So on May the 20th, we purchased 7 units at $3.55, not $3.50, $3.55. So that's $24.85. I didn't make any sales today, so I'm not going to use anything there. And I bring down what I already had, 3 at 3 for 9. And now I have 7 at 3.55 for $24.85. And that's it. Again, no attempt to combine them. No attempt to do any totaling here. On May the 24th, what happens on May the 24th? I buy 5 more at 3.7. 5 times 3.7 is 18.5. I had 3 at 3 for 9. I've added 7 at 3.55 for 24.85. And now I'm adding 5 at 3.7 for 18.50. So again, it's just a running tally of what I have. I always find when I work in Excel, I might be going too fast, and I apologize if I am. You can slow it down though, right? Don't be shy about pausing the video or just playing at a slower speed. If I'm going too slow, don't be shy about using those settings to pay at a faster speed. And if I'm speaking the wrong language, I've just learned they dub me. There's an AI dubbing, so you can hear me in Japanese if you want. It's pretty exciting. May the 31st. All right, I sell 11. Which 11 did I sell? And it's the newest 11. So I sold 5 at 3.7. That gets me up to 5 sold. And out of these 7, I must have sold 6 of these 7, right, to get me up to 11. 6 at 3.55. So 5 times 3.7 is 1850. 6 at 3.55 is 2130. What does that leave me with? Well, I had 3 at $3. I didn't touch those, so I still have 3 at 3. And of these 7, I sold 6 of them. So that leaves me with 1 at 3.55 for 3.55. Now, what about this 5 at 3.7? I sold them all. So they're gone. So they're not in my ending tally of my inventory. And at that point, we have completed a beautiful inventory record. We still have to calculate sales, COGS, and gross profit. Our sales, well, can do the math here. 22 times 10 is 220. 11 times 10 is 110. This is $330 in sales, right? 220 plus 110. Our cost of goods sold, just sum up the COGS column. 16 plus 51, 18 plus 21. Sum them all up, you get 107. 330 minus 107 sales minus COGS is gross profit. Our gross profit is 222.95. We'll do it as a percentage as well. So divide everything by 330. Of course, 330 divided by 330 is 100%. 1 is 100%. 107 divided by 330 is 32.4%. And 222 divided by 330 is 67.6%. So we have done parts A, which was prepare this template. Part B, calculate sales, cost of goods sold, and gross profit. Now on to part 3 or part C, which is do some journal entries. Let me just lay this out. Make it look nice. There you go. So it asked us for just May 24th and May 31st. It could ask for all the journal entries, but just to save us time, it only asked for 2 of them. May 24th. Now, why didn't it ask for May 5th? I just chose not to, right? If I asked for May 5th, it would be very similar to May 24th. Let's do May 24th, though. May 24th, what happened on May 24th? We bought some inventory, right? There was a purchase of inventory on May 24th. We purchased $18.50 worth of inventory. Debit inventory, 18.5, and credit AP. And since it's not made clear, we could also buy our inventory for cash, in which case we would credit cash. Debit inventory, credit AP, or cash. And then on May the 31st, what happened? Well, I made a sale. So debit cash, or AR if it was on account. And what was my sales revenue on May the 31st? Well, I need this information. I sold 11 units for $10 each. It's a $110 sale that I made. And we credit sales rev, of course. $110. We're going to debit cost of goods sold, and we're going to credit inventory. And for how much? Well, it's just this amount right here, right? It's May 31st COGS, $18.50 plus $21.35. $39.80 and $39.80, and there we have it. We have done all of the relevant journal entries. Now, if it had asked me to do the May 5th journal entry, very easy. Debit inventory, credit cash or AP for $16.25, right? Same journal entry here, right? Purchases are the same. May 20th, debit inventory, credit AP for $24.85. May 24th, debit inventory, credit AP for, we did that one, $18.50. Same thing for the May 13th sale. Our revenue on May 13th was $220. So we would debit AR, credit sales for $220. And then we would debit COGS, credit inventory for $67.25, right? 16 plus 51. $67.25 would be our debit to COGS, credit inventory if that was asked. The only reason we didn't ask is because once you've done like one purchase and one sale, it's all the same. That's something in accounting, right? It's when you're doing this on the regular, there is a lot of repetition, certainly. Okay, so we have solved part 2. We've done this LIFO. One more part. Stay tuned for the weighted average method. Thanks for watching. See you then. Bye-bye. Welcome back. We've been working through problem 728. In part 1, we did FIFO. In part 2, we did LIFO. This video, we're going to do the weighted average inventory record, and we're also going to answer what the sales, COGS, and gross profit are, and we'll do a couple of journal entries as well. But the main focus is preparing and understanding how the weighted average method works. So to do it, I've prepared an Excel file. You can find the link below or on my website, tonybell.com. It's all linked through, but if you're not given an Excel file, you can just prep this by hand, and I show you how to do that in like the final 30 seconds of part 1 of this series. So if you want to know how to prepare this by hand, it's not too complicated. Okay, so we're doing the weighted average method. Now remember the deal with the weighted average method. The weighted average method says, what's the average cost of what I have in inventory? But if I have a lot of one unit and less of another, I need to consider that weight. And you'll see what I mean here. Let's jump in and start with May 1st. May 1st, we have a beginning inventory of 20 units at $3 a unit, not a purchase, sorry. So we're not going to use our purchases column. We're not going to use our cost of goods sold column. Just what's our opening inventory? 20 units at $3 a unit. That's $60 worth of inventory. Put a line underneath, and we're on to the next. Now, whenever you make a purchase under weighted average, that's when you've got some work to do. So we purchase 5 at $3.25, so equals, 3.25. 5 times 325 is 1625. So very much like FIFO and LIFO, I say, well, I had 20, I bring it down, 23 and 60, and I'm adding to it 5 and 3.25 for 1625, of course. Now remember how to calculate a weighted average. So anytime you make a purchase, you're going to try to determine what's the average cost of my inventory. Now, if I were to do a simple average of these two numbers, right, 3 and 325 would be $3.12, 3.125. But I have way more $3 units than I have 3.25 units. So I would expect a weighted average to be weighted towards the 3, right? There's more of these $3 units. Now, how do I do a weighted average? It's not that complicated. You add the left side, you add the right side. So let's do that. So we have 25 units in total. The total value of our inventory is $76.25. So what is the average cost of what I have in inventory? Well, I go $76.25 divided by $25, 76.25 divided by 25, and I get 3.05. Now you can see that's not in the middle point, right? The midpoint was $3.12. We're only $3.05. Why is that? Well, because again, I got way more of the cheap units, right? Way more of the $3 units. So my average cost of what's in my inventory, $3.05. Let's continue. May the 13th. I sell 22 units. Now, with FIFO, I would have said, well, what's the oldest unit? What's the newest unit? With average cost, I said, well, what's my average cost of goods sold? So I didn't make any purchases today. I'm not going to use that section. I'm going to use my cost of goods sold section. Remember, we don't use these revenue numbers. These are revenue numbers. These are not cost numbers. So I have to say, what's the average cost of these 22 units I sold? And the average cost, we just did all that work to figure out the average cost is $305. So 22 units, the average cost is $305. 22 times 305 is $67.10. So I had 25 units, I sold 22 of them. What's my running tally? What do I have left in inventory? And the answer is 3 at 305. 3 at 305 is 9:15. That's coincidentally, that's my bedtime, 9:15. And there we have it, May 13th in the bag. Let's continue. May the 20th. We purchased 7 units at $355. 7 times 355 is $24.85. I didn't make any sales today, so I don't use cost of goods sold. And I go, well, I had 3 at $305 for $9.15. I've purchased 7 at $355 for $24.85. And guess what? Whenever we make a purchase, we re-average. So I'm going to total the left. I'm going to total the right. I take the right number divided by the left. 3 plus 7 is 10. 9 plus 24 is 34. 34 divided by 10 means the average cost of our inventory is now 3.4, the weighted average cost. Now again, if I were to take an average between 305 and 355, well, let's just do an average. That plus that divided by 2. I'm going to need some brackets here or it's going to mess me up. Bracket there. Oops. Get rid of the plus maybe. Oh, I got to hit equals. That's the thing. There we go. And the average cost of what's in my inventory is $330, but you can see the weighted average is $340. Why would that be? Why is it not just $330, the average between $305 and $355? And the reason it's closer to $355 than $305 is because I got more of the expensive units, right? I got 7 expensive ones, I got 3 cheaper ones, so my weighted average is a little higher than a simple average. Okay, let's continue. May 24th. I buy 5 more, 5 at 3.7. My costs are really skyrocketing here. Equals 5 times 3.7, 18.5. So I didn't make any sales today. I had 10 at 3.4 for 34. I'm adding to it 5 at 3.7 for 18.5. Add the left side, add the right side. 10 plus 5 is 15. Oops. What is going on? Keyboard lack of skill right now. 34 plus 18 is 52. 52 divided by 15 is 3.5. So our weighted average inventory cost is now 3.5. Now I've made the numbers work out beautifully and cleanly. When you do weighted average, you will often end up with awkward long decimals. I would suggest take as many decimals as you reasonably can. Take at least as many as what your professor recommends, probably at least 2 or 3. This one, though, the numbers worked out well. May 31st, we make a sale. So no purchases on May 31st. We're not going to use this section. We're going to use our cost of goods sold section. We sold 11 units. We have to say, what's the average cost of our inventory? Well, we've just done all this work to say the average cost of our inventory is 3.5. 11 times 3.5 is 38.5. I had 15 units. I sold 11. What do I have left? I've got 4 units left. Average cost is 3.5. 4 times 3.5 is $14, and we're done. So we have done our inventory record for this company, for this situation. Let me move this over to the side, and we're going to calculate sales, sales revenue, cost of goods sold, and gross profit. I got a little cough coming. There we go. Okay, so sales, COGS, and a gross profit. Let's do it. So our sales revenue, well, we've done this a couple of times. The May 13th sale was $220. The May 31st sale was $110. Oh, I'm like looking at the numbers, highlighting them, but they're behind my dopey head. So I sold $220 on May the 13th, and I sold $110 on May the 31st. Just 22 times 10 is 220. 11 times 10 is 110. And 220 plus 110 is 330. I sold $330 worth of product. My cost is just the sum of the COGS column, 67 and 38. It's 105. Sales minus COGS is the gross profit. How much did I make? I made $224 on these sales. Now we set the sales rev to 100%. I like to express these numbers as percentages. So our sales, of course, is 100%. Our COGS is 32%, and our gross profit, therefore, is 68%, our gross profit percentage, and that's a number that companies monitor very closely. The final piece here was to do a couple of journal entries. We were asked to do journal entries for May the 24th and for May the 31st. So here's my May 24th journal entry. I bought some inventory. So I debit inventory. I bought $18.50 worth of inventory. And I credit accounts payable or cash, right? So generally good to assume on account unless you're told otherwise, but question didn't say, so I would accept either. Then when we make a sale, remember, when you make a sale of inventory, you're going to debit cash or accounts receivable. Again, depends on what the question says. Often it'll say all inventory transactions are on account. Like that's a very common thing you read in these questions, and that's very true to life, by the way. Debit AR, credit sales rev. Debit COGS, credit inventory. That's a very normal inventory sale journal entry. Okay, well, what was our AR? What was our sales rev on May the 31st? Well, we just did the math. It's $110. We sold 11 units at $10 each. It's $110 in sales revenue. And what was our cost of goods sold on May the 31st? Well, it's the whole reason I make the table. My cost of goods sold was $38.50. And there we have it. We've gone through this whole problem doing FIFO, LIFO, and now we've done weighted average. If you've gone through all of those with me, for goodness sakes, I hope you won't be shy about hitting one of those buttons. I do hope the video helped, and if it did, I hope you will help me. Thanks for watching. Have a great day. Bye-bye. To start this module, I wanted to share a quick story about me and my dad. Even though we look very different, we're actually very similar people. And so it shouldn't have surprised me when a few years back, a funny thing happened. We bought what was essentially the same car right at the same time, and we didn't know it. We didn't talk to each other about it beforehand, but we bought the same car at the same time. And for this example, for this conversation, let's pretend we bought the exact same car on the exact same day. It was close enough. Same make, same model, same everything. And so we have this $30,000 car. And, if, we both had said, well, we'll get 10 years out of it. It's a Toyota. It's a pretty reliable automobile. And so this $30,000 car that we each think is going to last us 10 years, according to straight line depreciation, assuming no residual value, we'll discuss that later in the chapter, we would say, well, it's going to depreciate at a rate of $3,000 per year, right? These cars will lose value at a rate of $3,000 per year. But my dad's car and my car, even though we're similar people, our cars lived very different lives. My dad was just becoming a grandparent at that time. My sister was starting to have kids, so I was having new nieces and nephews around. And my dad lived in the interior of British Columbia, Canada, in a city called Kamloops, where my sister lived in Vancouver. And my dad was such a devoted grandfather that when my sister wanted to go back to work, he would drive from Kamloops to Vancouver. He'd get up at 4 a.m, drive to Vancouver, and then when she got home from work at 5 p.m, he'd drive back home. And this was a pretty substantial drive. You can see it's 380 kilometers. I think that's 220 miles for you American folks in the audience. And this is through like pretty treacherous mountain roads. He would do it in January and February. It was a very devoted thing for a grandfather to do. And at the same time, so he had his car just driving up and down over these salty, snowy roads. My car was sitting in a garage because I had just moved very close to the university where I teach. And in fact, this isn't where I live exactly, but it's about the same distance from the Starbucks near my house to the university. And you can see it's an 800-meter walk for you Americans. I can't help you there. What is that? Maybe 900 yards, 1,000 yards, something like that. It's a 12-minute walk. It's actually quicker for me to walk to school than to drive. And so my car was really going nowhere, where his was going thousands and thousands of kilometers a week. And so as a consequence, you look at the car at the end of the year and you go, well, we both have these $30,000 cars. We both think they're going to last 10 years. Our cars both depreciate $3,000 a year because we're using straight line depreciation. Whoops, mess. It's ironic. I can't draw a straight line when I'm writing the words here. Crooked line depreciation. So our cars would both depreciate $3,000 a year if we followed straight line. This chapter says, well, does that make any sense? Shouldn't Tony's dad's car depreciate a lot faster than Tony's car if he's driving the car a lot more? And there's a depreciation method, not straight line, that considers that. So we'll learn that depreciation method. It's called units of production. We'll also learn a method called double declining balance depreciation, and we'll learn some more complexities. What happens if you get rid of the car? You think it's going to last 10 years? It's a lemon. You sell it after 6 years. What happens if you use it for 15 years? How do you deal with those quirky situations? Well, that's what this module is all about. I can't wait to get started. See you in the next video. Let's take a look at problem 8.2a, a depreciation problem. And this has us doing straight line depreciation, which we learned in chapter 3. There's a couple quirks that we add on to it this chapter, but pretty straightforward. Units of production depreciation, which is not based on time, but based on how much you use the asset. So that's an interesting method. And the last one is the one that gives students the most trouble, double declining balance depreciation. It's easy once you've set it up, but setting it up can be difficult, and double declining balance is an aggressive, accelerated depreciation method. And we'll discuss all of them, and we're going to work through them all, I hope, in this one video. As we work through this problem, if you're looking to download this, just go to my website, tonybell.com. You click the PDF link. You can download a copy of the workbook for yourself. There's no logins, no nothing. You just get these juicy, beautiful problems. Let's get into it. On March 31st, 2029, Kemp Company purchased a new car for $25,000 cash. Debit card, credit cash, 25 grand. The car had an expected useful life of 5 years and an expected residual value of $5,000. What's a residual value? A residual value is how much we think the asset is worth when we're done with it. So after its useful life to us, how much do you think you can sell it on to the next person for? $5,000. So that has implications for depreciation. Depreciation is we're reducing the value of the asset, but we don't want to go from 25 down to 0. We want to go down from 25, the value of our asset, down to 5, the value we think we can sell it for. So that means, how much do I depreciate this asset for? Well, I hope you're saying 20, right? We go from 25 down to 5, it's a reduction of 20. It's a little calculation here that might be helpful. Our cost minus our residual value equals, I always whoop when I write poorly. I hope you're able to read that. Depreciable cost. So our cost minus the residual value is the depreciable cost. $25,000 is what they cost us. $5,000 residual value means there's $20,000 that we need to depreciate from our asset. Now we'll do straight line first, and we have all the information we need up to here, right? We can just stop reading here. The rest of this is all about units of production. It tells us how many kilometers we're going to drive, and we depreciate the asset base not on time but on kilometers driven, but that's units of production. Straight line, we got all we need. We have the cost of the asset, the residual value, and the number of years of service we think we're going to get out of the asset, and this thing we think we're going to get 5 years. So it's a $20,000 asset, or $20,000 in depreciation rather, we're going to take over a 5-year period. That gives us a depreciation rate of $4,000 per year. And so we would just do debit depreciation expense, credit accumulated depreciation for $4,000 for every full year of depreciation. But it asked us to make a schedule of depreciation over the life of this asset. So let's think about the years we're going to own the asset. We're going to own it in 2029 from March 31st to a fiscal year end of December 31st. That's 9 months. So in 2029, we're going to own it for 9 months. I'll just put 9/12 there is a fraction of the year that we'll own it for. In 2030, we're going to own it for 12 months. We'll own it for the full year. 2031, 12 months. 2032, 12 months. And let's just sort of think about this. We're buying it March 31st, 2029. We're going to own it for 5 years. So what is 5 years later? It's March 31st, 2034. So let's sort of truck on here. 2033, we'll obviously own it for the full 12 months. And in 2034, well, we're getting rid of it. If everything goes according to plan, we're getting rid of it March 31st, 2034, 3 months. And again, that's 3/12 of a year. Okay, so why did I do all that? Well, one, just to show you, like, we're doing a schedule for the entire life of the asset. We haven't done something like this before, so it's useful to know how long we're owning it for, how long we're planning to own it for. In total, if you add this up, 12 plus 12 plus 12 plus 12, that's 48. 48 plus 9 is 57. 57 plus 3 is 60. Oh, my goodness. Try that again. 60 months. So that is 5 years as sort of planned. So let's go through our straight line depreciation expense. Straight line depreciation expense. And for every full year, well, we said it's $4,000 a year straight line. So every full year is just $4,000. What about the partial years? Well, this one is 9/12 of 4,000. 9/12 of more than 3/4, right? 75%. 9/12 is 75%. So this is 3,000. And again, that's just 9/12 times 4,000. And this one is 3/12 times 4,000, which is 1,000. Add it all up, and you'd see 4, 8, 12, 16, 16, 19, 20. $20,000 in straight line depreciation over the 5-year period. Again, don't get confused. Sometimes a student looks at this and goes, isn't this 6 years? 20, 29, 30, 31, 32, 33, 34. That's 6. Why do we call this a 5-year asset? Well, the first year isn't a full year and the last year isn't a full year. If you add it all together, it is 5 years. So again, $20,000. Straight line has served its purpose. I probably overtalked this, right? I didn't need to go so long, but we're learning it for the first time. I want to make sure I pay attention to every detail. It's straightforward. You buy an asset, you just take the same amount off every full year and you go, okay, that's how it works, right? I'm giving my best estimate for how it loses value, and there we go. Sometimes people look at this and they go, this is not good enough, because some years I really push the asset hard and the asset falls in value more, and some years I barely use the asset, in which case I shouldn't depreciate it much. Shouldn't I depreciate not based on time going by, but based on usage? And that's what units of production depreciation says to do. So that's it for straight line. Let's do units of production now. Units of production says depreciate not based on years, depreciate based on usage. And in this case, how do you measure a car's usage? Kilometers or mileage. So exact same starting point though. The cost of our asset under units of production, which I'll do in blue ink here, minus the residual value gives us a depreciable cost of $20,000. Now, rather than divide by the number of years, 5 years, I'm going to divide by the estimated life in kilometers. I think I'm going to get 100,000 kilometers out of this asset. So it's $20,000 in depreciable cost divided by 100,000 kilometers. My depreciation rate is 20 cents per kilometer. And look at this, I've already estimated my kilometers. You can see the total here is 100,000 kilometers. And I've said, well, in 2029, I think I'm going to drive 10,000 kilometers. Well, if I'm charging myself 20 cents a kilometer in depreciation, that's $2,000 of depreciation. The next year, it's $4,000 of depreciation. The next year, I'm driving more, $5,000 of depreciation. The next year, driving a little less, it's $4,400. 22,000 times 0.2. 18,000 times 0.2. 3,600. And 5,000 times 0.2 is 1,000. So the total here, and you can also do the math across, but the total here is going to be $20,000 in depreciation. Now, it's important to note, this is if everything goes perfectly according to plan. Of course, in 2030, we're not going to drive exactly 20,000 kilometers. If we drove 19,472 kilometers, we'd be close. And in reality, when we get to that year, we check the odometer every year and we say, this is how many kilometers I drove, and therefore this is my depreciation expense for the year. This is just our game plan, right? This is our estimate based on a game plan before we've even begun. But know that in reality, these numbers will be different when you check the odometer on the asset and how much you used it. And I think problem 8.4 shows you a more realistic example of that. But this one is fine, and that's our game plan. So comparing straight line depreciation to units of production, UOP, depreciation expense, let's put them side by side on the same table. So $2,000 in 2029, 4,000 in 2030, 5,000 in 2031, 4,400, 3,600, and 1,000. That does total to $20,000. Looking at them side by side, the point of this was, let's just look at the biggest month for units of production, the biggest year rather, 2031. We said it was 5,000, where straight line said 4, and it sort of should hit your intuition as correct that the year I drove the most, I would depreciate the asset the most. Straight line says, no, just keep it simple, same every full year. Don't overthink this. Units of production says, I'd like to overthink it a little bit. I drove the asset more, I should depreciate the asset more. And so units of production has done its job. Straight line's also done its job. By the way, these are all estimates and guesses. Units of production may be a more educated guess for some purposes. Now, double declining balance is the last one, and it'll take us a little bit longer than the first two. Double declining balance is the most complicated of the three, and it's the one that GPAs get hurt by this one more than the other two. It's called an accelerated depreciation method. There's an old saying, a car loses most of its value when you drive it off the lot. If you think of some computer equipment, if you think of some computer equipment, something like this, it loses value, but it doesn't lose value evenly over time. And it doesn't even lose value in proportion to its usage. It just loses a big chunk of value at the start because it goes from being new equipment to used equipment, right? It loses a big chunk right in the early days. So double declining balance says actually most assets, they lose value like this, and then it kind of flattens out. We should design a depreciation method that tracks with the reality of the value of the asset. And there are some assets that behave this way. So double declining says depreciate the asset quickly. Now, unfortunately for you or for a student in the class, you have to make a bit of a table to do this. I don't give my students a table to fill in. Maybe your professor does, but your table is going to look something like this. Let me just change the ink color. So it's going to have a bunch of headings. So year, beginning, book value, depreciation rate, number of months, depreciation expense, and ending book value. I know that's a lot to sort of take in. If you can just get that, you got it made. You do. But just getting to that point can be a pain. So let's start to slot things in. Year, well, our opening year here is 2029. Beginning book value is what you paid for the asset. So beginning book value starts with what I paid. And what we paid is $25,000. And this one's a little bit weird because the other ones, our starting point for the math is this depreciable cost of 20. With the units of or a double declining balance, we start with what we paid, 25. Okay. So on to depreciation rate. Here, to figure this out, you take 1 divide by the number of years, and you get a percentage. So 0.2, which is 20%. And as the name suggests, 20% is what we took for straight line, right? 4,000 a year. Here we double it. That's what makes this double declining balance. You get 40%. That's your number. So you got to get used to doing that. It's double declining is based on the number of years. So you take 1 divided by the number of years, you get a percentage, you double it. That's what makes a double declining balance. Number of months in 2029, 9 months. We already had the number up above. This was, we bought it in March 31st. So 9 months to December 31st. So how do I figure out my depreciation expense? I multiply across. Let's see if I can get a calculator to be in the right spot for me. Looks good to me. 25,000 times 0.4 times 9 divided by 12. I get 7,500. Okay, so my beginning of year value of my asset was 25 grand. I'm going to depreciate it for 7,500 in the first year, bringing me down to an ending book value of 17,500. That's 25 minus 7,500. Okay, that's 2029. 2030. Not beginning with 25,000. I start with 17,500. My depreciation rate, 40%. How many months? 12, right? We own it for the full year. 17,500 times 0.4 is 7,000, leaving me 10,500. Let's move on to 2031. I start with 10,500, 40% times 12 twelfths. Again, times 12 twelfths is times 1. 10,500 times 0.4 is 4,200. So we just have to be on guard here for one thing. And the thing is, the residual value. We sort of ignored it, right? At the start of each of the other questions, we said, oh, I got to worry about this residual value. I don't want to depreciate more than $20,000 for my asset. Here, we just start with $25,000 and start blasting away. We have to say, my ending book value, just a little note to self, don't go below the residual value. So in this case, $5,000. That's note to self. Don't go below $5,000 because we're about to go below $5,000 in a second. So, okay, I go 10,500 minus 4,200. It's 6,300. Did I go below 5,000? No, I'm still good. 2032, we ended 2031 with 6,300 in our ending book value. So that's what we opened 2032 with, times 40%. Times 12/12ths, 6,300, 6,300 times 0.4 is 2520. And let's see, 6,300 minus 2520 is 3780. Now, this will be very common for students to do on tests. And what I say is, once you get to this point, just go, uh-oh, I gotta know I'm below 5,000. That triggers something in my mind. I draw a line through this. This is not correct. So how would I fix it? Well, I just go 2032. I start with 6,300. I ignore everything in these two columns and I plug. A plug just means I'm going to put in the answer that gives me the outcome I need, which is I can't go below 5,000, but I want to go all the way up to 5,000. So how would I go from 6,300 to 5,000? What is my plug value? 1,300. Now, we're not done because we own this asset in 2033 and 2034. So I start with a $5,000 asset. Again, I cannot put in percentages here. My plug is 0. I end at 5,000. 2034. I start at 5,000. My plug is once again 0. I end at 5,000. That's it. Sometimes this plugging doesn't sit well with students. They go, I don't like plugging. Neither do I. But it is a reality in accounting because a lot of accounting is based on estimates. And what we've said fundamentally here is 7,500, totaling our depreciation here, plus 7,000, plus 4,200, plus 1,300, is 20,000. We've said our total depreciation expense here needs to be 20,000. Well, if I put a bigger number in there, one of my estimates is going to get messed with, right? And so the overriding estimate is we don't want to depreciate below our estimated residual value, so we're going to depreciate this for maximum $20,000, at which point we're going to stop depreciating it. So there we have it. We've done double declining. Let's compare now. I'm going to put double declining numbers on the same table. DDB, depreciation expense, and it's 17,500. My gosh, different world from the other two. Or not 17,500, rather 7,500. That would have been insane. Plus 7,000, 4,200, 1,300, 0 and 0 for a total of $20,000. Okay, let's compare all three of our methods. Maybe I will screenshot this and just put it in its own spot. Let's put it down here just to have it all in one spot, all by itself. Get rid of my calculator here and let's discuss these three. So we've answered the question. Like this, what you're looking at is the answer to the question. They all serve different purposes, these depreciation methods. Straight line, very straightforward. Same depreciation every full year and simple, right? Like keep it simple. Units of production fluctuates with usage. Double declining balance goes fast, and you can see how much faster it is. It's way faster in the early years, way slower depreciation, way lower depreciation in the later years. But it's important to note, they all end up in the same spot. They all say after 60 months, this asset, we're going to depreciate $20,000 from the value of our asset. Now, you may be asking yourselves, which ones do real companies use? Which ones do I prefer? And the answer is, it's like, I think somewhere 90+% of assets are depreciated using straight line. Very, very few, this one is like around 9 to 10% for double declining, and a number approaching 0 to 2%. I don't know, maybe my math is bad here, for units of production. Units of production is the least used of the bunch, and you may think, why? I like units of production. I like units of production. It hits my intuition as being like, yeah, that makes sense. I use it more, depreciate it more. The reality is much trickier than that. So I always think of my mom when I think of units of production. She was a home care nurse. And I think about the accountant in the office there. And let's just say there are 100 home care nurses driving company vehicles in British Columbia. So 100 different vehicles in British Columbia that they need to depreciate. So let's say it was, again, $25,000 vehicle, $5,000 residual value, exactly the vehicle we were looking at. That accountant can just say, hey, it's another year, my depreciation is $4,000. Or they can go to 100 nurses and say, check the odometer on your car. Oh, your depreciation on that car was $3,982. Your depreciation on that car was $4,268. In every car, you got to do 100 different depreciations. Or I can go, hey, all my cars are a year older, all of them take a $4,000 depreciation. And that is on a car, and a car is a perfect asset for units of production. Now imagine all the assets that don't make any sense for units of production. You're sitting in a chair right now. How would you do units of production on a chair? Would it be, well, how many times my butt hit the seat? Oh, I've gained weight this month. Maybe I should take more. Like, it doesn't make any sense, right? So many assets, you just can't do units of production. And even the ones where it makes sense, it's a big pain in the neck for the accountant. So most accountants don't do it. Why is double declining balance used? Most governments, for taxation purposes, do a form of declining balance depreciation. And the reason is it's harder to manipulate. But anyway, there you have it. 3 different depreciation methods. Straight line, very straightforward. Units of production, maybe a little trickier. The tough one, though, and the one that I always test is double declining balance, and students do tend to struggle here. So I hope with the help of this video, you're not going to struggle, and I hope you're not going to struggle in hitting one of those buttons. Thanks for watching. See you in the next video. Bye-bye. Let's have a run through problem 8.3a, disposing of a depreciable asset at a gain or loss. When it comes to midterm exams, midterm 2 of my class, I love asking problems like this, often using straight line depreciation as we do in this question, but also units of production, double declining balance as we will do in problem 8.4. But the reason I like it is because it tests students on, can they do depreciation journal entries, which we will do here, and it also tests them on, like, what happens when they sell an asset and get more money than they were planning for or less? How does that work? And so that's what we look at in problem 8.3. It's a great type of problem. Highly recommend you practice these. Bills Towing purchased a new tow truck on April 1st, 2029 for $110,000 cash. The company expects to keep the tow truck for 10 years, after which time it expects to sell the truck for $10,000. That's, of course, the residual value, salvage value in other terms. The company's accountant wishes to use straight-line depreciation. Bills Towing has a fiscal year end of December 31st. On October 1st, 2030, now we thought we were going to have the truck for 10 years. Turns out we had it for like a year and a half. October 1st, 2030, Bill sells the truck for $106,000. So we don't know what's in Bill's mind. Maybe just didn't like the truck or whatever, changed the industries, right? He's just like, I got to get out of this truck, and sells it for $106,000. It says record all journal entries for the life of the truck. So let's start with buying the truck. That's fairly straightforward. April 1st, April Fool's Day, 2029, Bill buys a truck for cash. So we're going to debit truck. You could debit equipment or vehicle here. I'm going to call a truck $110,000, and we credit cash for $110,000. Now, in all likelihood, if Bill owns lots of trucks, maybe it would be like, this is the Freightliner model XYZ, right? Like some detail about the truck that, a Mack truck or whatever type of truck, and some detail around that. Okay, but that's April 1st, 2029. We bought a truck for $110,000 cash. What is our next relevant date? And the next relevant date is our fiscal year end. Now, even though nothing happens, right? We don't sell the truck, we're just driving it around. On December 31st, we need to do a journal entry. And what do we need to do? Well, I hope you're guessing or saying depreciation. This truck is not worth 110. It'll have dropped in value. We got to figure out how much. So again, the cost of our truck is 110. The residual value is 10. So the depreciable cost is only 100,000. That's the number we use to drive our calculations. Again, cost minus residual value equals depreciable cost. So our depreciable cost is 100, and we're going to depreciate it over 10 years. So works out to a nice clean $10,000 per year in depreciation. So you know somebody made up the numbers because they work out evenly. In real life, numbers never work out evenly like this. So it's $10,000 in depreciation per year. And between April and December, it's not a full year. Let's count months: April, May, June, July, August, September, October, November, December. I got 9 months. So 9/12ths of a year. So $10,000 times 9/12ths, that's 7,500, 75%. So the journal entry for depreciation, always the same journal entry, what we learned back in chapter 3. I hope you remember it. Debit depreciation expense, 7,500. And we credit accumulated depreciation truck, or whatever the asset is, 7,500. Okay, so this wasn't asked for, but it would be something you would have to deliver. You'd make financial statements, and on your financial statements, you'd say what the truck is worth according to the accountant, the book value of the truck. So according to our books, this truck was worth 110 when we bought it. It has accumulated depreciation of 7,500. Truck minus AD truck equals truck net, and we call that the net book value of the truck, 102,500. So according to the accountant thinks this truck is worth 102,500. What is it really worth? We have no idea. But the accountant just in their office somewhere thinks it's worth 102,500. They're not looking at the truck. They're not kicking the tires. They're just, making a guess saying, well, the truck's going to last 10 years. We guess it went down by 7,500 over these 9 months. Okay. So now what's the next relevant date? The next relevant date is October 1st, 2030. And what do we have to do on October 1st, 2030? We got to sell the truck. But before we can sell the truck, you have to depreciate the asset up to the date of the sale. So we have to say, okay, it's another depreciation, which means we're going to be counting months. How many months between December 31st and October 1st? Is it 9 again? Oh, that's lame. January, February, March, April, May, June, July, August, September, October. Oh, we don't count October because it's October 1st. 9 months. Yeah, it's 9 months again. So that's 9/12ths of a year. And so it's the same math, right? It's $10,000 depreciation per year. We've got 9 months to do. 10,000 times 9/12ths is $7,500 more in depreciation. So journal entry is actually exactly the same. Debit depreciation expense, credit accumulated depreciation truck for $7,500. And let's just update our assessment of what this truck is worth. So we had a truck that we bought for $110,000. We have depreciated this truck for, in total now, that's what accumulated depreciation is, $15,000, right? $7,500 last year during that 9-month period, and $7,500 this year during the 9-month period. And so we think the accountant sitting in an office somewhere thinks this truck should be worth around $95,000. Now, Bill turns around and sells the truck for $106,000 cash today. Does this mean he got a good deal or a bad deal? The answer is we don't know, right? Maybe the cost or the value of these used trucks has gone up for some weird reason, and he really should have got 120 grand for it. We don't know that, but we just know that he got paid more than the accountant in their accounting office thinks the truck ought to be worth. The accountant thinks it ought to be 95. Bill got paid 106 grand. He got paid $11,000 more than the book value of the truck. This represents now, there's two options when you dispose of an asset. You're going to sell it at a gain or at a loss. If you got paid more than the accountant thought it was worth, it's a gain. If you got paid less, it's a loss. And you'll never get paid exactly what the accountant thought it was worth. But if that happened, then there's no gain or no loss. There's nothing. But of course, in these questions and in real life, there's always going to be a gain or loss. Maybe a small one, but there will always be one. Okay, so let's do the journal entry. You debit cash because cash changed hands. Was $106,000. You get rid of the asset, so you got to get rid of the truck, credit truck, for 110. This is a place people go wrong. They credit truck net 95. No, you got to get rid of the whole truck, 110, and you got to get rid of the AD truck in a separate step. So to get rid of the truck, it was a debit account. You credit it to make it go to zero. To get rid of AD, something we haven't gotten rid of so far, you debit it, right? We credit AD to when we have depreciation, debit AD when you're getting rid of that asset and its related accumulated depreciation. You're getting this truck and all the accumulated depreciation off the books, $15,000 in total. And what you find is it doesn't balance, right? We took the cash in, we got rid of the truck and its accumulated depreciation, and this thing has 121,000 of debits, 110,000 of credits. We're off by 11,000 of credits. That 11,000 is just this difference, 106 to 95. It's $11,000. It's a credit that we need to fill in here. This credit is to an account we call gain on sale. And just to let you know what a gain on sale is, it's a revenue account. It is other revenue. It's not considered part of the day-to-day business. If you run a tow truck company, you're not buying and selling tow trucks. A tow truck retailer would consider this something different. But for us, just selling an asset that we are planning to use to do our work, which you don't do every day, it's not an operating revenue or operating expense. It is other in the financial statements. Okay, that's it. We have solved part A. I'll erase that, and we've done a beautiful job, if I do say so myself. Let's look on to part B. Part B says, assume that instead of 106, Bill got 75. Bill had received $75,000 for the truck. Re-record the sale journal entry given this new sales price. So all the other stuff is the same. The only difference is right here. Instead of 106 cash, we got, what was it, 75,000. So it's saying change this number to 75,000. And just eyeballing this, right? If we change this to 75,000, we still think it's a $95,000 truck, right? Everything up to now has been the same. We get paid 75,000. Well, we got paid less than the accountant thought the truck was worth. That is representing a loss on sale, as you will soon see. So let's do it all. So again, this was the question as asked. This was part A. I'll do part B just beside it. So October 1st. Oh, I want to do it right beside. These two are in the way. Maybe I'll delete them. Okay, so October 1st, 2030, debit cash, and we only got paid $75,000. We get rid of our truck, 110. We get rid of our accumulated depreciation on the truck, which was $15,000 in total. And we do the same thing we did before. We total it up. We go, okay, I got 90,000 in debits. I got 110 in credits. My debits don't equal my credits. I'm off by $20,000, and I need 20,000 more on the debit side to make this balance. And we debit loss on sale. It can be called loss on disposal also. And now we got 110 in debits, 110 in credits. So this thing balances. This was part B. And just to reiterate what's going on here with this loss on sale account, it is an other expense. It's a it's an expense, but it's not considered an operating expense. But there you go. We've solved the problem. I, as always, hope these videos are helping. And if they're helping you, I hope you will help me. Thanks for watching. See you in the next one. Bye-bye. Let's take a look at Module 9, all about liabilities, what we owe, what we need to be paying back. We've already been introduced to simple notes payable in our class. This chapter introduces some more complex liabilities, and students find this to be a very challenging chapter. Now, as I was getting ready to prepare this, I wanted to draw a little clip art image of liabilities, and I was like, what do I draw? I wasn't sure what to draw. So I asked ChatGPT, hey, what's an example of a picture I might draw? Generate a clip art image to symbolize debt or owing somebody. And this is what it came up with, a pretty depressing view of debt. But that's my view of debt on a personal level. I try to avoid debt, and it's something that I don't like when I owe somebody money. But you'll learn if you go on to a corporate finance class, your finance professor will tell you there are optimal levels of debt and companies use debt as a tool. I'm personally, I must confess, not a big fan of debt. But that said, companies do borrow money, and we need to learn how to account for that. So when companies borrow money, often they just take bank loans or notes payable, like what we've learned already in class, and that's about as complicated as it gets. So journal entries, you already know a lot of debt and liability related journal entries, but there's one notoriously difficult topic that we're going to cover, and I'm going to introduce it in this video. We're going to cover it as the chapter goes on, but this picture inspired me because when my students have to deal with bonds, it's a topic that they don't like. They're just like, oh no, bonds. It's a challenging topic. And I think this video is going to help them, and I think it's going to help you sort of demystify bonds. Because when we talk about, a bank loan, I think everybody understands what a bank loan or a car loan is because we can speak about it. Or if I talk about, assets, oh, they bought a building, they bought some equipment, everybody has an idea. When I talk about bonds, I think most people don't know even what it means. So this video, I'm going to introduce what it means, and I'm going to talk about why it's kind of tricky to account for bonds, and then in future videos we'll actually do the accounting for it. But this is just an introduction to bonds. If you are in a class where you're not going to cover bonds, skip the video, really, or unless you're curious about bonds, then carry on with me. So let's talk bonds. So here's a news story. MIT sells $500 million in taxable century bonds. Earlier today, I have the right pen yet. Earlier today, MIT sold $500 million in Series E taxable bonds maturing in 2116 and yielding 3.885%. I'm not going to say 3.885% a million times. Let's call it 4 for our conversation. Okay, so this is a funny turn of phrase. MIT sells bonds. What they could be saying and should be saying is MIT borrows $500 million. Now, when they sell bonds, it means, if MIT wants to borrow money, of course, they can go to the bank and they can say, hey, banker, I want to borrow $500 million. And the banker could say yes or no. Or, a big company like this or a big organization like MIT, they go to the bank and they negotiate. They don't just go in and go, oh, okay, we'll take whatever you're giving. No, they're going to various banks and they're hard driving and they're trying to get the best interest rate. Because look at this deal. It's $500 million they're borrowing, and they're going to pay back in 2116. I borrow $500 million today, and I give you your money back in 100 years or 90 years. It's a long-term borrowing situation. And so the bank might just say, no, we don't do 100-year deals, do 30, or the bank might say, sure, we'll do 100 years, but 8%, right? They might give us a bad percentage. They might just refuse. And so that's likely what happened here. MIT tried to borrow, and the bank, for one reason or another, said, you know what, we can't do the deal. And MIT, their finance office, thought, well, maybe somebody will. What if I package this $500 million up into little notes payable, and I try to get investors to buy them? Do you think there might be anybody interested in buying? And well, the answer was obviously yes. Investors did buy their bonds. And so they break these $500 million up into $1,000 pieces. And it's just notes payable, like a bunch of $1,000 notes payable that add up to $500 million. And then they do sell them. Like they try to get somebody to invest. You give me $1,000. I promise to pay you back the $1,000 in 2116 with 4% interest. Now, importantly, nobody's buying the bond if MIT doesn't promise to pay the interest on an ongoing basis. In other words, if you just wait 100 years, you're going to be dead. You're not going to get any money. So MIT not only promises to pay 4% interest per year, they'll make payments every 6 months. So let's imagine you're a retiree. You give MIT the $1 million. They give you 4% per year. That's $40,000 per year. And you think, I can live on 40 grand a year, and divide by 2. So that's per year. They write you a check of $20,000 per 6 months, right? So every 6 months, you go out to your mailbox and you go, look at that. Or you check your direct deposit and you go, I got $20,000 from MIT. That's what's in it for you as the investor. And why is that attractive as an investor? Well, you could buy an S&P 500 index fund, or you could buy Apple stock or Nvidia stock or Google stock or whatever company you want to buy. But then you got to deal with the ups and downs of the stock market. You know, the president announces some new deal and the stocks all go down and you go, oh, there's my retirement. Or the president announces a new deal and the stocks go up and you're in boom times. It's stressful, though. If you watch stocks on a day-to-day basis, they do go up and down. This is not stressful. You just have to say, is MIT still a university? If it is, they're going to be paying me my $20,000 every 6 months. I can have faith in that and I can retire on that. So they call this fixed income as an investor because it's the same amount and it's a fixed cost for MIT. So MIT is borrowing, and it's an attractive way for them to borrow. Now, this is not normal borrowing. You and I can't do this. So MIT would approach an investment bank like Goldman Sachs or Credit Suisse or something like this, and those companies, those investment banks, would underwrite the deal. They would make this happen, right? They would bring enough investors in, and investors would buy the notes payable, the bonds from MIT with Goldman Sachs serving as a middleman, or Credit Suisse or whomever. So that's sort of what's going on here. Now, all of this, I know it sounds convoluted. Accounting for it's actually not that hard. They're just notes payable. So we already know how to do notes payable. They're notes payable where you make an interest payment in the middle. Not complicated. Here's where the complexity comes in accounting. There is a market for bonds, right? And investors are free to invest in whatever they want. So let's say at the same time MIT's offering its 4% bond, Harvard here has a very similar bonds, very similar terms, and Harvard's offering 7%. Well, which one are you going to buy as the investor? The answer is investors are all going to pile into Harvard. They're going to say, oh, give me the Harvard. You know, I don't... Like, you have to be really biased to want to pick Harvard or MIT. You know, I think they're both good for their money. I think they're both going to pay me back. I trust them both equally. Give me the 7%, right? Like, as an investor, I'd be like, oh, please give me the 7%. And as a consequence, nobody's going to want the MIT bond. And so Goldman Sachs or their investment bank is going to have to negotiate. And they'll say, well, what if we give you a discount? You know, you're going to buy, these bonds are in $1,000 pieces. What if we let you buy the MIT bond for $950? And MIT will pay you back $1,000 and they'll pay you interest as if you loan them $1,000, but you only got to pay $950 for it. And maybe the investors say yes or no. And back, it's a market for this, and it's a math equation, honestly, but there's a market for this, and they'll come to a number. And so let's say the number is, so it's for $1,000 bond, you know, 500 million, but it's for broken up into $1,000 pieces, and the number is $900. People are willing to buy this one for $900 instead of buying the Harvard one. Let's just say that's the number we come to. Well, that means at the end of the life of the bond, MIT's got to pay back $1,000, and they issued the bond with $100 discount. This discount represents extra interest. We talked about our $1 million person. Well, this is easy interest, right? It's $20,000 interest expense every 6 months, debit interest expense, credit, cash every 6 months. Easy peasy. This discount, right? The fact that we only paid $900, but we're going to have to pay, or we only got, as it were MIT, we only got paid $900. We're going to have to pay back $1,000. This $100 discount is extra interest. And this is the crux of the chapter. When we learn how to deal with calculating the extra interest, the discount, or the premium, and dealing with the extra interest, that's a challenge. And by the way, maybe the Harvard bond, they ask for $1,000. People love the bond so much. Maybe they pay Harvard $1,150 for the bond. In that case, Harvard got a premium, and their accountant's going to have to deal with that premium, which is a reduction in their interest cost over the life of the bond. So kind of a complex concept, but I hope it's fairly clear. A bond is the company borrowing money, and it's just a group of notes payable. The challenge of the bond is the fact that it exists in a market where people buy and sell above or below the sticker price of the bond, and coping with the discounts and premiums is the big challenge in front of us this chapter. This is best done by doing examples, so please work through the chapter with me, and I can't wait to get started. See you in the next video. Bye for now. Welcome to the part of the chapter that discusses bonds, and bonds is a notoriously difficult topic. So I thought I'd introduce it with baby steps. 9.4a, 9.5a, pretty gentle, short questions, and then you get into 9.6, 9.7, 9.8. They're a little harder. But what is a bond fundamentally? It's a company borrowing money, but they're not borrowing from the bank, they're borrowing from investors. And in borrowing from investors, it means there's a market for their bonds. So in other words, I say, hey, I want to borrow $1,000 from you. I promise to pay you back with interest, and my interest rate is 3%. And the investor goes, 3%'s not good. And nobody buys it. And if that's the case, the price of your bond comes down, and so you end up trying to borrow $1,000 and you only get $900. Why is that? Because your interest rate was too low. The investors paid a discounted amount. Or if I say, hey, I'm going to offer 12% interest, and the investors go, oh my gosh, I love 12%, then your price gets bid up and your bonds issue at what's called a premium. Because of these market dynamics, it makes accounting for bonds more challenging. But let's just start with that fundamental concept. If you offer low interest compared to similar companies to yours in the market, your bonds will issue at a discount. Investors aren't going to buy them. They'll have to take a lower price. If you offer very generous interest, investors are going to pay extra. They're going to pay a premium. That's what this question gets at. So let's read it. High Flyers Inc. issues a bond that pays 5% interest. The market rate of interest for similar companies is 6.5%. Okay, so we're offering 5%. Similar companies to us are offering 6.5%. Will our bonds issue at a discount or a premium? Well, if we're only offering 5 and you can get 6.5 somewhere else, you're not going to buy my bond for full price. You're going to need to have some discounted price to want to buy the bond. So these bonds will issue at a discount. Why? Because there are more attractive, similar companies offering 6.5, right? You can get a better price somewhere else. There's no need to buy my bonds. Cool Beans Inc. issues a bond that pays 5% interest. The market rate for similar companies is 3.5%. Okay, so we're offering 5. Similar companies are only offering 3.5. Well, in this scenario, all of a sudden, we're much more attractive than those other companies. If we're more attractive than our competitor companies or similar companies to us, investors will be willing to pay a premium for our bonds, again, because it's all relative. It's compared to similar companies with similar risk profiles. Assume that High Flyers Inc. and Cool Beans issued their 5% bonds on the same date at the same time. Why would one issue at a discount and the other at a premium? The primary reason why two companies could issue, one at 5% and one's a discount, one 5%, one's a premium, is because, well, the company's risk profiles are different. Remember, a bond is you're loaning money to somebody. How likely is it that they're going to pay you back? If you told me I can loan money to MIT, one of the most famous universities in the world, very solid, very stable, or Harvard, that type of place, or I can loan money to Tony's discount education store, right? Well, you would obviously say, oh, I'd rather give my money to MIT than Tony's discount education store. I think MIT is going to be around to pay me back. If they sign the contract, MIT is a much safer bet than Tony's discount education store. So why would one issue at a discount and the other a premium? It speaks to the quality of the company and the outlook for the industry. So those are two big reasons why two companies can both issue at 5% on the same day, same time. One gets a premium, one gets a discount. It's the quality of the company and the quality of the industry. Is it possible in the real for two companies to issue 5% bonds same day, same time and have one issue at a discount and the other a premium? Why or why not? Absolutely yes. Again, MIT issues a bond offering 5% today, and Joe's crypto speculation investor offers a 5% bond today. Hey, I mean, Joe's crypto speculation investor might be a good company. I wouldn't lend him the money at this. Maybe I would lend him the money, but I would lend MIT the money first, right? So MIT would be much more attractive to me because, again, I'm looking just for somebody to pay me back. I want the very stable company with a very long track record. MIT is much more attractive and would be much more attractive to investors. Joe's would have to offer a much higher rate of interest to even be in the same ballpark as MIT, which is why MIT would issue at a premium and Joe's would likely issue at a discount, because you wouldn't want to lend that money to Joe's crypto investment scheme. Okay, there you go. We've solved a 9-4A, and I hope this is just us dangling a toe in the waters of bonds. As we go on, we step up in difficulty each problem. Stay tuned for our next video. Thanks for watching. Bye-bye. On to the topic of bond quotes. Problem 9-5A has bond quotes. So again, there is a market for bonds. Bonds are bought and sold by investors, and as a consequence, the price is never just perfectly right on to the dollar what you're looking for. So the company tries to borrow, issues these notes payable. The note payable says $1,000, but they seldom get paid $1,000. They'll get paid some amount higher or lower. And I just wanted to show you these two Canadian oil and gas companies, Enbridge Gas and Fortis Alberta. These are gas-related companies, and you can see similar bonds, slightly different maturity. One matures in 2051, one matures in 2053, in the distant future. And Enbridge, it's going to pay 3.2% interest. Fortis is going to pay 4.8% interest. Well, of those two, which one would you prefer? If you didn't know much about the companies, but just trust me when I say they're stable companies, right? They're good companies, and let's just say we expect them to pay us back. They're both good companies. They're both going to pay us back. Which company would I want to do business with? The one giving me 3% interest, or the one giving me about 3.2% interest, or the one giving me 4.8% interest? Well, of course, I would want to be in business with the one giving me 4.8% interest, and I wouldn't want 3.2, just simply for the interest rates. Well, look at what the market has said. The market has said, hey, if I want to buy $1,000 of Enbridge bonds, the ask price is 76.358% of that face value. So if I buy $1,000 of bonds, it costs me $763.58. I get a discount, right? I'm buying a bond that says they're going to pay me back $1,000, and I only got to pay $760 for it, and they're going to pay interest every 6 months, 3.2%. Okay, I get it at a discount. Now, because Fortis is paying so much more interest, I got to pay a premium to get it. I got to pay $1,000 times 103.039% of what they're asking. So if I buy $1,000 worth of bonds, it's going to cost me $1,030.39 if I buy $1,000 worth of those Fortis Alberta bonds. And why is that? Assuming the companies are similar, I didn't do a ton of research here, but let's assume they're both, stable Canadian oil and gas companies. the Fortis bond is way more attractive than the Enbridge bond, and the market shows that. Like these are real quotes. This is from a real investing platform I looked at today. So these are real numbers. So that's how bond quotes work. And so just looking at this, the size of the discount here, it's $1,000 bond. The size of the discount is $236.42. That's the amount of the discount. And here, there's a premium of $30.39. And what we'll learn in the next problem, 9.6, is accounting for the discount, accounting for the premium over time is the hard part of this. Calculating it, not so hard, and that's what we'll do in this problem, 9.5a. So it says, on January 1st, 2029, HIJ Company issues 10-year 5% bonds for $100,000 face value at a time when the market rate of interest yield to maturity is 6%. So we're offering 5%. The market can give 6%. What does that tell me? It's going to be a discount, right? 5% bond. We're offering 5. They can get 6 elsewhere. Actually, to answer the first question, will the bond be issued at a discount or premium? Discount. The bond will make semi-annual payments. So every 6 months we make payments. The bond quote is 92.561. What is that? It's just like the bond quote up here. This ask price. This is a percentage. We're going to get 92.561% of the money we asked for. We asked for $400,000. We're going to get 92.561% of that. We're going to get 0.92561 times 400,000. We're going to get 370,244. And how big is the discount? Well, we asked for 400. We're having to discount down to 370, so minus 400. The discount is 29,756. This wasn't asked, but if it asked us for a journal entry here, easy enough. We would go, okay, I borrowed some money in the form of a bond. It's January 1st, 2029. We debit cash. We got paid $370,244. We issued a bond payable saying we promised to pay back $400,000. The difference here is the discount. So it's obviously a debit I'm missing. We debit discount for 29,756. That piece wasn't asked for, but we're going to be doing it when we get to problem 9.6. Anyway, hope this video helped us understand how bond quotes work and also how bond discounts and premiums work. That's all for this one. See you in the next one. Bye-bye. Let's have a look at problem 9.6a. I think I've hyped it enough this chapter that bonds are a challenging topic, and they're certainly a topic that my students struggle with, and this is the type of problem I test on when I test bonds. Let's go through it, and you'll see the quirks and features that make bonds challenging. On February 28th, 2029, Tinger Inc. issues a $100,000 10-year 5% bond. The market rate of interest yield to maturity is 6%. Okay, so we're giving 5. The market says, other companies like ours are giving 6. Nobody's going to buy our bond unless it gets issued at a discount. This is a discount situation. Because the market rate is higher than the bond rate, the bonds issue at a discount. The bond quote is 92.561. Okay, let's figure out, and let's actually do our first journal entry, and then that's going to feed into this whole table and sort of lead our discussion off. But let's do that first journal entry. We asked for $100,000 because we're paying a lower rate of interest than people can get elsewhere. We're only going to get 92.561% of the money, $100,000 times 0.92561, we're going to get $92,561, meaning there's a discount here, take away 100, of $74.39, right? That's the amount of the discount, that's the amount of cash we received for our bond issuance. So let's do some journal entries already. Well, let's do a journal entry already. It's February 28th, 2029, not a leap year. We received cash, so debit cash. 92,561. Remember, this is us borrowing money. This is the debt. We're in the liabilities chapter of our course. So this is a debt. Now, we owe, and in how many years? 10 years, we're going to pay back $100,000. So we owe $100K, but there was a discount, and the discount account gets debited. Discount on bonds payable, $74.39. Okay, so that is the first journal entry. And here's where I want to pause and say, here is the problem with a bond or accounting for a bond. It's not a problem, it's just a reality, and it makes things difficult about accounting for a bond. When we make our interest payments, and let's do some math here. It's a $100,000 bond, 5% interest, but it's semi-annual. So every 6 months, we're going to make a 2.5% payment, which is $2,500. And everybody and their dog will identify that as interest expense. And it is an interest expense, right? This $2,500 we pay every 6 months. But what makes a bond tricky is this discount, this difference between the amount of money we receive at the beginning and the amount we have to pay back at the end. This $7,400, this is also interest, but it doesn't look like the other interest of the interest payment. In fact, it doesn't look like most other interest in accounting. It's weird interest. We borrowed $92,000, we got to pay back $100,000. That's interest, right? If you borrow $9 from your friend today and you pay them back $10 tomorrow, there's $1 of interest. You don't have to call it interest for it to be interest. So this is interest, right? This $7,400. The question is, when do we recognize the interest expense? And the answer is slowly over the life of the bond. So there are some courses where you'll learn to look at this as like straight line. Okay, well, every year that goes by, I recognize, I guess this is over 10 years, $740 more interest, right? Divide by 10. That is against the rules of GAAP. Unless it is not materially different from this method, which is the acceptable method. It's called the effective interest rate method. So I'm going to show you the effective interest method. That's what we're going to learn to do. And it's just figuring out when to recognize this interest expense and how. And to do it, we need a table. So let's start to fill in our table, and I'll explain it as we go, and we'll solve the problem. But you got to do the table before you can do any more journal entries. Okay, so the first date we're going to put in our table is the date we issued the bond, which was February 28th, 2029. We don't make any interest payment today. We don't have any interest expense today. We have not a premium, but a discount. So I'm just going to scratch out any reference to the word premium. We do have a discount. We don't have any discount amortization today. We do have a discount account balance on date 0. It's $74.39. And the final column, it says blank minus E discount bond carrying amount. You put in here the face value of the bond. So whatever you got to pay back at the end, you put 100,000. So if it was a premium, you put 100,000 down there. 100,000 minus E. So 100,000 minus, well, this is E. 100,000 minus 74.39. 92,561. It's actually always starts off the amount of cash you got, 92,561. Okay. Before I can continue and do the next relevant date, we need to put in these percentages under interest payment and interest expense. The interest payment is what we promise to pay. And again, because everything's semi-annual, you divide by 2. So we promise to pay 5%. Take 5% divided by 2. You get 2.5%. And the interest expense is based on the market rate, which is 6%. And again, just divide everything by 2. You put 3% in there. And once you've done that, once you've set up this table, the table just starts to fall out. And you'll see it'll not be too difficult. So that brings us to the next date on the table, which is 6 months later, August 31st, 2029. Interest payment, it says 2.5% of maturity value. The maturity value is how much we got to pay back at the end, which was $100,000. So 2.5% times $100,000, $2,500. And you can see that's the number we had speculated it was way back when. Interest expense, it says 3% of the preceding bond carrying amount. So I take 0.03. Now, what's a bond carrying amount? It's column F. So 3% of whatever number's in there, 92,561. 2,777. We're going to be rounding here to the dollar. Now, if you did it in Excel, go to the penny, of course. Discount amortization, C minus B. So I take whatever's in C minus whatever's in B. 2,777 minus 2,500 is 277. Discount account balance, E minus D. I take 7439. That's E minus D, 277. 7439 minus 277. 7162. And the last one, it's 100,000 minus E. This is a common mistake. People go 92 minus 7. No. It's 100,000 minus 7. So 100,000 minus 7162 and 92,838. Now, the next relevant date in the life of the bond is our fiscal year in September 30th, but that doesn't go on the table. The table is all about every 6 months. So February 28th, 2029, August 31st, 2029, then February 28th, 2030, and we'll just do one more, August 31st, 2030, just to practice doing it. Once you've done like 2 rows, it hopefully becomes automatic. Let's do 2 more rows. Our interest payment, it says 2.5% of maturity value, 0.025. Our maturity value is how much we got to pay back at the end, which was 100,000. It's 2,500. And in fact, it's going to be 2,500 until something weird happens or something changes with the bond. As an investor, they call bonds fixed income, and it means it's always the same interest payment, right? And it's a boring type of investment for sure. Interest expense, 3% of the preceding bond carrying amount. So I go 0.03, and then the bond carrying amount is column F. So 0.03 times 92,838, 2,785. Next column says C minus B, 2,785 minus 2,500 is 285. You should never get a negative number here. If you get a negative number, you did something wrong. E minus D, 7162 minus 285 is 6877. And finally, 100,000 minus 6877, 93,123. Okay, so if everything's going right, this column is getting smaller and smaller and smaller, and the idea is after 10 years, there's no discount. We got to pay it back fully, so after 10 years, no discount. Our bond carrying amount is getting closer and closer to 100,000. So in this case, it's growing, but it's getting closer and closer to this number. So you're expecting to see those things happen. If those things aren't happening, it means you're messing up. Interest expense. So again, going on to August 31st, interest payment, 2.5% of 100,000, still 2,500. Interest expense, 3% of 93,123 is 2,794. 2,794 minus 2,500 is 294. Discount account balance, 6877 minus 294, 6877 minus 294, 6583. And the last column, 100,000 minus 6583 is 93,417. And of course, we could just keep on going, and you would have to keep on going in, for a real company if this was a real bond. But, it's not a lot to ask. Companies don't have tons and tons of bonds. And even if they do, that's our job. Okay. So we have solved part A, which says prepare a bond amortization schedule. I should say an effective interest table is what I would call this. Maybe I'll change the name in the question for the issuance. And it says for the first 2 periods. So, this is the issuance. Let me just highlight the whole line in yellow. And then this one is period 1, blue. And this one is period 2, pink. And so if you had just done that, you would have solved it, right? We did an extra one just for my own pleasure. Okay, and now it says it wants us to do 4 journal entries. One for the issuance of the bond. We did that already, Feb 28th, 2029. The first interest payment on August 31st, 2029. That's this one. That's the blue one. And we just take data from the blue row. And it's 6 months, right? The information here covers the 6 months from February 28th to August 31st. It is a 6-month period that we are considering here. And the first row says interest payment. Well, yeah, we're going to be paying cash every 6 months to service our debt here, to pay our bondholders. So $2,500 is a payment. Debit interest expense, the next column, interest expense, is $2,777. Interest expense, $2,777. And now we're left, it's off by $277. And you got to look at this and say, are we missing a debit or a credit? And the answer is we are missing, of course, a credit to make this balance. I got to credit something by $277. It says discount amortization. It means this discount of $74.39, we want to make it smaller. How do I make it smaller? I credit my discount. And the idea is, as months go by, this discount is going to go down to 0 over the 10-year life of the bond. It just gets reduced a little bit at a time. Now, here's what I want to be clear about. At the start of this, I said, okay, we got to pay interest every 6 months, $2,500, and that obviously to anybody's eyeballs is interest. And that is part of our interest expense here. The other $277 of interest is, we said, well, I borrowed $92,000 cash. I got to pay back $100,000. The extra $7,400, that's extra interest. When do I recognize that as interest expense? And we said, oh, well, just a little bit over time. Well, here we've recognized our first $277 of extra interest related to that $7,400 discount. That's why our interest expense is not matching our cash, right? We pay $2,500 cash, but we recognize $2,777 of interest. And that's the whole key to a bond. That's it. If you kind of have your head wrapped around that, and I don't expect you to your first time through, but if you do, that's how you handle bonds. It's just a little bit of extra interest due to a discount or an interest reduction due to a premium, as we'll see in the next problem. Okay, that's August 31st. What's the next relevant date? The next relevant date is our fiscal year end, September 30th. But wait, you say, there's no September 30th, 2029 on our table. And so here's how I look at these tables. I say to myself, okay, let's see, self. I go, okay, I did a journal entry for this one, done. I'll erase the cross out. I just did a journal entry that covered all of this. And now I'm on to this pink line in my table. And I have to say, well, what months are covered here? And it was from August 31st, that was the last one, August 31st, 2029, to September 30th. I got to do 1 month to get from here to here. But remember, each line of the table represents 6 months. So this is a 6-month period, but I'm interested in just 1 month. So I take the information from here and I go, well, I take 1/6 of what's going on here. So let's do that. Let's take 1/6. Our interest expense from that line is $27.85. But I need 1/6 of it. So $27.85 times 1 divided by 6 is 464. We'll call it 464. All right, well, what about our credit to discount, our discount amortization? Our discount amortization is $285, but I want to take 1/6 of it. Times 1 divided by 6, 47.5. We're going to round up. We'll call it 48. And last, I want to credit cash, except for I can't credit cash because I don't make a payment on this day, right? The people who I issue the bonds to, they're checking their mail for a check every 6 months on August 31st and February 28th. They're not going out on September 30th looking for a check. So therefore, we don't pay it. It's interest that's unpaid. It is interest payable, which is a year-end adjustment, of course. And the math here is 2,500 times a sixth, 4167. Now, 417, pardon me, not 4167, 417. Now you're going to notice, and this does happen sometimes here, we're off by $1, and the reason is I didn't go to the penny here. If I had gone to the penny, let's see, 2785 divided by 6, 464.167, and this was 47.5, and this one was, what was it? 2,500 times a sixth is 416.67. So you can see it does work, right? 464.167 equals 47.5 plus 416.67. The maths, but when you do it this way, we're off by $1, and it's just due to funny rounding. I just leave it that way. I go, okay, I get that it looks like it's off by $1. If I kept all the decimals, it's not. This is okay. Long way of saying it's okay. Last one, February 28th, 2030. And now we just did 1 month to get us up to September. Well, how many months from September to February? I hope you said 5, and it's 5/6. So I'm still on the pink line. I used up 1/6 of it in my last journal entry. Now I got to use the other 5/6 in this one. So my interest expense, 2785 times 5 divided by 6, 2321. So that is my interest expense. And you'll see these journal entries start to look the same after a while. 2321 is 5/6 of the number there. 285 times 5/6, 237.5, which we're going to call 238, which again, we credit our discount. Now, again, funky things happen. We end up off by $1, but it's not the end of the world. We credit cash. Now, do I credit cash for 5/6? Absolutely not. I credit cash for the full amount, $2,500. So we credit cash for $2,500 because they don't get 5/6 of their check. Every 6 months, they get the full check. So they get $2,500, and you can see we're off. If I add up the debits, I get $2,738. If I take away the credits, $2,321. I'm off by $417. Well, what do you suppose that is? Of course, it's the interest payable, right? We just paid the interest, so the interest payable we accrued before goes away. 417. And at that point, I think we're done. I think we have solved 9.6a. We have prepared the effective interest table here. And let me just erase the crossouts. And we've done the first 4 relevant journal entries that were asked for in the question. This is challenging. When students have to learn this the first time, I think it just doesn't come naturally. It doesn't hit their intuitions as correct. The only way to learn this stuff is to practice, and I do hope this video helped you to that laudable goal. And if you made it all this way, for goodness sakes, hit me with a thumbs up. Thanks for watching. See you in the next video. Bye for now. Let's take a look at problem 9.7a. We're going to deal with bonds issued at a premium. So on April 30th, 2029, Smoky Inc. issues a $10 million 10-year 7% bond. So we're promising to pay 7% interest annually, or 3.5% interest every 6 months. The market rate of interest, yield to maturity, is 6%. Okay, so we're offering 7. They can get 6% from other similar companies, similar risk profile companies. Our bond is going to be attractive, and they're going to bid the price up, and this bond will fetch a premium. Because the market rate is lower than the bond rate, the bonds issue at a premium. The bond quote is 107.439. Remember, bond quotes are the percentage of what you asked for that you're getting. So we're getting 107% of what we asked for. We asked for $10 million. We're going to get 107.439% of that. So $10 million times 1.07439, that's 107.439%. we're getting, oops, I think I missed the 9, but it's 107,43900. I just didn't put the 9 in the calculator, but that's the number. Okay, so let's do that first journal entry then. It's April 30th, 2029, and we get paid 107,43900. Got to remember the 9. I screwed it up in the calculator. And in, I forget, was it 10 years? Yeah, 10 years, we've got to pay back $10 million. So what happened here? Well, the bond issued at a premium, $743,900 above what I asked for. And that represents a premium. Now, this is not like good news for me. Whoa, bonus, I got all this extra money. No, all that means is I got to pay a lot of extra interest expense, like interest payments, as time goes on. Now, what we said was when we get a discount, I get paid $900,000 for my $1 million bond. That extra $100,000 that I got to pay back, that is extra interest cost. This extra $743,000 I received, this is a reduction in our interest expense, as we will see as we work through our effective interest table. So let's start to fill in the effective interest table. Semi-annual interest period, these are the dates, and it's the issue date and then every 6 months later. Interest payment, blank percent of maturity value. This is what I promised to pay divided by 2. So I promised to pay 7% per year. Well, we put in 3.5% here because everything here is semi-annual, 3.5%. Interest expense, this is the market rate of interest, the yield to maturity, 3% in this case. So it's 6%, but again, divide by 2 for half a year. Discount amortization, no. We're a premium. This is premium amortization. Discount account balance, no, it's a premium account balance. And blank minus the discount, no, it's, or blank minus E discount, and no, it's blank plus E premium. And the blank here is the amount, I'm just going to say $10 million. It's the face value of the bond. It's the $10 million amount there. Okay, so the first period that we have to worry about is not even an interest period. It's the issuance, and that's on April 30th, 2029. And then we just go plus 6 months, October 31st, 2029. I notice our fiscal year is December 31st. We don't care about our fiscal year end. We just care 6 months later. So then it'll be April 30th, 2030, October 31st, 2030, and so on and so forth, and so on and so forth. But we'll stop there just because it only asks for the issuance and then the first 2 interest periods, right? Prepare a bond amortization schedule up. Discount or premium amortization schedule for the issuance and the first 2 interest periods. And this is the effective interest rate method. So, okay, the issuance. What happened? There's no payment on day 1. There's no interest expense on day 1. And there's no premium amortization on day 1. But we do have a premium balance on day 1, $743,900. And we do have bond carrying amount, $10 million plus $743,900, $743,900. Our interest payment, 3.5% of maturity value, 0.035 times $10 million is $350,000. Interest expense, 3% times the preceding bond carrying amount, $10,743,000. So 0.03 times 10, oops, not 7, $10,743,900. 322,317. B minus C. Now remember with discount it was C minus B. Here it's B minus C. So 350 minus 322. 27,683. Next one is E minus D. 743 minus 27. 716, 217. So again, 743 minus 27,000 is 716,217. And the last one, 10 million plus 716,217 is 10,716,217. Let's do the next line. You should be trying these on your own, but again, it's okay to follow along with me if you're a rookie here. Interest payment, it says 3.5% of maturity value. Well, 3.5%, the maturity value is still 10 million. It's the amount we got to pay back at the end. 3.5% of 10 million is still 350. And in this class, this number will be the same every time. They call this fixed income investment because it's boring. It's the same every time unless there's some sort of bond redemption or something funny happens, which is more a matter for intermediate accounting class than intro. Interest expense, 3% of the preceding bond carrying amount. So 3% of 10,716,217. 10,716,217 times 0.03. That's the bond carrying amount. So it's 32148. We'll call it 7. 321,487. 350 minus 321,487. Oops, 321,487 is 28,513. 716 minus 28, 716,217 minus 28,513, 687,704. And last 10 million plus E, 10,687,704. And we're looking for this number to get closer and closer to 0, and this number to get closer and closer to the bond carrying amount of, or not the bond carrying amount, the maturity amount of $10 million. And certainly that's happening here. So 3 lines we're worried about here. The first line we've already done the journal entry for, so we can check that yellow one off the list, and that's just this journal entry we did on April the 30th. So I'm going to scratch that one off. Again, don't you scratch this off on your own paper, but that's just for me to keep track. We've done it. The next relevant line is October 31st, 2029. We say, did any fiscal year end happen between April and October? The answer is no. And so given that, we can just take the whole line. And remember, each line here represents 6 months. So between April and October 31st, 2029, it's a 6-month period. So we just take 6 out of 6 of this line, and we just take the whole number. So our interest payment is $350,000. We credit cash for our interest payment, $350,000. We debit interest expense for the interest expense column, $322,317. And then the rest goes to premium. Now it's premium amortization. Our premium was a credit. We want to reduce it. So to reduce the premium, we debit it. And we debit it by the amount in the column, $27,683. And what you find is this does in fact balance, right? Our journal entry is a good journal entry. Now, the thing I want to point out here is we paid $350,000. This was an interest payment we made, but our interest expense is only $322,000. Why is that? Well, remember what we had said about the premium. The premium means we got $743,000 extra dollars. With a discount, we didn't get enough money. We had to make it up. We said, oh, there's extra interest expense over time. We said this extra $743,000 we got, it's going to reduce our interest expense over time. And that's what we're showing here. Our interest expense, if we just took the cash value of the interest, it would have been $350,000, but we're saying, no, because I got that extra money up front, I'm going to reduce my interest cost over the life of this bond. And that's what we've done here. So even though we paid $350,000, we only recognize $322,000 of interest expense or interest cost. Last couple of entries here. Our next relevant date is the fiscal year end, December 31st, 2029. And that, of course, is 2 months later, October, so November, December. And so we're going to look at the next line down because we've done the blue line. We've already done a journal entry for October 31st. Boom, done. And now we're looking at the next line down. We're going, well, it's got November, December, January, February, March, April. That's the 6-month period, right? November, December, January, February, March, April. That's the 6 months ended April 30th, 2030. And we got to say, well, between October and December 31st, it's 2 months. So I'm going to take whatever's on this line, highlight it pink, and I'm going to take 2/6. So our interest expense, 321,487 times 2/6 times 2 divided by 6, 107,162. 107,162. 107,162. That goes to interest expense. We're going to debit our premium for 28,513 times, again, 2/6 of it. 9,504. That goes to premium. Now, you can see, looking at the journal entry above, we credited cash there, but we don't make a cash payment on December 31st, so we got to say how much interest is built up to our fiscal year and that hasn't been paid, and that goes to interest payable. And it's just 350 times 2/6, and it's 11,667. Now, we're in that situation, 116,667, where our journal entry doesn't quite work because this is 2 plus 4 is 6. It's 11,666. If you're off by $1, it's not the end of the world. It's just a funky rounding thing. This is actually 0.333, 0.333, and this is 0.666. It does work. It's just a funny thing that happens when you round to the dollar. Not the end of the world that we're off by $1 here. Okay, last one then. So that was December. On to April. April 30th, 2030. How many more months is that? And of course, it's 4 months because we're going to finish this line. We just did 2/6. Now we're going to do the last 4/6. So let's do it. Our interest expense, 321,487 times 4 divided by 6. Is 214,325. 214,325 as our interest expense. Our premium, again, it's going to be 4/6 of 28,513 times 4 divided by 6, and I get 19,009. That goes to the premium. We're going to credit cash for the full amount, which was $350, because we don't pay them 4/6 of the cash we owe them. We got to pay them the full amount, and then we get rid of the interest payable. And this is another circumstance we might end up off by $1. I think we will. 116,667. If I add up my debits, 214,325 plus 19,009 plus 116,667. Yeah, you can see I'm off by $1. Not the end of the world. It's a rounding thing that's happened here. Okay, so at that point, we've done all the journal entries. We prepared our effective interest table. We've done 9-7A. If you made it all the way to the end with me, thanks so much for watching. I'll see you in the next video. Bye for now. Welcome to Module 10 of our course in financial accounting. This module is all about shareholders' equity. And to understand shareholders' equity, we have to understand how corporations, how businesses work. So this is you, and let's say you're interested in buying into one of those big US tech companies, Apple, Amazon, Meta, these types of companies, and let's say you buy some Apple share, and so you join a diverse group of shareholders. Surely there's millions, not like more than I'm putting on the screen, and there you own one share of Apple. That's you. Now, all these shareholders get to vote on various things the company's doing, but it's not one vote per person, it's one vote per share. So if the guy beside you has 200 shares of Apple, they get 200 votes, and the person beside them might have 1,000 shares and they get 1,000 votes, and you have your one measly vote. But that's how the company operates. Now, you might think that this shareholder group has a say in the day-to-day decisions of the company, but they really don't. The shareholder group has really one big job to do as far as corporate governance goes. They have to elect what's called a board of directors. And the board of directors should be experts in the field that the company's operating in, and their job, this board of directors, is to represent the shareholders' interests. So these shareholders are all very different people. They're a diverse group. And if you're the board of directors, what an interesting task. You've got to represent this massive group of people. And because their interests are all different. So, for example, if I bought shares in Apple, I'd want to advocate they produce a small phone again. Their phones are all too big. I'd prefer to have a smaller iPhone. Well, somebody else in this group might say, no, small iPhones are stupid. They need to go bigger, right? And they might totally disagree with me. And this group, no matter what decision you put to this massive group, they can't agree on anything except one thing. The one thing this massive group agrees on is they'd all like Apple's stock price to go up. And the reason they want it to go up is because they're shareholders. And you may say, well, no, what if I just wanted to go down for a little while and then go up? Well, if you wanted to go down for a while and then go up, don't be a shareholder. Sell your shares. You shouldn't be a shareholder of a company if you want their price to go down. That's a foolish financial decision. So pretty much every single one of these people agrees they want the share price to go up. So you'll often hear in a finance class, the goal of a company is to maximize shareholder value. And that's the reason is these people all put pressure on the board of directors to do things to raise their share price. And at the same time, the board of directors hires the CEO. So the board of directors is in charge of hiring, firing, and deciding how much the CEO gets paid, right? How do we incentivize the CEO to, again, protect the interests of this big shareholder group? So Apple's board of directors is composed of Tim Cook's the CEO of Apple right now, but like high flying experienced people. So these are people that have been running at the top levels of business, and they should hopefully be able to give Tim Cook advice, and they should also be able to evaluate how he's doing in his job. So, a couple of people, this person is the former executive at Johnson & Johnson. Well, Johnson & Johnson, massive manufacturer in America. Well, Apple is also a massive manufacturer and American company. Susan Wagner, the co-founder and director of BlackRock. BlackRock's one of the biggest investing companies in the world. Well, if you're a shareholder, certainly BlackRock, having one of the largest investing companies in the world on the board of directors makes sense because you're an investor. BlackRock's going to try to protect your interests. So that's the idea of the board of directors. You want to hire diverse, smart group of people to represent your interests in directing the CEO. They give the CEO advice. They tell the CEO, big picture, they help point the CEO in the right direction. The CEO is in charge of the company. The CEO hires, the marketing manager, the HR manager, and points the direction of the company, the operations manager. And the CEO really is in charge of the company. So again, just to sort of summarize this relationship, you become a shareholder in a company. As a shareholder, you don't really get a say in the day-to-day operations of the company. You do get a vote on who will be on the board of directors. And the reason you don't get to vote on much is because it would just be too unwieldy if you're voting on, what type of coffee goes in the lunchroom or, which size of iPhone they should make. You just don't get that level of scrutiny. You just get to pick or vote towards the board of directors. The board of directors chooses the CEO and when to fire, when to hire a new CEO and how much to pay the CEO. It's the CEO. It's a very key role. They operate the company. Now, you may be saying, well, that's nice for Apple. Apple's like this mammoth company, one of the largest companies on earth. What about just a small business? And I'll go from the largest now to the smallest size corporation. Let's say you're running your own small business and you decide to incorporate, and that's what our chapter is all about. We're not looking at proprietorships or partnerships in this class. You are a proprietor and you decide, I'd like to incorporate. I want limited liability. Might be some tax reason that I want to incorporate. I decide I want to incorporate my business. I want to run as a corporation. Well, it's very plausible that you decide to invest, so you decide to incorporate. You are the only shareholder. You are the only director. Because as the only shareholder, you vote on the board of directors. You have to have at least one director. And so you go, oh, I know, I'll be the director. Let's have a vote, everybody. Oh, looks like I won. I'm the board of directors now. I'm the director. You appoint yourself as CEO because there's nobody else going to run this company. It's a very small business. And then you operate the business. So it's sort of a quirky thing. You're wearing all these hats, but the accounting will be similar in terms of debits and credits, just on a much bigger scale for a massive company. But this is a very plausible way for two different corporations to be, right? And there's a lot more of these ones than there are of these ones. But we talk more about this type of corporations because, of course, they're much more famous. In any event, I hope that's given you some insight into how corporations sort of operate and the oversight and the, like they call it, corporate governance of a business. This module, though, we will focus on debits and credits, the nuts and bolts of accounting for this equity situation. All right, that's it for this intro. I can't wait to get started with some examples. Thanks for watching. See you in the next one. Bye-bye. Let's take a look at problem 10.1a. We're talking equity, and all sorts of new concepts here get laid bare in this question. And the first concept we haven't discussed so far is the concept of preferred shares. When I was a little boy, I played a board game, and the board game was called Stock Ticker. And you could, you pretended to be an investor, and as an investor, you could pretend to buy preferred shares or common shares. And I, as a little kid, always wanted the preferred shares. And why was that? Because of branding. The name preferred. I thought, well, I would prefer a preferred share. Wouldn't you prefer a preferred share? I always thought preferred shares were better. Now, as an adult, I buy stock in companies. I do invest in, well, I buy mostly index funds, but I do buy stock in companies. And generally speaking, you want the common shares. And why is that? So what makes a preferred share preferred? Really two features that stand out. Different preferred shares can have different features, but the two ones that you see most frequently are, one, dividend preference. So if the company pays a dividend and they want to pay dividends to all their shareholders, they got to pay the preferred shareholders first. So they're first in line for dividends. And the second related to that is they often have a promised or a guaranteed dividend just built into the preferred share, an expectation of regular dividends. The final thing preference-wise is if the company goes bankrupt, which you're hoping it doesn't, but if it goes bankrupt and all the creditors are lining up to get whatever money they can, preferred shareholders get made whole before common shareholders. Preferred shareholders get paid off in the case of a bankruptcy. But why would I prefer the common shares? Well, the common shareholders have access to the retained earnings. The retained earnings are thought of as belonging to the common shareholders. So when I buy stock in Microsoft or Apple, I'm looking for common shares, generally speaking. Okay, let's read on though. So this company has preferred shares, $10 non-cumulative. The $10 is the dividend. Non-cumulative means if they fail to pay it this year, it doesn't build up. Cumulative, maybe I'll explain it that way. If this was cumulative, $10 cumulative, they failed to pay the dividend this year, next year they got to pay 20. And the year after that, they got to pay 30. It's building up. This one is non-cumulative. It says 500 shares are issued, $50,000. You can do some quick math and go, oh, it's $100 a share. That's of the shares that are out there. No par is an interesting thing. We'll explore the concept of par value shares in problem 10.2. For now, just no par is like generally thought of as the way to go in the modern world, or having a par value so small it might as well be no par. We'll discuss par value though in problem 10.2. I think no par is better than having par value, but that's just me. Common shares, 1 million authorized. So we're allowed to issue up to 1 million, but we've only issued 20,000 shares and $200,000 worth of shares. So it's $10 a share, and you can see the retained earnings. Okay. A little bit of an intro there, but the following equity transactions occurred, and we're going to have to do journal entries. So, January 31st, we issued 5,000 common shares for $12 each. 5,000 times 12 is $60,000. And so what does that look like? Well, January 31st, we got cash. Now, when we issue shares for $12, the assumption here is they paid us in cash. So we're issuing shares. They're giving us cash, debit cash, credit, common shares. I want you to remember, and this is a common misconception, sometimes students think the credit to common shares is we are reducing an asset. We're giving up our shares are an asset, credit common shares because we're reducing an asset. No. This company has more shares now than it had before, which is a weird thing. The company had 20,000 common shares before. After this, it has 25,000 common shares. Remember what common shares are. It's us keeping track of ownership stakes. And now we have more owners, right? Somebody just bought in $5,000, $12 each, $60,000 more got invested in our company. We have an owner that has a claim on $60,000 more of our assets, right? That's what this idea is. So credit in common shares makes our equity go up, not down. May 14th, issued preferred shares. Well, issuing preferred shares, just like issuing common shares, we issued 100 shares in exchange for equipment with a fair value of $10,500. Well, we got an asset, debit equipment, $10,500, and we credit preferred shares. And preferred shares, in terms of like journal entries, behave a lot like common shares. So it's just like, we issue the share for an asset, debit the asset, credit the share, in this case, a preferred share. Declared the regular cash dividend on the preferred shares. July 1st, Canada Day. Okay, well, how many preferred shares are there? There were 500, and they were $10 shares, so 500 times 10 is 5,000. But wait, we issued 100 more shares. So how many preferred shares do I have? I have 500, and then I just issued 100 shares. I have 600 shares on which I'm paying a $10 dividend. That's $6,000 worth of dividends. What does this look like? I'm going to debit preferred dividends. Some textbooks at this point debit retained earnings directly, because remember, our dividends come out of retained earnings. I don't do that. I debit a dividend account, but it's totally appropriate. If your textbook or your professor says debit retained earnings when we pay a dividend, that's great. Like, that's how I would do it in practice. That's not how I teach it. Debit preferred dividends, we're going to credit. Normally we would credit cash, right? We pay a dividend, but it says declared the dividend. It doesn't say we paid it. And in fact, on July 15th, we paid it. So if I declare a dividend, it's saying I'm promising to pay a dividend. I'm going through a formal declaration. A dividend is coming. And so because of that, I create a liability called, I'll call it preferred pref dividends payable. And the amount, again, $6,000. Then on July the 15th, we pay. So July 15th, credit cash, $6,000. And the debit is to preferred dividends payable. I'll just read that one again because I feel like I read it in my head and I didn't read it out loud. Always with these problems, you can download them from my website, linked below, but and you should be downloading. Paid the regular cash dividend on the preferred share. So declared the regular dividend, that's July 1st, where we create a payable, and then paying it. That's pretty straightforward, I think. August the 7th. August the 7th. What happens on August the 7th? We declared and issued a 5% stock dividend on the common shares at a time when the market price was $13 per share. Okay, a stock dividend is we pay our shareholders dividend, but we don't give them cash. We give them shares in our company. And it's a funny transaction if you think about it, because when you pay a dividend, you reduce your retained earnings, like dividends get paid out of retained earnings. Just think of the statement of retained earnings, beginning retained earnings plus net income minus dividends. Dividends come out of your shareholders' equity. So Our shareholders' equity goes up because we got a bunch of new shares, but it goes down by the exact same amount because we paid it's a dividend, so it reduces our retained earnings. This company should look exactly the same the day before and the day after a stock dividend. So why do we do it if it doesn't change the company at all? And there's all sorts of academic papers around why does a stock dividend move a share price? Theoretically, it shouldn't do anything to the company, but it's an interesting thing, and it's more for a finance course. But for us, let's just look at the mechanics of it. So we had, when we entered this question, 20,000 common shares outstanding, and then we issued 5,000 common shares in our first transaction. So we have 25,000 common shares, and we're saying for every 100 shares you own, we're going to give you 5 free ones. We're just going to issue you a dividend of 5 shares per 100 that you own, 5% stock dividend. So 25,000, we're going to issue 5% new shares. That's 1,250 new shares, bringing us up to 26,250 in new shares. But we want to issue 1,250 new shares at a time when the market price is $13 per share. So 1,250 times 13, 16,250 worth of shares, $16,000 worth of shares. You may look at this and go, well, wait, the share price, if I go 200,000 divided by 20, these are like $10. And if I look at this, these ones were $12, and now we're looking at a $13 share price. What's with this? Doesn't it need to be consistent? Doesn't it need to be the same? And the answer is no. The market price for shares goes up and down over time. Even for a private company, the market price changes, right? How much you could buy and sell your shares for. So there's nothing weird that the number was different every time. That's very normal. Okay, so we issued 16,250 of new common shares. So credit common shares, 16,250, and we debit dividends. But in this case, I'll call it common stock dividends because it's not just a normal dividend, like not a common dividend, it's a common stock dividend, sort of a special dividend. But again, ultimately, this is just a retained earnings. This is just going to affect our retained earnings. There we go. We've done the first 5. Now, the second part of the question, so we've done the journal entry, we've done part A. Part B says, assuming net income for the year is $125,000, prepare the December 31st, 2029 shareholders equity section. And this is the year before shareholders equity section we were given. And so it's just like update this for those transactions. That's what we've got to do. So let's do it. Let me grab that, pull that across. There we go. Beautiful. Okay, so we'll start with our preferred shares. And I'm just going to copy word for word what's in here, but just update anything that I know is out of date. So I know it's still $10 non-cumulative. I didn't change my dividend policy. In fact, I lived up to it, right? We know we paid the dividends. 500 issued. No, it's more than 500 issued because on May 14th, we issued 100 more preferred shares. Then we paid a dividend that doesn't affect the number of shares. So it's 600 issues. 600 issued. And again, no par. We'll talk about par value in 10.2. So you have that to look forward to. Now, it was $50,000. But it's going to be more than that because I've added 10,500 to my preferred shares, right? I credited preferred shares. They started at 50. They go up by 10,500. They're going to be 60,500. That's my preferred shares. What about my commons? Still have 1 million authorized, and this authorized amount is just legally what I'm allowed to issue, the maximum amount of shares I can issue up to 1 million. Now, the reality is, if my company is wildly successful, I issue more shares, I can do it. I just need the shareholders to all agree to it. The idea is I can't issue more shares than I'm authorized and like screw somebody over, essentially. If you issue so many new shares that you end up issuing so many that somebody who had voting power no longer has voting power or something. So this is a way to limit that. But the reality for most companies is it's just a non-issue, the amount of shares authorized. 20,000 issued. Well, is it 20,000 issued? No, I issued more shares. I issued, let's see, I had 20,000. I issued 5. That was the first common share transaction. And then I issued $12.50 with my stock dividend. I'm at 26,250 issued now. And yes, these are no par. And as I've said time and again, we'll be looking at the concept of par in problem 10.2. What's the value of the common shares? Well, let's check what we credited common shares for. So the opening balance, 200,000. Then I credit common shares for 60, so we're up to 260. Then I credit common shares for 16, and that's it. No other credits to common shares. So 200 plus 60 is 260 plus 16, 276, 250. 276, 250. Okay, what about the retained earnings? Here you have to think of that old statement of retained earnings that we learned in chapter 1. So remember how that works. I'm just going to do a rough one here. Beginning retained earnings plus net income. I'm going to subtotal minus dividends. And we got a few dividends. I'll leave a few lines here. Equals ending retained earnings. So our beginning retained earnings, 750. That was the end of last year. That's the beginning of this year. We're going to add net income. Net income was given 125. Subtotals to 875. Then we take away our dividends. Now, what do we have for dividends? My computer froze. That's not good. It's going to unfreeze in 3, 2, 1. There we go. I don't know what happens here. This is a fancy computer, but it freezes occasionally. So we had 2 dividends. We had this preferred dividend here that we declared, and the day we declared, that's a dividend as far as our accounting system is concerned. And we had the common stock dividend. Those both affect our retained earnings negatively. Those are our only 2 dividends. So 6,000 and 16,250. So minus 6,000 minus 16,250. In total, that's minus 22,250. Okay, so 875 minus the total of our dividends, 22,250. 852,750. That's our ending retained earnings. That's what's going to go on the balance sheet. And we would do this, like you would already know this number because you would have prepared your income statement, you prepare your statement of retained earnings, and then you prepare your balance sheet. We're just having to sort of jump the step here. So 852,750. Let's total it up. Let's total our shareholders' equity. Now, there's no double check here. It's not like, oh, I can see that my balance sheet is balanced, therefore I did it right. There's no magic number we're shooting for. We're just trying to be careful, trying to make sure we do it right. Plus 852,750. And I end up on 1,189,500. There it is, my total shareholders' equity. So we've done a bunch of new equity transactions. We've prepared a shareholders' equity section with a little bit more detail than what we learned previously. I hope this video helped. And as always, if these videos are helping you, it really does help me to hit one of those buttons. Thanks for watching. Have a great day. See you in the next video. Bye-bye. Let's run through problem 10.3a, some equity section analysis. So we've got the shareholders equity section of Hart Inc.'s balance sheet, and we're asked some questions about it. So it says preferred shares, $6 non-cumulative, 1,500 shares issued, no par, $75,000. Common shares, 1 million authorized, 40,000 issued, no par, $80,000, and we got retained earnings and shareholders equity. The first question says, explain the concept of par value as it relates to shares. So as you saw in problem 10.2, par value is a stated minimum amount that the company is allowed to issue shares for. And as I think I would have shown, but you might not have seen, it's increasingly just an irrelevant number. When a company starts, they set the number so low, like as $1 or 1 cent, that it just doesn't matter. Now, the concept mattered a long time ago when the idea was you were worried if you were an investor that your partner might try to issue a bunch of new shares really cheap and basically play a trick on you, play some shenanigans on you. And, if they could issue a bunch of new shares for 1 cent and you had paid $50 for your shares, you could get, screwed over. But there's legal recourse now where it's just not as much of an issue. And so a lot of companies set the par very low. And in a lot of countries, no par shares have become the norm. So par value, though, the minimum amount you're allowed to issue a share for. Anything above par gets tracked through an additional paid-in capital account. You can see for most normal companies, if they have par value shares, the additional paid-in capital account is really big, and the par value, the common shares account tends to be smaller. How much were the preferred shares issued for? Well, we got $75,000 worth of preferred shares, 1,500 issued, $50 a share on average. Now, we could have done, 1,000 of them at, what would it be? 1,000 of them at $40 and 500 of them at 70, whatever lands us on that number. It certainly could be the case, but on average they're $50. What about the commons? Well, 40,000 issued, $80,000, so it's $2 per share. What does authorized mean? Authorized is the maximum we're legally allowed to issue unless we change something, right? Unless there's a meeting at the lawyers where the shareholders all vote and agree, let's increase the cap here. And generally speaking, when the company starts, they authorize themselves to have issue more shares than they can imagine ever needing, right? So you just do it once and you don't have to do it again. So it's the maximum number of shares that the company's allowed to issue without changing. I think it's the articles of incorporation, but changing something at the lawyer's office. What does the term non-cumulative mean when it relates to preferred shares? It means, I'll explain by cumulative. Cumulative means if they miss a dividend, they got to pay double the next year, right? So it's a $6 dividend annually. Well, if you miss this year's $6 dividend, next year you got to pay 12. If you miss 2 years in a row, the year after that, you got to pay 18, and so on. A non-cumulative dividend means if you miss this year, next year you still got to pay 6. Preferred shareholders get dividends before common shareholders. So if I want to pay my common shareholders anything, got to pay those preferred shareholders first. What amount must the preferred shareholders receive before the common shareholders can be paid a dividend? $6. Assume the company declared and paid the preferred dividend and also paid a dividend of $2 per common share. Journalize the transaction. All right, so we have 1,500 preferred shares, $6 a share. That's $9,000 of preferreds. So let's credit cash. So I don't know. They didn't give us a date. Let's say it's December 31st. Credit cash. $9,000, and we're going to debit preferred dividends. Now, again, this can be just simply debited to retained earnings as well, but we'll do preferred dividends in our class. Also, on December 31st, we paid some common dividends. Again, could debit retained earnings. The amount was $2 a share, and there's 40,000 shares, so that's $80,000 of common dividends. And we'll credit cash for $80,000. And at that point, we've solved it. We've done 10.3a. As always, hope the videos are helping, and I'll see you in the next video. Bye-bye. Welcome to Module 11 in our financial accounting course. This module is all about the cash flow statement. Now, we've already introduced 3 other statements, the income statement, the statement of retained earnings, and the balance sheet, and we add the 4th key financial statement, the cash flow statement. So you've likely heard this phrase before, cash is king. And it's true, and it's true for a multitude of reasons, but isn't it interesting, right? We have all kinds of assets. We have accounts receivable, inventory, we have all kinds of equipment. Cash is the only asset that gets its own financial statement dedicated to it, and it's because cash is king, and that means cash is super important. Now, It's important for many reasons. I'm going to introduce 2 reasons why a cash flow statement is needed. And the first is, if a company runs out of cash, it's dead. It is over. If you don't have money, you can no longer pay your bills, and therefore your suppliers will stop supplying you, and you can no longer pay your employees, and your employees will stop coming to work. The company is dead if it runs out of cash. So it's a very, very important asset. So if you're a shareholder, you're interested in a company, you are very interested that they don't run out of cash. And isn't that reason enough to have a whole financial statement devoted to cash? But there's another reason as well. And you might not know this if you're in an intro class, but accountants are not just accountants. They're often magicians. Certainly the best and most highly paid ones are magicians. And what do I mean? Well, there's a joke in accounting, and it's not the funniest joke in the world. Us accountants aren't the funniest people, but I'm going to tell you the joke. You're hiring your new accountant. You ask that accountant, what's 1 + 1? If the accountant says 2, you don't give him the job. The correct answer to what's 1 + 1 is whatever number you want it to be. You want your profits a little higher? A good accountant can make your profits a little higher. You want to show less profit and pay less tax. A good accountant will show you all sorts of tricks and techniques to avoid taxes. Financial statements can be maneuvered by good accountants. A good accountant is like a magician. Well, finance people, if you're a financial statement user, this is actually bothersome for you because you go, do I trust the financial statement, or is the accountant actually being a magician and playing a trick on me? And so there's one account that really is exempt from a lot of these tricks. If I want to overstate my equipment or change my receivables balance, I can change estimates, right? I can change my estimate for depreciation expense to change the equipment balances. I can change my estimate for the allowance for doubtful accounts, and that changes the receivables balance. One thing even a great accountant will have a hard time maneuvering is cash. Now, there's cash management, there are cash flow decisions, but cash is a very real number. Ask me how much my car is worth. Is it worth $10,000 or $12,000? I really don't know. It's an estimate, right? What is my used truck? It's a truck. What is it really worth? Somewhere between $10,000 and $12,000, I guess. How much is my checking account worth? I can tell you to the penny, right? It's a real, true number. And because of it, finance people, financial statement users, are very obsessed with cash. When you go on in your coursework, you might take a finance class and you'll see all they talk about in finance is cash flow. They're interested in cash flow, and because they're interested in cash flow, it's the job of the accounting function to provide them with good cash flow information. So you may be saying to yourself, good cash flow information. I remember chapter 2. We learned how to do journal entries. And in chapter 2, I know how to make a cash T account. Why don't I just give them this, right? And just slap a label on top of my cash T account and call it cash flow. Oh, my writing is beautiful. Statement, right? Why don't I just slap a label on top of a cash T account and call it a cash flow statement? And the answer is, well, there's a couple of reasons why we can't and don't do this, because, you know how to prepare a cash T account already. Why can't I do this? If you've ever worked for a real company, it becomes very obvious very quickly. I'm imagining Walmart in my hometown here of Kamloops. It's not a particularly big city. It's not a particularly big Walmart. I imagine if I looked at their cash T account this morning, it's before noon right now. I imagine if I looked at their cash T account this morning, it would not look like this. Walmart's cash T account in my hometown for one morning would look like this. And in fact, it would just keep going and going and going and going, right? It continues on and on. So, and that's for half a day, let alone a year. It would just be pages and pages and pages and pages. And even for, it doesn't have to be a big, massive company like Walmart. Small companies have a lot of cash transactions. It would take pages and pages and pages. And so you have to summarize it in an organized and logical way. So organizing this makes this volume of information useful. And that's what the cash flow statement is for. It's saying, taking all these cash transactions, summarizing them, organizing them. I just smashed my hand into my monitor, and making them useful. So we organize it into 3 sections. The first section is the operating section. So we say any operating cash flows go here. And operating cash flows you can think of as the day-to-day business. So talking of Walmart, what are their operating cash flows? It's selling stuff to their customers, generates positive cash flow for them, paying their bills to their suppliers, right? People ship them inventory. They got to pay for that inventory. That's a big outflow, paying employees' salaries, and just paying the day-to-day bills of running a business. Those are the typical operating cash flows of a Walmart. Now, I summarize that into most transactions that make up net income, so revenues and expenses, as well as most transactions that transact in current assets and current liabilities, paying off your accounts payable, collecting on your accounts receivable. Those are the key accounts involved in operating activities. In investing activities, so we want to split those off, right? The day-to-day, so Walmart, selling stuff to our customers, paying our employees, paying our suppliers, paying taxes is also considered an operating activity. And there's a few others, but those are like the key activities. And we're just saying what's cash in, cash out from doing this, right? And hopefully you're generating a lot of cash from your day-to-day business. It should be a positive number and hopefully a big one. Investing activities are all about long-term assets. So when Walmart in my hometown, they just did a huge renovation, cost them multiple millions of dollars. Well, that renovation isn't part of the day-to-day business, right? The fact that they added a whole grocery store wing to the store that didn't exist previously, that is an investing activity. They bought a ton of long-term assets. They renovated the place. That is an investing cash flow. So anytime a company's buying and selling equipment, buildings, things like this, it's an investing activity. And companies buying and selling other companies, if you get to that size, right? When Facebook bought Instagram, I think for $1 billion, years and years ago. I guess they're all called Meta now. But anyway, Facebook owns Instagram and it was $1 billion. Well, that was an investing activity. They paid $1 billion to buy Instagram. Financing activities, all about long-term liabilities, debt, and shareholders' equity. So the company issues new shares, it's a financing activity, or they buy back their own shares, that's a financing activity. They borrow money from the bank or they repay their loan, that's a financing activity. And last, with shareholders' equity, dividends, if they pay dividends, that is also considered a financing activity. So those are the 3 major sections. We're going to learn this chapter to summarize our cash flows into those categories. One last point in this video, and then we'll say goodbye. I put a little star by operating, and that star is, when it comes to investing and financing, there's only one way to do it, and we'll learn that one way. When it comes to the operating cash flow, there's 2 ways to prepare them: the direct method and the indirect method. In our class, we're going to learn both. I'll just give a high-level summary here. The direct method says, where did your cash come from? And where do you spend it as it relates to employee salaries, as it relates to collecting from customers, that type of thing. Most academics like me prefer the direct method, so I will teach it in the course. But if you only have to learn one or the other, it's easy enough to skip around in the videos. The indirect method says, no, start with net income and work backwards. That's why they call it indirect. It's kind of backwards working. So it sort of says net income's almost like our operating cash flow. Revenues and expenses are mostly operating items. Why don't we start there and just work backwards? So we're going to learn both the direct and indirect method this chapter, but if your course is focusing on one or the other, you can focus on one or the other. If you're my student, lucky you, you're going to be responsible to learn both methods. But the best way to learn anything in accounting is to do examples. So please go on to the next video. We'll work through a comprehensive example of a cash flow statement. I can't wait to get started. I'm so glad you're here, and I'll see you in the next video. Goodbye. Let's take a run through problem 11.1a, the first of many cash flow statements that we're going to practice this chapter. As always, tonybell.com to download the problem, as well as you're going to see I'm going to use a template as I work through here. If you'd like the template, also available, tonybell.com. Should be linked below. The financial statements of Bait and Tackle are presented below, and there's a set of financial statements, a balance sheet, an income statement, some additional information. And the question says, prepare a cash flow, and for the operating section, use the direct method or the indirect method or both, depending on what your instructor assigns. Well, we're going to do in part 1 of the video, the operating section doing the direct method. In part 2, the indirect method, and then in part 3 we'll do the investing and financing section. So if you only need to know the indirect method, really you can skip this part. But if you need to know the direct method, well, you're in luck. That's exactly what we're going to do. So as we look at the direct method and as we have a look at our template here, you'll see that the operating section, you can either prepare direct or indirect, and the investing and financing is the same no matter what. So it's just the operating section where companies have this choice to make. Most companies choose the indirect, so therefore most professors cover the indirect first. However, most academics like me think this method is better. The direct method is better, and so that's the one we'll start with here, but we'll do the indirect method after. And again, companies won't do both. They'll pick one or the other. So the direct method, you can see we need to calculate cash collections from customers. And so when I ask my students about this, I say, okay, well, let's look at the financial statements and think, what accounts are involved in getting money out of my customers? And students immediately go, sales, right? You sell more. Like, what account on the income statement is most involved in getting money out of your customers? And of course, it's sales. You sell to them and they give you money typically. So yeah, that's absolutely right. So sales is involved in getting money out of our customers. Well, what on the balance sheet is involved in collecting money from our customers? And I hope you looked at this and said, oh, it's AR. Like, AR is involved in collecting money. You collect AR, it's collecting money from your customers. So there's a formula here, and the formula is sales plus decrease in AR. And the idea is, if your AR is going up, it means you're not collecting the sale. If your AR is going down, it means you are collecting more money from your customers. So a decrease in AR means more money in your pocket. So there's this formula, and you'll see I've got other formulas on the page. Hopefully it appears here. Cash collections from customers equals sales revenue plus decrease in AR. Now I put in brackets there, minus increase in AR, and the idea is if AR is going up, you're getting less of your sales, right? If you sell, and let's just say AR, there was no AR, so sales didn't go up or down because AR was 0, well, then our cash collections from customers is just our sales. But if AR went from 0 to 50,000 one year, what does that mean? I made a bunch of sales, I didn't get the money, so that's why it's sales minus increase in AR in this case. So I always tell my students, like, look, you can sort of follow along that theory, that story I just told, but you can also just remember this formula. I don't provide the formulas. I do provide the template that you just saw, but let's solve this. Sales plus decrease in AR for our company. Our sales, 635,000. AR did not decrease. AR increased by 14,000. So it's going to be 635,000, our sales, plus decrease in AR, but minus increase. And we said it was a minus 14. 635 minus 14. What is that? That is 621. So my cash collected from my customers is 621. I sold 635 grand worth of stuff, but I didn't get all the money because my AR went up, meaning I didn't collect from every customer. So 621 goes in here under cash collections from customers. I guess I forgot to put a title on this template. Again, there should be a link right below this to download the template if you want to do it yourself. And if you want to do it in Excel, of course, that's fine. Name of our company, Bait and Tackle. Bait and Tackle. We're preparing a statement of cash flows for the year ended, and what is it? December 31st, 2029. And we're on to the next one, which is cash paid for merchandise, cash paid for merch. And so again, I always go over to my financial. Now, we do have the formula there that you might have seen. And I say, okay, on the income statement, which account here is most involved with inventory? What income statement account is most involved with inventory? And the answer is cost of goods. And this one is tougher, right? Sales, I think, is pretty obvious. You sell more, you collect more. Sometimes students have to think this one through. But yeah, of course, cost of goods sold. If my cost of goods sold doubled one year, well, what likely happened? I had to buy a lot more inventory to sell double the inventory. I had to have double the cost of goods. So yeah, cost of goods sold is involved in the buying of inventory. And so our formula is COGS plus something on the income statement or on the balance sheet. Let's look at the balance sheet. What balance sheet accounts are involved with inventory? And I hope you said inventory. Yes, and that would be correct. So it's COGS plus increase in inventory. And we'll go to a proper formula or more beautiful formula in a second. Plus, and there's one other account that is likely involved in inventory, and we make the assumption it is. In these problems, we say accounts payable is involved in the procurement of inventory. And the formula goes COGS plus increase in inventory plus decrease in AP. That's the formula. Let me just explain the pieces. So again, this is cash paid for inventory. So cost of goods sold, you obviously have. If COGS goes way up, how did you sell more inventory? How did your inventory costs go up? You bought more inventory, so cash paid for inventory went up. Increase in inventory. Why would inventory increasing mean more cash paid for inventory? It should be obvious. If inventory is going up, we're buying more inventory. We're spending more inventory. Decrease in AP. Why is that? And that's always weird. And the first time students see it, they're like, plus decrease just feels weird to say. But why is it a plus, a decrease in AP? If AP goes down, why does a bill go down? Because you paid it. Your cash paid goes up. It's kind of a convoluted way of saying it, right? If AP goes down, why? Because I'm spending more money. So you can see the formula here more beautifully laid out. In fact, why don't I zoom out and give you a chance to like screenshot that if you'd like. There's our formulas, I'm going to say formulas. Could be wrong. Cash paid for merch though, cost of goods sold plus increase in inventory plus decrease in AP. Let's see what our company's situation is. Cost of goods sold, 320. So let's just pull that number over. 320 plus increase in inventory. What happened to our inventory? Oh, it did not increase. It decreased by 30K. That means we have less money tied up in our inventory. So minus 30K. That's a funny one, right? Minus decrease in inventory. I always think of this going the other way. Increase in inventory, it's obvious. Well, inventory went up. It means I bought more inventory. If inventory goes down, it means we bought less inventory. Some of the goods that we sold in our COGS were inventory we purchased before. That's what that's saying. Plus decrease in AP. Let's see, what did our AP do? Where is AP? AP did decrease by $8,000. Why did it decrease? Because we paid some of our bills, minus $8,000 to our cash. Or, sorry, plus 8,000 here, minus 8,000 to cash, because of course this is cash paid. So I'm talking myself in a circle here. 320 minus 30 plus 8. 320 minus 30 is 290 plus 8, 298. I want to explain that last piece again because I think I explained it clumsily. Decrease in AP, so that's what we had. AP went down. Why did AP go down? Because I paid more money, right? I spent more money. That's what happens when AP goes down. So 298 is our number there. Let's plug it into the table. Cash paid for salaries. Well, again, I always go look at the income statement and go, are there any expenses on our income statement related to salaries? And of course, there is one called salaries expense. And in our question, just to make it fit on the page, I formatted it a little bit funny. Rather than list out the operating expenses, I put them down in the additional information. And you can see in additional information, there's salaries of $50,000. So obviously that's involved in cash paid for salaries. It's salary expense plus decrease in salaries payable, but we don't have any salaries payable. So for our company, it's going to be salaries expense, $50,000. plus decrease in salaries payable. Well, we had 0 salaries payable. We had obviously just paid their salaries. So for us, it's $50,000. Now, why do I have this decrease in salaries payable here if we don't have it? Because when you do 11.2 or 11.3, we're going to have it. So it's worth introducing the formula to you and to my students in my class. So there you go. Cash paid for salary. Salary expense plus decrease in salaries payable, 50. In this case, plus 0 is 50. Now, something I should have done and I forgot to do, cash collections from customers. This is a plus to our cash. So it's a positive number. Cash paid, this is minus to our cash. We're cash outflow. So any cash in, just put it as a positive number. Any cash out, put it in brackets. Cash paid for salaries, we're going to put it in brackets because we're paying cash for salaries. Next, cash paid for operating expenses. Okay, let's look at our operating expenses. And here they are, $126,000. And this one, again, has the bullet point below. Operating expenses are $126,000. It says composed of depreciation, 12, salaries, 50, and other, 64. Well, let's think about these three. Depreciation. You'll hear this in your chapter on cash flows. Your professor will say this. Depreciation is a non-cash expense. What does that mean? It means when you record depreciation, you don't pay cash. You know, my car is a year older, right? I bought a $20,000 car. It's going to last me 10 years. There's $2,000 of depreciation on the car. I don't write the car a check for $2,000. I don't staple $2,001 bills to the outside of my car. I just go, oh yeah, my car's lost some value. No cash flow for depreciation. And so this one I got to ignore when I'm doing the direct method. So just ignore depreciation completely. Salaries, well, yeah, salaries is a cash flow, but I deal with it on its own. So I got to take it out of consideration here. And that leaves me with other. Now, other, again, this is the way I wrote the question. Could be repairs and maintenance expense. Could be advertising expense. Most of these other expenses do tend to be cash expenses. You're spending money on some cost. And so in this case, it notes other operating expenses are cash expenses. You will see in future questions, other operating expenses are tied to prepaids. If you have prepaid insurance or supplies and you have more insurance this year than last year or more supplies this year than last year, you spent more money. So that's other operating expense plus increase in prepaid insurance. That works for my questions as they're phrased. Your questions, you got to be careful. Like look for repairs and maintenance, look for advertising, look for rent expense. These are all expenses that you got to pay with money, right? Business like fees, like accounting fees, legal fees, professional fees. That's the word I'm looking for in my class. So I just call it all other because the question gets out of hand if I list them all out. Okay. So in our case, other operating expenses was 64. Increase in prepaids. We did not have prepaids in this question. And where would prepaids be? Up here, right? We're looking for prepaid insurance. We're also looking for supplies, supplies asset. If it's going up, we're spending more on our supplies. Like that's a operating cash flow. But in this case, we don't have any prepaid insurance. We don't have any supplies or prepaid rent, any prepaid. So in this case, it's 0. So it's 64,000 plus 0, it's 64,000, and that is our cash paid for operating expenses, 64K. Cash paid for interest. Well, same formula. Maybe not same formula. Let me explain the formula. It's, of course, look at the income statement, go, okay, are there any income statement accounts related to interest? Of course, interest expense. And on the balance sheet, are there any balance sheet accounts related to interest? And there is one called interest payable. And this company doesn't have any interest payable. And why not? Because this is a basic cash flow statement. As you move on to 11.2, 11.3, 11.4, they'll have these things. So what's our formula? It is interest expense plus decrease in interest payable. And that should make some intuitive sense, right? If your payables are going down, like up here are salaries, if your payables going down, it means you're spending more money on it. Your cash paid is higher. So interest expense was, where are you? There you are, $9,000. Wait, I circled the wrong number. $1,000. Holy cow, it's tricky for me to read. Our cash paid for interest is $1,000 plus decrease in interest payable. There was no interest payable, so it's just $1,000, right? It's $1,000 plus 0. It is $1,000. Last one. Cash paid for income tax, same formula. Income tax expense, which in this case is $43,000 plus, we do have income taxes payable. Look at that. Decrease in income taxes payable. Well, income tax payable went from 11 to 10, meaning we paid down our taxes. We reduced our liability, and reducing our liability means you paid money. So 43,000 plus 1,000, it's going to be 44, and we can see the formula here. 43,000 is our income tax expense plus decrease in income taxes payable. This is 1. It was a decrease. Had it been an increase, it's a minus, but 43 plus 1 is 44,000. So let's plug that into our table. I missed the -1 for interest. There's minus 44 for income tax. And now we just have to sum up the list. Let's crunch some numbers here. Get the calculator out. Sorry, it's not lined up properly on my end. 621 minus 298 minus 50 minus 64 minus 1 minus 44, and we end up at 164,000, and it's a positive number, right? This was a positive number, and so this would be an inflow from operating activities. Okay, I want to take a pause here and just talk a little bit about the formulas. Now, we're done. Like, this is part 1 of the video done. We've completed the operating section of our statement of cash flow using the direct method. I hope it was clear. I hope you're like smashing that thumbs up button. I hope you're smiling politely. But I want to discuss one more thing before I say goodbye. You could go goodbye now. Of course, you could say goodbye at any time. Sometimes I get students that go, okay, this doesn't make sense to me, this arrangement. And they'll say it about any one of these formulas, but I'll talk about the last one. I just want to tell a story. So they'll say to me, hey, this formula doesn't make sense to me. Decrease in taxes payable, because if I look at the taxes payable, my taxes payable went from 11 to 10. But of course, that's not what happened to the taxes payable in real life, because presumably what happened was last year, I owed $11,000 in taxes to the government, and I paid. That's what normal companies do. They get a tax bill, they pay the taxes right away, right? They didn't wait a year and go, I'm just going to pay this down by $1,000, and therefore my reduction in taxes payable is $1,000. That's not what happened, right? What really happened is they paid it off, and then the $10,000 is like new taxes. But our formula doesn't seem to indicate that. And so I just wanted to show you the story of this company's taxes. So maybe I'll type the story because my handwriting is so messy. I want you to keep these numbers in mind though. This one, these numbers, and this 43,000. So this is the story that our financial statements tell. Getting a keyboard here. Last year, I'm going to have to make this bigger. I owed, let me make this bigger. Big, maybe 50. Oh yeah, that's perfect. Oh, what a guess. Last year I owed $11,000 in taxes. Or my company, Bait and Tackle, owed $11,000 in taxes. I paid it. So I paid $11,000 cash, right? Let's presume that's the normal thing that a company would do. Let's presume that happened. This year, based on my business, my tax expense was $43,000, right? And you can see that at the bottom of the income statement. I didn't pay the full $43,000. How do I know? Because I have taxes payable of 10. Since I have taxes payable of 10K, I can fill in the blanks here. I can infer I paid of the 43K. Oh my God, I'm saying this so clumsily. I can infer, I'll get rid of the word I paid. I can infer of the 43K, I paid 33K, right? Like that's what you can infer from that, income statement and balance sheet situation. So again, last year I owed $11,000. I presume I paid it all off. This year, new business year, new tax bill, $43,000 through the year was tax expense. I haven't paid it all off because I have taxes payable. I paid $33,000. So how much did I pay in taxes in total this year? Well, I paid the $11,000, the first tax bill, and I paid 33 out of 43. In total, I paid $44,000 in tax. 11 plus 33. In total, I paid 44K. Let's see what we said we paid. We said we paid 44K. So our formula worked. It told the correct story. It did not tell a lie. Now, every single one of these formulas I could tell a similar story about. I'm not going to because it takes all day, but that's when I read the financial statements, when I read the formulas, I can see that's what's happening with each of these. Sometimes a student looks at this and they go, the formula is kind of cheating, or it's just not true. It's not reflecting reality. The formulas are reflecting reality for real companies. And I hope that story helped if you weren't so sure. But you don't need to memorize the formula. Of course, you can just you don't need to memorize the story to apply the formula and to get the answer right. All right, we're at the end of the video. I rambled way too long there. If you stuck around till the end, for goodness sake, smash one of those buttons. Let me know you made it to the end. I don't think too many people make it to the end of long rambling stories like that, but I appreciate your being here. Thanks so much for watching. And in the next part of the video, we'll do the indirect method and then on to the investing and financing sections. Okay, bye. I've talked too long. Goodbye. Okay, in our last video, we worked through the operating section of the bait and tackle question, problem 11-1A. Download the link below, and you can also get my template at the link below. No logins, just click and you can download it for yourself. So we did the direct method of the operating section. In this video, we're going to do the indirect method. And what the indirect method and the operating section says, okay, the day-to-day business, what were the cash flows generated or spent in this business? The direct method says, here's where my money came from and here's where I spent it. The indirect method says, net income's kind of like operating cash flow. Let's start with net income and work backwards from there. That's why they call it indirect, right? I don't like it as much, but more companies use the indirect method than direct method. So certainly I think it's appropriate to teach and appropriate for you to learn. Just have to change one setting here. There we go. Okay, so the indirect method, and just working down our template, I think the first time you do this, you're wise to use a template. If your professor does not allow you to use a template, that's totally appropriate. They're within their rights to do that. You can see we've done the direct method. And it just means you got to practice and remember what's going on. So the indirect method operating section, very straightforward. You start with net income. You got to remember these two items, and then it's all just current assets and current liabilities. So we'll look at this as we go. So start with net income. So just like plug in net income. We start with net income and we work backwards from there. You can see net income is 136. Let's put that in at the top of our table, 136. Okay, now it says adjustments to reconcile net income to net operating cash. Here's what these two adjustments are for. One is when I calculate net income, part of my expenses, and you can see the operating expenses are 126, part of this is depreciation of 12. Well, if one thing gets like rammed into your mind about a cash flow statement, you will know depreciation is a non-cash expense. If you're coming here, you've already done this in your own class, you will have heard that. You will have heard the good news about depreciation. It is a non-cash cash expense. Just smash that into your brain. And what does that mean? Like, okay, you've heard the phrase, but what the heck is the person saying? They're saying, if I'm saying net income simulates cash flow, when I calculate net income, I deduct depreciation expense, but I know depreciation doesn't involve cash. Like sales involve cash. I'm selling stuff to my customers. They pay me. Cost of goods sold. I got to pay for the goods that I sell. So that's cash flow. Like there's cash is coming in and out as a result of my sales and my costs. Depreciation is one cost that doesn't involve any cash. And so if I'm saying net income simulates cash flow, take depreciation out of it. So I minus depreciation to arrive at 130. I got a plus depreciation to say, no, that didn't involve cash. So let's take that away from consideration. So plus 12,000. I always think of this section as like opposite day. Expenses, normally it's a minus. In this little blue section, this little blue section, just do the opposite. So here, gain loss on sale of assets. Well, when I sell assets, yes, it is a cash flow, but the reality is it's not an operating cash flow, and the gain or the loss, it doesn't belong here, right? So it's included in net income because gains and losses are revenues and expenses, but it needs to be taken out. So if it's a gain, again, it's opposite day, minus it. If it's a loss, plus it. And again, it's the opposite of what your intuition might say to do with a gain or a loss. And the reason is we are working backwards. So in notes, we have a loss on sale of equipment of $9,000. All right. So again, loss, normally lose is a minus, but in this case, we work backwards. It's a plus 9,000. Whew. Okay. Now, so if you had to memorize this, right? Net income. You practice this enough, you're just going to remember. Okay, net income goes first. These two you got to remember. Depreciation will be in every single question that ever existed. So you hopefully just remember add back depreciation. That's the phrase an accountant will use. And then if there's a gain or loss on sale of assets, you do the opposite. If it's a gain, it's a minus. If it's a loss, it's a plus. Okay, so we've set the table to this point. These, whoops. Oh, I hope, what is going on? I can't seem to touch my screen without dragging the thing. These items from here down, this is just all of my current assets and current liabilities. If this thing doesn't stop moving, it's driving me absolutely insane. Okay, there we go. These are just all of my current assets and current liabilities. You can see these are typical current assets. These are typical current liabilities. And then I just put a couple of other in case I didn't list ones that are in your question, that you can put them in other. Okay, so let's start with the first one, change in accounts receivable. So I go over here and I see my company's accounts receivable went up by $14,000. So that's the change, right? Plus $14,000 in accounts receivable. I need to say, how does that impact cash? I always try to tell a story. At the end of this, I'm going to give you a trick to do this quickly. But I always try to tell a story. And the story I say is, okay, well, if accounts receivable went down, why did it go down? And the answer is, because I collected money, right? If somebody owed me $100 yesterday, they only owe me $20 today. What happened between yesterday and today? They paid me $80, right? I collected money. So if accounts receivable goes down, we're collecting money. If accounts receivable goes up, it means we're making sales, but we're not collecting money. It's negative for your cash flow. Negative $14,000 to cash here. Now, again, it means these are sales that I've made, but I didn't get the money. I counted the sales in net income, and I'm saying I got to take it back out here in accounts receivable because I didn't get that money, even though it was counted as part of my net income. Okay, next one I think on our list was inventory. Okay, so again, with inventory, I think the opposite way. I think, okay, if inventory goes up, what's happening? Well, I'm buying inventory. Cash is going down. If inventory is going down, less of my money is tied up in inventory. Cash is going up. So in this case, inventory went down by 30. Cash goes up by 30. I skipped office supplies, but our company didn't have any office supplies. I'm going to skip prepaid insurance because we don't have any prepaid insurance. And I'm just working my way down the balance sheet, right? So we don't do cash. We do AR. We did it. Inventory, we did it. Next is equipment. Equipment is long-term, so it doesn't belong here. On to accounts payable. Went from 40 to 32. Well, what happened? I paid some bills, right? If your AP goes down, you're paying your bills, your cash goes down. If your AP goes up, it means you're not paying your bills, your cash goes up. Try not paying your bills for a month. You'll see your cash will go up. So again, 40 to 32 means our cash goes down by 8 minus 8,000 to your cash. Maybe I should be putting these ones in brackets. Let's put them in brackets. I'm going to be consistent. And just don't do pluses here. If you've done the pluses so far, don't worry about it, but this is probably better formatting. Change in wages, salaries payable. I don't think we had that in this company. No. We had taxes payable, though. Our taxes payable goes down. Why does it go down? Because you paid it. So minus 1,000 here. And I think that's going to be it. We did not have interest payable. We didn't have any others. So yeah, that's it. Let's add it up. And then I'm going to give you a real shortcut here. I think I talked a lot this video. I hope it was helpful. I'm in a chatty mood today. I'm just adding the list, right? 136 plus 12 plus 9 minus 14 plus 30 minus 8 minus 1. We land on 164. Now, of course, most normal courses, most normal professors don't have you do both. If you do happen to have to do both, nice feeling that these matched, right? That's like, oh, that's good vibes. All right, I got it to work out. Not for sure that I'm right, but probably I'm right that these two things matched. But again, real companies are not going to do both. They're only going to do one. Okay, I wanted to hit you with a quick trick on the indirect method when you get to this part. If an asset goes up, cash goes down. And you can look through and see when my accounts receivable goes up, you can see our cash goes down. The opposite is true. If an asset goes down, cash goes up. Now, there's only assets and liabilities. So if a liability goes up, cash goes up. If a liability goes down, cash goes down. If I had to memorize this, I wouldn't even look at this part either. I would just go asset goes up, cash goes down, liability goes up, cash goes up, and the opposite is true. So just a little shortcut, just a little cheat sheet you could refer to, and it's so good for this section. I gotta say, when I'm grading exams, this section is a part that gets screwed up all the time. Don't you screw it up, please. I don't know. I was going to beg for likes there, but I don't even want to beg for likes. Stay tuned for our next video, though. We're going to jump through the investing and financing activities, and we'll finish this whole thing up. I feel like I talked longer in this one than I normally will, but I wanted to explain because it's our first problem together. All right. Thanks for watching. In the next part of the video, we'll do investing and financing. Bye-bye. We have been working our way through the statement of cash flows for problem 11.1a, bait and tackle. We're moving on to the investing and financing sections. Remember, the investing section, all about long-term assets. Basically, buying and selling equipment or buildings or land, buying and selling PPE, property, plant, and equipment, and buying or selling investments. Now, this problem, the company doesn't have any investments, but they do have some equipment. So let's see what happened. Usually in these questions, when they buy and sell equipment, it will be discussed in the additional information, and I wrote this problem. I'm no exception. I discuss equipment in bullet points 3 and 4. Let's read them and see what we're up against. Equipment was purchased during the year for $135,000 cash. Oh my goodness. Well, that makes our life easy. They told us we bought equipment. They told us how much cash. My spidey sense is tingling when I read the word cash, and I'm preparing a cash flow statement. And let's go over to our table, cash flows from investing activities, cash paid for equipment. I think this is pretty obviously $135,000. They told us we paid $135,000 for equipment. The next one, it says equipment was sold for cash during the year. It doesn't tell us how much money we got, and so this one requires a little bit of work. Equipment was sold for cash during the year. The original cost was $60,000, and the accumulated depreciation was $45,000. Okay, so remember, oops, oh my goodness, my touchscreen is wonky today. The cost of the equipment was $60,000. The accumulated depreciation was $45,000. So the book value, the equipment net, the net book value of the equipment was $15,000. The accountant thinks this equipment is worth $15,000, and they sold it. Did they get paid exactly $15,000? Well, the answer is no. How do I know they weren't paid exactly $15,000? The answer is because we sold equipment at a loss of $9,000. So if I lost $9,000 on equipment I thought was worth 15, what did I get for the equipment? The answer is, hopefully you guessed, 6. So if it's a loss, you would minus it. Had this been a gain, which you'll see in future questions, you would just plus it. 15 minus 9, though, is 6, and that's cash received on the sale of equipment. Oh, not equipment, equipment. And it's $6,000. Okay, so let's put that in as a plus 6. And I haven't been putting pluses, just put it in as a positive number. There were no investments here, so negative 135 plus 6 gives us negative 129. Now, we had noted that it was an inflow from operating because it was a positive number. This is an outflow from investing activities, and this is normal. We expect companies to have cash outflows from their investing activities. Why is that? Well, if you think it's a healthy company, they're having to replace old equipment with new equipment. When they sell the old equipment, they've used it for 5 or 10 years. It's used, it's relatively cheap. When they buy new equipment, they pay full price. It costs money. So generally speaking, a healthy company will have negative investing activities cash flows. It depends on the company, but general rule of thumb, especially as it relates to equipment. Sometimes investments might be different. Last section is the financing activities. The financing activities, debt and equity and dividends. So you can see debt, money coming in, borrowed money, money going out, you paid off the debt. Same thing with equity. We issue new shares or we buy back our old shares. So it's debt. There's 2 lines, money in, money out. Equity, there's 2 lines, money in, money out. And dividends, there's 1 line. Did we pay a dividend? If so, how much? So let's look at our debt first, our long-term debt. And we do. We have a bank loan, right? We've already done this one. We've already done this one. We're on to this one. And our bank loan went from 0 to 20. Well, what happened? We borrowed $20,000. That's presumably what happened. In the absence of other information, you should assume cash received on the issuance of bonds or long-term debt is plus $20,000. Let's look at our equity. Equity went from 50 to 60. Well, why would equity go up by $10,000? The answer is we issued new shares, $10,000 worth. So plus 10,000. Oops, that's not a repurchase of shares. That's an issuance of shares. The last one, the dividends, it'll often tell you in the additional information, but I was mean. It says dividends were declared and paid during the year. And we got to figure out what our dividends are here. And to figure it out, we have to make, and this is kind of unrealistic because if you were at the point of making a cash flow statement, you would have income statement, statement of retained earnings, and a balance sheet. But we're only given an income statement and a balance sheet. We've got to recreate the statement of retained earnings to figure out the dividends. So remember the statement of retained earnings, and we don't need a good format one. Beginning retained earnings plus net income subtotal minus dividends equals ending retained earnings. We've done this calculation a lot through this course. So for 2029, the beginning retained earnings of 2029 is the same as the end of 2028. It's 186. Add net income. Our net income is 136. Subtotal 186 plus 136. 136. 322. Deduct dividends. We don't know the dividends. That's a question mark. Equals ending retained earnings. We know our ending retained earnings is 272. All right, so fill in the blank. What is our dividend? And I hope you're looking at that going 322 minus something is 272. Our dividend must have been $50,000. Now, there is a formula for this, and the formula is dividends. Let me write it out, actually. Cash paid for dividends is dividends declared, which is what is up there, dividends, that number, 50,000, plus decrease in dividends payable. Because it is possible, as you learned in Chapter 11, to have unpaid dividends. So dividends plus decrease in dividends payable. Now, you'll notice in this question, there's no dividends payable. So it's zero. And again, you might be saying, well, why are you wasting my time with this formula that I didn't use? And the answer is when you do 11.2, 11.3, 11.4, you're going to need it. So just wanted to introduce it here. So it's 50,000 is our cash paid for dividends, just the amount we calculated. But in future questions, there's another step at the end. Okay, so cash paid for dividends, negative 50,000 to our cash. In total, 50 minus 20 minus 10 is negative 20, right? And at this point, we're almost done. So we've said cash flow statements have three sections: operating, investing, and financing. We've calculated operating, investing, and financing cash flows. Now we just need total cash flow, which is the sum of the three totals there: 164 minus 129 minus 20. I feel like it's going to be 15 positive, right? Well, let's do it in a calculator. 164 minus 129 minus 20. Yeah, it is 15 positive. So I had $164,000 come in as a result of my day-to-day business. 129 went out in the net amount of the asset purchases I made, the equipment purchases I made, and 20,000 went out largely on the strength of a $50,000 dividend, but that's sort of where my money came from and where I spent it. And overall, my money went up by $15,000. It was an increase, right? Positive 15, it's an increase in cash. I should have noted that was an outflow in the financing activity. So am I right? Did my cash go up by 15,000? The moment of truth. This is one question where you get to the end and you know if you got it right. It looks like we got it right, because you look at your cash balance and you go, yeah, our cash started the year at 24. It ended the year at 39. That is an increase of 15. So cash balance beginning of the year, 24. Cash balance end of the year, 39. And look at that. We said it would be 15. It was 15. Congratulations to us. If you made it all the way to the end of the video, congratulations to you. Thank you so much for watching. You'll learn this stuff by practicing, so I hope you'll practice more of these types of problems, and I hope you'll practice hitting the thumbs up button. Thanks for watching. See you in the next video. Goodbye. Let's run through problem 12.1a, a horizontal analysis. As the name suggests, we're going to be looking at financial statements horizontally. And what does that mean? Well, if you look at your favorite company, if you Google whatever company you're interested in, look at their annual report or financial statements, you can't help but notice they never just give 1 year. They always give 2 or even more than 2 years. And so a lot of times you're interested not in the sales. Like if I tell you this company had sales of 168,000, that's what this says. You're not interested in just the sales. You're interested in how did they change over time? Are our sales going up or are they going down? If I didn't see this column, you wouldn't know if 168 meant growth or shrinkage for this company. And so horizontal analysis says, when we look at financial statements, we don't just look at the financial statement alone, we look at it in comparison to the previous year to see how it's growing and changing. And so what we're going to do here is we're going to calculate the change and the percentage change. And the math here, very straightforward. This is not a complicated question, but I got to tell you, it's one of the most useful skills you can have when you're looking at a financial report. And just calculating a percentage change is something people are surprisingly shaky at in real life, and they needn't be. And you won't be after watching this video. Maybe you're not already. Maybe you're good at it already. But even if you're not, after watching this video, you'll be great at it. So it says prepare a horizontal analysis by completing the table above, compute the dollar change and percentage change of each line item. Okay, so our sales, what happened to our sales? They went from 151 to 168. That is plus $17,000, right? Our sales are up by $17,000. Our cost of goods sold, that's up by, is that $12,000? Our gross profit is up by $5,000, 73 to 78. Operating expenses are plus 2. Operating income plus 3. Interest expense down $1,000, minus 1. Income before tax up $4,000. Income taxes up $1,000, and our profit, our net income, looks like it's up $3,000. Okay. So that's the change. And the change doesn't mean that much. Probably if you're running the company, you're a manager, actually those numbers might mean something to you. To me as an outsider, the sales are plus 17,000 doesn't mean much. However, percentage change means more. So to get percentage change, you just take the change, the difference between the 2 years, and divide by the earlier year. So for example, the change of 17,000, I'm going to divide by 151. 17 divided by 151 is 11.3%. It says round to the nearest tenth of a percent. So that's what we're doing here. That's the ugliest 3 of my life. And I've had a lot of ugly 3s. 11.3%. That's a much more beautiful 3. Cost of goods sold. 12 divided by 78. 12 divided by 78 is 15.4%. Oh, and I should be putting pluses and minuses here as well. Gross profit. 5 divided by 73. 6.8%. 2 divided by 30, 6.7%. 3 divided by 43, 6.97%. We round that to 7.0%. Negative 1 divided by 3, well, it's negative 33.3%. 4 divided by 40 is 10%. 1 divided by 10, that's also 10%. Wow, actually a bunch of 10% here at the bottom. And 3 divided by 30 is also 10%. Okay, so we've done our horizontal analysis. We've said the percentage changes over time. Now the question, this is the one that students often struggle with more than the first part. Like the mechanics here, I hope, weren't too hard, but what items jump out at you? And for this one, maybe it's a little bit of a tricky question. A lot of students pick on interest and they go, wow, interest expense is negative, everything else is positive. Well, that one wouldn't jump out at me necessarily. I'd look at the balance sheet and see how much debt we had. Maybe we paid down some debt and therefore the interest was lower. Or maybe I just know in the economy, interest rates are lower and therefore our interest costs are lower. But something we were taught in the CPA program was look for big numbers that have big changes. Big numbers with big changes. And this, in the context of 168 grand in revenue, it's not a huge number. You know, $1,000 change is not a big change particularly. So often the key numbers on an income statement, often, not always, are sales and COGS. That relationship is an interesting one. Our sales are up by 11%. And so you can see it's the biggest change number, 17,000. Our COGS are up by 15%. That situation for most companies, you know, it's not outrageous. Like sales are up about 11%, costs are up about 15%. It's not a crazy situation. Companies will go through this all the time. If you're on the board of directors, if you're managing the company, this is not good news. You're growing your revenues, you're growing your sales, but your costs are growing faster, right? Your costs are growing at a faster rate than your sales are growing. That is a not good sign, and that is something to be investigated. Sometimes you can investigate things that are good news. You can say, oh my goodness, our sales are up 80% this year. Why is that? That's terrific, right? That's great. Or our costs are down. Why is that? That's good news. So sometimes it's a positive indicator you're investigating. Here, this would be a negative indicator, right? You're sort of saying, our sales are up by 11%, but our costs are growing faster. So that's what I would investigate. I would investigate those two items. Why are sales up? Why is costs growing at a faster rate than sales? Because you would expect them to go together, right? If Apple sells 10% more iPhones, we would expect Apple's cost of goods sold to also go up by 10%. They sold 10% more stuff. If Apple sells 10% more iPhones and their costs go up by 15%, you'd go, oh, that's a problem, Apple. And that's what we're sitting with here. Okay, that's it for 12.1a. As always, I hope my videos are helping. And if they are, I hope you will be helping me too. Have a great day. Bye-bye. Let's take a run through problem 12.2a. This has us doing vertical analysis. These are also called common sized financial statements. And the idea of these financial statements is if I have two companies that are very different sizes, they can be difficult to compare. If I run a little coffee shop here in my hometown of Kamloops and I want to compare my financial statements to Starbucks, they just don't compute, right? I might have a couple $100,000 in sales where Starbucks has billions and billions of dollars. So the numbers don't match. And vertical analysis is the way to compare two companies of different sizes, or one way to do it. As the name suggests, we just did horizontal analysis where we compared year over year financial performance. Vertical analysis, we're doing it up and down on the page. So I'll show you what we mean as we jump into this problem. Harpreet Gill is concerned about his company's financial performance and financial position. He obtained the financial statements of his largest competitor, Hossein Inc., and notes the company is over 10 times larger than his in terms of sales anyway. You can see Gill's sales are 400 grand and Hossein's 5 mil. So it's making the numbers difficult to compare. Below is condensed financial information from Hossein and Gill. And it says complete the vertical analysis for both companies in the table above. Complete the columns labeled Hossein vertical and Gill vertical. Round your answers to the nearest 0.1%. Okay, so here's how vertical analysis works. Vertical, as the name suggests, means we're just looking at one column at a time. You know, horizontal, we're comparing left to right. Here we're looking up and down on the page. And so that means, and I'd advise you to do this, ignore the other company as you're doing it. So you just do one company at a time because it's vertical. So I'm going to ignore Gill. Don't you scratch it out like this. I'm doing this because I'm on a digital tablet. I'll erase my scratching out in a minute. But I'm going to pretend Gill doesn't exist. A vertical analysis, you set the sales on the income statement and total assets on the balance sheet. You set it as 100%. And then you look at every other number as a percentage of that. So let's start with sales for Hossein. We just say, okay, well, I'm going to call that 100%. And the idea is when I do the same for Gill, I set Gill's as 100%. I can compare percentages where the dollar amounts aren't really comparable because they're just so different in size. Cost of goods sold, 2.1 million divided by 5 million is 42%. 2.9 divided by 5, I can see is 58%. 2.2 million divided by 5 is, 44%. 700 divided by 5 million is going to be 14%. I should be checking my numbers here. 700 divided by 5 million. Yeah, 14%. Okay, I'm feeling good then. 60,000 divided by 5 million. This is a small number. 1.2%. 640 divided by 5 million. 12.8%. 150 divided by 5 million, 3%. And 490 divided by 5 million, 9.8%. Okay, so we've done Hossein's income statement. Let's do Hossein's balance sheet, and then we'll do the same for Gill. So the balance sheet, you set the total assets to 100%. So you go, okay, well, this 4 million represents 100%. Then every number is a percentage of that. So 1 divided by 4 is, of course, 25%. And again, the math here, 1 million divided by 4 million. This one's going to be 75%. 3 divided by 4 is 75%. What about 500 divided by 4 million? It's going to be 12.5%. 12.5%. 1.5 million divided by 4 million. You might notice I'm putting 1,500 divided by 4,000 in the calculator. The reason is if everything's 3 zeros, you can just lop off those 3 zeros. The percentages will be the same. If you want to put them in as full numbers, you certainly can do that, but just saves a few zeros. 12.5 plus 37.5, or 2 divided by 4 is 50%. 2 divided by 4 is 50%. And of course, 4 divided by 4 is 100%. Okay, so we've done Hossein. What does this mean nothing. Doesn't mean much to me. You could compare Hossein to industry averages. You could compare Hossein to one of their larger competitors. You could compare Hossein to something else. But the point of this is you got to compare it to something. So in fact, the story of this question is Gil gets a hold of Hossein's financials and they want to compare, and they're like, oh, the numbers are so different. Well, let's redo Gil's as percentages, and then maybe we can compare the percentages and learn something. So 400 becomes our 100% number. We set sales to 100%, so that's 100%. 120 divided by 400, 30%. 280 divided by 400, 70%. 130 divided by 400, 32.5%. 150 divided by 400, 37.5%. 10 divided by 400, it's going to be 2.5%. 140 divided by 400, 35%. 30 divided by 400, 7.5? Yeah, 7.5%. And 110 divided by 400, 27.5%. Okay, so we've done Gil's vertical analysis. Let's do the balance sheet now. We did the income statement. Let's do the balance sheet. So we set, again, the total assets to 100%. And now, again, we're doing vertical. We pretend Hossein doesn't exist for these calculations. We're just doing Gil. 75 divided by 250, 30%. 175 divided by 250 is going to be 70%. Looking at the current liabilities, 60, again, divide everything by 250. It's 24%. 120 divided by 250, 48%. 180 divided by 250, oh, not 280 divided by 250 is 72%. 70 divided by 250 is going to be 28%. 70 divided by 250 at 28%. And of course, 250 divided by 250 is 100%. Okay, so we've filled in the table, but this is always the point in the question where my students get annoyed with me. They go, I can fill it in, but you always ask me to comment on this or, point something interesting out. And I'm not too picky here as the professor. I just want them to say, what's jumping out at you? And so how would I figure out what's jumping out at me? And here I actually blank out in my mind, right? You don't scratch this out on the test question, but I blank out the dollar amounts and I just look at the percentages and I sort of say, well, which one of these do I prefer and why if I didn't know anything else? So let's go down the line here. The first thing that jumps out at me is gross profit percentage is quite different. Like costs are different and therefore gross profit. So you kind of look at the relationship between COGS and gross profit. And as far as that goes, Gil's is way better. You would, if you didn't know the dollar amounts, Hossein makes way more money than Gil because it's way bigger. You would way prefer Gil's costs and margins as gross profit. Interestingly, you would also prefer Gil's operating expenses. They're significantly lower. And these are sort of key numbers that jump out at me. The rest I actually don't look at as much. But what's in yellow and what's in pink are key numbers to be considered. And across the board, Gil's are better. Gil has better margins and has better control over its expenses. If I didn't know the dollar amounts, I would say to Gil, your financial performance is terrific. The only thing you should be driving for is to generate more sales. Maybe Gil's price is way higher or something, right? Maybe that's why it doesn't get as many sales as Hossein and its margins are higher. But I would be telling Gil, this is a good looking income statement compared to your competitor. And I guess the bottom line, it certainly shows through the profits, right? Gil's profits are significantly higher as a percentage, not as a dollar amount. You can see Hossein makes 5 times the profit of Gil, but as a dollar amount, Gil's are better. So comment on this. if I were asking a student or expecting this on a test, I would expect them to call out really one or two of the items I just outlined. Say Gil's costs are significantly lower than Hosseин's, as evidenced by blah, 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 right? As evidenced by the cost of goods sold being 30%, where Hossein's is 42%, or as evidenced by operating expenses being 32%, where Hossein's are 44%. And, you'd be delivering good news. Gil is a real person. Gil asked you to take a look at things, and you'd say, your financial performance looks really good here. The only thing I would say is, you don't get this from vertical analysis, but, what can we do to increase our sales, right? Like, the rest of the income statement is terrific. In terms of the balance sheet, actually a different tale. So I tend to look at two things here, and one is just the current ratio. So like current assets compared to current liabilities. Again, pretend I don't see the dollars, I just see percentages. So scratch that out and scratch that out. Hossein has double the current assets as current liabilities, means can pay the bills. Gil, it's a little dicier. So Hossein's liquidity is better. The other thing to look at on a balance sheet is just how much debt they have, how much leverage compared to equity. So Hossein's debt equals the equity. The liabilities equals the shareholders' equity. Gil has a lot more liabilities than equity, and that's a sign of risk. Some finance professors might tell you risk is good, debt is good. This accounting professor in my class, when I'm telling my students, I'd say risk like this, debt should be sort of analyzed in a negative way. You should say, okay, this is more leverage, more risk is a problem. At least that's how I see it. And I'm bringing my own biases to the table when I say that. But certainly we can say, I think conclusively looking at this, that Hossein's balance sheet is in better condition than Gil's. Gil has a lot more debt and a lot significantly less liquidity. So those are the thing I've highlighted in yellow. It's sort of two lines combined for 1 point of analysis, and the two pink lines also combine for a little bit of analysis. So maybe the reason my students don't like this is because I talk for like 5 minutes and they're like, okay, what's the sentence I can write here? So let me think of a sentence to write. I would say Hossein's liquidity is better, as evidenced by it has a better ratio of current assets to current liabilities. I think that's okay in terms of, a sentence. I might also say Gil is more highly leveraged, which means Gil has more debt, and that means Gil is riskier. So I prefer Gil's income statement, but I way prefer Hossein's balance sheet. And that would be my feedback to my friend, Mr. Gil. Thanks so much for watching. See you in the next video. I hope the video helped. Hit the thumbs up on your way out of here, and I'll see you in the next one. Bye-bye. Let's examine problem 12.3b. More ratios for us. We're going to be completing this big, long ratio table for the problem. And in fact, why don't we just jump into it by starting to do ratios? The first one we're asked to do is the current ratio, current assets divided by current liabilities. So we're going to go on to our balance sheet. We're going to find the total current assets. And where are you? Total current assets. There you are. We're going to find the total current liabilities. Total current liabilities. And for 2029, we're going to take the yellow one divided by the blue one for our current ratio for 2029. So it's 801,000 current assets divided by current liabilities, 155,000. And we get 5.17. Our current ratio tends to just be a number, so we don't have to put a percent or a dollar amount. It's just 5.17, and there's my current ratio for 2029. Let's do the same for 2028. So the yellow one for 2028, of course, divided by the blue one. 855 divided by 345. 2.48. And something I should add to my table here, and I'd suggest you do, is just B/W. Is this getting better or is it getting worse? And a rule of thumb for us is, for the current ratio, bigger is better. And maybe bigger is better is the wrong turn of phrase. Bigger is safer, and for us, safer is better. So that's getting better. The next ratio, and so we introduced the current ratio in like chapter 1, and the idea of the current ratio is, do I have enough short-term assets to pay my bills, right? Am I covered, essentially? Well, some smart person looked at this and they maybe saw a company or two fail that had an okay current ratio, and they thought, wait a minute, if they have a lot of prepaid insurance or they have a lot of inventory that they can't sell, right? They're just stuck with some bad or old slow-moving inventory. That doesn't help you pay your bills, right? Cash pays your bills. Receivables, most companies do pay if you're owed money, so receivables help you pay your bills. And if you had a bunch of Microsoft stock, you could sell it. Short-term investments help you pay your bills. So why don't we, rather than taking all the current assets, including inventory and prepaids, why don't we just take the very liquid current assets, total them up, then divide by current liabilities, rather than taking all the current assets? So let's do that. Our acid test ratio is the cash, short-term investments, which would just come below cash if we had it, and accounts receivable, net receivables. And we're going to add up the yellows and divide by the blue. So adding the yellows here, 175 plus 61 is, what is that? 236. And 220 plus 150 is 370. And we'll just take the yellow, divide by the blue. So 236,000 divided by 155,000, 1.52. And for the year before, 370 divided by 345, 1.07. So you can see that the acid test ratio is going to be lower always than the current ratio. The rule of thumb for the current ratio, I don't know if you remember from way back in chapter 1, we said 1.5. If you're above 1.5, you're generally thought of as safe. The acid test ratio is anywhere above 1. Well, it's 0.9 to 1. Anywhere above that, you're thought of as safe. So this company is fine in all counts, but we would say its liquidity position is bigger in 2029, and therefore we're going to say better. Okay, let's move on to inventory turnover. So as far as liquidity goes in total, right, both ratios are better. I think this company is doing better as far as liquidity goes. For turnover ratios, cost of goods sold divided by average inventory. So let's highlight those. Cost of goods sold is, of course, on the income statement. I'll highlight it here in yellow. So that's going to be the numerator. The denominator is average inventory. This is something I always screwed up as a beginning student. The average inventory for 2029 is the average of these two numbers. The average inventory for 2028 is the average of these two numbers. Now, why is that the average? And the reason is, let's take 2028, for example. We ended 2028 with 450 grand. We ended 2027 with 400. Why was the average of those two numbers? The reason is 2027, the end of that year, is the same as the beginning of 2028. So we're saying we started 2028 with 400 grand in inventory. We ended with 450. The average inventory for the year is 425. And again, just add them together, divide by 2, right? 400,000 plus 450,000 equals divided by 2. That's how we get the average of 425. 525 plus 450 divided by 2, our average is 487,500 for 2029. That's our average. So I'm going to take the yellow number, cost of goods sold, divided by average inventory, which is the blue number here. So let's do it for 2028. 650 divided by 425. I get 1.53 times. Inventories turn a number of times. 1.53 times. And the year before, 900, or the year after rather, 900 divided by 487,500, 1.85 times, 1.85 times. So inventory turnover is a measure of how quickly you're rotating or selling through your inventory. Bigger is better. You want to sell through your inventory more often. So this is absolutely better. We are improving. 2029 versus 2028 is an improvement. And you're always like, the more recent year is the one you're most worried about. You're either getting better or getting worse over time. This is getting better. The next ratio, 365 divided by inventory turnover. I love this ratio, 365 divided by 1.85. So for 2029, it's 197.3 days. And for 2028, 365 divided by inventory turnover, which again, that's our inventory turnover, 365 divided by 1.53 is 238.6 days. This is a measure of how long our inventory is sitting unsold. So last year, 2028, it was taking me around 240 days to sell my inventory. From the day I bought it to the day it shipped off to the customer, it was about 240 days. This year, it's around 200 days. Less is better, right? You would rather your inventory be sitting around unsold for fewer days rather than more. So we are improving. AR turnover, net credit sales. A lot of times we don't have that information, so we just use net sales as a proxy. And that's the top number on the income statement divided by average AR. Okay, so net sales divided by average AR. Our net sales, top number on the income statement. And this will be different for different companies, how important it is. Like, there are companies that don't make a lot of sales on account, in which case, who cares about their AR collection period if they don't have significant AR? But most companies will have significant AR, and we got to do the average AR. How do you do average accounts receivable? Exactly what we did for inventory. You're going to average these two numbers, 150 and 100. The average there is 125. And the average between 61 and 150, 61 plus 150 divided by 2 is 105,500. I'm just going to put 105.5K. Okay, so I take the yellow number, the net sales, divided by the average net AR. So 2.1 million divided by 105,500, 19.9 times my AR turned over. And for the year before, 1.6 million divided by 125,000, 12.8 times. Okay, what is this ratio telling us? It's saying, how frequently am I collecting my AR, my total AR? How frequently do I collect it? This year was 20 times, last year was 13. More is better, so we did more. I always find this days one or collection period, like days sales and inventory is 365 divided by inventory turnover. This one's 365 divided by AR turnover. So we just did AR turnover, 365 divided by 19.9, 18.3 days. And 365 divided by 12.8, 28.5 days. Like I was saying, I find this ratio speaks to me on human terms, where I say, oh, last year was taking me about 29, let's call it 30 days to collect my inventory or my receivables. You know, when somebody owed me money, it's taking me 28 days to get paid. This year, it's only taking me 18 days to get paid. You for sure in real life, if you're a company or just a real person, you would rather get paid more quickly. So this is getting better, right? We're collecting more quickly from the people that owe us. Okay, so in terms of turnover, and turnover is like a measure of management effectiveness. So inventory turnover, are we bringing in the right types of inventory? Is it selling? You know, obviously the fact that we got better is a good sign. It means the managers are doing a good job. And in terms of AR collections, this is like, again, is your accounting function doing a good job? You have AR clerks and people supervising them. Are they doing a good job collecting from customers? Do we have good credit policies? How are we doing? Well, this is a measure of that. So these are both management measures. And on this, across the board, management's doing pretty well. I promise there'll be some worses coming, but they've all been better so far. Long-term debt paying ability, the debt ratio. This is just like how much debt do we have? And here, bigger is going to be worse, right? Like less debt is less risky, and we're going to say worse. Again, don't tell your finance professor I said that. So it's total liabilities divided by total assets. Total assets, not total current assets, but total assets. Take the yellow one divided by the blue one, 815 divided by 1751. 46.5, and this is a percent, 46.5% for 2029. And for 2028, 845 divided by 1558. Oops, I kind of missed some zeros there. 845,000 divided by 1558,000. 54.2%, 54.2%. Okay, so if debt is going down, we're going to say this is better. It's less risky. We can say that conclusively in our class. In my class, I say that this is an improvement. It represents a better financial position, certainly a more stable financial position. Again, your finance professors will disagree with that intuition or that insight I'm providing. Times interest earned. This is a measure of can we cover our interest costs? So it's our operating income divided by interest expense. This all comes from the income statement. Operating income divided by interest expense. I'll take the yellow one, operating income, and I'll divide by the blue one, interest expense. So this year it's 500,000 divided by 25,000. It's 20 times. So it's times interest earned. The answer is in times, so 20 times. And the year before, 425 divided by 20, 21.25 times. So last year, I earned enough operating profit to cover my interest cost 21 times. This year, I earned enough operating profit to cover my interest cost 20 times. Is this getting better or worse? The answer is worse. You'd rather cover your interest costs more than less. So this is getting worse. So long-term debt paying ability, more of a mixed bag. That said, I would say if I were looking at this company and I were being sincere in my own belief, even though I got one better, one worse, I would say this one outweighs this one. I would say the better is more important than the worse. And the reason is our debt reduced significantly. Debt dropped by 8%. Our times interest earned is a measure, can we afford the interest bill? And the answer is yes, I can definitely afford my interest bill. And yes, I can definitely afford my interest bill. Marginally more in 2028 than 2029. But this one to me would carry more weight. And so I would say in terms of long-term debt paying ability, because we reduced our debt, right? That would be a sign to me that it got better overall. Okay, on to profitability. The first ratio, gross profit percentage, any retail store is going to monitor this thing super close. For all the profitability ratios, bigger is better. I know I sound like a greedy capitalist when I say it, but that is the truth. If you are monitoring your own company, you would rather have more profit than less. So let's look at our gross profit as a percentage of sales. 1.2 million divided by 2.1 million. 57%, that's our margin, our gross profit percent, 57%, 0.571. The year before, 950 divided by 1.6 million, 59.4%, 59.4%. Return on sales, net income divided by sales. Okay, so blue one remains the denominator. The yellow one is our numerator. We're going to take the yellow and divide by the blue. So 355 divided by 2.1 million, 16.9%, 16.9%. And 305 divided by 16, 19.1%. 19.1%. Now, I forgot to mention this, and it's worth mentioning. Are we getting better or worse? Well, the gross profit percentage got lower. That's worse. It's not that much worse, but I got to say, a real company, like if it's a big company and its gross profit percentage dropped 2%, it's a bad sign. They will not be happy. And the net income dropping by, again, around 2%. This is worse. Just no doubt about it. It's not hugely worse. It's not like insanely worse, but it's worse, no doubt. Okay, next, ROA, return on assets. Net income plus interest divided by average total assets. Okay, net income plus interest. I'm going to make the denominator here, net income plus interest. So net income, and now I'll just make another line called NI plus int. So net income is 355. Let me highlight those. Net income is 355, interest is 25, net income is 305, interest is 20. So net income plus interest is, what is this, 380, and net income plus interest is 325. And so that number is going to be my numerator, right? Net income plus interest. So I'm going to make this number my numerator in my fraction here, net income plus interest divided by average total assets. My total assets just down here, and I need averages, just like we did with inventory, just like we did with receivables previously. You just average these two. So 1751,000 plus 1558,000 equals, divided by 2, 1654.5K. 1654.5K, and 1558 plus 1455 divided by 2, 1506.5K. 1506.5K. Okay, so net income plus interest, there's our numerator, divided by average total assets. There's our denominator, the yellow number divided by the blue number. 380 divided by 1654500, 22.97%. That rounds up to 23.0%. And the year before, 325 divided by 1506,500, 1506,500, 21.6%, 21.6%. Okay, so for profitability stuff, bigger is better. What is this measuring? It's saying, how effectively are we using our assets to generate profit? And so it's saying profit is a great measure for a company, but how well are we using our assets? Because of course, if you're an investor, you're going to be giving money, and you want to know how well they're going to use that investment, how well they're going to use the assets that they have to generate profit. So the answer here is they did better. Now, again, you would be interested not only in how this company is doing compared to itself last year, you'd want to know industry competitors for all these ratios, right, to get a feel for it. ROE, return on equity. Net income minus preferred dividends divided by average common shareholders' equity. Okay, so the concept of preferred dividend we covered, I think it was last chapter. It was 2 chapters ago. Chapter 10, I'm going to say. We talked about equity. And what we said is preferred shares often feature a dividend, which is like a guaranteed dividend. And in this case, it's a $4 dividend. They state it when they're listing the various shareholders' equity things, and they also tell you how many shares they have. So they promise to pay a $4 dividend on 500 shares. That means every year there's a $2,000 preferred dividend. Now, when we say return on equity, we're typically thinking of common shareholders' equity, which is why it's net income minus preferred dividends. Why do we take out preferred dividends? Because the common shareholders don't get any of those preferred dividends, right? That belongs to preferred shareholders. The common shareholders, the retained earnings, and therefore the net income of the company belongs to them theoretically. So that's why net income's involved here. Divided by average common shareholders' equity, and the common shareholders' equity is common shares and retained earnings. So this is a pretty convoluted one. Let's do the numerator first. It was net income minus preferred dividends. So net income minus preferred divs, and it's $355 minus, it's a $2,000 dividend, right? It's $4 dividend on 500 shares all year. So it's $2,000 in preferred dividends every year. Tried to scroll down, something funny happened there. So $355 minus the $2,000 dividend is $353. And $305 minus the $2 dividend is $303, or $2,000 dividend, pardon me. And so this yellow highlighted number becomes our numerator. The denominator, average common shareholders' equity. So let's do we got to do a bunch of math here. Our common shareholders' equity is all the equity accounts excluding preferred shares, which is common shares, retained earnings typically. And there might be some other, if you take an advanced class, you might learn about AOCI, but we'll leave that for another day, for another class. Here, we're just going to go, okay, 150 plus 736, that's 886. 150 plus 513, that is, 663. And 150 plus 310, that is 460. And now, so that's our common shareholders' equity for the 3 years. Now we need averages. So let's average 663 and 886. 886,000 plus 663,000 divided by 2. The average is 774,500, 774.5K. And the year before, 663,000 plus 460,000 divided by 2, 561,500. Whew. Okay, so that was a long journey to tell you we take the yellow number, net income minus preferred dividends, divide by the blue number, average common shareholders' equity, and let's do it. 353 divided by 774,500. We get 0.456, 45.6%, 45.6%. And the year before it was 303. The yellow divided by the blue divided by 561,500. 53.96%. That runs up to 54%. And so this is a measure of how effectively they're using their shareholders' investments. And the answer is this year 45%, last year 54%. We're getting worse. Now these are really big numbers. But it's possible, but just they seem like large numbers. But in any event, bigger is better for profitability ratios. We are getting worse, and this is a measure of how effectively they're using their shareholders' investments. As a shareholder, you're interested in this number. The next ratio, earnings per share, has the same numerator, net income minus preferred dividends. So it's the yellow numerator we just did, divide by the average number of shares. And it's saying, hey, as the common shareholder, you have a right to the profit. And this number, more than any other, is the one that big companies like Apple and Amazon and Google and Meta, all when they're reporting how they're doing, if they want to just summarize, here's how we did in one number, this is the number that investors are very interested in. If you take an intermediate accounting class, you will see this number is very complicated to compute because of the denominator. Now, in our intro class, very easy to compute. Net income minus preferred dividends, so there's our numerator, divided by average number of shares outstanding, well, the common shares. Here's our denominator. There's 10,000 shares all years. So let me erase this previously prepared information. And so we're just going to divide by 10 because the average number is 10. It's 10 every year. Now that gets complicated when you have employee stock options, the company's buying and issuing and buying back their own shares, right? These big complicated companies, it actually is hard to figure out the average number of shares that are outstanding. For our company, though, in this class, it's going to be easy. So I take 353 divide by 10,000. I get 35.3, $35 a share, $35.30 a share. $35.30 a share, and the year before, 303 divided by 10,000, I get $30.30 a share. So, did this get better or worse? Well, is it bigger or smaller? It's bigger. Bigger is better. Whew. So a real mixed bag there for profitability. I can tell you this is like the number that investors are typically looking at first, but it is not a home run here. I would call this a mixed bag as far as profitability goes. Last couple, stock market performance. This is only for publicly listed companies, I would think, because it's hard to get a market price otherwise. Market price per common share. And we have our market prices there, 200, 190, 160. And we take the market price and divide by earnings per share. So for 2029, it was $200 was our market price. Our earnings per share, 35.30. We just calculated 200 divided by 35.3, 5.6 or 5.7 times earnings. This is a times one. What about the year before? It was 190. Divided by our earnings per share, which is 30.3, 6.27, or we'll call it 6.3 times. Okay, what is this telling us? This is a measure of how much the stock market likes us. And it often has nothing to do with the company itself. It could be to do with global events. You know, if the president of the United States and the president of China say, we don't like each other right now, all of a sudden the stock market goes down. You know, if you're Apple, your stock price plummets because Apple does so much business and manufacturing in China that if the US and China aren't getting along, shareholders will go, oh, this is bad for Apple, right? We want them to get along if you're Apple. And so, you know, it doesn't matter who's to blame, whose problem it is. This CEO will see their share price fall, even though it's got nothing to do with whether the iPhone's any good or not, right? And so this is a measure of how much the stock market likes you. It could be that you just happen to be in an industry that's really hot right now. You know, you were an AI company 5 years ago, and then all of a sudden AI is super hot. Well, your price to earnings ratio is going to go up. So does the stock market love us or not? Last year, 6.3. This year, the measure is 5.7. They don't love us as much. That's worse. That's a bad sign. That means something in our company, or it could be to do with us too. It could be that the CEO has, drinks and drives and gets caught and gets in big trouble. Well, the stock market's going to go down on that news, even though it isn't reflected in the financial statements. Okay, last one, dividend yield. My dad is like obsessed with dividends. If he invests in a stock, he wants them to pay a dividend. So he'd look carefully at this. How much dividend do they pay compared to how much you got to buy the stock for? 13 divided by 200 is 6.5%. So in 2029, it's dividends per share, 13 divided by market price, 200. So it's 6.5% is the dividend yield this year. Last year, it was 12 divided by 190. It was 6.3%. So if you're my dad, you like this juicy yield. You want bigger to be better, and bigger is better. Okay, so we have answered it. And I in terms of commenting, I would suggest commenting on each ratio, just saying whether it represents an improvement or not, and maybe a little why. It depends on your professor. My class, I allow the students just to tell me, is it better or is it worse? But you should be expected to know, like, why is this a good thing to have current ratio go up, right? Or why is it a bad thing that price to earnings ratio is lower, right? So that would be my expectation. But here we have it. We've computed all of the ratios for 12.3b. As always, this is actually it. This is the last video of this series. For goodness sakes, if you made it to the end, Thank you for watching. Let me know in the comments if you made it to the very end. I often think nobody makes it to the end of these things. Let me know in the comments you made it to the end. I just want to say thank you. Really, from the bottom of my heart, thank you for watching all these videos. And thanks for making it to the end. You are a rare one. Thumbs up to you. All right. See you in the next video. Maybe see you in the next video series. Congratulations. You're done this course. Goodbye. You've made it. Congratulations. I'm always amazed that people do make it to the end, and you are one of that elite crew. So thank you so much for watching the videos. I've got to say something a little bit personal. This is the greatest honor of my life that I get to do this. It gives me a lot of pleasure to make the videos, and I hope it helped. So I wanted to give just as a little Easter egg, a little tour of my studio. I like tech and I like gear. If you don't like tech and gear, that's fine. You can say goodbye. I write on this screen here, and I'm monitoring myself on that screen, and there's the camera, and of course a green screen in behind. And I edit my videos over here, and that's my used to be a guest room, but it's become my YouTube studio. And again, it is the thrill of a lifetime that I get to make these videos, and I hope they helped. All right, thanks for watching. Goodbye, and I hope to see you in the next video series. Bye-bye.